we call a workplace network. In offices like this, when you have Wi-Fi access points, you've got switches, you've got routers. That business for us grew at about, it was pegged to inflation. It grew about 3 to 4% a year.
Right.
Last quarter, we had 25% order growth. So imagine that.
Yeah.
And that's not something that's a blip for a quarter. I think we can see sustained level of double-digit growth for a while. And that's because of this kind of pattern shift that's going on in the architecture of the networks itself. So when you look at the numbers from the financial standpoint, there's a fair amount that's going to be spent on these networks because everyone wants to modernize their workplace. When you look at it from agents and what they're doing, every human is going to be a manager of agents. And we now have at Cisco our first product that is completely written with AI. Okay. No human lines of code.
At all?
At all.
Okay.
Humans will verify the code, but the agents wrote the code, right? By the end of the year, we'll have about 6 products that are completely written with AI.
Wow.
By the end of next year, get this, we will have 70% of our products that will be 100% written with AI. And in 2 years, Cisco will have no legacy code. We will have refactored all of our code. So when you start thinking about that level of implication on of agents on the workplace, there's going to be a tremendous amount that changes in the campus. Of course, we've been working with data centers, as you know, on the numbers. 3 years ago, there was barely any revenue with AI-related, kind of data center revenue. Last year, Chuck Robbins, our CEO, said, hey, let's make sure that we actually let the market know what we think we're going to be able to do. So we put out a number. We said we'll do $1 billion in year 1 in AI revenue for data centers. We ended up at 2.3.
Yeah.
So we said, next year, what do we do? Which is this year, this fiscal year for us. We said, let's do 5 billion. Let's double it.
Yeah.
We're going to end up at 9.
Wow.
And so there's this kind of massive exponential curve of increase in infrastructure. And then you add on top of that things like security because of Mythos and what's happening over there. And you see different models that are going to be there from OpenAI and from Anthropic that are going to be very, very potent. I think there's going to be a tremendous amount of emphasis placed with every class of customer we have, whether it be a hyperscaler, whether it be a neo cloud, a sovereign cloud, a service provider, or the enterprise, in completely kind of changing their architecture to go out and accommodate for these new patterns of work, the new ways that security is going to be implemented, the new kind of exploits that the agents are going to be participants in and drivers of sometimes, and they'll also need to be participants of the defense against the agents through machine scale.
Yeah. I'll address that and what you're doing on that front in just a second, but that was pretty mind-boggling what you just said, that in 2 years, all legacy code will be re-architected as far as Cisco is concerned.
There will be no such thing as legacy companies anymore. That's a thing of the past. Because.
But what does that mean exactly?
So what does a company, but by the way, this is an interesting thing because legacy used to be where I as a company have actually enjoyed so much success.
Yeah.
And products have been used so much by so many people that I need to now make sure that I slow down my innovation so that I don't go, because I've accumulated tech debt over time.
Right.
And so large companies had a harder time in moving as fast and with the level of agility like a startup would. Now what's happened is we are starting to see that when you actually do write this code and you do have success in the market, you can continue to keep refactoring the code. So for example, in our security business, we had our firewall. I'll give you a couple examples. It's just mind-boggling. So we have our firewall management console. And what we did was we said, let's refactor the code here. 8 million lines of code. Within 6 weeks, the teams were able to refactor it to less than 1.5 million lines of code. So firstly, you've compacted the code. What does that mean? Performance is faster. It's more efficient. It's actually got less security vulnerabilities. The way in which we've designed the product can be updated faster. All of these things have a profound effect on the customer. And now, all of a sudden, our scale of being with all those customers, but being able to go out and innovate at a very, very fast speed becomes our very asset. And so I feel like as time goes on, you're going to have very little legacy code because everyone's going to write code using agents. And what you're going to then do is these, like we have about 32,000 engineers right now.
Yeah.
I think in 2 to 3 years, they're not going to be writing code. So then the question is, well,
What are they going to do?
What are they going to do?
Yeah.
Well, they're going to review the code. And in a world where you can write anything, what you choose not to write and what you choose not to build is actually far more important. So the product judgment and the product intuition is going to be really important. The other thing that these engineers will do is they will actually be the front lines for our customers because they will help our customers adopt better. So every engineer will become a forward deployed engineer at some point for a certain percentage of their time. And so you'll see the configuration of the entire workforce change, where a product manager is going to actually become a product developer of some sorts. And the first prototype will actually be built by the product manager and the designer. The engineer is not even involved. The engineer gets involved in the architecture. And then the engineer is involved in the front lines with the customers. And so I think you'll actually start to see a workforce shift, which is very different from what we've been used to. But I don't think it's going to be around this notion that there's going to be fewer jobs. What I've started to see and observe is every single time we've seen a massive step function improvement in AI, actually the bottlenecks have been largely human. So when we have much, much higher volumes of code, now my bottleneck is code review. So I say, okay, I'm going to automate code review. My bottleneck then is going out and building a test harness. So I automate that. My bottleneck is going to be what kind of products do I build, and do I need to do the right kind of market research, and do I need to do deep thinking and apply intuition to it? So I think there's going to be a snowball effect, and I think you're going to need more people.
Really?
I think over time you will have a shortage of people that are dexterous with AI and have fluency in AI. Now, by the way, the gap between someone who is really fluent in AI and someone who is not fluent in AI is not going to be like a 10% productivity gap. I think it's going to be 50x or 100x. What does that mean? That means it's going to be very hard to justify someone who's not AI fluent to be in a job. It would be like saying, let's hire someone that doesn't know how to use the browser or the internet today. It would be an absurd concept in knowledge work. So I think that'll be an area that we'll have to make sure that collectively between public-private partnership, we will have to make sure that we raise the dexterity level of people with AI. But if you look at every single person that we hire today that is fluent with AI, they get paid really well. In fact, I would say if I was in my 20s getting paid that kind of money, I'd be in trouble. So they get paid really well. They have a tremendous amount of shortage of those people. And the value that they add is enormously high compared to what they're getting paid. And I think you're going to see more and more of the workforce get there. So there's going to be more of a demand, but there will be this painful period where the retraining of the workforce will require some displacement, and there will be some people that'll lose their jobs. I think every job is going to get refactored, and there'll be entirely new industries created.
Have we moved now to production cycles, production stage in companies, or is it still sort of, okay, let's sort of experiment and figure things out before we actually make those big calls?
No, it's completely a non-controversial issue at this point in time that chances are you're not going to lose your job to AI, you're going to lose it to someone that uses AI, but actually that's not even the most non-controversial thing. Now what people are saying is, if I don't use AI, I don't even know how I'm going to get my job done. Right? And so that I don't think, now that's not an evenly distributed viewpoint yet. I think you go to different geographies in the world, it's different. I think we live in Silicon Valley, we tend to live in a bubble. That's why I tend to travel a lot, because I want to make sure I keep my pulse on the ground and like what is actually happening in the field with the customers. And what you do find is across every industry right now, there's a fair amount of momentum, but certain industries are doing much better than others. I think if you look at the life sciences industry and biotech, amazing levels of innovation happening over there. You look at financial services, crazy levels of stuff happening there. Software was the biggest industry. And by the way, in software, the thing that was really strategic in my mind is the fact that it started with this whole notion of, hey, I'm going to use software to write software. And you're going to use AI to write AI. That self-learning loop that got created has actually created an exponential curve that is a vertical line. And so that's why the time is so compressed. So I think it was a genius move to say that's the use case we should start with, because one, it had the most amount of data that you could train the models on. Two, the data was very quantitative in ways. So you could know right from wrong very quickly. There wasn't too many shades of gray. And now what you're starting to see is it's become almost a habit where we have to figure out ways that the use of tokens. In fact, we were recruiting a candidate recently that went to another company and then came to us. And I said, hey, why are you leaving there so quickly? He said, well, I went there and they weren't going to give me tokens. Like, I don't know what I'm going to do without tokens. That's like not giving me a computer to work on and saying code. And so that was his entire reasoning in 6 months for him saying, you know what, I'm going to throw in the towel there. That to me is very telling on the state of what the expectation is going to be from the talent pool. Poverty will get eradicated. Education will get evenly distributed. Those are things that we never could have the audacity to think that those would actually happen. And I think those things are going to happen.
But is that optimism real? And what do you base it on?
I base it on the level of exponential progress that we've seen in the past 3 years specifically. And there's a snowball effect. And that snowball effect is creating not just a high rate of improvement, but that rate of improvement continues to keep compounding and getting faster and faster and faster. And now you have this completely, kind of reinforcing self-learning loop where these systems are building themselves and they're learning. And every single time you ask it a question, it's not only answering you, it's learning from you in the way that it's answering the question. And it just keeps getting better and better and better. And that over time, if you just extrapolate that, most people have a hard time thinking exponentially. We all think very linearly. When you have to start thinking exponentially across multiple different domains, it's actually just humanly not a very intuitive thing to do. But just start thinking about what happens if 4 or 5 industries simultaneously start showing that exponential curve of improvement. What happens to society? Capital flows easier, healthcare gets better, education is actually going to be, like the amount that I can teach myself today compared to what I could teach myself a decade ago is night and day different. Night and day different. In 2 weeks, I am almost a different version of myself every single time. And it's not just me, everyone's that way. Like we're all learning at a very fast pace. So that's good. Now, what I do think is important is not forgetting the fact that we can't leave behind people in this because that'll cause suffering. And I do feel like that's an area that Cisco is very concerned about. And so what we do is we partner with governments all around the world. We've got tens of millions of people all around the world that we try to make sure that we get up to speed from a upskilling perspective. We had this network academy that we called NetAcad, and now we've added AI programs to it. We've added cybersecurity programs to it because that propels the economy forward.
Since we're talking about opportunities and we're talking about not leaving people behind, I also want to understand from your lens and all the work that Cisco's been doing in India for several decades now, on how confident and optimistic you feel about the role that India is likely to play in all of this. I think the natural assumption is that India should play the applications layer and that is our strength and that should become our competitive moat. How do you see it?
So my take on India is, maybe it's a little biased because I came from there, right? And I'm just fascinated by the pace at which the country has developed and grown. And I think the entrepreneurialism that the public sector has shown over there, because like every single time I go to India and I meet with government leaders and, Prime Minister Modi and others, I feel like I'm talking to startups. And they're very keen on, like, I'll give you an example. Like one time I was with Chuck there and we were talking about some export control license that we were trying to, get approved. And that conversation that we had with some of the ministers was very much around, hey, what do you think is broken? How do we need to fix it? Let's make sure that we actually talk about it. Immediately, few people got on it. And by the time we had landed in India and what the issue was, by the time we left India, the issue had been resolved. And I think that level of entrepreneurialism in public sector is very rare to find. You're now starting to see that in many governments, and that speed and scale, you're seeing it in the US, you're seeing it in India. I think that speed and scale is going to be really, really important. And I'm superbly optimistic. I also feel like India has a demographic advantage, which is almost unheard of compared to any other company because the size and scale of the population you have of people below the age of 30 that are in the workforce I mean, it's a superpower of India, and you should be able to take advantage of that. And like I said, if you assume that there's going to be a human shortage of talented pool of workers, India is in a tremendous advantage.
What are some of the other mega trends that you're focusing on as the CPO, as president here at Cisco, that you intend to double down on?
I'll give you like 4 or 5. First one is robotics. I think physical AI is going to be pretty huge. And you will see, I was at an event recently with TSMC and their, you know, our partner for manufacturing chips. We make our own silicon. And a lot of the presentations that were there at that event, I was keynoting, others were keynoting, were around physical AI. So physical AI is actually here already, just unevenly distributed. So I think that's a pretty important trend. And that's only going to actually change, because you can't just change the world as dramatically as you want to only with software. You need to have the physical dimension factored in. That's one. I think there's going to be models beyond large language models that'll need to feed physical AI, like things like spatial models and world models. Those are going to get much, much more prominent in the next 3 to 5 years. And by the way, there's a shortage of data on that one. So just like language models were pretty easy because you could take large swaths of data that, you know, were human generated data, publicly available on the internet, and train the models with. With physical AI and spatial models, harder to do that because you don't really have readily available spatial data. So you have to go out and generate synthetic data. But you're starting to see great advancements in synthetic data for training models. So that entire field will get to be pretty interesting. One big area that there's a huge shortage is power, right? We will see tremendous amount of advancements in power and efficiency of the use of power for terrestrial data centers on Earth. But you'll also see tremendous amount of demand and movement towards suborbital data centers in space. And so I think the SpaceX IPO tells you a lot about like the kind of momentum that can create. But that'll be an area that you'll see. Because why is that the case? Because you will have 90% of the apparatus in a rack is cooling apparatus from a weight perspective. In space, you have a very different way that you can actually go out and handle cooling. The energy is 30% more potent in space with the sunlight and solar is 30% more powerful in space than here. And the sun never sets, which means you don't need to have batteries. You can actually just get round the clock, you know, kind of powering of the sun. And now you've got payloads that can be taken up on a very regular basis. I think Elon's talking about like a spaceship every hour being launched with a payload. If that were to happen, you actually have a tremendous amount of promise in space. We're not quite there yet today. I think you ask some people, they say 3 to 5 years, might be 5 to 7, maybe 7 to 10, but it's definitely going to happen within the mid to long range. So that's the other piece. I'd say quantum is going to be a big one because of the way in which you'll actually be able to do computing, which is going to be at a very different kind of scale. And you're now starting to see quantum networks. In fact, we have a quantum entanglement chip that we just recently announced that is still in the labs, but it doesn't require, you know, kind of cryogenic chambers to go out and do this stuff. You can do this in room temperature, which is pretty cool. And then what you'll find is a ton of application layer advancements that'll get made in the future around this stuff, which is what specifically do we need to do to innovate in every business process that you have in every company to be rethought and reconfigured and recalibrated. I think that's where you're going to see the most amount of effort. Eventually, infrastructure is great, but it's only as good as the applications it delivers. And you will start seeing a lot of value in applications being delivered. When
you're not working on your desktop or whatever else that you're doing, retail therapy, that's your gig, isn't it?
I am very consumptive in my patterns of, I do feel like Apple should give me like a certain amount of credit because part of their EPS might just be my
Courtesy
consumption
you?
of
Yeah.
how much I consume.
Who else's EPS are you boosting?
I think every shoe manufacturer, every clothing manufacturer,
You're not the monk who sold his Ferrari, right? That's not what you're going for.
But I will say this: my family, my better half is extremely kind of simple.
So you're making up
so
for
I'm
that.
making up for her. I'm like, I need to. And my daughter is actually, oddly enough, turned out to be. She judges me. There was one time when we were sitting down, and I'm like, she came to one of my keynotes, and she said, "Hey, Dad, like my friend thought you were cool." I'm like, "Oh, thanks. Did you think I was cool?" And she goes, "Yeah, but you do a lot of stupid shit."
Well, keeping you grounded. You can count on daughters to do that. But Jeetu, it's been an absolute pleasure. Thanks so much for joining us on Voices from the Valley, and we wish you the very best of luck. As you said, you're just warming up here at Cisco and ready for the AI era. But thanks for your time, and thank you for very comprehensively giving us a glimpse into what the world is looking like and the kind of re-architecting that's going on at companies like yours. Appreciate that insight.
I appreciate you coming to the U.S. and you're welcome here anytime. And
Thank you.
Love having you here.
Thank you so much. Well, with that, it is time for us to wrap up this edition of Voices from the Valley. Do send us your feedback. We always like to hear from you. We'll be back with more headliners and newsmakers. Till then, from all of us here, goodbye and many thanks for watching.
Microsoft isn't just building AI tools, it's rebuilding the entire software stack for the AI era. At the core of this transformation is Core AI, a startup inside Microsoft led by Jay Parekh, focused on creating the next generation of agentic applications.
So how many times do you get mistaken for Satya?
I was waiting. I was like, I wonder if she's going to ask that question.
Of course I'm going to ask you. So how many times do you get mistaken for Satya?
From weekly iteration cycles to rethinking how humans and AI agents work together, the rules of software are being rewritten in real time. Core AI is building the end-to-end platform to run, manage, and secure agentic applications across enterprises.
Meeting Satya Nadella, joining Microsoft in 2024 to set up the AI startup, if I can call it that. You know, with a 50-year legacy behind the organization, how challenging has it been?
Yeah, so when I got here about a year and a half ago, really what we want to do in the Core AI team is help not only the company, but also our customers kind of reimagine, rethink what it's going to take to build, to run, to manage all of these like new applications that are being invented, being created out of this technology that is AI, right? So, and that requires an entirely top to bottom kind of systems overhaul of what we've done to build software in the past, right? So in terms of like being able to build the applications with different tools, being able to support and build a new platform where these agents are running because they're interacting with the real world, they're thinking, they're planning with the models. You need different security guardrails around these things. So the entire technology stack needs to be kind of, we need to rethink the whole thing. And that's what we're focused on, is migrating or kind of transforming the way we create this new agentic software stack.
You know, I'll come to the agentic software stack in just a little bit, but let's talk about what's happening with the pace of change that AI has brought upon us. I mean, you know, within 3 months, the world is looking completely different. Now, from your point of view, as you plan out for the future, is this pace of change sometimes overwhelming? I mean, how do you deal with it?
Yeah, it is
and
absolutely.
And how do you plan for it?
Absolutely. everything's going so fast, right? And sometimes for us, it is where you will come up with a plan or an idea one day and you wake up the next day and you have to scratch it out and try something else. So there's a few things here, which is one is it's really about the way we are working as an organization, because the technology in the world is going to keep changing quickly. So saying, hey, we're going to read more, we're going to
Hello, good morning. You've tuned into Power Breakfast on CNBC TV 18. I'm Vinny. With me is my colleague Rachna as well. Rachna, a very good morning to you as well.
Good morning to you as well. Vinny, let's take a look at the headlines this morning. Chip and AI-related stocks drive Wall Street higher. All three major indices rose to close out a strong first half of 2026. Nasdaq gains more than 1%, while the S&P 500 rises more than 0.5%. Asian markets open mixed, while the GIFT Nifty is suggesting a muted start for the Indian market.
Oil prices edge up as investors await news on Doha peace talks, even as Iran refuses to meet US envoys. Precious metals rebound.
Indian economy continues to exhibit resilience, says the government's monthly economic report. Flags weak monsoon and geopolitical uncertainties as key risks. Met Department warns of below normal rainfall and higher temperatures in July.
RBI's financial stability report flags sharp growth in gold loans, warns that correction in gold prices could weaken collateral and lift delinquencies risk as well. Adds that banks' exposure to retail and MSME sectors require close monitoring. Also projects bad loans inching up to 4.1% from 1.8% currently, even in the worst case scenario.
HCLTech warns of US dollar revenue drop on sequential basis. Company attributed this warning to a sudden drop in revenue over the last few weeks due to the recent profit warnings and a deteriorating business outlook at multiple European auto companies, including BMW.
Okay, that were the top headlines for today, but let's look at what the Asian markets are doing this morning. A bit of a mixed opening is what we could say that's coming for the Asian markets as well. Right, we're seeing the Nikkei, which is holding on to gains. We're seeing Taiwan index that is holding on to gains. Kospi, on the other hand, is seeing a decline of 2% in the trading session as well. We are seeing Hang Seng that's also trading with cuts in the trading session. The ASX 200, that's our Australian index as well. I beg your pardon. So Hong Kong is shut. So we'll keep watch out for that. That is yesterday's days, right? But obviously, we're seeing ASX 200 that is also seeing a decline in the trading session. But yes, most of it is a mixed opening that we're keeping an eye out on this morning. So what's the indication that comes in for the Indian market? Because yesterday we saw that we've seen a decline coming in, second consecutive day of decline that came in for the Nifty. We closed below the 24,000 mark again, 23,800, around that level, 850 is what we closed at. Today it's indicating a 64-point downtick as of now. The Nifty implied open, that's what is coming up on the screen. So we'll watch out for a bit of a red start for the Indian markets. Whether we recover is something that we'll watch out for, Rachna.
Sure, well, definitely. It's the start of a new quarter, and yesterday, of course, marked the end of a quarter. We saw Asia end on a mixed note, but a lot of overnight cues to be watching out for. Now, how will these overnight cues impact the Indian market? We have our research team joining in with how the trade setup looks like and the stocks that are likely to be in news. First up, Vivek joins in to get us all the market cues we need to watch out for today. Good morning, Vivek.
Well, good morning. It appears to be quite a mixed start as far as H2 is concerned. Now, in terms of the overnight cues, US markets, like you mentioned, all of the US markets ended with gains. In fact, the Dow Jones has seen the strongest first half performance in the last 5 years. In terms of oil prices overnight, oil prices fell marginally, almost a 1.5% downtick overnight. But what's actually transpired in the month gone by is that the Brent fell over 20% in the month of June. Asian markets, GIFT Nifty, all indicating mixed cues are what we are receiving from Asian markets this morning, but GIFT Nifty is indicating a slight gap down start for our own markets today. In terms of how Indian markets fared yesterday, remember, ended largely low, and it was expiry session, and Nifty ended below the 23,900 levels. The mid-cap index and the small-cap index, however, outperformed, and the advance decline ratio was in favor of the advances. Nifty IT continued to be one of the top drags as far as the markets are concerned. What is it that we'll be starting out or we will be watching out for as we start July? Number one, the July series, so it'll be interesting to see how F&O performance starts. There are quite a few additions as well as deletions. Number two, auto sales, and the entire auto pack will be in focus on account of the sales data that will start trickling in come today morning. Manufacturing PMI data is expected for the month of June. Two listings today: Waterways Leisure Tourism, also known as Cordelia Cruises, as well as Advait Jewels. Remember, it was a very strongly oversubscribed issue. And lastly, keep an eye out on impact on trading volumes in this particular month from RBI's tightened broker funding norms.
Okay, Vivek, thank you so much for that important cues that we'll keep an eye out on today. But let's move on to Ria and also talk about the important stocks to watch out for in the trading session. Good morning, Ria.
Well, good morning. Let's start off with Reliance as well as MRPL, both of which will be in focus as the government has cut the special additional excise duty on diesel exports, which has now been reduced to 8.5 rupees per litre versus the earlier 14 rupees per litre. And the levy on ATF exports has also been reduced to 7.5 rupees per litre versus the earlier 12.5 rupees per litre. And this is with effect from the 1st of July of this year. Moving on to KPIT Technologies, which will be in focus as the company has issued a profit warning for the first quarter of FY27. They expect their Q1 performance to be lower than the earlier expectations due to a drop in revenue in recent weeks. And the company has said that they are expecting a decline of nearly 1% in the US dollar reported revenues for this quarter on a year-on-year basis, primarily due to the sudden actions taken by some European OEMs. So this stock will remain in focus on the back of that today. Hudco will also be in focus as the company has dispersed rupees 16,377 crores in Q1 versus nearly 12,800 crores in the year ago quarter. Loan sanctions are also at 65,485 crores in this quarter versus just about 33,900 crores in Q1 of last year. Bandhan Bank has sold its rupees 291 crore assets to Acre, which is Assets Care and Reconstruction Enterprise, for 119 crores thereabouts. NCC will be in focus as they have bagged an order for the transport division, where the orders are worth nearly 535 crore rupees. RITES will also be in focus on the back of an order win, 175 crore order for the company for project management consultancy services, which will be executable over the next 30 months. And Paras Defense also in focus today as the company has signed an IP license agreement with Tandem Defense LLC, which is a company based in Georgia for Guardian's drone interceptor technology, giving the company an exclusive license to use this licensed IP within India.
All right, Ria, thank you so much for that. Quite a long list for today's stocks and news. And finally, we have Sudarshan, who joins in with cues from the F&O space. Good morning, Sudarshan.
Good morning, Rachna. So it's been pouring in the city of Mumbai for the last 24 hours, and normally we call rainy days are equal to happy days. And on that happy note, we welcome the July 2026 series. Now, over the last few weeks, what we have seen is that market has been consolidating in a narrow range. But historical data, if you take a look, July series has always seen a wild move. So we'll start with July 2022, when market, I would say Nifty had moved almost 7% higher. In 23, it was up almost 4%. In 24 too, it had gained almost 2%, but in 2025, it had fallen 3%. There would be hope that we do not see what exactly we had seen in July 2025. Now, take a look what exactly happened in the last few series, monthly series. So in June and in the month of May, we had seen a range less than 100 points. So in June, Nifty had fallen 48 points. In May, we had fallen 82 points. But go to April 2026, we had moved higher by almost 1,600 points. But in the month of March 2026, we had seen a fall of almost 3,100 points. What about the indicators? So it's a mixed indicator. If you take a look at the rollover, so June, July rollover is looking healthy at 80% versus 3-month average of 73%. But FI longs exposure is at 10%. That's the lowest level we have seen since January of 2026. What all would be the main key triggers for July series? So first, we'll start seeing quarterly updates, also the results for Q1 FY27. Second, what's the update on US-Iran talks? Third, if there is any update on US-India trade talks. And lastly, what exactly happens on the monsoon front after the continued rains that we have been seeing for the last 24 to 48 hours.
Absolutely. We want those happy rainy days to continue as of now. So Darshan, and those happy days will come to office if you order us some vada pav and bhajiyas also, so Darshan, today. But thank you so much for the update. In the world of FNOs, we'll keep an eye out on how this July series turns up versus 2025, and the before years will be key to watch out for. On that note, we're going to slip into a very short break. After the break, we'll come back with cues from Wall Street. Stay tuned.
Welcome back. You're watching Power Breakfast on CNBC TV 18. Now getting you updates from West Asia. Qatar's Prime Minister met with US envoy to the Middle East, Steve Witkoff, and US President Donald Trump's son-in-law, Jared Kushner, who are in Doha to discuss the US-Iran agreement. Iranian negotiators are also in Doha, but there are no plans for face-to-face talks with the US just yet. Qatar's foreign ministry says technical level discussions are continuing between Washington and Tehran, whether directly or indirectly, adding that any high-level meeting will depend on results they produce. Iran's parliament speaker insists Tehran will not begin talks on a final agreement with the US before Washington implements provisions on ending hostilities in Lebanon, reopening the Strait of Hormuz, waivers on Iran oil exports, and release of frozen Iranian funds. Meanwhile, US Vice President J.D. Vance says oil traffic in the Strait of Hormuz has reached its pre-war height. Manisha Gupta joins us now with all the updates from the commodity space. Good morning, Manisha.
Morning, and thank you so much for that. I'll start with the crude oil prices, and as you were mentioning, well, yes, the Strait of Hormuz and the kind of ship passage that we have seen from that one seems to be really building up very, very strong. Iran has said that they have shipped more than 40 million barrels since the U.S. lifted its naval blockade. We also have Russia saying that the exports have record highs therein as well. So we have seen the prices continue to decline 23% down in the month of June, and it has been down 38% in the previous quarter, which is the steepest decline in any quarter since 2020. But the declines have just about continued for the metals as well. You have gold near 8-month lows, silver near 7-month lows. The U.S. job openings climbed to a 2-year high, and now the markets will watch out for the U.S. non-farm payroll data. The decline has just about continued in base metals as well. Today morning, the street is reacting to the China manufacturing PMI data, which is the weakest expansion in factory activity since the month of March. Strong numbers in new orders and jobs, though, has been seen. But even with that, copper fell nearly to 4% in the month of June. Platinum was down 20% for the month of June. So when you look at the previous quarter gone by, almost all commodities have closed it a very strong negative.
Well, those are the cues coming in from commodity space. Thank you so much, Manisha. But let's go over to the U.S. market. Now, Wall Street ended higher on Tuesday with the Dow Jones Industrial Average closing at a record high. The Nasdaq led the gains while the S&P 500 also finished firmly in positive territory. CNBC's Julia Burstein gets us a wrap of all the action on Wall Street.
U.S. markets are up across the major indexes in Tuesday trading as the Dow notches its best first half of the year since 2021. The Dow added 135 points, the S&P 500 was up 59, and the tech-heavy Nasdaq gained 394 points. A federal judge on Tuesday rejected Meta's bid to dismiss multiple states' claims that Facebook and Instagram were designed to addict children. The judge said Meta did not comply with the federal Children's Online Privacy Protection Act. Meta says it strongly disagrees with the allegations that the company has worked with parents, experts, and law enforcement to protect users. Meanwhile, TikTok settled with the plaintiff in a lawsuit headed to trial in July. That lawsuit also involves Meta and Snap. YouTube settled with the plaintiff in that case earlier this month. And Nestle told Reuters Tuesday it plans to remove artificial food colorings from all products worldwide by the end of the year, making the Swiss food giant the first major food company to do so. Nestle has already eliminated artificial food coloring in the United States as Health Secretary Robert F. Kennedy Jr. and the FDA target the ingredient and other processed foods. That's what's happening here in the U.S. Back to you in Mumbai.
Well, that's all that we have from the Wall Street. But here's some opinion from Mike Wilson of Morgan Stanley on the U.S. market moves and what's driving this rally.
If you look at the way the year has played out and we came into 2026, I think people expected the Fed to cut rates, ourselves included. The war kind of interrupted that with the oil price spike. But what they have done is they printed a lot of money. Okay, that's what really began with the asset purchase program in December. And since that activity, we saw like monster rallies in gold, silver, then some of the rare earths, then energy stocks, and then eventually semiconductors. So it's just sort of this rotation around. And we did this chart about a month ago showing how semiconductor index was basically tracking the silver stocks from 4 months prior.
That's weird.
And it's just an interesting analog. Now, I'm not, I'm a technician. I look at these types of things. It's not a guarantee it's going to play out that way, but it does make a lot of sense because we're right now, I would say, in the peak rate of change in the revision breath, right? We've been probably the most bullish of any strategist on the street for earnings this year. But the rate of change, gets to a point where it's unsustainable. That's one of the reasons why the market's starting to go sideways. And it's one reason why semis could take a break here. That's generally my view.
Well, semiconductor, that's what led the rally in the U.S. But Bank of England Governor Andrew Bailey says inflation would be on target if it wasn't for the U.S.-Iran war. Listen in.
First of all, I mean, it is frustrating. I really believed, and actually I believe even more now I've seen the sort of the data over the last couple of months, that we would have been back at our 2.0 target around about April, May time. So the fact that we aren't is hugely frustrating. And we've had obviously, so we have an increase. So inflation in the UK is at 2.8 at the moment. I expect it will go a bit higher than that because we have this sort of lagged response with the household energy price cap mechanism. So, at the moment, I think we think it could go up to 3.2, something like that. That will be quite a bit later this year, though, because of the lag in the adjustment.
Well, now getting you the latest on Trump-related developments in our special segment, Trump Watch. Vinny has more on that. Vinny?
Hi, so let's talk about what's the latest update here. The US Supreme Court has struck down President Donald Trump's executive order seeking to end the birthright citizenship, ruling in the favor of 5-4. The Constitution guarantees citizens to virtually all children born on US soil, regardless of their parents' immigration status. Now, Trump, in a Truth Social post, later called this ruling too bad for the country, but said the Congress could easily address it through legislations, adding that no long, unwidely constitutional amendment is necessary for this. And in a separate post, what did President Trump do on Truth Social? He said, sarcastically, actually congratulated China's President Xi Jinping after the court upheld this birthright citizenship. Now, moving on, what also came in as a ruling from the Supreme Court, where President Trump actually hailed the Supreme Court's decision upholding the state law that bars transgender athletes from competing in women's and girls' sports, terming it as a big win. Trump wrote that this is a very big win for the United States. The Supreme Court just ruled against men playing in women's sport. Wow, that's the take. That is, ridiculous situation, takes off the ridiculous situation off the table, is what he highlighted in his post. Now, moving on, what also came in yesterday was that the U.S. Office of the Government Ethics released annual financial disclosures form of both President Trump as well as Vice President J.D. Vance. Now, a new government report, this is what is showing for U.S. President Donald Trump, that he made millions from cryptocurrencies and settlements with media companies last year, raising questions about the possible conflicts of interest. This is a 927-page document that lists all Trump's reported assets and income for 2025. They include more than around $1.4 billion from his family's cryptocurrency ventures as well. So that's the latest update that we have in terms of Trump developments.
All right, thank you so much, Winnie. But now it's time to slip into a break. Up next, we get you the updates from the world of artificial intelligence and technology. So stay tuned.
Welcome back to Power Breakfast on CNBC TV 18. Now, RBI's financial stability report shows that the banking system remains resilient under adverse scenarios, but the report flags sharp growth in gold loans. Ritu is joining us this morning to take us through what this report is highlighting. Ritu, good morning.
Morning, Winnie. RBI's latest financial stability report simply says the financial system is resilient, but there are quite a few risks that it flags. The biggest watch point, of course, is that sharp rise in gold loans, and we've been talking about that here on CNBC TV 18 as well. Now, RBI flags that this correction in gold prices, and if you recall, gold prices have corrected as much as 25% since the start of this year, and that could weaken the collateral value and increase the loan defaults, although the LTV or the loan-to-value buffers among banks, that remains comfortable for now. Now, RBI has also asked lenders to be careful and to closely monitor, one, retail, and second, MSME loans, because it warns asset quality could come under pressure if the macroeconomic conditions weaken, linking it to what's happening in West Asia. But overall, both banks and NBFCs, their balance sheets are healthy, they're well capitalized. profitable and resilient. And the stress test, which RBI typically does twice a year, that reinforces this view as well. For instance, in the case of banks, the gross bad loans ratio, which is at about 1.8% for all banks currently, is seen rising only to 1.9% in the baseline stress scenario, but it could rise all the way to 4.1% under a severe or worst case scenario. Capital adequacy, or CRAR, that's at about 17.5%. It could come down to 13 to 13.3% in an adverse scenario. But even then, RBI says only one or two banks could breach the minimum capital norms. For NBFCs, the bad loans could rise from 2.4% currently to 5.2%. That is the absolute worst case scenario, while capital still remains healthy at more than 20%. Although, and let me end with this, 15 NBFCs can fall below the minimum capital requirement in an adverse stress scenario.
Okay, Ritu, thank you so much for that. Now let's move on. And the government's monthly economic review says that Indian economy is continuing to exhibit resilience. Inflation is expected to remain under control, but the report warns of moderation in select high-frequency indicators, suggesting some easing in the growth momentum. Now, the report also flags weak monsoon and geopolitical uncertainties as a key risk. Separately, the Met Department has predicted below normal rainfall in July, which is a crucial month for Kharif crops. The month of June has ended up with a 40% rainfall deficit across the country as well. And the IMD is also warning of higher temperatures in July due to strengthening of El Nino conditions. So that's the update that we have coming in on the weather front. But on that note, let's move on and get you the latest update in the world of tech and AI in a special segment, AI Pulse. We have Rachna joining us for that from the world. Rachna, over to you.
A major regulatory truce, a record quarter for chips, and a fresh push into pharma. Here's all that is moving the world of artificial intelligence today. First up is Anthropic, that said that the US Commerce Department has lifted export controls on its Claude, Fable 5 and Mythos 5 models, ending an 18-day standoff with the Trump administration. Access to Fable 5 restores Wednesday, while Mythos 5 was already cleared for more than 100 approved organizations last week. That same Mythos moment is paying off for cybersecurity firms. Palo Alto Networks and CrowdStrike just posted their best quarter ever, surging 95% and 113% respectively between April and June as enterprises race to secure their AI deployments. Anthropic is also making a move into pharma, launching Claude Science, a workbench connecting over 60 scientific databases alongside an internal drug discovery program focused on neglected diseases. Then there's the broader chip sector that had a record run. Micron and Intel and AMD added about $2 trillion in combined market value in the second quarter, with Micron and Intel more than tripling as investors widen their AI bets beyond NVIDIA. Then there's Amazon Web Services that's putting about $1 billion behind a new forward-deployed engineering unit, embedding thousands of engineers directly with clients like the NBA and the RICO to speed up AI rollouts. And in Washington, President Trump's latest financial disclosure shows more than $1.4 billion in crypto income last year, including $635 million from sales of his meme coin. That's all that's moving the world of AI right now, but we'll get you more updates through the day.
Okay, Rachna, thank you so much for that. But with that, we're absolutely out of time on this edition of Power Breakfast. The Nifty implied open indicating a red start for the Indian markets. We'll see whether we actually make a comeback and see a recovery. As of now, 56-point downtick for the Nifty implied open is the indication. But with that, thank you so much for tuning in. Up next, we'll pass on morning call.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We're coming to you live from the CNBC TV 18 Motilal Oswal studios. Wednesday morning, middle of the week. Markets, of course, not showing any signs of enthusiasm, even though rains are here. And yesterday, I thought, was the first proper downpour, guys. Good morning. We've been waiting for it for a while. This morning, is it pitter or patter, Mangalam?
It is splish splash today, this morning. I say that because, while I was driving here, there were a bunch of kids going to school, and every time they were, jumping on puddles, etc., there was a fair amount of splish and splash that was happening. But I take your point, whether rains or not, irrespective, the last two series, so to say, the Nifty has moved all of 70 points, a grand total of 70 points, as you pointed out.
But July, generally seasonality favors the bulls. So out of the last 10 July series, in 8 of them, we've closed up in the green. And other than monsoon, this series is going to be important to track. Of course, the monthly auto sales numbers kick in today, but we will get the Q1 updates, what happens with the AI trade, crude. So all that is going to be crucial.
Absolutely. And I think, let's take it from the top then with what we know and what's happened last night. So, it's basically a repeat of what we had yesterday morning when we were reporting on, of course, Monday's Wall Street. So last night, that is Tuesday's Wall Street, Nasdaq 1.5%, S&P 0.78% higher, and largely led by tech and AI. So one point is that, like Monday, yesterday as well, last night, 60 to 70% of the S&P 500 constituents were in the red. Even as the Nasdaq was up about 1.5%. So, X of this tech AI, rather XAI, broader markets in the US once again are starting to. It's basically a rotation. We've seen huge underperformance in the Magnificent Seven companies. The rest of the market got a breather while those stocks did nothing, and then. It's starting to reverse once again. Those stocks are being bought, the Amazons and the Apples of the world. Now, the more notable price action in that sense in the US was the bond market price action. The 10-year yield went up 9 basis points to 4.46%. There was this job openings data, what's called the JOLTS data, which was strong. Perhaps that explained it. Today, we get the ISM data. And then on Thursday, I think Friday is a market holiday in the US. Thursday, we get the jobs number, the NFP, the big jobs number. Now, just to look back, right, it's of course, we wrapped up Q2 in the US, so the quarter which has gone by, and it's actually been incredible, right? Look at the numbers. Nasdaq went up 27% in the second quarter. It's the second strongest that we've had the Nasdaq do in the last 25 years. And what's called the SOX index, which is the Philadelphia Semiconductor Index, was up 88%. 88. So, and those are the biggest semiconductor and technology companies in the world. And that index going up 88% just kind of sort of tells you what kind of euphoria we've seen. Absolutely stellar runs is what we've seen. Just in terms of sticking with US news flow, the Supreme Court has rejected President Trump's bid to curtail birthright citizenship. So that's a bit of a setback. But there are other ways. And if you read reportage in the US, the Trump administration seems determined to pursue other ways this of course has been one of the core points in which the election was won. Not the birthright citizenship, but generally immigration. And of course, they seem to be focused on it. In terms of Iran-US, Qatar, there was a statement from Qatar which said that Jared Kushner, who's President Trump's son-in-law, and Steve Witkoff are in Doha for ongoing peace talks between US and Iran. And and we had a statement from Iran saying that the release of $12 billion in frozen Iranian assets is underway. Oil's not moved that much. I think we're at about $72, $73 a barrel, so not really having a big one. Now, KPIT, yesterday, by the way, the IT index sold off hard, and the index was down 2.5%. And KPIT was down 6%. I think KPIT was down on Monday as well. I think it did poorly last Friday. So perhaps the markets had a bit of a signal, but they've issued a profit warning, and it doesn't look all that great. There are some brokerages which have cut their expectations naturally. So we'll see if, especially KPIT with the sell-off we've seen, which is, I think, about 12% or so very quickly coming into this profit warning, where has more to go here. And of course, what does it mean for the broader IT space? Now, the levels, Nifty is back at about 23,800 levels. Not quite, we're slightly above it. So there's actually, the first support is about 23,846 and then 23,800. So I'm just sticking with 23,800, which is the big round number, which has acted as a support multiple times. And I'm just hoping that, we see 23,800 and that holds, and then we sort of, resume our upward journey. Upside levels, of course, we can put them when the upside resumes, but 24,100 is the first sort of, decent, meaningful level, which we've got to take out on the upside. For now, of course, we are sort of fielding downsides here, so we'll see how we start. GIFT Nifty will tell you that. I think it's about a 50, 60 odd point lower start right to the word go. That's the indicative open. Mangalam has walked across to the wall with F&O stats and the positioning data. Mangalam, take it away.
Well, yesterday the Nifty closed just above the 50-day moving average. 100 points below is the 20-day moving average. So let's see whether we hold on to that or not. But that's for today. As we kickstart a new series, let's just say hello July series. Why do I say that? Because if you look at it over the last couple of months, we've seen very muted moves on both May and June series. The cumulative move was close to around 130 odd points. And now the GIFT Nifty indicating a minus 58 point to start with. Can July series be a big one? Well, history so suggests, because if you look at the past few July series, we've seen big moves on either side. The last one, we actually lost about 800 points. But prior to that, we've actually seen big moves to the tune of anywhere between 400 to about 1,200 points. History suggests that July usually favors the bulls more than the bears. But then again, if you look at, some of the positioning out here as well, the rollovers have been extremely high, 80% rollovers as against an average of 73 odd percent, which tells you that conviction is fairly on, for the next series. And importantly, it's on the downside. Why do I say that? I'll explain it to you. We're starting with about 1.79 crore shares in open interest. So it's heavy. And if you look at, the FII rollovers, 55% of their long positions have been rolled over. And that compares with 98% of their short positions that have been rolled over. So conviction on the downside is a lot more than conviction on the upside, and which is what explains that the FIIs have started this series with just 10% long exposure. The last time they did that was actually in the start of Jan series itself. In fact, not even April, May, or the war-related series did we see the FII long exposure fall to as low as what we are seeing at the start of July series. Importantly, if you look at some of the stats here, FII long exposure lowest since January 2026. At the same time, the net contracts at minus 2.56 lakh are actually the highest that we've seen since the start of April series. The only counterbalancing factor here is the local clients, HNIs, all of them are actually 80% long, and their net exposure is the highest that we've seen. So this is a dichotomy that we're seeing, that domestic investors and HNIs fairly bullish on the market, even as the FIs are extremely bearish. Triggers for July series, obviously, we'll be looking at monsoon spread, commentary coming in from the IMD, first quarterly updates, and the results as we move along the series. And more importantly, we'll be also eyeing all the geopolitical developments, US-India trade updates, conversations are underway, the AI trade, and that would result in any sort of change that will come by in our capital flow. So by and large, July series known for big moves. Let's see whether this one has a big move, and if yes, then on what side, because the FIIs are still fairly net short.
Thank you very much for that. Well explained. A quick check on Asia before we get our guest in. Hang Seng markets are shut today. Korean markets continue to sell off. So Kospi is down more than 1% today, taking the weakness in the last 3 days to more than 7%. But on the flip side, Taiwanese markets are going strong. And for Japan, the big cue is the yen at a new 40-year low. And now it's even breached the 162 mark against the dollar. Ben Powell, Chief APAC and Middle East Investment Strategist at BlackRock Investment Institute, is now joining in. Ben, thank you very much for joining in. I was reading your latest note and you said India's premium to emerging markets has compressed to a towards long-term norms, and now lower energy prices have improved overall India's outlook in terms of trade backdrop. So what does that mean from an India investment point of view? Does that mean that things are looking attractive, one can go ahead and buy, or does it just mean that the phase of derating may be behind us now?
Good morning. Great to be with you. Yeah, look, I think things are looking up for India. For the foreigners, for the global investors, the combination over the last several months of perhaps a slightly elevated starting position in terms of valuation, combined with the higher energy prices created by the war situation here in the Middle East. And lastly, the fact that for now, at least, India is not perceived to be the central AI play. Those three things kind of all overlapped and created a significant downdraft. I do think looking forward from here, the resolution, hopefully, the resolution of the situation in the Middle East and the significant decline we've seen in energy prices all the way back below February the 27th when the conflict started is frankly just very, very good news for India. And when global investors are looking around, what can we dip our toes into to try and benefit from some of the improvements post the ending of the war? I think India is on that list.
Where on that list, Ben? Is it right on top because of the kind of underperformance, or it still lags, say, Korean markets or Taiwanese markets? You said that things are looking up and we're back on the buyer's list, but where exactly?
So we are always trying to think about the whole portfolio. So I will give you a bit of a both and answer. The AI super boom is real. It's ongoing. We'd want to be careful and selective within that, but that's just something like a fact. Now, with that being said, we've actually downgraded emerging market equities to neutral. I want to stress we're not bearish. We are still fully invested. But the real reason for that is just the extreme performance we've seen in Taiwan and Korea over the last several months. So, we're still on board with the AI trade, but obviously we want to be kind of valuation sentiment aware. And Korea and Taiwan have just done, obviously, very, 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 very well. There's nothing wrong with that, but we're wondering if we can take some of our chips off that table and reallocate them. And India would be, we think, a beneficiary of that trade in the weeks and months ahead.
Nice wordplay. I don't know if you intended it. Chips off the table, Ben. Good morning. Just one quick word, Ben, on Korea, right? Some $75 billion of foreign selling, and still the market is up 100% in the first 6 months of the year. This is largely, and we've talked about this with other guests on the program, that this is largely technical because there are limits and single stock exposure limit. That is what it is, right? Otherwise, overwhelmingly, the view is positive.
I think that's right. So structurally, we are still, as discussed, overweight AI. And in particular, when we think about AI, we want to think about the bottlenecks. And it might seem a strange thing to say, but the bottlenecks are good news for us as investors. So bottlenecks create higher prices. That encourages capital to come in and supply and solve the supply shortage. Obviously, we like investing in things where the prices are going up. So we've seen that in memory. Korea and Taiwan are clearly at the epicenter of the AI super boom. So we're on board. But to your point, we want to be careful. And in the very short term, the technicals, the leverage, the volatility have been a little bit unsettling and have just given us a little bit pause for thought and have us kind of reconsider tactically for the next 6 months. Can we be a little bit more careful, I suppose, with that exposure? We think yes, and looking to reallocate accordingly. So we're still fully on the AI train, I guess. That is still, we think, a hinge moment in human history. We're on the path to abundance. But that doesn't mean we should be max bullish every day. Hence, we're taking EM down to neutral, largely driven by the Korea-Taiwan amazing performance and looking to reallocate, including into India.
Briefly, Ben, if I can ask you to respond to this. There's lots of reportage which kind of suggests that there are lots of these Chinese models which are lower cost, and companies, enterprises, even in the US. I think there was a Wall Street Journal story said 60% of enterprises that they've surveyed are looking to, they're actually using some of these models which give them more access, and they're, of course, cheaper, much cheaper as well. And then there is the other bit where increasingly, not everything, a simple query like, find me a good restaurant in my area doesn't need to go to a data center cloud, right? That application can be run on your computer. So my point is, are these things which will build up and are these risks to this AI big boom that we're talking about, which is, the hyperscalers writing the checks and then all of it, of course, flowing downstream?
I think you're making a profoundly important point. So what I want as a consumer is kind of like an overarching conductor of the orchestra who can allocate my query to the right model kind of in real time. So I think that'll probably happen over the next several years. We're not quite there yet, but you're identifying the reason for that. You don't need a professor of economics for every question you might have, right? So you don't need the elite models, to your point, for relatively mundane questions. And yes, I think what we are working through now, we're moving kind of just from AI excitement through to trying to actually unpack the specifics. And I think that's true in the AI landscape, which is something you're identifying there. The attraction of some of these open source models, they're not just 10% cheaper, they can be 10 times or even 100 times cheaper. That's a lot. So that seems like that's going to grow and grow for most queries. At the frontier, these cutting edge models, if you're trying to run a government or an elite research project, they still probably are worth the money. But yeah, trying to unpack that and be more sophisticated in picking our spots, whether it's choosing which model or choosing which investment, we think that's where we are in this story. We're moving from the euphoria to trying to be more selective, be that for the model, be that for the investment.
Right. Just before we let you go, a short one and perhaps a left field one as well. This also is the week where the US celebrates its Independence Day, and this one is a big one. It's a milestone one, 250 years. Do you expect any sort of announcement to, be made during those celebrations that may change the course of maybe the geopolitical situation that we're currently in?
It's very hard to forecast US politics, I find. President Trump is extremely dynamic, and so I won't try and be ahead of him. What I would say is the US continues to be an exceptional economy where the future gets created and monetized, and I still think that's true. So we're overweight US equities. The economy looks pretty good. Unemployment looks more than fine. The Fed probably on hold, and that's going to give room for the earnings boom to continue. Not entirely, but largely driven by this AI phenomenon. So happy birthday, America. And for now, they are the right side of the big boom of our time, and I don't see that being derailed in the near future.
Okay, all right. Ben, we'll leave it there. Thank you very much for joining us. It's always a pleasure. And, come on for a slightly longer chat. The last time you were here in Mumbai, of course, we had you on for a market town hall. Look forward to the next one. Thank you.
Thank you.
Well, we'll take a quick commercial break, but here is what's lined up in terms of interactions. 8:35, we have Rajesh Baheti to talk about RBI circular on what proprietary traders can use as far as funds go. There are restrictions which are going live from today. We'll ask him what this means for market volumes. 9 o'clock, Vijay Agarwal of Equirus Capital puts a spotlight on infrastructure space. 9:20, Sanjeev Prasad of Kotak Equities is a market master of the day. 9:30 will bring you a discussion around the discretionary consumption space. At 9:50, a discussion around Delhi EV policy 2.0 and more. And towards the end of the program, Latha discusses the impact of the 42% monsoon shortfall in June with economists Sonal Verma of Nomura and Pranjal Bhandari of HSBC.
Right, with that, we'll take a short break, but a lot of stock-specific action to track today. We'll get to all of them in just a bit in our special top 10 segment. But for starters, we're looking at Reliance Industries, MRPL, Hudco, Bandhan Bank, NCC, RITES, Paras Defence, Prestige Estates, all of them on our radar on the back of positive news flow. On the way down, KPIT Tech, after their first quarter update, we have Jana Small Finance Bank, all of them which are likely to open in the red.
Welcome back. You're watching Bazaar Morning Call. It's time now to talk about stocks. And let's begin with KPIT Technology. The company has issued a warning for Q1 FY27, that's the upcoming quarter, saying that revenues in Q1 will decline 1% on a year-on-year basis. They're saying performance has been impacted by a sudden drop in revenues over the last few weeks. We've seen some profit warnings by companies. For example, BMW in June issued a profit warning, and BMW is one of the big clients for KPIT Technology. And generally, they're saying we've seen a deterioration in outlook at multiple European auto companies. The management goes on to say the slowdown was not anticipated and only materialized recently. And the reason they're saying that is because when we spoke to them in April, they kind of indicated that FY26 was a weak year, a challenging year, but that would be a trough. The words were that FY27 outlook is looking far more promising than FY26, but clearly Q1 has started off on the wrong note. They also go on to say that while revenues will compress, even margins and profits will decline sequentially, and there is limited room for cost optimization. They believe that this is a short-term phenomena. Long-term cost-cutting by clients will accelerate outsourcing. But as we highlighted on Friday and just in the last 2 days, KPIT stock price has been under pressure. Yesterday also it was down 5-6%. And even some of the other auto companies, like example, Tata Elxsi too, took a bit of a knock. But clearly, this should be the stock to watch today. But moving on, let's talk about Reliance Industries and MRPL. Sudarshan joins in to tell us more.
So yesterday, government has gone ahead and revised its special additional excise duty on fuel exports for the month of July. For petrol, it's increased, while for ATF and diesel, it's been reduced. So on petrol, it's increased to ₹4 from ₹1.50 per litre. For diesel, it's been cut to ₹8.50 from earlier ₹14 per litre. And for ATF, it's been reduced to 7.50 from ₹12.50 per litre. Now the question is why it's positive for Reliance Industries and MRPL. Reliance is the largest diesel exporter of India and contributes almost 45 to 50% of total India's diesel exports. That's the reason it's hugely positive for Reliance Industries. For MRPL, it contributes major part of its diesel production. It's used for exports, and of total India's diesel exports, MRPL's contribution is in the range of 4 to 6%. That's the reason it's positive for both MRPL and Reliance Industries.
Right, we take that point. Sudarshan, thanks a lot for that. Let's go across to Ritu now. Ritu, you have updates coming in on Jana SFB.
That's right. India Ratings has downgraded Jana Holdings, which is the holding company of Jana Small Finance Bank, to a default rating after they deferred the repayment of their NCDs. Now, the downgrade follows the extension of the NCD maturity from the end of June to the end of December. And remember, this, we understand, was done in discussions with their debt holders. So it was a restructuring that has been classified as a default. According to the rating agency, Jana Holdings and its parent Jana Capital, they were both unable to refinance the debt or even monetize their stake in Jana Small Finance Bank before this repayment fell due. And that forced them to renegotiate the payment timeline with the debt holders. The key question, of course, for investors is the impact on the listed entity, that is Jana Small Finance Bank. Now, remember, Jana Holdings, which is the holding company, they own about 16.9% stake in the bank, which has fallen over a period of time from, as high as 44% earlier. The holding company still, it's very clear the holding company still needs funds to repay the debt. So it's possible the remaining stake could also come up for, sale, and that could create an equity overhang on the stock. But other than that, the debt event is very much at the holding company, not at the bank, and there's no linkage as far as any dependence on capital or even both seats is concerned.
Got that. Thanks very much, Ritu. It's an important one. We'll track how the stock opens up. Well, Ananya is here with Hindalco and Bandhan Bank. Ananya, good morning.
Good morning. So let me first start with Hindalco. They have started FY27 with an impressive momentum. We can see for the June quarter, loan sanctions surged 93% YOY to 65,485 crore from 33,904 crore, while loan disbursements increased 28% to 16,377 crore from 12,812 crore. Now, the strong start comes on the back of a record FY26, when the company reported its highest ever loan sanctions of 1.65 lakh crore, highest ever disbursements of 51,194 crore, and highest ever loan book of 1.61 lakh crore. Now, as of end of FY26, the company also maintained one of the best asset quality with gross NPAs at 1.04% and net NPA at only 0.05%, which reflects disciplined risk management alongside strong growth. Now, good numbers for HUDCO. Now coming to Bandhan Bank. Now meanwhile, Bandhan Bank has continued its balance sheet cleanup by selling a 291.44 crore housing finance NPA portfolio with over 180 DPD to assets care and reconstruction enterprise for 119.49 crore, a 41% recovery through the Swiss challenge process. Now the move is expected to reduce legacy stress asset and further improve the bank's asset quality. So overall, positive development for both the companies.
Thank you very much for that. For more stocks in the news, Ria joins in.
Well, good morning. Let's start off with Paris Defense. First, the company has signed an IP license agreement with Tandem Defense LLC, which is a company based in Georgia. And this is for Guardian's interceptor technology. Now, the Guardian 1 interceptor is a high-speed battery-powered counter-drone system, which is designed to combat low-cost aerial threats. And through this agreement, Paris Defense will now get an exclusive license to use this licensed IP within India for the manufacturing and commercializing of these products. And the contract is valid for 12 months. So the stock expected to open in the green on the back of this. Yesterday, also, in fact, Paris Defense was the biggest gainer among the defense pack, up around 9%, and a positive move expected today as well. Moving on to two stocks that will be in focus on the back of order wins. The first one is NCC. They have bagged an order worth 535 crore rupees for the transport division. But remember, the company already sits on a very strong order book of nearly 72,000 crores at the end of FY26. RITES has also bagged an order worth 175 crore rupees for project management consultancy services. The execution period is 30 months for the initial project work, and the FY26 order book for the company is nearly 9,416 crore rupees. Lastly, Prestige Estates will also be in focus today. The company has launched phase 2 of their residential project in Mulund. They have a total developable area of approximately 1.7 million square feet with a GDV of 2,200 crore rupees. So this stock also expected to open in the green today.
Right, we take that point, Ria. Thank you so much for that. Those are a bunch of stocks that we'll be tracking this morning. In case you missed it, a quick recap. Stocks with positive news flow. You have Reliance Industries, MRPL, HUDCO, Bandhan Bank, NCC, RITES, Paris Defense, and Prestige Estates. Stocks with negative news flow. You have KPIT Tech and Jana Small Finance Bank. With that, let's move on and let's get you an important update coming in on the financial space. The RBI Financial Stability Report shows that the banking system remains resilient even under adverse scenarios. But the report does flag a sharp growth in gold loans. Ritu joins in with more details of that report. Ritu.
Mangalam, there's a few risks that have been flagged by RBI, but let me start with the biggest one, and that is that sharp rise in gold loans that RBI says warrants caution. You know, they warn that this sustained correction in gold prices that we've been seeing, it could weaken the collateral coverage, and that in turn could increase the borrower stress and raise the risk of loan defaults, although currently it does say the loan-to-value buffers that lenders have are comfortable. Now, the RBI has also asked banks to very closely monitor retail and MSME loans because it says the asset quality there could also come under pressure if these macroeconomic conditions weaken. And another worry is the rise in household debt. But for now, the debt for India is relatively low compared to some of the peer emerging market economies. Overall, though, RBI says the banking system remains in good shape, and RBI's macro stress test also reinforces that view. So, for banks, for instance, when they apply that shock test, the gross NPA ratio, which is currently at 1.8%, in the baseline case, rises to 1.9% by March of 2028, but it could rise all the way to 3.8 to 4.1% in a severe stress scenario. Capital adequacy for banks overall at 17.5% currently. It could moderate all the way to 13% in a worst-case scenario, but even then, only one or two banks are projected to breach the minimum capital requirement. NBFCs as well, for them, the gross bad loans could rise from 2.4% currently to 5.2% in the worst-case scenario by March of next year. While capital adequacy is healthy at more than 20%, but RBI does warn that there are 7 NBFCs that could breach the minimum capital requirement even in the baseline scenario. scenario and as many as 15 in the worst case scenario.
All right, Ritu, thank you very much for that. So that's the RBI financial stability report and some of the key takeaways there. Commodities in focus now. What will equities sort of pay attention to, and what's happening there? Manisha is here with that. Manisha, good morning.
Morning, Prashant. Thank you for that. I'll start with the crude oil prices, where after falling 23% in the month of June and 38% in the previous quarter, we've started July on slightly positive notes. So we are holding around $73 a barrel. This is as investors await updates on ongoing peace talks between US and Iran in Doha. In the meanwhile, you have a lot of supplies coming in from the Middle East. Russia exports have hit a record high. Iran has said that they have shipped more than 40 million barrels since US lifted its naval blockade. The declines, though, have continued for the metals as well. Gold prices now trading below 4,000, near 8-month lows. Silver is trading at a 7-month lows right now. The markets have seen the US jobs data, which is at a 2-year high, and now await the US non-farm payroll numbers that come in on Friday.
Thank you very much for that. We will slip into a very short break. On the other side, we'll connect with Rajesh Baheti to discuss the RBI circular on prop trade financing of brokers that goes live from today.
Welcome back. Well, I think GIFT Nifty should come up on your screens, and we're done about 50 odd points or so. Well, there's an important development with regards to the market microstructure in that sense. And let me just tell you what has happened. That from today, that is the 1st of July, guarantees for proprietary trades must now be fully collateralized, and at least half of that collateral must be cash or FDs. So, that is what is happening today, starting today. Earlier, prop desks could access a bank guarantee with far less cash locked up. So basically, you got to bring in 100% of the cash, if you want to trade. And this applies to proprietary trades. And by the way, there are some estimates which say that on both exchanges, both major exchanges, this activity, prop trades, which is of course a lot of HNIs, etc. as well. This is now between 30 and 35, even up to 40%. Those are numbers that we've heard from industry sources. So, what will this do? Let's bring in Rajesh Baheti, Managing Director at Crosseas Capital Services, to answer that. Rajesh, good morning. Good to have you with us here. How significant is this?
Oh, it's very, very significant. I think it's the most significant death knell to the prop trading industry since the NSE came into existence. Just to give a background, these products by the banks have been in existence since the time NSE started. And since then, we've seen the dot-com boom, dot-com bubble burst. We've seen the great bull run of 2003 to 2007. We've seen the financial crisis of 2008. We've lived through COVID. We've lived through war and peace. And these products have had as low as an NPA in the system as anything else the banking sector has seen. And these products were not vended by the so-called cooperative banking sector in cahoots with some politicians. This was vended by the likes of SBI, HDFC, ICICIs of the world. And for absolutely no reason, RBI has chosen to shut it down. This is an ambush. This is not a credit move or a credit risk move by the RBI. This is an ambush to shutter down an industry that was really growing with the markets.
Yeah. I mean, that's pretty strong, right, Rajesh? You're saying this is a death knell.
I haven't said it strongly enough. It should be said much stronger than this. You do recall a few years ago, RBI shuttered the currency derivative.
Yeah.
It has taken 15 years to develop. We exported the market overseas. The reason then was to give stability to the rupee. Now you know what has happened to the rupee since then.
Yeah. 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 So just to get the nuance right here, this is only for people who are trading with their own money, right? That's prop.
So if you look at the equity trading segment, and if you look at the global banks like JP Morgan and the Goldman Sachs of the world, the banks that are allowed to do equities trading, they run a large prop book. This is a professional prop book they're running, like we are running. And banks are even permitted to run prop books. Now, leave alone the banks not being permitted to use or to run prop books in India. You're shutting down every means of financing to the prop book in India. Now RBI is saying, in order to get a bank guarantee, you got to give 100% collateral. I can give 100% collateral straight to the exchange. I don't need it to go to a bank, give it to a bank, pay them a commission, and then get 100 out of 100, which I've given to the bank in the form of a bank guarantee. I can go to the exchange. Exchange accepts various forms of security towards margin. I don't need to go to a bank.
And this applies to NBFCs, etc. as well?
No, this is only applying to the brokering houses that operate in the Indian market.
No. I'm saying a source of funding. This applies to bank. Can NBFC step in as the non-banks?
Yeah. Governed by their own norms, but NBFC bank guarantees are not accepted by the clearing corporations. So essentially, if the bank guarantee is the product that we're talking about, then it has to be the banks.
I see. This, what we define as prop trading, how much would this contribute to daily volumes on exchanges?
So let's put it this way. There are two kinds of prop traders in India today. You have the foreign brokerages and the foreign HFTs that are operating, and the Indian broking firms and the Indian HFTs. This hit is disproportional because it hits only the Indian prop houses. The foreign prop houses will get everything they will get from the banks overseas with no control of RBI. So they will continue to thrive at the cost of Indian firms. So we are not exporting our markets this time. We are exporting our income that will be converted into dollars and taken out of the country.
I see. And also there is the fact that foreign HFTs, I mean, they are extremely well capitalized in any case, right?
Absolutely, and they get funding limits from their bankers at very low levels of collateral. Forget 50%. I don't know what the real number is, but I'm sure it's lower than even 50%.
Yeah. Rajesh, put yourself in the regulator's shoes. I mean, you're saying this is not a credit decision because NPS in this segment has been very, very low, right? What is the, have you made representations? What have you heard? And what's the logic on the other side?
Typically in India, representations don't work because decisions have already been taken. Some of the representations they refer to is just a cover to implement policy. I would like to see if RBI is claiming that it got feedback. I would like to see that feedback. Put it out in the open. Let me see who has said that this product needs to be stopped. I don't think the bankers wanted it. I don't think that the brokers wanted it. I don't think that the exchanges wanted it. So who wanted this?
Yeah. No, I mean, sometimes regulators step in, right? And take note of a certain situation and implement measures. Rajesh.
What is the situation? There was no situation. I'd like to know. Somebody should tell me what is the situation.
No, I'm just asking, you've not been in touch with anyone? Because I know representations have been made.
I know, but I'm still trying to figure my head over, what prompted you to do this? Because what is the situation? What has suddenly happened? It's not a credit situation. There's no credit risk. There are no NPAs in the system. So why is RBI doing this? It's not as if there's some unregulated banking cooperative banks that are lending this product. It's the best banks in the country. I think they've got good people in there assessing individual credit risk. and lending and advancing these products with brokers. So really, somebody up there wants to take a call on the entire industry and say everybody must follow this.
I see. Just to go back to the question, what's the number in terms of the volumes contributed? Because you said there is a foreign element as well, which is largely, which perhaps will remain unaffected. So we got to look at the Indian brokers and Indian HFTs, right? Those are the guys who are going to get affected. And how much volume do they contribute?
So I think the Indian broking houses on the prop side and the Indian HFTs would have contributed at least 30 to 35% of the exchange turnovers, and I think 30 to 35% of that will be hit. The larger question is that everybody works on the concept of return on equity, and return on equity is a product of return on capital borrowed plus the return on the equity that you put in. If the return on equity goes below a certain threshold, the whole business becomes unviable considering the risk.
Yeah. Fair enough. 30 to 35% volumes, and you say the hit could be how much to this? Because of this?
30 to 35% of the prop trading volumes, yeah.
Okay.
So about 10 to 12%, definitely, and the entire intraday. And let me point this out to you. The Indian broking houses cannot even borrow against property. You're not allowed to borrow against property. So even if we take loan to value of 50%, you're not allowed to borrow in order to fund your prop trade.
Well, strong comments, and we'll if you hear and you're part of these representations and which are made, which we'll love to have you back. I will of course try and ask the regulators as well. I know I had the SEBI chairman. I interviewed the SEBI chairman. So this is of course some time back, and I asked him if this is the SEBI is essentially making a representation. But at that point, I think, of course, I mean, this is on camera. Mr. Tuinkanta Pandey essentially told me that this is RBI's domain, and we will defer to them on this matter. But we'll see how this one goes. But thank you very much, Rajesh, for joining us. Strong words coming through. Death knell for the prop trading industry, at least here in India. Foreign firms, foreign HFTs continue to operate. Rajesh, thank you again. We'll take a quick commercial break here. We'll come back. We'll focus on some volume buzzers. We'll also connect with the head of research at Elara Securities for some fundamental stock conversation coming right up.
Welcome back. This is Bazaar Morning Call that you're watching. We kickstart a new series. The GIFT Nifty indicating a slightly softish start to about 55 points lower. Hormaz joins in. There were a bunch of movers in yesterday's trading session. In fact, the mid and small cap indices did well through most of yesterday's trading session so far. And we have Hormaz with the list of those which saw big moves with heavy volumes.
Morning, Mangalam. The list unfortunately has more large cap names than the broader market ones today. But since auto stocks will be in focus today, Maruti was one big mover in yesterday's trading session. Among the top gainers on the Nifty, the biggest single day gain in nearly 3 months for the stock. In fact, the 14,000 call option of the July series was the most traded yesterday. The premiums went up by 170%. The volumes yesterday were the highest since January of this year. And 15 lakh shares were traded on Maruti, 3x its 20-day average. Half of those were marked for delivery as well. So 7 lakh shares for delivery. That too is almost 3x its 20-day average as well. And the stock at closed above the mark of 14,000 for the first time after March of this year, and it was the fourth most traded on the Nifty 500 in Tuesday's session, still down around about 19% from its record high levels, which are in excess of 17,000 rupees. Infosys, of course, continued to see selling pressure yesterday as well. The third straight day of losses. It has now declined in 6 out of the last 8 sessions. The 1,000 put option was the most traded yesterday. Premiums went up by 35%. The volumes yesterday were the highest, the third highest in the month of June. 2.5 crore shares were traded, 20-day average of 1.5 crore. 55% of those shares were marked for delivery, so around about 1.3 crore shares, also higher than their 20-day average. It is the third most traded Nifty 500 stock on Tuesday. It's at a very important level is Infosys. It briefly slipped below the mark of 1,000 rupees as well yesterday. It has not closed below the mark of 1,000 rupees since the 24th of September 2020. And lastly, of course, the stock that could possibly be the one for the day, HCLTech, the second worst performer on the Nifty 500 yesterday. It has already in fact declined in 8 out of the last 11 trading sessions. Tuesday's volumes were the highest in nearly 2 months. 55 lakh shares were traded yesterday, the 4x its 20-day average, and 32% of those were marked for delivery. So around about 17.5 lakh shares for delivery. That too was 4x its 20-day average. The stock down around 40% this year from its record highs, down around 65%, and from its 52-week high too, the stock has almost halved.
Thank you very much for that. Could be the accident of the day. Dr. Bino Pathiparampil, Head of Research at Elara Securities, is now joining in. Bino, before we get chatting to you about pharmaceutical, because that's a space that you look at very closely, at Elara, what is the call now on HCLTech following the Q1 warning?
Overall, IT sector is seeing quite a bit of pain. Part of that we are seeing in KPIT as well. This pain, which is coming from the AI trade, the deal squeeze, margin squeeze, etc., is expected to continue for some more time, which we believe FY27 and possibly part of FY28, we will continue to see this pain in the IT space. But having said that, the stocks are to a great extent already pricing it in. So I believe at some time, which is not very far away, a level will reach where the stocks have priced in the weakness and possibly will start looking attractive at these levels.
Right. You know, now on the pharma space, a bunch of stocks have been outperforming, and some with reason, some because, you know, the market was such that people are seeking some sort of growth opportunities or capital safety here as well. What's your call? What are the triggers, and what are the best placed stocks here?
So the pharma space has been a pretty defensive space to be in this era of geopolitical conflicts. But then it's not completely safe as well, as we have seen raw material costs going up, freight costs going up, geopolitical and logistic issues impacting revenues from certain geographies, etc. But despite all that, it was a safe haven to be in, which has led to an outperformance of the space. But after this outperformance, valuations have become reasonably full. Plus in 1Q, I'm also expecting some kind of margin pressure to be seen in many of the names in the pharma sector because of the higher material costs, freight costs, etc. So to an extent, it's still not very expensive. It's still a decent space to be in. But the kind of returns and the outperformance that we saw over the last 3-4 months may not continue.
Got that. Bino, let me open the field wide for you, right? Let me ask you what you like and what you are convinced about. Because, you know, I was, in the last hour yesterday, I was looking at stocks, and it's pretty much every day. Momentum begets momentum. What is done well is done so exceptionally well. Is just, you know, there are routinely 100% movers this year. And then we call this a poor year. But the point is, it's a narrow list, and it's largely focused on that manufacturing, industrials, the kind of space, right? Power and that broad category. What do you like, Bino, most focused on?
So after the long time correction we have seen in the markets, over the last maybe around 3 years. We think the market is broadly bottoming out. From a 1-2 year perspective, we are turning much more constructive on the markets now. We have seen rupee correcting, which has made the economy more competitive. We have seen oil coming back to 70 from the highs of 100 plus, which favors well for the country's economic growth. We have seen consumption not being impacted significantly even when there was worry of inflation. There is a short-term worry of insufficient monsoon, but I believe we will soon get over that too. So overall, the economy, the country seems poised very well. Markets have seen significant correction over the last 3 years, time correction plus marginal real correction. So overall, from a 1-2 year perspective, we are turning significantly more constructive on the markets. Now coming to what sectors we like, as an economy, since we are going to grow banks, definitely. We have seen banks underperforming the broader markets over the last 2-3 years. We believe this will change. Valuations look very attractive. Power as a theme we continue to like. Energy diversification is definitely a theme which we need to play in multiple ways. Power generators, exchanges, power-related capex plays, etc. Consumption, which we would like to play through auto companies and some of the new age companies like Eternal, Swiggy, Nykaa, Lenskart, etc. Like I mentioned earlier, it is possibly a time to look at two sectors which have underperformed significantly, IT and real estate. At some point, all the negatives will start getting priced in. So overall, we are turning more constructive on the market.
So in terms of pockets, Bino, the new age companies is one, right?
Right.
And there it's it's not the there's Lenskart, there's Nykaa, but not the quick commerce names, right? Or you have the quick commerce names as well?
Yes. Eternal, Swiggy.
I
so
see.
These names corrected in between because of the worry of inflation, oil price going up, etc.
Sure.
Now those headwinds are behind us.
Okay, and which is the first one that you mentioned? The first area?
Banks.
Sure. Okay. And you're saying that IT and real estate perhaps should come back into the mix. Now, IT is a big debate. Is it at what point? How do we know at what point, Bino?
Yeah, that is the tough question now. We have seen many of the names are below their below their prices 5 years back. At some point, all this gets priced in. The pain in terms of growth, margin pressure, etc., will continue likely for next 1 to 2 years more. But the stocks will price in those much earlier. Has it already priced in as of today? Very tough question. But maybe within the next 3 to 6 months, I think definitely we will see the absolute bottom.
So what? You know, do a SIP kind of thing here? I don't know how to, because no one rings the bell at the bottom, right? So how do you know? Or you think, I mean, once you start to see some visible signs of some change, and then you kind of, even if you get in a little higher, but is that the way to do it?
I would start buying right away. Of course, catching the absolute bottom is difficult. So I would start buying right away at some point. And there could be specific names. Among the large ones, Infosys seems relatively better positioned. Among the mid caps, maybe Persistent. So at some point, this will bottom out. If it is exactly today or 3 months down the line, it's very difficult. But I would start adding at this point.
And real estate, Bino, again, what you're saying that they'll turn around. You do the same here with real estate. Start buying some of these names here, and which ones?
Yeah, so real estate also we have seen significant correction in stock prices. There was some amount of worry about volumes, etc. Also in the background of inflation and to some extent related to the job seen on the IT front, etc. So these worries are also to a great extent priced in. We have started seeing some pickup in launches by the good players. At this point, Oberoi would be my top pick, followed by DLF.
Thank you, Bino, for joining in. Motilal Oswal today in the preview note for technology has lowered the upper end of the guidance given by Infosys and HCLTech for FY27. They're saying just going by the pure run rate, it looks like that the upper end is going to be unachievable. So Infosys had given a guidance of 1.5% to 3.5%. Motilal Oswal believes that the company will tweak it. It will become 1.5% to 3%. So the upper end looks unachievable. And even for HCLTech, the guidance is 1 to 4. According to Motilal Oswal, that could be revised to 1 to 3%. So we'll have to wait by. This is all the organic guidance. Companies have been making a lot of acquisitions, and that will boost the overall growth. But let's get to the brokerage calls of the day. Sudarshan Sukhani, our own Sudarshan is joining in. Sudarshan.
So we'll start with MCX. Jefferies has initiated coverage with a buy call and target here is 3,600 rupees per share. That implies an upside of more than 25% from current levels. It believes that commodity market lags equities, but penetration should increase going forward. And MCX, being a leading non-agri exchange, is well placed to benefit. It forecasts MCX revenue to grow at 20% CAGR despite elevated base. And along with 260 basis points margin expansion, earnings CAGR forecast is of 22% till FY29. Next one is Dixon Technologies. Investec, after meeting with the management, maintains buy call target here is 14,500 rupees per share. It says management remains confident of mobile phone volumes ex Vivo staying at least flattish in FY27. And Vivo JV approval. Yesterday, we have also reported that approval is expected very soon, and that should add 20 million plus volume on an annual basis. Mobile exports should pick up and contribute 4 to 5 million additional volume in FY27. And should pick up significantly from FY28, and that would be aided by PLI 2.0. Other segments like IT, hardware and telecom businesses are also on a strong growth trajectory, and backward integration should boost margin from FY28. Management is also looking into specialty EMS foray through acquisitions. Last one, HSBC has written a note on cement. It has upgraded Shree Cement to buy from hold, and target is increased to 30,780 rupees per share, and downgrade Ambuja Cement to hold from buy, and target is 490 rupees per share. Preferred buys Ultratech, Shree Cement, Nuvoco and Dalmia Bharat. Hold call on JK Cement and Ambuja Cement. It believes that cement's Q1 is expected to be better than investors feared, and Q2 normally is a seasonally weak quarter, but S2 FY27 should be better.
Thank you very much for that. M&M numbers are also out for the month of June. Overall, looks slightly ahead of the estimates that we had. The total sales crossing that 1 lakh units mark in the month gone by. Tractors looks like a big beat. CNBC TV 18 poll was for 43,500 units. The company has delivered 50,000 plus, 58,000, I think. And overall, the passenger vehicle sales for M&M also very strong, up about 24%. So we'll come back to Sudarshan for more analysis on this. For now, it's a break. On the other side, we'll be joined by Vijay Agarwal of Equirus Capital to put the spotlight on the infrastructure space. We'll also connect with our technical experts for a few trading ideas.
Welcome back. Mahindra and Mahindra June tractor sales numbers are coming through. And the auto and tractor, both numbers are coming in. 28% growth. And that's a big jump. We'll, of course, put this up against the expected number. But, all day today, we will get these numbers. Three-wheeler sales are up 63%. Total exports are up 125. That's, of course, on the auto side. And I think we had the tractor numbers coming through as well. So more on some of these, which stood in a bit. 12% growth in tractor sales. We're at about 58,177 units. Well, Sudarshan Sukhani is with us, and so is Mitesh Thakkar with what they want you to do as far as trades go. Gentlemen, good morning. Good to have both of you here. Sudarshan, you go first. What would you do on the Nifty to begin with?
Yeah, good morning. Well, the idea is to look at 23,800, which is a support zone for the Nifty, and then consider going long. Today, the chances are we'll reach that level in the morning itself. Now, around this zone, if the Nifty finds some stability during the day, the trade is to buy at 23,800 with a tight stop at 23,700. We want to risk only 100 points, and the reward on the upside is much more.
Yeah. Got it 100 points higher, but this is, of course, the initial rates on the gift in the pre-open session. So you're saying that these levels will be protected, Sudarshan, and basically we should resume the uptrend.
That's right. At somewhere around 23,800, we should find support.
Yeah.
And keep a 100-point stop loss and go long.
Got it. Mitesh, what about you?
Yeah, I have been maintaining that we might do a range, which is same level as mentioned, 23,800, 750 broadly on the downside and 34,300 on the upside. Now, having said that, we might approach that support zone today. In case we rebound from there, I think we should be back into the range, try to head towards the upper end. But in case the Nifty kind of declines below this 23,800, 770, 750 zones, then I think we might look at a start of some kind of a mild declining movement, and we could look at levels below 23,500 as well. So I think in that sense today, post-opening movement would be very important.
All right, we take that point. Sudarshan, your thoughts on individual stocks? What are you backing?
Yeah, but let me quickly add one more line.
Yes, please.
This is a lot of people most of us are pessimistic. The Nifty has done nothing. For investors and for position traders, that is good news. 2 years of trading range in the Nifty, whenever it starts on a big move on the upside, it will be a big move. So also be aware that we are maybe at the right point. Maybe the 380. Britannia is a buy, and it's a positional buy with a stop under 5,000. Indus Towers is an intraday short, stop above 400, and UPL is a short with a stop above 580.
All right, so Britannia is a positional buy and UPL is a short along. So that's your stock call. We take your point entirely. Not much has happened, and usually that's what happens before a big move. Let's go across to Mitesh for his individual stocks as well. Mitesh.
I have a mix of buys and sells. On the buying side is Cochin Shipyard. If it starts getting past yesterday's high of 1519, buy with a stop at about 1494 for targets of 1575. Another defense name is Bharat Dynamics. That's a buy as well. Keep a stop at 1344. Look for targets of 1410. On the selling side is HUL with a stop at 2141 for targets of 2070. And Bank of India is a sell with a stop at 144 for targets of 133.
All right, we take that point. Thanks a lot for that, Mitesh and Sudarshan. We'll come back to you just shortly. Let's go across to our next guest then, Vijay Agarwal, who's the Managing Director and Sector Lead Infrastructure, Equirus Capital, joining in now. Vijay, the solar EPC space, everyone's speaking about a bunch of opportunities, but there are also worries around a supply glut coming in out here. What is your sense, and what stocks are best placed to benefit from this opportunity, and which are the ones which, according to you, have run ahead of its, the expectations?
So see, on the solar EPC, you have a 60 gigawatt opportunity. Only thing, I think if people bid with margins, I think there's no issue on that. And so if you see all the module manufacturers like Premier, Wari, and other players are also entering into the EPC space also. So the players who are into integrated play will be much better from the perspective of a long term.
All right. And what would those names be?
Like Wari, Premier, they are going for an integrated play. And then there are a couple of other stocks also who are trying to do that. Like SAEL, which is upcoming IPO, which is also trying to play the integrated play where manufacturing, EPC, IGP. Acme is there, who is into integrated play. So these are the stocks which we should keep watch on them.
Right. And on the larger infra space, what is your sense on ordering activity? Obviously, it was impacted in the first quarter because of the disruptions. But how do you expect that to move going forward? Is there enough legroom for the government to increase their ordering activity? And how should one position themselves on the other infra players?
I think if you see on the road side, I was interacting with a couple of players and including the NHAI, Moth and that. Expect more bids to come in coming future. I think there were land acquisition issues which have been resolved and now they are not giving any project, bidding out the project without land is acquired, substantial land is acquired. So they want to bid out the project and start the work. So they had to go reach to 90% level. So they are coming out with the bids where they are 80% plus land. And then by the time the bid and the contractor is on ground, the rest 90% is also done. So from that perspective, there were delay in last 2 years, and that's why you had seen less bids. And now this year, you will see more bids. Secondly, on the front of government funding, I think this year the government is looking for more monetization of road projects and raise funds from that and give to NHAI for construction. So I don't see a dip in the bidding activity. Probably this year, probably we should see a bids of around 1.5 lakh crores to come and awarded. And then on the power EPC side, we are seeing, we expect again a similar range of a 1.5 to 2 lakh crores work to come awarded from the transmission, because we are all struggling on the transmission and distribution infrastructure. So it requires augmentation. And on the renewable side, your solar IPP again will give the same size of order book. So I think this three vertical and railways also is a more than 1 lakh crores. Railway capex will also come. So we are seeing a good play coming for order book is increasing. If you see last year, everybody's order book has dipped. This year, their order books have come up. Basically, last year, many players have reached to like 1.8 times of sales, 1.5 times of sales. Now they are above 2 times and reaching upwards, basically. And if you see a large players like NCC, KPIL, KEC, they are having a very decent order books from that perspective. Even L&T to that extent, they are really having a large order book, which gives a long-term visibility, and other players are also catching up. And government, I think the oil prices are now cooling down, so government should have a headroom to spend on the capex.
Got it. So you're saying that, you know, these pure road contractors will make you money, will make investors money? It's possible?
We have to see, because that it is possible because currently their P multiples have come down drastically. It's like 8 to 10 times of P multiples, which is historically low. And if the order book and execution takes place, I think there is a good headroom to grow there. The stock price will grow.
Yeah. Got it. So we spoke about you spoke about solar. We spoke about some of these road names. Any other areas we should be focused on?
I mean, airports.
Airports.
Airports is again a very good coming up, and I think if we see two large players, GMR and Adani, they are the large players, and they are all in a capex mode, stabilizing their existing airports. So that's another area which one should look for.
I see.
But it gives you a consumption, you play on the consumption story also in both the stories.
Right.
Along with infra.
Right. You have coverage on GMR? GMR
No,
Airport?
we don't have a coverage. No, we don't have a coverage on GMR Airport. We have Adani Port as a coverage.
Adani Port, not.
Yeah, Adani Ports. Adani Airport is not listed.
Of course. There's, I guess, a fundraiser foot at some point, which has been, of course, we are awaiting. So we'll see what happens there.
There are rumors there. Yeah. We have to see.
Yeah. Got it. So that is another kind of area from the broader infrastructure space that you are focused on. What about smart meters?
Yeah. Smart meters, the rollouts are happening because of the elections in many states. The rollouts had slowed down. But now I am hearing that the rollouts have kept, again, got a pace. And like I was interacting with the Bihar government, the CMD of Bihar distribution. And he was like, I think Bihar has the highest number of prepaid smart meters, which is 90 lakhs. And I was also surprised that the Bihar Discom, when they said that we make a payment to our IPPs after cutting a cash discount. That means they are on time for payment also. Smart meters are really helping. Bihar example, you see a 35% T&D losses, they had come down to 14% now. It's a big growth, big savings for the utilities.
Got it. We'll leave it there. Thank you very much for joining us and appreciate your time here, giving us a broad overview on sectors with regards to this next round of capitalization as far as NIIF is concerned, where that money actually may find, which sectors it may be sort of going into. Thank you. Well, I think let's just get 9-10 calls out of the way. Sudarshan is back with us. Sudarshan, what do you have?
It's AB Capital, buy AB Capital with a stop under 380.
AB Capital is a buy with a stop under 380. Mitesh, what about you?
Yeah. I'll go with a buy on BDL for the time.
Okay, got it. Can we just put up a KPIT in the pre-open session? Just a quick bit. And Mitesh, if you want to just pull up that chart, it's locked down 10%. Where do supports come in here?
For KPIT?
Yeah, KPIT Tech.
So I think, there's some negative commentary, and the last bottom is around 632, but we might actually open below that. So total long-term charts, I think the bigger supports, kind of kick in at a slightly lower level of 545, 50 zone. So maybe, we might go to those levels as well.
Right. And if you've, have you looked through the IT names? Are we seeing fresh? I mean, it's been pretty weak. The index is down 4% this week. It's already. KPIT, by the way, came out with a profit warning last evening. That's why it's down so sharply. But broadly, the IT stocks, more weakness?
That's actually possible. That, IT stocks will go through more corrections because, while they're extremely oversold, there is no sign of, the trend reversing as yet. So I would not be surprised if the Nifty IT also declines to another 5 to 6% from here easily in the next few days.
Okay, all right. Thanks very much, Mitesh, for that. We'll have you back and we'll talk more about some of these ideas. But that's the 9-10 calls for now. Brokerage reports of the day, standout ones. Nimesh has gone through that. Nimesh, take us through it.
Hi, Prashant. So I think the sector to watch would be consumer. A big report, in fact, interesting reports on consumer names from Citi today, but standout is on Havells. Citi has today upgraded the stock to a buy from neutral, and they've retained a target price of 1,500. They believe that after the recent correction has created a good entry point for this very high, strong electric and consumer durable franchisee. They expect growth to return for Havells in FY27 on the back of improvement, gradual recovery in the consumer business, improvement in the cable and wires space, and solar segment will emerge as a strong, growth driver for Havells in FY27. Even margins are likely to improve as per the Citi note for Havells in 27. So that's the trigger why they've upgraded Havells to a buy. Interestingly, Citi has also put out a 90-day positive catalyst watch on Page Industries and on Titan. On Page, they have actually, it's a double upgrade from Citi to from a sell to a buy, and they've raised the target price on Page Industries to 47,700. Even in Titan, there is an upgrade from Citi to a buy from neutral, and there they were target price of 5075. So across the consumer names, Citi is very bullish, and they've upgraded 3 names today: Havells, Page Industries, as well as in Titan.
Right, take that point. On Titan, obviously, we will await the quarterly update that will come by. And this time around, there will be a positive surprise on the margin front, largely because of the excise duty, customs duty, hike that had come by. So all these companies which are sitting on old inventory will obviously benefit from that.
Okay, all right. Well, 30 on the Nifty and about 60, 65 on the Sensex is what you have. The pre-open KPIT was down, but the rest of the IT stocks were actually higher. They had some green, so let's see. It's going to be interesting. A 0.25% higher on the Nifty, and the Nifty Bank up about 0.14. The Sensex is up about 0.2. Small cap index is up a half, and I think the mid cap index will come up with some gains as well. I think should be in line about 0.6, actually stronger than the other 3 that I mentioned. The small cap index is up 0.6%. So 23,930. So once again, as we were saying in the morning, 23,800 has been a support, has acted as a support so many times in the past, and it looks like once again, we didn't quite go to 23,800, but that broadly is the number. We are bouncing, but let's see if the bounce lasts. Titan is the number 1 gainer, the top gainer on the Nifty. Mahindra follows. Mahindra, of course, reported numbers, monthly numbers across segments. Let's go back to the heat map for a quick bit and give you a snapshot there. We'll just have that up. So 23,900, 910 on the Nifty right now. There's Eternal, Sun, Bajaj Auto, which are all higher. So more up than down. There is Bajaj Finserv, HDFC Life, and Coal India, which are down at this point in time. So 45 on the Nifty. Rima.
Well, on the way up, it's Titan, as Manglam was saying. We should get the quarterly update soon, and margins could positively surprise. Eternal is seeing buying. Kotak Mahindra Bank, which has made a play for Deutsche Bank's retail assets, is rebounding after yesterday's fall. Bajaj Auto, higher in trade. M&M, very strong June sales for passenger vehicles, a growth of 24, close to about 25, 28%, and even tractor sales beating estimates. Infosys TCS holding up in the green. Infosys briefly had dipped below the 1,000 rupee mark in yesterday's trade, and now it's vigorously trying to defend that. So it's 1% up on that. And Reliance Industries, where there was a little bit of a positive news, that's holding up in the green. On the way down there, you've got a 1% plus fall coming through in Bajaj Finserv, HDFC Life, Tech Mahindra, Coal India, Adani Enterprises, a couple of these metal names like Hindalco, JSW Steel under pressure. A quick check on IT. It's KPIT Tech right at the bottom, but along with that, even the other ER&D companies. So whether it's a Tata Elxsi or an LTTS, these are the stocks under pressure, and Tata Elxsi in particular, because they also get more than 40% of their revenues from the automotive segment. KPIT gets 100% from autos. For Tata Elxsi, it's about 40% plus. So Tata Elxsi is the one falling, the most outside of KPIT Tech.
Right, if you look at the mid-cap end, a lot of them are actually outperforming and a few of them are surging now. Page Industries, stock of the morning, the positive catalyst watch, as Nimesh pointed out, with Citi working well for them. In fact, this week itself, the stock is up nearly 5% in the last few trading sessions. Starts well in the morning. We also have Havells, which is up around 3%. The Citi note that has come in, they've upgraded the stock to buy a target price of 1,500 rupees. And they are saying the solar segment will be a driver for them. Keynes Tech continues to do well. We're seeing some traction on MCX as well. And on the way up, we also have a lot of these stocks which are actually buzzing on the back of some of the order wins. So you did see some traction coming by for RITES, 175 crore order win that the company has made. You have Realtel as well, which is marginally in the green right now, has opened with 1% in terms of gains. They've got an order worth about 108 crores. And EPAC Durables, that's another stock, which is up 2.5%. The Andhra government has approved incentives and land allotment under the electric manufacturing policy for them. The capex that the company's planned is over 1,000 crores. Prestige Estates is the other one, which is seeing some green, about 0.5%. They've launched 2 more towers in their Mulund project with a gross development value worth nearly 2,200 crores. The stocks which are on the downside here are, more the same. It is largely IT, or we are also seeing some weakness in a couple of these real estate names, which otherwise saw some traction. So we have Keystone Realtors, which is lower, and the others. Avenue Supermarts stands out as the lone, consumer sector loser in today's trading session. It'll be very interesting to see what's causing this downtick because, there's nothing, to suggest a downtick of the sorts at the open for Avenue Supermarts in a stock which is otherwise done fairly decently this year so far.
I don't know if I'm imagining it, Mangalam, but I'm just looking at the screen across the top NSE 500 list and, just sorted by volumes. Volumes are a little, usually, lately volumes just out of the gates, I mean, they fly, right? But, maybe about 10, 12 names have got decent sized volume and it'll pick up. It's too early. Maybe, we should give it time. But, Viatech Vabag is another name, 6% higher. I don't know if there's any news flow. But it's basically back at the recent highs. It corrected a little bit after having a one-way rally. Car trade is up about 3%. Again, very strong volumes. Ather is up 2.25%. We've got a couple of discussions around EVs coming up in a bit from now. MCX is up 2%. Keynes is up about 2.25% or so. There is Newland Laboratories. By the way, Newland, Loris, all these names did very well yesterday, 3, 4, 5%. Axis Cades is up about 1.25%. MTAR Tech is up about 1.25% or so. So yeah, I mean there is some move here. Tata Elxsi Rima is down 3.5. I think we mentioned it. almost 3,700. It's got large volumes in it as well. Tata Tech is down about 1.5%, and of course KPIT is limit down 10 at this point.
Just a word on Viatech Vabag. This morning itself, at around 8:30, they've informed the exchanges of them winning a large order in Vienna, Austria. And as per the company's own, classifications, a large order domestically is between 250 to 600 crores, but internationally is between $300 to $75 million as well. So anyway, $30 to $75 million. So which implies anywhere between 300 to 750 crores. A large order that they've gotten for some waterworks in Vienna, Austria. So Viatech Vabag is higher on account of that. This morning itself is where the company has informed the exchanges, 8:29.
And just one word on KPIT Tech. So we highlighted the news. So JP Morgan today, when they downgraded it, they're saying the valuation multiple of KPIT Tech should be 17 times. Currently, the stock is trading at about 20, 21 times. And even according to JP Morgan, based on the earlier target price, it was closer to 20, 21 times. And now as they downgraded it, they basically see a further derating. So currently from 20 times valuation multiple, they believe the fair valuation multiple should be about 17 times. So EPS cuts are there. And on top of that, perhaps further derating.
Okay, all right. So that is KPIT coming through there. Let's actually bring in Sanjeev Prasad, MD and co-head Kotak Institutional Equities. Sanjeev, good to have you with us here. Thanks for joining in. I think Rima gave us the question on a platter. IT with this KPIT profit warning. We had analysts earlier who were saying, well, maybe it's time to nibble in and slowly buy. It's time to do it because you won't know if there is the bottom in that sense, but something's got to change. What's your sense, Sanjeev? How will we know when that happens?
I wish I knew it, Prashant, to be honest with you. Given the issue around deflation and realization, which everybody is talking about, the big billion-dollar question is what kind of deflation one is looking at. So far, the market has congregated to around 2 to 4% average deflation pricing for the next few years. Now, I don't know whether that's the right number, if it is sufficient, or it could be significantly higher. Who knows? Given the impact of AI is still very early in a way, very hard to assess what it could be. Having said that, what's the downside over here? If you look at from a historical perspective, valuation may look very cheap. If you look at where this was trading at, say March 25 to about 24 times what you found, correctly down to about 12, 13 times what you forward. So on that basis, it will look pretty attractive. But the problem is we have to ultimately value stocks in the future. And this is where the market has been making mistakes for the last 2 years. There's too much over-reliance on historical multiples, which may or may not capture the new context. And in case of IT specifically, we have no idea what is new context. Is 0% price growth enough? Is 2% inflation enough? Is 5% inflation? 10% inflation? I have no idea, to be honest with you. And God forbid, if the deflation is more, you have to also start worrying about the margin impact. If you look at every analyst model, it basically assumes flattish to slightly higher margins. There's one more angle, which is more from the rupee part. A lot of growth, whatever you have seen in the last 1 or 2 years in rupee terms of IT service company has come from the rupee. This time around, the rupee, at least from whatever I understand, looking at the fundamentals, RER basis of rupee has fallen well below its fundamental level. With improvement on the BUP, likely on the back of whatever the government and RBI have done, hopefully the rupee does not depreciate that much. Hopefully from an investment standpoint, maybe not so much from an IT sector perspective. So that tailwind, which has naturally supported margin or margin expansion for the IT companies, may or may not be there going forward. And in the worst case situation, this could well become, much lower cost of, return business, much linked to somewhere cost of capital. Who knows, So I just don't know what is the bottom or the downside over here. So to try and catch a falling knife, I don't know. It's too early, maybe. All I can say is if I look at the multiples of a Cognizant at 7 times 1 year forward and Accenture at about 9 times 1 year forward, in the US, maybe the US guys understand whatever is the AI story much better than what the domestic community understands. Who knows? I'm just, making the statements over here. Honestly, I have no idea.
So this at 7 and 9 times 1 year forward, what are you saying? Are you saying that this is, we should mark to market to those valuations here? The IT stocks here, no.
I have no idea. As I said, 7 to 9 means effectively the US market is telling us that the profits of this company will decline going forward. Effectively.
Got it. Now, Sanjeev, just one more area I wanted your thoughts on. This entire power, industrials, capital goods, right? That is the strong bull market here. And many stocks here are up 100% in the first 6 months of 26 already, after having strong 2025s. How do you think about valuations here? Because, order books are strong. Yeah, go on. You're smiling, but go on.
Honestly, I don't know. See, in India, so many narratives come and go, and I always become the villain highlighting some of these, issues. Look at railway stocks 2 years back. Exactly the same thing is playing out over there. Where are railway stocks now? Now that the government capital slowed down, nowhere to be seen. 50% cut from 2 years levels. Look at how much the stock price of all the railway companies. Yes, I understand there's a big electrification theme that is there for the next several decades. India will rely more on domestic energy going forward, which can only come to the solar route. So there is a big electrification theme. But the question is, how much you want to pay for it upfront? Is the 80p enough or 100p quarters? People try and do some sort of a reverse DCF, etc., to, try and justify the valuation. The kind of market size they're looking at, 3, 4, 5 years later would be humongous. I don't deny that there will be growth, but then it has to put in some context, whether it makes sense, the kind of growth that we're talking about, and whether the multiples or the valuation that have been recording currently, fall somewhere in a reasonable, ballpark. And Prashant, look at the number of narratives which have come and gone in India in the last, 2 years. I have one page in my presentation actually. So people forget after some time. Something happens, people get excited. After 2 years, forgotten. That's how things go on.
Okay, so IT is uncertain from here on. You're unconvinced about the industrial space, whether it can continue to run up when it's trading at these kind of valuation multiples. What is the theme which you're comfortable with, all things considered? And generally on the markets, when we last spoke to you, your tone sort of shifted from negative to neutral. How do you expect the second half of the year to be?
Themes which we like, I would say, is what I call broadly the domestic services space, which I would broadly put financials, healthcare services, hospitality, which includes obviously travel, tourism, transportation, all that stuff, retailing, and telecom. The reasons are reasonably straightforward. One is the long runway of growth. As India becomes richer, more and more money will be spent on discretionary services. Second is, at least in 3 out of those 5 sectors, which is healthcare services, hospitality, retailing, you have a very large unorganized sector to the extent of about 80 to 90%, which means the organized sector continue to gain market share for a long period of time. And third thing is, obviously, there will be no global competition over here. These are ultimately largely regulated and not physical services. So the modes are fairly decent and where growth is fairly long, and at least the multiples, are palatable over here. If I look at the private banks, for example, or even the PSU Bank, multiples are looking pretty reasonable. The macro has improved quite significantly. If you look at the top-down view on banks, credit growth is looking a lot better. You're now looking at 15-17% credit growth compared to a few months back. That on the back of higher nominal GDP growth, some pickup of real economic activity. So at least credit growth is looking fine. NIM should be broadly stable, and if conditions are favorable, they could expand also. Assuming the PSU banks become less aggressive in competition in the secured space, we could possibly see some expansion in terms of the private banks. And if inflation is somewhat higher than whatever we are assuming, maybe we could also see rate increases, which obviously helps the private banks more than the PSU banks. And credit quality looking pretty good. And multiples all said and done, if you look at the top tier private banks, if you exclude ICICI Bank, most of them are in the range of 1.7, 1.8 times 1 year forward book if you take out the value of the non-bank businesses. So limited scope for de-rating, maybe some scope for re-rating, 14-15% ROE, which means over a 2-year time frame, you could get about 30% return from ROE itself in 2 years of compounding in the book, plus maybe some re-rating. So yeah, you could expect decent returns as far as the private bank are concerned.
All right, private banks are easy return pickings right now, limited downside, possible re-rating is what we'd see. But, just to further that point before we ask you about other stuff, you did speak about the healthcare space and the hospitality space. What do you think of the multiples here, specifically in the hospitality space, largely because, the street is now betting on ARR growth to drive business forward. The demand-supply mismatch, obviously that narrative is well discovered, but in micro markets, now there is more supply than demand as well. So how do you play that theme, and what opportunities really seem exciting to you despite the run-up that we've seen in the hospitality space?
No, if you look at most of the hotel companies are creating a reasonable valuation, I would say, whether it is Indian Hotels or SAMI, etc., which we covered, not too bad valuations, I would say. And here, again, when I was talking about the 5 sectors, it was more just on long-term growth pieces and broader macro points. Obviously, you have to overlay the valuation part over there. So you'll have to pick up, choose, between various spaces. Point I was highlighting was, at least in the case of private sector banks, that multiples are quite okay. Beyond that, you'll have to look at more things on a bottom-up basis. For example, in this case of business, we are still okay with something like Apollo Hospital example, even though the stock has done reasonably well over the last year or so. So it's not as if there is a slam dunk out here. You will have to clearly look at valuations, before taking a call. And before I complete, the other space which we like is the entire domestic manufacturing space. So going back to the original question, which was on electrification, yeah, it's a great theme. So whether it is CDMO, capital goods, industrials, everything will do well over a period of time as India does more and more domestic manufacturing. The question is how much multiple you want to pay for either companies which have technology. They are all trading north of 60p now. Or many companies which do not have technology are, more or less similar as of now. Even they are trading north of 40, 50p. So that is a struggle over here. How much multiple you want to pay in the context of growth and the business models of these companies.
So as you like this space, right? And again, it's not, that same euphoria is not to be found in the CDMO companies, etc., but the manufacturing part of it, the electrification, that entire theme. How do you, so what do you like there now, Sanjeev? Because what you pay is the question. So let me ask you that.
CDMO space, for example.
Including CDMO. Sorry, ex-CDMO. I'm talking about the electrification space in domestic manufacturing, that entire piece.
Just better to be honest with you. Whether it is, we used to like ABB Cummins until recently, but I had to take them out of the model portfolio because they were just looking too expensive. ABB at about 75 times 1 year forward. Cummins is now reaching about 60 times 1 year forward. I understand the electrification theme, the digitalization theme, on which this companies play on the data centers and all that stuff. But how much multiple you want to pay for that? That's the big issue.
Right, and
that is one. And anything else there, which is
honestly struggling.
Okay, and you've looked. It's not as if you're sticking to the large caps because there are lots of.
We cover 320 stocks, so we have enough stocks to look at. It's not as if we're not looking and we do not cover it. Unfortunately,
And domestic manufacturing outside of electrification, what do you like? You said, there were CDMOs and a few other areas.
CDMO is fine. There are enough number of decent companies over there, and valuations are actually pretty reasonable. And thankfully, our analysts have been very positive. The stock has done well. Multiple still looking okay. So not too bad, I would say.
Yeah, so the one space we didn't discuss is the metals and mining. You've got views there. I don't know that. And what's the sense here now after the war premium on a lot of the commodities have come off? Some believe that maybe higher prices for a few metals will sustain because of structural reasons. Is there anything that appears attractive here?
So we like aluminum space, given the fact that you're not seeing too much of global capacity addition for the next 3-4 years. If you look at aluminum smelting capacity next 3 years, that is 25 to 26 and 28 calendar years, we are only looking at about less than 4 million tons per annum global capacity addition, which is quite low compared to the consumption, which would be well north of that, closer to probably 5 million tons over this period. Incremental, I'm talking about. So that looks okay. It could continue to be fairly tight. The problem over here is obviously everybody worried about the fact that if energy prices start coming down as they have, and some of the smelter capacity in the Middle East which got shut down, they restart, you could see downward pressure on aluminum prices, which is the reason why you have seen a downward correction in some of the aluminum links like Hindalco or Vedanta. But structurally, things are looking better over there, I would say. The capacity addition should be north of 90 to 93%. I'm talking on a global basis for the next 2-3 years.
All right, take that point. So aluminum is one of the spaces that you like in the metal space. Always a pleasure speaking with you, Sanjeev. Thank you so much for joining in. Maybe you want to listen in to the next discussion that we've lined up for you, which is regards the consumption space. Nilesh Gupta, who's the director of Vijay Sales, joins in. Along with him, Kumar Rajgopalan, the CEO of Retailers Association of India as well. Thanks a lot, gentlemen, for joining in. And Nilesh, you must be the man of the moment right now because rains haven't, really splashed the country so far. And while that has happened, we've also seen a serious heat wave. Does that mean a lot more ACs sold this year? We've heard from the companies. They've seen a great summer. But now we want to hear from you. What's the kind of sales growth that you've seen, especially in the AC space and the general consumer durable space this summer?
So good morning, everybody. Definitely the heat wave which happened and the extended summer which we had saw high growth of sale of air conditioners and air coolers also. Basically, we have to also understand that last year we had a very poor summer because of the intermittent rainfall during the summer. This year we had an extended summer. So except for the north in June, except for the north in June, which did not do as well as it normally does because last year June in the north was very good, but the rest of the country, I think we had an extended summer in June. So this year we can easily say that the growth has been around 20% in numbers and around 30% in value. So it's been a good season.
All right, it's been a good season. And Mr. Rajgopalan, what about the lack of monsoon and the impact it has had on general retail? Multiple factors playing out here, right? The lack of LPG and the fear around geopolitical uncertainty, inflation, all these things played out in consumer sentiment. We've heard about that. Has that eaten into share of retail this time around? Plus the convenience of quick commerce at the upper end. So you have squeeze coming in from both sides.
Yeah, hi, good morning. I'll try and answer the first part. I think we still got to see where this monsoon takes us. Early times yet. I think that by end of July is when we'll get to know whether we are going to be on a good stand or no. We do know that the input prices had gone up, including fertilizer prices had gone up, and the war has not been kind to most of us across the world. So we saw that in the month of May, the overall sales growth was around 5%. Now this, as compared to our earlier months where it was 9-10%, I think it was not as great. June, I guess, is not going to be a very great month also, although many of the retailers have started their sale, end of season sale, around the 20th of June. So maybe they are capable of catching up to some extent. Also, June has got 1 weekend lesser than the last year, so that also makes a difference in retail for many. And also the festivals that kind of got preponed. Eid was in May and not in June. So these are some of the factors. But overall, if you compare ourselves with the rest of the world, I guess we are much better off. There is still consumption, there is still growth. Customers are coming into the store. The real pressure is on margins, and I think we need to sit and wait what gets declared by many of the retailers, because the input cost for cotton went up, input cost for many of the items, including all kinds of synthetics, covers, carry bags, everything went up. So we'll have to wait and watch where that takes us.
All right, we'll have to wait and watch where that takes us. Just take a moment for a minute to look at the market as well. It's a big surge that we're seeing this morning. 75 points higher on the Nifty, and a large part of that is actually led by some of the consumption names. So you have Nestle, which is up by about 2.5%. M&M, obviously, on the back of strong auto sales numbers. Titan is the other one, which is higher. HUL itself is seeing a gain of almost 1.5%. The Nifty Bank, which is higher by just about 0.1%, is not a big contributor today. It's the FMCG pack. And alongside that, we have Reliance as well, which is higher by about 0.5%. So all these factors taking the market higher on day one of the July series. Can't say the same for KPIT-Tech, which opened with a 10% circuit freeze. And now as that opened, it's actually gone down by about 15%, 570 on KPIT-Tech.
The company has just said that even Q2, so they've just given an addendum to the earlier exchange notification, that Q2 will be in a similar range compared to Q1. So Q1, remember, the company is already guided. Revenues will be down 1% year on year. Street is saying if you look at it on a quarter-on-quarter basis, it will be a drop of 4%. So broadly, 4% down quarter-on-quarter, down 1% on a year-on-year basis, and Q2 will be a similar number as Q1. So basically, there is no recovery in sight, at least in the first half of the year.
No recovery in sight, and as on Q, we have Tata Elxsi as well, which opened about 3% lower, has now corrected to further. It's down about 5.5%.
Just one question, Rima. The entire KPIT news is regards to the trigger is I think Europe, in what's happened in Europe, right? So it's
BMW in the month of June basically gave a profit warning guidance. So they lowered the margin guidance from 4 to 6%, from 1 to 3%. So it was very sharp, 3% drop in the BMW profit guidance. And for KPIT-Tech, BMW is a very large client. So generally, the company had already said that H1 will be muted because 2 of their large programs come to an end. But the fresh trigger for the weakness is, I think, what's happened with BMW. But even the others, so whether it's Stellantis, which owns Jeep, or even Volkswagen, from the start of the year, they have been talking about that, last year was challenging, and even this year, the same pressures, whether it's confusion about EV versus hybrid versus ICE, companies cutting back on their R&D spends, then there was tariff, then there was war. So anyway, the outlook was muted, but I think that BMW was the final nail in the coffin.
I sat down with the global head of sales for Mercedes. He's part of the Mercedes global board recently. This is about a week and a half back. He said, well, China was the big growth market. And there is so much pressure with regards to, local products, which are all high tech, and they're all like technology products rather than cars. They're like tech
Xiaomi,
products.
for instance, has a fantastic car in China. So these are all tech companies,
and at much lower price points. So the competition is humongous, and I'm sure it's true for everybody.
So KPIT acknowledged that they lack presence in China. So I think maybe a year and a half or 2 years back, they did make some inroads in China to try and understand the technology and do some partnerships. But it's predominantly gets its revenue from these European large makers.
No, they don't have to be in China to service Mercedes.
I think they were trying,
BMW. I'm saying that they could do it in, but the point is that the business is low for BMW. I mean, it flows through downstream, and I think that's the worry with regards
Cars
to.
are the largest software TAM right now. The hardware to software ratio in the cars is.
It's like a
software on wheel, right?
Yeah,
it's
exactly.
a software on wheel now.
It's like a phone on wheels.
Which explains why I'm surprised till date why Apple is not
doing cars.
Yeah, I mean, they've been working for it.
They had a project, I think, going back 10, 15 years.
20 years, right? Still not happened. Let's see where that goes. But when you said that you were sitting with a Mercedes guy, I thought maybe it was because you wanted to buy a car. When is that one coming?
Well, I think let's just get back to the consumer discussion here. Nilesh, good morning. Prashant here. So within this entire, what category will, according to you, do the best? there are companies like LG which do everything. There are more specialized companies which do one segment. There is which do you think, which category will do the best to your mind this season? I don't know if you want to name a brand which you think is doing exceedingly well. That will be helpful as well.
So I think as far as category goes, since air conditioners, compressor products are seasonal products, so looking back at summer, what happened, I think ACs and air coolers are one of the highest growth categories this year. Now followed by, surprisingly, in mobile and laptop, the quantity is there. The volumes may have slightly shrunk because of an increase in price of nearly 30-35% in the last 3 months because of the chip shortages. But in spite of that, as a value growth, I think these are the two segments which will show the maximum value growth. Rest of the categories we are seeing is a muted single-digit growth, not happening much, whether it is refrigerators, whether it is washing machines, whether it is televisions. The only silver lining here is that in spite of all what is happening in the geopolitical space, people are still looking for upgrade. People are still going for premiumization. So along with the price increase, the ASP is also going up. So value-wise, I think everybody is growing. Quantity-wise, there is a slight stress in a few categories like televisions, washing machines, and refrigerators. But I think a very fluid situation. The best part is the consumers are still walking in. There is no negative impact of the geopolitical situation that we have to stop buying. They're still buying. But the growth has got a little muted, I would say.
You said 30 to 35% increase in prices on account of the chip shortage at the entry level? And this is across which category?
It's basically the major price increase of 30-35% is laptops. Then in mobiles also the similar story is there across the categories, except in the premium, super premium segment, the prices have not gone up. And in televisions, we have seen a 7 to 10% growth increase in price because of the chip shortages.
Right. Just
again here also the higher screen size, the increase is not so much. It's at the entry level and the mid level.
All right, take that point. Nilesh, just one word on induction cooktops. That's a big surge during the uncertainty, geopolitical uncertainty. It's fizzled out, or is it still elevated, but perhaps not as high as what we saw earlier?
No, it has now fizzled out. It has come back to normal. But in those 40-45 days, we sold a 1.5-year sale, normal sale.
Got that. It's fizzled out. And just a final question on sentiment, Kumar. The proliferation of quick commerce. That's the one point that we didn't discuss yet, right? A lot of people are saying that incremental sales is going there, at least at the premium end, because quick commerce is accounting for nearly 13% of e-commerce sales. So that's roughly 6-7% of the overall FMCG sales in the country.
Yeah, I think quick commerce is here to stay. The fact of the case is that customers want to buy, and when they decide to buy, they want it immediately. Also, not necessarily that in quick commerce, price is the big determinant. The main thing is that when customers want to buy something, they're getting it immediately. And that immediacy and convenience is the one that customers are willing to take. Most of the brands in the country have really realized that quick commerce is one more channel. They cannot keep away from it. And they're definitely trying to place their products and their brands into these quick commerce sites that we have in this country. It's good for customers. I don't think anybody can say that one channel or the other channel is the only preferred channel for customers. Depending upon what they want, when they want, and at what segment that they want an item for, customers keep shifting. Most of the retailers that we speak to are trying to also place their brands with quick commerce. So yeah, that's the way it is. The fact is that marketplaces, the quick commerce, as well as offline stores, have still got their allure as long as you are able to really make sure that you are aligned with the customers.
All right. We'll leave it there. Thank you very much, both of you gentlemen, for joining us. And it's always a pleasure speaking to you to get a sense of the consumer pulse at this point. 95 points on the Nifty, 23,960. So there is a bit of a up move which has taken place. We'll take a quick commercial break here. And we'll talk about a big deal in the e-mobility space, electric bus space. Nishant Arya of JBM Auto and Rakshit Kapoor of Motilal Oswal Alternates will be with us to talk about in what is being billed as, I guess, the largest or perhaps one of the larger deals in that space. Stay tuned, coming up. Welcome back. As I said, let's talk about the big deal in the e-mobility electric bus sort of segment, so to speak. Motilal Oswal Alternates, along with group entities, is investing 750 crores in JBM EcoLife, which is the electric bus platform of the JBM group. I have representatives from both JBM and Motilal Oswal with us to talk about this. Rakshit Kapoor is head of private credit at Motilal Oswal Alternates, and Nishant Arya, of course, is Vice Chairman and Managing Director at JBM Auto. Nishant and Rakshit, good to have you with us here. Thanks for joining in, and congratulations on this big deal. Nishant, talk to us a little bit about what you plan to do with this money. Will this go towards acquisition of new buses? This is growth capital, right?
Yeah, no, I think it's a great deal. We see it as a strategic partnership with Motilal Oswal, and will bring in very high growth for JBM EcoLife, which is a subsidiary of JBM Auto. And with this, we'll be deploying multiple buses. So like from about 3,300, 3,400 odd buses will go to more than 5,000 in the next 1 year. Also, this capital will be used for creating a depot infrastructure, a charging infrastructure, fleet acquisition, and launching large contracts, which we have won in PME Drive, in PME Bus Seva, as well as in other city and state level contracts across India.
So what is the capacity right now, Nishant, for e-buses at JBM EcoLife? 3,300. Oh, that is, yeah.
So JBM EcoLife is a mobility platform.
Okay.
So it provides mobility services to all our customers across the country.
Okay.
And JBM Electric is a separate entity which is into electric bus manufacturing.
Okay. And this money is going into the mobility platform, all of it?
Yes.
Right. And you will, so what's the business model like? I mean, states come out with these tenders, electric bus tenders. They will be, bus manufacturers will come and pitch and perhaps get the tender. Where does JBM EcoLife as a platform come in? I mean, how does it work? Just give us a sense.
So what happens is that there are long-term concessions which are there with the different states and cities and central government, where we bid from JBM EcoLife, and then we basically set up the whole infrastructure and the project and the operations for the longer term. And that is the JBM EcoLife mobility business as a mobility business. In electric bus business, we manufacture electric buses and lithium batteries, but we are one of the only fully integrated EV ecosystem play, where we are having our mobility business, electric bus technology, because we have the world's largest electric
Nishant,
bus
just one question. Will your customer be the government or will it be the private sector in JBM EcoLife?
EcoLife, it is primarily the government.
Okay. Now, in the case of Mumbai, for example, right, there is the BEST, right, which is the state bus operator, which is not in great condition. Maybe at some point we will see e-buses. So, typically, how does it operate? The government here will give JBM EcoLife the right to operate these buses as a whole package. Is that how it's working in other places?
So the government wants to deploy electric buses. So we are not involved in any new buses on diesel or in the prior older buses. So we are getting only involved in the electric buses, and the electric buses are getting deployed for different contracts. And these are new tenders which keep coming out.
Yeah, no, I get that. My only question was that will the BEST take buses, electric buses, and operate it themselves, or they'll ask you to operate this e-bus fleet? What is the model which most states are following?
Majority of the states and cities are asking us to operate on their behalf.
I see.
Yes.
I see. Got it. Fair enough. That's basic clarity for me, for myself, and I guess for viewers as well. Now, Rakshit, talk to us a bit about why this investment, and what's the trend is clear. There is more and more states which I guess will go for electrification. We've just seen what's happened in Delhi. Of course, perhaps the timelines being brought forward quickly, and we'll see what other states follow. So just talk to us a little bit about the idea here.
Sure, Prashant. Thanks for having me. So I think for us, I think within the private credit framework, I think we are looking at energy transition as one of the key sectors that we would sort of be deploying the capital. And I think within that framework, obviously, the electric buses segment fits in very well. And if you look at, I think, JBM Auto as a group, I think been present for almost 4 decades. I think from an auto ancillary to the capability of manufacturing the overall buses and maintaining the entire battery charging infrastructure. So, and I think they are some of the largest players and with the largest capacity that you have. Second, I think if you look at where the macro data is today, I think roughly about 20 to 21 million buses that you see on India today. And I think if you look at the electric buses, I think that probably would be mere about 20,000, not even that much maybe. So if you look at the runway that you have from the entire, growth in the sector is very high. Thirdly, I think the government push around the entire this theme is again is very encouraging, and I think you see more and more states coming out with bigger tenders in terms of reaching out to players like JBM to sort of operate these buses, and I think JBM is sort of well positioned to sort of capitalize on this opportunity in a big way.
So what is your team must have, of course, done extensive work. In terms of the CAGR growth here, in terms of electric buses, what are your expectations? Say, where we are now and where will we be, say, in the next 3, 4, 5 years?
So probably, I think, as I said, I think from where we have about 20,000 buses on electric vehicles today, I think we probably can see every year an addition of about 4,000 to 5,000 buses. And, so there aren't too many players currently, but I think as the sector grows, I think we'll sort of have some sort of more companies coming into the picture. But I think from a number, I think we clearly see that in next 3 to 4 years, I think it would have a CAGR of almost 50 to 75% year on year in the next 3 to 5 years.
Right. Nishant, this is this EcoLife is a subsidiary of JBM Auto?
Yeah.
Okay. So could you give us a sense of the numbers here? What EcoLife should be able to do if some of these projections are come true? What Rakshit is saying?
So here, basically, we are seeing that EcoLife would grow to about 2,500 crores in the next couple of years.
In how many years?
Next couple of years, so 2 to 3 years. Yeah.
Okay, so by FY28, you should be 2,500 crores in revenues.
By FY29, yeah.
Okay. And what kind of profits what are margins here at a net level?
So EBITDA levels, we are approximately around 45 to 50%.
45 to 50%. Got it. And with how much stake do you retain now in EcoLife post bringing in investors?
So we have equity and equity-like structures. So we'll be coming out with that soon. But definitely we hold a very significant majority stake in EcoLife.
Okay. Over 50%, basically, in EcoLife still?
Yes. Yeah, absolutely.
Well, what is the valuation at which you've raised this money? Can you give us a sense?
So the valuation will be playing out, with our deployments as we are going along here. So as I said, based on those valuations, the things will span out in the next year or so. So I think that would be fair to share that then, yeah.
Yeah, but you already raised this money and we're talking now. So the valuation, both you and Rakshit know. So could you give us a sense? What's the total valuation at which this money has been raised?
So if you look at EcoLife platform, I would say today has a valuation of more than $1 billion.
I see. So this 750 crores values the platform at $1 billion or so, the EcoLife business.
Yes.
Got it. Thank you very much, both of you, for joining us. Nishant, good luck. And Rakshit, thank you very much. for being here and talking to us as well. So that is the deal as far as the e-bus segment is concerned. But I think we've got more
more
electric
e-talks.
coming.
Venkesh Gulati, Chairperson, Automotive Skills Development Council and former President of FADA, and Shailendra Luthra, Executive Director, Bride Group and State Chairperson of Delhi, is now joining in to talk about the Delhi EV policy, which is a significant pivot towards EV, and some says it comes at the expense of ICE and hybrids, because there is now a hard stop on ICE. Three-wheeler sales no longer allowed from 1st of January 2027, and no ICE two-wheeler sales from 1st of April 2028, and hybrids have been excluded completely from the final notification compared to the draft norms. Mr. Gulati, if we may start the discussion with you, let's begin with your overall thoughts on the Delhi EV policy, and do you think this will serve as a template for other states? Will they follow?
So good morning. Thanks for having both of us here. So obviously, this is a phenomenal thing what has happened. One is now we have a clear path what Delhi is thinking, and as dealers, as OEMs, we can think of what to invest, how to plan future. And you are right, Delhi being the center, being the capital, if we are able to implement this well and the challenges what we are thinking today are overcome in a right way, this will become the policy for the nation. Because seeing the environment, seeing the pollution, this is the future where we can manage. No doubt there are a lot of, this will create a lot of disruptions and challenges, but I hope seeing the bigger picture, we'll all be able to manage this as it, because we still have time for three-wheelers around another 6 months and for two-wheelers around 1.5+ years. So we still have time to update ourselves and upgrade the infrastructure like charging infrastructure and all, and support the Delhi government in achieving this success for the policy what they have launched.
Why do you think, sir, hybrids have been excluded? Globally, hybrids are taking a lead compared to EVs. I mean, they are finding traction, but there are no incentives in this policy for hybrids when it was there in the earlier draft policy. Why do you think, the government has taken such a hard stance?
So actually, hybrid is a better version of ICE engine. It's actually an ICE engine, which is supported by EV battery. Wherever if you are driving slow, the vehicle shifts to electric vehicles or battery towards, which in turn still pollutes. No doubt it's better than what ICE are. So if we want to really talk about net zero, if we really want to talk about wiping out environment, whatever comes from vehicle pollution, EVs are the best. No doubt there'll be a lot of people who will be talking that you should talk about cradle to grave. But at least for places like Delhi, this is the only best option which we can do, because for the past so many years we are talking of pollution, and the winter season normally is very difficult for Delhi people to live also or breathe. So hybrids do help, but it doesn't help to the level of EV today. So I feel this is the right decision what government has taken.
All right, let's go across to Shailendra as well. Shailendra, I just wanted to understand what proportion of vehicles plying on Delhi roads actually are registered in Delhi? Because, large part of them actually do come from Gurugram and Noida as well, which are neighboring states. So, how effective will this be?
Well, first of all, good morning to you and all the viewers of your channel. And thank you for this interesting question. You do not have to see Delhi as a whole. So when we talk about Gurgaon or Noida vehicles or Ghaziabad or Faridabad or Meerut vehicles coming to Delhi, there's a large portion of Delhi vehicles also which move across. The point is that, I'll just give you a small stats. In a month, every month Delhi retails 50,000 two-wheelers. All these 50,000 two-wheelers monthly are registered in Delhi. And around 5,000 three-wheelers are registered in Delhi. This is over and above the vehicles which are registered. So, since we have open borders, we believe that 100% of Delhi vehicles should be plying in Delhi. And Delhi is one of the biggest automotive markets in the entire country. And we see lakhs and lakhs of registrations every year in Delhi.
And if other states, the ones that we speak about, don't follow suit, then does that mean the sales from Delhi actually go to others, which is actually negative for Delhi dealers?
Well, we are of the opinion that this is the first starting point, because a start has to be made from one place. And obviously, this will be implemented, followed by various states in the country. Why only Delhi? Pollution is a problem which is all over the country. Import of petrol is a problem which is all over the country. And since Delhi is starting, NCR has a character where the neighboring towns, what you have just spoken about, whether it's Gurgaon or Noida, fall into the other states' prerogative. It falls into the geographical area of other states. But I'm damn sure that the day is not far that we would see a centralized policy. But a beginning has to be made, and Delhi has made a rightful beginning. We all know what happens in winters, and like Mr. Gulati said, that such policies, such incentives were the need of the hour, and it has come rightly at the right time. If you see the government investment, you have flashed it 15,000 crores. We have 7,000 crores, a direct transfer. It's a big number. It's a big boost.
Yeah, no, absolutely. Gentlemen, morning. Vinkesh, same question to you. Do you have a sense others will follow? Because they must follow, right? Because otherwise, I mean, the policy is ineffective.
Mr. NG is right, others will surely follow. But one thing I want to add, if you really see today what is happening, we pay 1% green cess on the vehicles which are sold above 2,000 vehicle, 2,000 cc and diesel vehicle. And that's a policy which is implemented in NCR, not only NCT or Delhi. So, and it has been implemented for the past, what, around 7-8 years or 10 years since NGT came in. No doubt it's today CAQF. So I feel this is the start. The day now actually policy is on, the day if this implementation is actually on stage, slowly and steadily, NCR will come. That is 100% sure, because Delhi alone can't improve, and practically Delhi alone is not a place where pollution is a problem. We have seen Noida, Ghaziabad, even neighboring states of Haryana, cities of Haryana getting affected. So everybody will have to come together and implement it. And as it has been before, where we are talking about green cells, this will surely be implemented, maybe in a phased manner. And one thing more, we are lucky that the central government is covering everything which is bordering Delhi, which means Rajasthan, Haryana, and UP, all are NDA states. So I feel this will be a cakewalk if they have that focus on getting it corrected.
Yeah. Well, we'll see. And that hybrid question, we could go on. I had a few more points, but we're out of time. So we maybe another time. Thank you very much for joining us, both of you, for being here. Vinkesh Gulati and Shailendra Luthra. Thank you very much. We'll, I think, take a quick break here. Markets, I think, are up 100 points, which is, of course, a vast improvement from the time that we started. It was kind of looking flattish, just slightly higher, but we picked up pace. Market breadth has also improved quite a bit, almost 2:1 now. If you look at everything which is trading on the NSE, which I think is pretty solid. We'll come back with Manisha on the other side. Commodities in focus once again. Stay tuned.
Everyone, some stocks doing extremely well right now. As the market's at the high point of trade, closing in on that 24,000 mark for the frontline index. REITs is up nearly 11%. Latravenues Tech, which is Ixigo, up 7%. And we are seeing serious traction on Z as well, up around 5.5% as the FIFA World Cup gets a little more interesting. Looking at the BSE data right now, and this is ahead of the BSE expiry tomorrow. The Sensex is holding well, closer to 77,800 thereabouts, 76,800 thereabouts. And it's been led by both the auto index as well as the FMCG index in absence of big support coming in from the banking and IT pack as well. If you look at the technical levels, the 50-day moving average, 76,165 is what it's crossed today. And now 600 points from here, 700 points from here is the 100-day moving average. So we'll monitor that level fairly closely. As we move into expiry tomorrow, we have the 76,700 call, which is extremely active, has a premium of 400 rupees, telling you closer to 77,100 thereabouts is where resistance is. 77,000 call has the maximum open interest. So crossing past that 77,500 mark would be extremely crucial ahead of expiry tomorrow. Bulls believe that that's the level at which we will see some supply. So bears are holding on to those levels. And 76,500 put is extremely active, which tells you that around 76,150 thereabouts, which is also the 50-day moving average, is where the support lies. So that's the way the situation is positioned. So as far as the Sensex is concerned, ahead of expiry tomorrow, the BSE expiry tomorrow. But that's all about the equity space. Let's go across to Manisha, who joins in with a focus on the commodity space. Manisha.
Well, thank you so much for that. I'm looking at the gold prices today because we've seen a very sharp decline continuing on to this one. We are trading below 200 and 100 days moving average as well when it comes to the gold prices. And the pressure comes in because of the strength in US dollar index. So when you look at the US data, that has come in on the positive side as well. The US jobs opening have been much on the stronger side at a 2-year highs, by the way. And then the markets are now waiting for the US non-farm payroll data. The US may hike interest rates at least once in this year. It also seems to be weighing onto the markets, and that perhaps has been baked in already. So sharp declines coming in for the Asian markets as well right now, whether it's about gold or silver prices. But I'm focusing more on gold because we're trading below $4,000 an ounce right now. It's a near 8-month lows. For the month of June, we've seen the prices decline by 11.5%. For the quarter, it's the lowest or the weakest quarter that we've seen in 13 years. And we have seen the prices decline by 13% in the June quarter for the gold prices. And the prices, by the way, have turned negative now for 2026, down 7.5%. If you look at the last 12 months, we still are trading in the positive, but a very small positive from where we started this year. So just about 18.5% higher in last 12 months. The next chart shows you on what we've done in sense of gold prices in last many years in sense of gains and losses. And as you can see, in the last 5 years, this year perhaps is the one that we are trading in the negative. Last year, of course, was a great one. We saw all-time highs in the month of Jan as well. But from there, it continues to decline. And 7.5% of a cut is what the gold prices are putting in, at least till time in 2026. I also want to take you through a picture on what the gold imports into Indian markets have been. January was a very strong number. It was an all-time high. The ETF inflows were at record highs as well. And we saw nearly 100 tons of gold import in the month of January. Since then, it has been a constant decline. It was in the month of April that we also saw that increase in import duty, and that has led to a very sharp decline on what we are dealing with in sense of May as well. But if you look at the first half of this year as compared to last year, the imports are still 50% higher. So that's the kind of consumption that India continues to see in sense of gold. And finally, take a look at what the markets are now saying about gold prices going forward. And there is a revision on the lower side coming in from various banks and brokerages. You have JP Morgan talking about 5,200 by the end of this year. Goldman Sachs has revised its gold forecast to $4,900 an ounce. ING much lower at 4,600. And that's exactly what we're looking at, various other banks at it. Citi most bearish at 4,000, Deutsche Bank 4,300, and you have Morgan Stanley talking about 4,800. Most of these banks, by the way, were talking about 5,600 coming back, $6,000 an ounce as well. But we are looking at a revision on the lower side.
Thank you, Manisha. For that, we will get into a break. On the other side, Lata will discuss the impact of the 42% monsoon shortfall in the month of June with the economists Sonal Verma and Pranjal Bhandari. Stay tuned.
Welcome to It's the Economy. Even as the problem of crude price ebbs, the worry of deficit monsoon is rising. Today we discuss two interesting reports on the deficit monsoon. Sonal Verma of Nomura has called her report Parched June, referring to the 42% deficit rains in that month, while Pranjal Bhandari of HSBC had titled it more picturesquely at Here Comes the Sun, Here Comes the Rain. To understand how the deficit monsoons can hurt and other issues as well, I have with me both these economists. Welcome, Sonal and Pranjal, to what should be a colourful discussion. Sonal, I didn't get your growth forecast. Because of the combination of crude fall and monsoon fall, where do you, how have you changed your GDP numbers?
Yeah, hi, Lata. I think on net, the growth projections as of now are broadly tracking as previously. So for FY27, we're expecting a 6.6%. So the moderation in oil and other energy price definitely is going to ease some of the margin pressure going forward. So that is a positive for growth. On an annualized rate basis compared to our baseline, the lower energy prices should boost GDP growth by about 20 basis points or so. But on the other hand, as you said, the starting position on the monsoon has been very bad in June, and even July looks like it's going to be on the lower side. So the outlook on food production and therefore on agriculture output and rural consumption looks softer. And I think relative to our baseline, there is also a 20-30 basis point downside on that. So I think on net, the two essentially even out. What changes is sort of the composition of what drives growth. In the higher energy price scenario, the balance sheet pressure was being borne more by the manufacturing firms and by the government. In a weak monsoon scenario, it's going to be more the consumption side, particularly the rural consumption, which we think could soften.
Pranjal, your number actually upped to 6.3% growth. When you, both of you are living abroad, in India, it doesn't feel like a slowdown at all. The Jan, Feb, March is 7.7. And for the full year as well, it is 7.7%. Jan, Feb, March was 7.8. You have a 6.3% number. Really, it doesn't feel like a 1.5 percentage point weaker economy. Why do you feel things can be that bad?
Okay, thank you, Lata, for having me. I agree with you. I think some parts of the economy have been remarkably resilient, particularly manufacturing and exports. In both, we have benefited from front loading. I think what corporates did was as soon as they had access to any energy, they went ahead and they produced. And today we have seen huge stockpiling by corporates. Stock of finished goods are at a 1-decade high at this point of time. Similarly, once the tariff rates that US applied on India were cut from 50% to 10%, and fears that they may be raised back up with Section 301, that sort of window in which exports have really taken off. So manufacturing and exports have benefited a lot over the last couple of months. But there are some parts of the economy that are slower, and they have been slowing, particularly trade and transport services because of freight costs, and also construction activity because availability and price of industrial feed. So look, there are parts which are resilient, but parts that are slowing. My sense is that what we are going to see, perhaps not in the June quarter, but rather after that, is growth slowing on the back of El Nino. That is the growth shock that I'm talking about at this point of time. And, we all know about rains, but I'm more worried about temperatures. We have a lot of irrigation facility to take care of rain shortfall, but no magic wand for temperatures. Today, temperatures have crossed previous thresholds. They are not just impacting and disturbing fruits and vegetables, all of these sensitive crops, but a lot of the hardy crops like edible oils, pulses, rice, wheat, and also livestock, egg, meat, fish. So my worry is that that is going to weigh on growth, and we will see that in weak growth numbers, perhaps around the December quarter and in the March quarter. And that is the main reason why my GDP growth numbers are a bit low for the fiscal year. By the way, for fiscal year, I have 6.3%, but for calendar year, I have 6.8%. So you can imagine that a lot of the slowdown will be seen in the Jan to March quarter, where I think the Rabi crop will come under some stress.
Yeah, yes, the Rabi stress could be because the winter is expected to be shorter. I mean, I heard that fears yesterday when I spoke with Dr. Ramesh Chand and Harish Damodran. The bigger problem, perhaps, that we should discuss, especially because I have a bond market audience as well here, is inflation. What's your sense, Sonal? Do you feel compelled to increase your inflation forecast, considering that, as Pranjul said, edible oils, clearly, it's not just India, Malaysia, Indonesia, all of them are feeling the pinch of El Nino?
Lata, I mean, obviously there are many moving parts that drive inflation. So we do have upside potentially to monitor on food-related items. But we've also seen LPG prices, go down. ATF prices are moving down. So a lot of the energy complex, which had seen a run-up in prices, will also see a reversal going forward. So I think our inflation projection for FY27, which is around 5%, we are fairly comfortable on that. Two, I think, important issues here to discuss. One is the outlook on food inflation, and second, the extent to which this spills more broadly. So on food inflation, yes, it is likely to pick up. We're expecting on average around 6% in FY27, starting off on a low base. Production is likely to be negatively impacted on rice, pulses, oilseeds, and potentially also wheat. Now, rice, we do have some buffer, so that can potentially get managed, but we do anticipate a higher inflation trajectory in pulses, edible oil going forward. And as Pranjul was saying, the heat wave also means higher vegetable price inflation this fiscal year. So we are building in the higher food inflation trajectory in our base case. But I think the second issue of the extent of spillovers from there, we do think is going to be a lot more muted this time around. The broader macro conditions, even with the energy price shock, actually we were surprised despite this big spike in WPI inflation, the pass-through on the core CPI specific categories has been a fraction of what we had anticipated. So it does look like a lot of the companies have in mind the objective of keeping demand steady. So they are taking a bigger margin hit. So I do think that core inflationary pressures incrementally will be in check. And if weak monsoons weigh on rural consumption, then again, these spillovers outside food should be quite limited. So when you put the whole package together, you have higher food inflation, incrementally lower fuel-related energy costs, and core inflationary pressures, which I think should remain contained. So our projection of 5%, I think, takes that into account.
And rate hikes?
Not a macro environment for rate hikes. I think the oil prices coming down is definitely a big positive. If we don't see the food-related second round effects, that should also be a positive for the RBI. And I think the measures announced on the balance of payment front from government and the RBI will also swing the BOP from a deficit to a surplus. So the potential adverse impact on rural consumption is something which is going to also have some negative
no
impact
rate hikes,
on
you're saying?
So on net.
No rate hikes?
No, I don't think this is the macro environment for rate hikes. We have RBI on hold.
Okay. Pranjul, your report clearly says that there can be 2 hikes, which you call a shallow rate hiking cycle. But the bigger question for me is, which is what it is for viewers, will this have a big difference on the cost of capital for a borrower because of this FCNR inflow that we are seeing or that we will see? Do you think, in spite of a rate hike, banks or NBFCs or borrowers will have to pay more? It looks like yields are only headed lower.
Yeah, so look, I must say that I'm calling for a shallow rate hiking cycle simply because I think inflation will be close to the 6% upper bound for about 6 months in a row starting October. And that's too high a number for the RBI to ignore. And on the back of that, there will be some shallow rate hikes. Having said that, I also in my forecast have that in the second half of FY28, once, hopefully both the oil and food shock are behind us, we go back to being a 4% inflation economy. So on the back of that, shallow rate hikes. Now, my point is that all of this is already priced into the markets. Like the OIS curve is actually pricing in even more than 2 rate hikes at this point of time. So my sense is that even if we have rate hikes at this point of time, it won't be very disruptive. In fact, if anything, I think liquidity is on its way to easing once we start seeing all of these FCNR flows coming in. Also, when we start seeing government spending a lot more, my sense is liquidity at that point will only increase. So I don't think these rate hikes, these shallow rate hikes will be disruptive to, this sort of benign view I have that domestic liquidity conditions are really easing in India.
Okay. But very quickly, I mean, I didn't have time to discuss the rupee at all, but what's the margin you're working with, Sonal? Very briefly, please.
Margin on balance of payment?
No. Balance of pay. Okay, go ahead with balance of payments, but I meant the rupee range.
Right. So balance of payment, we're projecting a surplus of $15 billion, but if oil averages less than $80, then we think the BOP surplus this year will be over $40 billion US. So more than sufficient, and a lot of the inflows, of course, coming in the next 3 months itself. For the rupee, we have it largely stable. So we think the RBI will step in and build reserves as these inflows come through. So looking for rupee to be in this 93 to 94 half range.
Okay. Pranjal, same question to you.
Yeah, so we have a BOP surplus of $25 billion for this fiscal year, which is on the back of both a current account deficit, which probably won't look as large as we were worrying, just a month ago when oil prices had crossed $100 a barrel, and also inflows coming out of this entire FX package, which, there are a lot of moving parts, but we are sort of putting it close to about $65 billion. So that in itself gives us a BOP surplus of $25 billion, which is in line with the 10-year average of BOP and will provide some support to the INR. But remember that we always look at it as the dollar INR, right, against the dollar. And here we have a strengthening dollar view over the next couple of months. So from that perspective, our sense is that towards the end of the calendar year, November, December, we could see the currency in the 95 and a half range.
Oh. Okay. So it starts weakening later on. Thank you very much. I'm sorry, I'm trying to pack in a lot in just about 15 minutes. Thank you very much, Sonal and Pranjal, for giving us a way to parse the monsoon deficit and other factors. Wrap up on this edition of It's the Economy. Time for a break and then Chartbusters.
Indian market makes a strong start despite indications suggesting a weak open. The Nifty scales near that 24,000 mark, led by gains from the auto sector, FMCG sector. IT comes under pressure, while the broader market slightly underperforms.
KPIT Tech's management issues a warning for Q1 FY27, says it expects dollar revenue to decline by 1% as the outlook for European automakers deteriorates, with the second quarter likely to see a similar trend. Multiple brokerages also downgrade the stock, which is now down 15%.
Page Industries and Havells rally as Citi upgrades both to a buy rating, sees risk-reward turning favourable for Page Industries 3 years after a downgrade. Citi also sees the price correction in Havells an attractive entry point for the stock.
Jefferies initiates coverage on MCX with a buy rating and a target price of 3,600 rupees per share, expecting higher penetration in the commodities market. The stock rallies over 4%.
M&M, that's the top Nifty gainer after its sales in June beat estimates. Escorts Kubota also reports good growth, while EV registrations continue to show strength. That explains the up move that we've seen in Ola, Escorts and M&M. Ather, though, down 1.5%. It's a good day of trade. We kickstart July series. I'm Manglam Malu. With me is Vinny Motiwala. You're watching us here on Chartbusters. We come to you live from the CNBC TV 18 Motilal Oswal studio. The last 30 minutes of trade did belong to the auto space as well as the FMCG pack. But the last few minutes, we've seen a big spike in the banking index, and that's caused the Nifty to move closer to that 24,000 mark. So if you look at the auto space, that's been doing well from the word go. The FMCG pack has been doing well too. But look at the time from 10:15 or thereabouts. It's the Nifty Bank which has surged by about 0.5% after a quietish morning. And now that's led the Nifty to move higher as well. Closing in on that 24,000 mark. Can't say the same for the IT pack, which continues to reel under pressure.
Hi, Mangalam. Good morning. So, rightly mentioned, right, FMCG today doing well. We have the IT pack that's under pressure as well. And we have some listings that came in today as well, right? Cordelia, that listed at a discount today. So, muted listing that came in over here for the company. Now, apart from that, media is another sector that's managing to hold on to very strong gains in today's trading session. More than 3% gains over there. And in the broader end of the market, so what are the mid and small caps doing? They're performing relatively in tandem with the benchmark indices. 0.3% of gain for the Nifty mid-cap, as well as the small cap also is holding on to gains of around 0.4%. Advance decline ratio obviously is today a bit more in terms of the advances versus a decline. So July series, Mangalam, seems like we're starting on a good note at least.
Starting on a good note, a bunch of broader market names which are actually spiking. You spoke about the media space. Look at Z. That's up around 7%. That's the top contributor to the media index, and that explains why that index is outperforming today. Then in the consumer space as well, we have Go Fashion, which is up around 8.5%, Travenues Tech, which is up 7%, and we are seeing some traction in car trade as well, which is up around 5%. Good time to welcome Chandan Taparia for a quick technical check on the market. Chandan, May series and June series were pretty much range bound. We saw an 80-point decline in the May series, some 50 points decline in the June series as well. We're kickstarting July series with a lot of optimism. Do you think that optimism continues, and what's the next direction the market goes into?
Good morning, Manglam. Thanks for having me. So if I look at the price behavior of last two series, it was more of the range bound. In the last series, the Nifty remained in a range of 23,000 to 24,250. But the good part was the decline was being bought. If I look at the rollover, we have seen rollover of around 80% from June to July series. That is much higher than its last 3 months average of 74% and last month rollover of 70%. So rolls are better, and open interest addition was more than 25% with marginal or flattest market movement on close basis, which clearly indicates that accumulation is clearly visible in the market at lower levels. Now, if I talk about the seasonality point of view, historically in last 10 years, July month has potential to do well, and 80% track record of gaining in the month of July. So after the consolidation with better rollover data, support-based buying, all are indicating the bullish sentiment in the market along with decline in the VIX. So as of now, I believe with support of 23,700, 23,786, Nifty has potential to move towards 24,224 and then fresh attempt of rally towards 24,500 to 750. Now talking about Bank Nifty index, Bank Nifty outperformed the broader market, moved by more than 4.5% in the last series. Rollovers are better, around 77%, which is higher than last 3 months average. But open interest decline, which clearly indicates some short covering, and Bank Nifty is likely to outperform as well. till it holds above 57,250, it has potential to move towards 58,250 to 58,500. So in both the indices, looking for bullish stance after the range-bound bias and positive reload data, also indicating the start of the next momentum in the market as well.
Chandan, point taken there in terms of levels for Nifty as well as Bank Nifty. But any specific names that you're looking at as well in today's trade?
Yeah, so first I will buy on Medico. Nifty FMCG counter started to witness buying interest. Positive price pattern is clearly visible, and here I am suggesting to go long on Medico. We have seen a consolidation breakout of last 38 trading session with formation of bullish pole and flick, which is indicating further 5 to 10% upside in the counter. So one can buy with support of 840 for an upside target towards 855. Second trading idea, there is buy on Maruti. Nifty Auto has bottomed out after the consolidation of last couple of weeks, and we have seen support-based buying with surge in the open interest, with put writing indicating upside move in the counter. Most of the auto stocks are in momentum, and Maruti looks good. One can buy with support of 14,000 for an upside target towards 15,150. Last trading idea, there is buy on Adani Energy Solution. We are witnessing consolidation from last couple of weeks or couple of days, and now it seems that fresh leg of rally after the breakout could be seen, as rollovers data and the open interest data are indicating the bullish stance. So recommending to buy on Adani Energy Solution with a stop loss of 1590, and this counter can head towards 1590 to 1600, led by this short covering and the consolidation breakout.
All right, we take that point. Thanks a lot, Chandan, for that. The FMCG pack definitely doing extremely well. We are awaiting, Q1 updates from a lot of these companies over the next few days, and we'll, track how that pans out. The IT pack lower. What we'll do is take a short break, come back on the other side. We'll get the first management on our show. We have SIS joining in to discuss their buyback plans. More details on that and their business after this break.
Welcome back to Chartbusters on CNBC TV 18. Nifty is still around 23,980 levels. Wait out for where it's going to be in the second half of the trading session. A bit of a green on the screen today for the Nifty 50. But on that note, let's bring on the first management for today. We have SIS who's joining us right now. Why? They've announced a 120 crore rupee buyback. This is the fifth buyback since their listing in 2017. CEO Dheeraj Singh is now joining us to discuss the following 3 points. One, rationale behind the buyback, the outlook for their different segments and businesses, facility management business, as well as the opportunity that actually comes in for them because of the labour code reforms. What is the quantum of that benefit over there? We'll understand all of that with Mr. Singh. Mr. Singh, good morning. Thank you so much for joining us on the show. Let's start by talking about the buyback, right? This is the fifth buyback since you all have listed. 120 crores is the buyback that you all have proposed. Last year also, you all had a buyback of around 150 crores as well. What is the reason for the buyback? Any specific thing? Given that you could focus also in terms for growth, M&As, is that not something that you all are looking at? What are the specific outlook here?
We continuously look at a combination of retiring our debt, rewarding our shareholders, as well as funding our future growth. And if you see in the last year also, we've done all of that. We've reduced our debt. We have returned about 250 crores via buybacks and dividends to shareholders. And we've invested in acquisitions for APS. We've given out more than 70 crores, as well as made some other investments. So we believe as long as our operating cash flow and free cash flow is strong, which it is. Last year, we had an operating cash flow to net debt ratio of 1.07. And our free cash flow is about 600 crores. So it's a strong cash generating business that does not require too much capital to run the day-to-day business, which is funded by the normal debt and which is more tax efficient for our shareholders. So we believe that we will continue to have an optimal combination of returning wealth to our shareholders.
All right, we get that. I reckon this is a market-wide, market route buyback, right?
This will be, the promoters won't be participating, but yes, it will be offered to all other shareholders.
All right, so it's a buyback via tender route and the promoters will not be participating in this. That's good to know because this opens, the returns window for all the others who are there as well.
Also a sign of confidence.
Exactly.
Correct.
No, we take that point. On the business itself, you've guided for 15 to 20% growth continuing into FY27. If you could give us a sense on whether that continues. We're speaking at the end of the first quarter. And at the same time, all three segments, how do they pan out over this year?
This is a very important year where the tectonic shift of the labor reforms are getting implemented. And any such reform of this scale does take time. So we believe it will be a process of over 6 to 8 months' time. We are leading that in the market. We believe it is a great opportunity for our workers as well as for the client side. But in spite of that, we maintain our growth guidance of 15 to 20% for this year. We are well on track for that. And I don't see any reason for not delivering that.
Well on track for that. You've spoken about the opportunity. What is the possible opportunity size? If you could quantify in terms of that as well. Last time also we spoke, you said that, labor code reforms would be a huge opportunity, especially for that unorganized sector. Anything on the quantitative front that we should watch out for in terms of FY27?
The impact will be in two ways. One is the overall macro impact. When the shift happens from the unorganized to the organized sector, it is natural because the clients will not want to take the risk of being non-compliant because they're equally liable now as per the new definition, new codes. And it will be a big risk if they go with the smaller players who are taking shortcuts for compliance. So that shift will happen over the year. And the impact of that will be felt more in the medium term. For the short term, there are impacts that we are seeing on the minimum wage revisions, as well as on other provisions like the gratuity, where we are recovering more from the clients. And it will build up during the year. And I said over the 1 or 2 years period, it will stabilize more so.
So also in terms of the margins for the company as well, overall, when you talk about the facility management margins also, you've spoken about it, reaching 6% in FY27. That's a 50 basis point increase versus Q4 FY26 that we saw. What are the factors that will work out for facility management? And as a share in terms of your overall performance also, how do you see facility management business growing?
Facility management business, the margins has been a very strong turnaround story over the past 1.5 to 2 years time. We've seen a 20 basis points increase in the margin percentage quarter on quarter. And we expect that trend to continue over this year and finally stabilize at around the 6% guidance that you also mentioned. So 6% margin is what we are aspiring in the facility management business, largely driven by the operating leverage. The business has still to achieve the optimal level for the growth as a security business. But the operating leverage as well as the new solutions that we are offering and the SG&A focus, all three combined have yielded the growth in the margin percentage and will continue. There's enough buffer or room for the next 3-4 quarters for that.
So 6% is peak, or do you expect further headroom here as well? Because this is such a competitive industry, right?
The good part of this industry is that you can outsource every other service that is non-core to the client. And that can offer some very interesting opportunities with very high EBITDA potential that can be accretive to this segment. And we are continually exploring that both on an incubating basis as well as acquisition.
Okay. So what's the upside potential for margins here in a business like this? Because on the one hand, you can optimize it. On the other, you can increase your ancillary services for clients to pay a little more. But as you do that, competitors realize those services as well. So net, it is an industry where margins find themselves, right? So in the very near term, what's the upside potential?
For the facility management, we continue to maintain at the 6%, but there is a potential for 0.5% more, both on the organic existing basis as well as some of the opportunistic inorganic opportunities that we are looking at.
Okay, Mr. Singh, thank you so much for joining us this morning, helping us understand the buyback, the thought behind that, as well as in terms of your overall business outlook going forward. Thanks so much for joining in. But on that note, we're going to slip into a very short break. After the break, we'll come back and focus more on markets, more on stock-specific actions. Stay tuned in.
But among the top gaining index today is the auto pack, and that is on account of good data coming in for the month of June. We have M&M, which has reported its numbers, which is fairly strong. That reflects in the stock price. Street is anticipating decent numbers, I guess, from Maruti and the others as well, because that's what the stock price is so suggesting. So for a roundup of what's come so far and what the overall expectations are, Sudarshan joins in with that data. Sudarshan.
So M&M has started the numbers for the month of June 2026 and it has released the numbers for both auto and tractor segment, and overall sales have come in largely better than expectations. So talking about the auto SUV, continues to see a healthy growth. Even in the month of June, the growth was around 28%. What is surprised in the auto segment was the LCV that has seen growth of more than 30%, and in resultant, total sales have come in at 1.06 lakh units versus our expectation of around 96,400 units. Talking about the tractor segment, growth has come in at 12%. Our expectation was in the range of 7 to 8%, and company has gone ahead and said that it's early to assess the full impact of emerging El Nino conditions. But if the monsoon situation improves, I won't be surprised if M&M goes ahead and meets the estimates that it has given for the tractor segment growth. Next one, another tractor company, Escorts Kubota, has released the numbers for the month of June, and that too has seen a healthy growth of 19%. Total sales have come in at around 13,700 units versus 11,500 units in the same period last year. Now coming to electric two-wheelers, two companies, Ather Energy and Ola Electric. You can see the registration numbers from Vahan website. It was another strong month for Ather Energy. It has seen a growth of almost more than 90%. Sales have almost doubled YOY, and now its market share has increased to more than 16%, and the company retains number 3 player as far as the market share is concerned. Ola Electric, on month-on-month basis, company continues to see a growth for the 4th straight month, and the total registrations have been higher, or more than 16,000 units. But YOY, company continues to see a decline, but it has managed to meet the estimates that it had given for Q1. Q1 estimate that company had given was in the range of 40 to 45,000 units, and now it has achieved more than 43,000 units. So whichever companies have reported numbers so far are looking slightly better than expectations.
Okay, looking slightly better than expectations as of now, the companies that have reported their auto sales numbers. Thanks so much for that, Sudarshan. But on that note, let's shift focus and talk about a special segment where we get you a few ideas of profit from Money Control Pro. Khushbu Rai is joining us of moneycontrol.com and talking to us about the stock that she's been tracking closely. Khushbu?
In today's idea for profit, we have Nestle India. Nestle is a major beneficiary of the GST-driven consumption recovery. We think that resilient rural demand supported by rising penetration is also driving higher growth for the company. Going forward, the outperformance of the food and beverage category will continue to favor discretionary players such as Nestle, with formidable brands including Maggi, KitKat, Nescafe and Cerelac. Moreover, Nestle's strategic innovation and strong brand recall positions it to benefit from the recovery in the urban demand. In terms of raw material prices, while coffee and sugar costs are easing, the milk prices are expected to continue to remain at elevated levels, while edible oil and wheat will also trade at higher levels, leading to margin pressure in the near term. The stock continues to trade at a significant premium to the peer group, and we feel that the higher valuation could sustain, supported by consumption tailwinds and rising market share backed by expanding rural footprints and urban demand recovery.
All right, Khushbu, thanks a lot for that. That's about Nestle. A good day for all the FMCG stocks. As we take your leave on this edition of Chartbusters, we leave the market perilously close to that 24,000 mark on the Nifty, and the midcap index a shade better with 62,000 on that. From Vinny, me, thank you for watching. Trading Hour comes up next.
Good morning. It's time for Trading Hour. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Hormuz Fatakia. Joining me as always is Ritu Singh. It's a strong start to the July series for the markets, at least as of now. In the first couple of hours, it's a 100-point move on the Nifty today. 120 points are marginally off the highs of the day, but still holding out around that 24,000 mark as well. Business updates have started to come in thick and fast as soon as the quarter has come to an end. We have started off the new quarter, and of course, we are on the cusp of yet another earnings season as well. Flashes from Coal India at the bottom of your screens. Coal production down 0.6%. Offtake, though, is up 7.5% in the month of June. So, at least on the offtake front, it's a positive update that has come in from Coal India, although production has remained sluggish. But then that's a trend for Coal India. Production in the first half generally remains on the sluggish side and then picks up in the second half. But of course, for the markets, the banking stocks, the broader markets, they are all doing well today. The broader markets were outperformers yesterday. They are doing well today as well. But Ritu, yet another day where the markets have started off on a positive footing. But the question is, will this last as we go into the close of trade?
Absolutely, Hormaz, and good morning to you. But we continue to remain in this very narrow range. But actually, pull up the volatility index. I mean, if you had that up on the screen, you'll see it's actually at one of the lowest levels we've seen in a few weeks. So at least that's one positive trigger to start with. There you go. It's down at about 13.5%. That's where the volatility index is. Look at the advanced decline ratio. That also shows you how the breadth of the market is shaping up today. Whatever the frontline index may be showing, you have almost double the number of stocks that are advancing versus the number of stocks that are declining on the National Stock Exchange. The broader markets, you said, yeah, they're holding up well, trading with gains of about 3 to 4/10% each. The Bank Nifty is also up, but remains below that 58,000 mark we saw last week. The IT pack now, that's one that's dragging the markets lower, and we know who to blame. I mean, the KPIT profit warning, that's not going down too well for the entire pack, and that's why you have them looking down in trade today. What's doing well actually today pretty well is the media pack for some reason. Z, Network 18, yours truly, Tips, PVR, all of them perked up in trade today. But on the flip side, the metal pack, the pharma pack, and of course IT trading in the red. But as always, let's put the spotlight on the individual names in focus in trade today, and Hormaz has walked over to the wall to give us that list.
The index has started off well today, but again, the question is, will 24,000 be back on the screens? And if it does return on the screen, does supply return as well? Along with that, that has been the case. And every time the market has made a move towards the 100 DMA and then levels of around 24,200, 250, there has been supply that has come up, and then the markets have reversed back to the lower end of the trading range. Two determinants of that: the Nifty Bank started off slowly this morning, but picked up pace over the last few minutes. So now around about 250 points higher, heading back towards the 58,000 mark after managing to defend 57,500 yesterday on the downside. So that 1,000-point range still remains for the Nifty Bank, which is 57,500 and 58,500. But the positive side, though, has come from the FMCG index today, almost 2% higher in trade. Almost every other constituent on the index trading with gains. Cannot not talk about KPIT Tech. Of course, Rima will talk about that more in greater detail. But 15% lower on the stock, extending its losses. Not that it was not already down well over 60% from its record high levels. Add another 15% to that as well. And the impact of KPIT Tech sell-off has resulted in the damage to some other ER&D companies as well. Its peer companies. Look at Tata Elxsi. That's down for the third day running. Tata Tech is down for the fifth day running. And over this period, both these companies have cumulatively lost 6,000 crore rupees in market cap. We spoke about the FMCG companies. They're all doing well. Nestle, of course, it's an ICICI Securities note that has come in on the Maggi noodles, 3% higher on the stock. Dabur is doing well today, 4% on that one. Godrej Consumer is doing well, and HUL, that's contributing to the Nifty gains as well with a 2.5% up move. Look at the newsmakers today. Ritu highlighted that the media stocks are doing well. That is also courtesy Z Entertainment. Of course, that has a disproportionate weightage on the index. 5.5% higher on that stock ahead of its board meeting today to consider a fundraising proposal. Rights, after the order win, is up 12%. In fact, all the PSU railway names are doing very well for themselves in today's session. Look at Railtel as well. That also announced an order win. That's up 5%. And Mahindra, after the auto sales numbers reported earlier in the day, 2.5% higher on that stock as well. Plenty of brokerage notes came in earlier this morning. Of course, the HCLTech downgrade from JP Morgan, of course, was the highlight. But Jefferies initiating coverage on MCX was a positive. And that came in with a buy rating in 4.5% higher on this one. Page Industries, a positive note from Citi, and Havells too, getting a positive note from Citi this morning. Both of them trading with gains of around 3% each. And lastly, names at 52-week highs today. IKS, that's up 5.5%. Look at Triveni Engineering, that has now extended its gains, 7.5% higher on the stock. We spoke about the railway names, and Kernex Micro is not far behind, 6% higher on that one as well. That too is at a 52-week high, Ritu.
All right, Hormaz, thanks very much for taking us through that. But let's shift the focus back to the IT space we'd spoken about briefly. And by the way, my colleague Rima also points out, Infosys is back below 1,000 rupees, 999, almost like it's on sale. But, the reason the IT pack is down in trade today is KPIT. Now, shares of KPIT Tech have been in focus because the company has issued this profit warning for the June quarter and even extended it to the second quarter after that. And that weak outlook has prompted JP Morgan to downgrade the stock rating. Rima Tendulkar joins us for more on this one. Rima.
Thanks so much for that. So basically what KPIT Tech has done is they're saying in Q1, they're expecting the revenue growth to decline by 1% on a year-on-year basis. To put that in context, a brokerage like Motilal Oswal was anticipating a growth of 2%. So a growth of 2% year-on-year has become negative 1% on a year-on-year basis, according to the company. And JP Morgan says if you look at it on a quarter-on-quarter basis, we are looking at a drop of 4% in constant currency revenue terms. Now, what has changed for the company? Well, anyway, the company had said that H1 is going to get impacted because two of their large programs come to an end. But what's changed is the company says the performance has been impacted by a sudden drop in revenues over the last few weeks, and they attribute it to the recent profit warnings and a deteriorating outlook by the European auto companies. Particularly, I think it's the BMW profit warning, which was issued in June. Even JP Morgan says that BMW is one of the top clients for KPIT Technology. According to them, it contributes about 12% to their top line. And if you remember, in June, JP Morgan had cut their profit growth guidance, the profit margins, quite sharply. And I think that is the big change that's taking place. And what's also very disappointing is that the company is now saying Q2 will be similar to Q1 in the same range, which basically means that we're not seeing too much of a recovery. And KPIT Tech has anyway gone through a period of slowdown. The growth rates have been coming down for close to about 18 months. But when we spoke to them in April, the company sort of indicated that maybe FY26 would be a trough and things will start picking up in FY27. The outlook, they said, was promising for FY27, but that doesn't seem to have played out. Now, what's the way forward? As I said, because the company has been slowing down, the stock is corrected. It's fallen close to 65-70% from its all-time high levels. But it's currently trading at, it was trading at about 20 times forward multiple as of yesterday's closing level. And JP Morgan today, when it downgrades the stock, is further lowering the target multiple to 17 times, and they've downgraded it to an underperform rating. So disappointing news. Q1 is going to be much lower than the expectation. No recovery in sight, even for Q2, and the stock is taking a beating.
Taking a beating, and how? Rima, thank you for that. So continuing to remain 15% lower is KPIT Technologies. No respite whatsoever, even at lower levels. But we were highlighting a couple of these brokerage names just a few minutes back. Havells, Page Industries, Titan, and that were always part of the standout brokerage note that Nimesh highlighted just before market open. It's a positive note coming in from Citi, and he's back with more details on that. Nimesh.
Hi, Urmas. It's turning out to be a consumer day, right? The FMCG index is up 2%, and a lot of these consumer names are buzzing in trade. Some interesting upgrades coming in from Citigroup on some of those consumer stocks. The first is Havells. Citi has to upgrade the stock to a buy from hold and a buy from neutral, and they have a target price of 1,500. They believe that after the recent stock correction, it is at a favorable entry point into a very high quality electrical and consumer business. The only near-term monitorable would be the margin weakness in Lloyd, the Lloyd business. So that is something to track. But they expect a very strong earnings growth in FY27, largely led by strong growth in the cable and wire business, a steady recovery in the consumer business, and solar segment is expected to be the next growth driver for company going forward. Even the margins are going to improve in FY27 on the back of product mix and everything. So on back of all this, a big upgrade on Havells to a buy from neutral by Citigroup. Interestingly, Citi has also put out a note on Page Industries as well as in Titan. They've added a 90-day positive catalyst watch on both these names. On Page, it's a double upgrade from Citi, from a sell to a buy, and they've raised the target price on Page Industries to 47,700. Similarly, for Titan, it's an upgrade to a buy from neutral, and there they have a target price of 5,075. So largely the expectation is that Q1 is going to be quite strong for many of these consumer names, and hence Citi has upgraded some of those names, and you're seeing a big uptick on most of the consumer names with the FMCG index getting nearly 2%.
Yes, all of them. Nimesh, thanks very much. Page, Havells, all of them trading with gains of more than 3% as we speak. Let's slip into a short break on that note. But up next, as always, we'll get you all of the bond market action. And Manisha Gupta will be joining in when we return.
Welcome back. Shifting focus to the bond markets then. Manisha Gupta is here with all the latest updates. Manisha.
Well, thank you so much for that, Hormuz. If you look at the government bond yields, they have started July on a very steady note. The sentiment for government securities especially remains quite resilient as we see it there. The yields, remember, fell nearly 26 points in the month of June. This is the biggest decline that we have seen come in since July 2019. And for the quarter, it has been a 25 basis points of a decline, which is the biggest decline again since March quarter 2020 therein. The bonds did rally in the month of June after RBI measures to shore up capital inflows, the tax cuts and the new bonds, all of that boosted foreign interest as well. If you look at the Indian rupee as well, that strengthened 0.3% for the month of June and for the quarter as well. We're looking at first quarterly gain coming for the Indian currency since March 2025 therein. The foreign investors in the meanwhile, let me remind you, have invested a record $4.4 billion in the Indian bonds in the month of June. The 5 states, as expected yesterday, have collected nearly 136 billion of bond auctions, and traders at this point in time are pricing in nearly 67% of a probability of a rate hike coming in from the US Fed, and that is what the markets are taking quite cues from. Finally, private bond issuances, there are 4 of them coming in today as well. You have HDB Financial Services, which is looking to raise 14.5 billion. They are doing it via issuances of nearly bonds maturing on June 4th, 2029. And then you have NIF Infrastructure Finance Limited. They're also looking to raise 10.5 billion. They're doing it via 2 bonds, reissuances of that with different maturities therein. MBM FinServ should come in on your screens because they're also looking to raise nearly 300 million, and they're doing it via bonds maturing in 2028. And then you have Squadron Development, which is looking to raise around 250 million with bonds maturing in 2030 therein.
Manisha, thanks very much, as always, joining us here to bring us the updates from the bond market. Let's slip into a short break, but when we return, we're going to discuss Reserve Bank of India's new norms that kick in today with Dheeraj Velli of HDFC Securities and Abizar Divanji of Newswat Advisors. Stay tuned.
Well, the markets have taken a bit of a leg up now, 150 points higher on the index, back above the mark of 24,000. That's the big takeaway. And now, of course, the question being whether it sustains or not. But for now, it's good going for the index, and that has been led higher by the Nifty Bank, which has also taken a leg up and has moved at the highest towards the highest point of the day. 360 points higher now on the Nifty Bank, almost closing in on a 400-point up move and back towards the mark of 58,000 as well. So the market's at the day's high. It's a good start to the new quarter and to the new series as well. But the new RBI rules to raise funding costs for proprietary trading firms have come into effect today. The RBI now requires bank guarantees issued to firms trading in the capital markets to be fully backed by collateral with at least half in cash. Earlier today, Rajesh Bhayeti, the managing director at Cross Seas Capital Services, said that the new collateral rule is a death knell for prop trading. Listen into what he had to say.
It's very, very significant. I think it's the most significant death knell to the prop trading industry since the NSE came into existence. Just to give a background, these products by the banks have been in existence since the time NSE started. These products have had as low as an NPA in the system as anything else the banking sector has seen. And these products were not vended by the so-called cooperative banking sector credit move or a credit risk move by the RBI. This is an ambush to shutter down an industry that was really growing with the market. This hit is disproportional because it hits only the Indian prop houses. The foreign prop houses will get everything they will get from their banks overseas with no control of RBI. So they will continue to thrive at the cost of Indian firms. So we are not exporting our markets this time. We are exporting our income that will be converted into dollars and taken out of the country. So I think the Indian broking houses on the prop side and the Indian HFTs would have contributed at least 30 to 35% of the exchange turnovers, and I think 30 to 35% of that will be hit.
All right, let's get in more voices on that important regulatory change that kicks in effective today. And joining us now to decode the implications for brokers, banks and the markets overall with these rules coming into force is Dheeraj Relly, the MD and CEO of HDFC Securities, and Abhizar Devanji, founder of Neostrat Advisors, with us now. Gentlemen, thanks very much. Dheeraj, you just heard what Rajesh Baheti had to say. To begin with, to your mind, immediately, how does life change? And that 3-month reprieve window that RBI had given, the markets following the deferment of the circular, was that adequate time to prepare for, what changes from today?
So, Ritu, capital market intermediaries have been navigating slew of changes in last few years and navigated them well. This time, these changes are coming from a different regulator, RBI. RBI has issued a direction, at least a discussion paper first on the November 24th. Then the final direction came in February 2024. But they deferred the implementation to July 1st because there was a request from the capital market intermediaries to prepare in time. Let me just tell you this: these changes are on the funding to the capital market intermediaries. So banks have been funding capital market intermediaries. It's not that this is the first time they're going to start the funding to the capital market intermediaries. There were earlier funding as per their own credit assessment and as per their own exposure norms. There were no specific guidelines or directions from Reserve Bank of India. This time there are specific directions. That's where there have been some concerns. When we look at these guidelines, my take is that for the client-facing brokers, the impact is very minimal. It's only on the intraday requirements. Otherwise, it's more or less same what we have been witnessing in the past as well. When it comes to the prop brokers, yes, it has been harsh on them. It's been tough on them because they will have to now take bank guarantees, which will be fully secured. Earlier, they were paying 50% margin, and now it has to be fully secured. These guidelines are getting implemented from today, but it doesn't mean that all your existing bank guarantees will get positioned from today only. In fact, when they come for a rollover, that's when this additional 100% fully secured requirement will come in, not from effective from today. So there'll be no knee-jerk reaction. Whether capital market intermediaries are prepared or not prepared, I think 3 months was good enough period for them to look at their own business model and how they would want to focus on the business. And that's where I believe that they are may not be fully prepared, but reasonably prepared to deal with this thing, and they've been quite resilient. Prop traders contribute about 40% of the volume. Rajesh said 25-30%. My assessment is it's 40% of the volume. So to that extent, there could be concerns on the liquidity, there could be concerns on the volume, and also spreads may increase, particularly in the options. So that's where we'll see some concern. I can explain what are the changes if you want me to go and explain these changes to you.
Dheeraj, you can explain these changes briefly as well. But what I wanted to ask you is this a way of disincentivizing prop trading in any way? If that is the case, then what happens to this entire sector? Because Rajesh Baheti went on to the extent of saying it is a death knell for the entire segment. And since you mentioned, you also mentioned the fact that it will not be applicable right away on the onset. If you could explain that as well. When does this take effect? So if somebody has to take any collateral or something of that sort today, they would be having to pay as per the new regulations, right?
Yeah. So let me just tell you what exactly are the changes. Let's say a broker wants to set up an office premises, they can give that as a mortgage, office premises, and take 100% limit on that. That's not a problem. That funding can be done. They can also pledge their equities and take loan against equities. That is also available to them for all prop traders also. They can also go to the NBFCs and take loan against securities at terms. So that's also available to them. Now it comes to the bank guarantees. Brokers have been reaching out to the banks to take the bank guarantees to provide margins. When it comes to providing the bank guarantees for client trades, now you require a 50% margin and 25% out of that must be in cash. So to that extent, this is almost a current practice. Maybe in some cases, there could be a different arrangement with the banks because there were no standardization. But from here onwards, there is a standardization and this is what it will work. 50% margin, 25% of that must be in the cash and rest 25% can be any other collateral. Now, when it comes to the bank guarantee for proprietary trades, that's where it has to be fully secured. 50% must be in cash or FDs with the lending bank, and 50% has to be in cash equivalent, and Government of India securities. There is limited clarification on cash equivalent, but our understanding is it could be even Group 1 securities with the haircut of 40%. So to that extent, now if additional new bank guarantee is obtained by a proprietary trader or a broker, they will have to today provide 100% margin on the same. So that's where it kick starts today. But those bank guarantees, that's our ongoing bank guarantees, which will expire. Some will expire in end of July, some will expire in August, September. So that will continue. And that's where, because these bank guarantees are already issued and they are with the clearing corporations. So to that extent, I don't think so. There'll be they need to provide an additional margins on the same. When it comes to...
That's a very, Dheeraj, yeah, we got that. That's a very interesting contra view to what we earlier heard from Rajesh Baheti. But let me quickly bring in Abizar on this as well. Abizar, overall, your takeaway, I mean, earlier guests on the channel were saying this is not even a credit risk move. It's an ambush by RBI as far as prop traders are concerned. But what to your mind was the larger message or the thinking behind RBI coming out with something like this? I mean, is it just simply telling banks, go fund the real economy, not speculation?
First of all, I think RBI does not direct credit in any form, nor does it control security markets because SEBI does that. What RBI does or intends to do is to make sure that there are no bubbles forming in economies, which creates a systemic risk. That is fundamentally the reason behind any RBI regulation. I'm only talking from an RBI point of view. Now the issue here is that there has been a general narrative that domestic prop-ups have happened to Indian stocks, which has led to FII outflows. Correct? So RBI needs to make sure that the stocks are realistic enough in India. One, for the domestic investor who still continues to put in money in the market, and two, for the FIIs who are trying to make a buck in terms of saying, okay, if the markets are higher up and the exchange flows are able, let me sell and get out of this market. So to cover those things and to make sure that that does not result into a bubble, RBI has tried to tell and Dheeraj has rightly said, only on prop trading, to say that you please collateralize it with the level of capital that you have. And by capital that you have means have collateralized guarantees, 50% of which has to be cash. If you don't have it, then don't play in the market. Now, for example, if prop positions are being taken to be squared off within a period of time, I don't think that is actually a thumbs up to the markets in any form. The thumbs up from the market has to come from systemic long-term capital. For example, the SIPs and the regular investors. Prop trading is primarily a trading book which takes care of short-term advantages in prices. And I think the RBI wants to say that let that not happen in the market and let there be systemic investments. In any which way, I think I don't think a lot of money is taken up in prop, which is depriving industry of productive capital. So that is, I don't think, the intent of it.
But Abizar, to your mind, are there any unintended consequences of this? For instance, do the foreign brokerage houses benefits versus the Indian ones that will now have to comply with these rules and look for other sources of funding when they don't have the collateral?
Oh, I don't think there are unintended consequences. There are intended consequences. So I think that the intended consequence is to reduce those levels and make sure that realistic valuations stick in our markets and are not propped up by funding which otherwise comes from the banking system to create systemic risk. However, what one needs to understand, sorry, you took 1 second. What one needs to understand is that I don't think RBI intends to destroy markets. It just tends to channelize this capital adequacy.
Got that. Since we've run out of time, Dheeraj, very quickly, if you could quantify the impact of this on trading volumes, etc., what to your mind immediately will happen?
It will have an impact on the option volume to the extent of 10 to 15%, but not immediately knee-jerk reaction. But that's well factored in. And my take is that the prop brokers will be able to find a way to navigate this as well. We've been navigating many changes. I don't see a significant problem with this. Earlier, it was not so well structured and defined by RBI. Now they have defined it. And as it will get implemented, we'll get a lot more clarifications also. It's not that it's sealed completely. If there is a requirement, one can really approach to the Reserve Bank of India through SEBI or otherwise, and also seek some more clarifications around these things. Little bit impact will come on the intraday limit side for both client-facing brokers as well as prop brokers, which means that on an expiry day, you will see lesser volume, lesser volatility. So that's where we are in terms of funding for capital market intermediaries. It has also opened up options for funding the MTF, which was earlier not available. All of us have been borrowing only from the by issuing commercial papers. Now we have an option to borrow from the banks as well through by pledging the MTF receivables. Though it comes with the 50% cash margin and 50% collateral, so may not kickstart immediately. But my take is that this will become an alternate source of funding for the brokers to fund the MTF book.
Dheeraj, Abhisar, thank you for sparing time and joining us today on this very important subject with your views as well. Flashes at the bottom of your screens, the June GST collections up 14% on a year-on-year basis at 1.95 lakh crore. That's the other important macro data being reported today. Take a short break. On the other side, get you a chart check and some trading. Before we do that, Sachitanand Uttekar from Trade Bulls is joining in now for a chart check and some trading ideas as well. Sachitanand, good morning. Thank you for joining in. The Nifty is now back above the mark of 24,000, but yet again, it's been a similar story. Every time the index goes up, there is supply that is coming in, whether it be 24,050 or 24,150 or 24,200. What are the levels that you are watching now on the index and your trading ideas as well for the morning?
Good morning, Hormoz. Hormoz, I think that particular sequence may be breached in this particular series, and the way the data has been supporting this fact is 23,800 has acted as a very strong support. Even yesterday, we saw the Nifty sustaining above that particular level. And if you look at today's price action, it is also concealed within that particular range itself. So going forward, we are of the opinion that the market could see a breakout from its 3 weeks consolidation. We are expecting that there could be a trigger in today's session itself, 24,040. If this particular level is breached on closing basis, we may see a surge towards 24,300 zone, within a couple of days itself. So the bias when it comes for the Nifty remains positive. When it comes to momentum, I think we are at that particular juncture wherein some momentum can be expected. We have already seen a good consolidation here, especially if you look at the Nifty Bank data. It has been a very strong outperformer. The higher top, higher bottom sequence has been well maintained. Even yesterday, we saw it defending its 5-day exponential moving average support. And if you look at the overall cluster data, 57,500 looks like a decent support right now. On the higher side, it needs a breakout about 58,000. We are of the opinion, and this is what we have been communicating, that we see the Nifty Bank scaling eventually towards 60,300 kind of a zone. So I think it's a good time wherein some long positions can be created both on the indices. But when we look at Nifty itself, I think today's low has been defended well. So I think until unless the Nifty doesn't, drift below 23,940 on closing basis, the bias remains positive even from a momentum perspective, and we may see a surge towards 24,200, 24,440 kind of a cluster, during this particular week itself.
All right. And quickly, your top trading bets for the day as well?
Well, IndusInd Bank, I think, has given us very good breakout. What we are expecting here is a quick surge towards 988 levels, and hence we are recommending building fresh long positions in IndusInd Bank futures. The stop loss can be placed at around 938 on closing basis. The other stock on our radar has been TVS Motors. The consolidation is good. We are seeing a base getting formed at around 3,500. So fresh long positions can be committed here. Keeping a stop loss at 3,490 on closing basis, we can expect a surge towards 3,630.
Sachidanand, thank you for sparing time and joining us today, the views on the index and your trading ideas as well. But as we are back on 24,000 on the index, what are the FNO trends indicating at the start of the new series? Mangalam is at the FNO desk with the latest trends. Mangalam.
Well, July in the past has been a good series for the bulls. At least 8 out of 10 Julys have done well and big moves at least. The last one we saw a decline of almost 800 points. But this one, at least the start has been fairly sanguine and up around 100 points for the Nifty, 125 points to be precise, closer to 24,000. And we have the mid-cap and the small-cap indices also gaining almost largely in step with the frontline index as well. The good part is the sectoral breadth that we're seeing, across the board. Domestic-facing names doing extremely well. We have Nifty Bank, which is leading the way. We have, the auto index doing well and led by good fundamentals here as well. And the FMCG pack, hopes of better sales this time around the first quarter, pricing growth returning, and, the dissipation of war means that commodity inflation is also easing. So all these factors are doing well for a bunch of these names, and which is why, when the mood in the market is upbeat, we have platform companies do a lot better. So Eternal is among the top gainers, up around 2.5%. We're also seeing traction in names like Asian Paints and HUL, which have been erstwhile underperformers. The only important level to now track on the way up for the frontline index is the 100-day moving average, a mark that has been elusive for so long that, the index itself, the 100-day moving average itself, has come down from levels closer to 24,300 to around 24,131. And as this happens, the chances of it being crossed on the upside are a lot higher. The Nifty Bank, we've been making this point that so long as it holds the 200-day moving average, there's no problem. Today as well, the low was very close to the 200-day moving average. From there, we started seeing a recovery out there too. Today's up move has given bulls a lot of confidence to go ahead and ride the 23,900 put, telling you supports are fairly strong. 24,000 put writers are also equally active in today's trading session, and these are options that expire next Tuesday. So we have seen some 150 rupees sort of build up out there in the 24,000 put. Again, 23,850 to 23,800 is where the support is. On the way up, 24,000 call writers still aren't giving the fight up, despite the Nifty being close to the 24,000 mark. And out there, the impediment is the 24,131 mark, which is the 100-day moving average, and that's what explains the 170 rupees premium that we have on the 24,000 call. But a lot of stocks on our radar, a lot more stocks than just the index. So we have MCX, which is doing extremely well. A brokerage note has come by. Shorts caught on the wrong side. That stock up 5%. Fresh long seen on Dabur and Page Industries, both, from the consumption space, doing extremely well. And then we haven't even touched upon the weakness that we've seen in the IT pack so far. So look at KPIT, nearly 50-60% jump in open interest, all of them on the short side. So very important to track. And because of KPIT's performance, we have seen a rub-off, a negative rub-off on the names like Tata Elxsi as well as Coforge, both of them seeing fresh short addition.
Oh yes, Mangalam, thanks very much for bringing that setup for us. Slip into a short break, but up next we're going to discuss the market fundamentals with Anup Vijaykumar from Capital Mind AMC. Stay tuned.
Welcome back. Continuing our conversation on the markets, then Anup Vijaykumar from Capital Mind AMC is joining in now. Anup, good morning. Thank you for taking out time. You know, there has been no week, no day where we have not spoken about IT, and the latest that has come in from KPIT Tech does not present a pretty picture either. So what was already dicey has now become dicier. What do you do in a scenario like this? Do you have any exposure to this ER&D segment or any of the IT segment as a whole? Because companies start reporting results in just a week from now.
Yeah, so I mean, there's been, as you said, a lot of uncertainty around IT, which primarily first played out in the large cap space. And then now it's kind of just following on to the mid cap space. And given that these companies niche in their exposure and the kind of services that they offer, and their elevated valuations relative to the large caps, is where we are kind of seeing the impact of any kind of a negative guidance in terms of future revenue growth, earnings, and the specter of the impact of AI and all of this is obviously there. So the margin of safety for mid-cap IT, in my mind, was always narrower than large-cap IT, and therefore you're seeing a little more activity there now. To your point, we don't currently have significant exposure to IT, primarily because there is a fair bit of uncertainty as to happen over the next few quarters. From a valuation perspective, though, large cap IT looks reasonably attractive. That being said, it all comes down to how do they sort of manage this ongoing transition. One thing is for sure, that the next 5 years for Indian IT is going to look very different than the last 10. So it comes down to what is it that they do to kind of deal with the deflation that is going to inevitably arrive in some of their core businesses, which is primarily FTE-based billing, where productivity gains from AI will need to factor in, and clients are going to be asking for that kind of a reduction. So whether they're able to successfully pivot to kind of enabling AI for enterprise customers, which I still think is a significant opportunity, is where we're going to see how is it that they're going to be dealing with this disruption.
How are you placed in the auto space? I mean, we're going to be getting updates on their sales numbers by and by. M&M is one of the names that's doing well today on the back of that. Particularly, on the EV space, in light of, that Delhi EV policy that's being talked about. We don't know if it's going to be national, but where do you see pockets of value?
So auto, if you look at Q4 earnings were pretty decent. At the same time, we are mindful of the fact that the Q1 of this FY is going to be the first quarter where the full impact of the US-Iran war and related crude prices and all other inputs is probably going to show up in company earnings. So in our mind, the earnings growth for Q1 is likely going to be slowed given all the uncertainty that was there. Having said that, yes, some specific names are showing signs of decent performance in spite of that, but it's something probably to watch out for the next couple of quarters before taking a definite call on where value really lies.
Anup, there has been a lot of churn in the private financial space as well on the top managements and so on and so forth. The largest lender finally getting some clarity, a new chairman, a new CFO. Does the chatter now finally shift away from growth, from governance concerns, and finally move back to growth and in an environment like this? Private financials, NBFCs or PSU banks?
So private banks have been fairly anemic in terms of the kind of growth that they've delivered. We don't expect that to change significantly over the next few quarters. So we're more interested or excited about, I would say, the mid-cap private bank space, where they have kind of delivered significant growth in their loan books as well as in their NIMs, as well as the prospects going forward in our mind are probably better there, given that they've consistently traded at valuation discount to the private banks, the large private banks rather. So within that, I would say, we're fairly selective in what we consider to be attractive, but you're right. The focus has fully now finally shifts from just overall governance to business growth.
Anup, quickly, capital goods, industrials, names, they've been doing pretty well through this year, even through last year. What do you make of the valuations there? Any particular names you're more bullish on?
So I would call this market almost like a barbell market, where at the one end you have these mid and small caps that are trading at extreme valuations on the back of decent earnings growth, and then on the other hand you have a lot of large caps names which are beaten down in terms of their relative valuation to themselves over the last 5 or 10 years. So in that sense, we're mindful of the fact that anything to do with, let's say, power infrastructure or anything that is downstream of data center build out has been bid up quite significantly in the last month or so. The prospects are good, but then a lot of that upside has already been built into the valuation. So we'd be a little cautious in that space, although we do have some selected exposure to some of that. The large caps are where there is some valuation comfort in terms of even though they have, I would say, large single digit earnings growth, their valuations are fairly attractive compared to their own 5-year trends, and therefore, that's where some value is to be had. I'd just be mindful of the, like you said, the industrial manufacturing pack, where there is a fair bit of optimism already built in, which is not dissimilar to what's happening with the memory chip makers in the US, where I think the semiconductor index is up almost 80% over the last quarter. The last time that happened was sometime back in 2000, before the dot-com bust happened. So yes, there are, in my mind, signs of a little bit of exuberance in some pockets of the market. But having said that, there are also others seem to be largely ignored and therefore merit a closer look.
Anup, pleasure having you as always. Thank you so much for sparing time and joining us on the show. Looking forward to the next conversation. Just before we take that break, pull up Vedanta Oil and Gas. The stock's now out of the trade for trade segment, and the stock is now up 16% as we speak. So at the highest point of the day is Vedanta Oil and Gas, of course, one of the demerged entities of Vedanta that recently listed last month in the month of June. There you go, 17% higher now on Vedanta Oil and Gas. Take a short break, back with more on the other side.
Welcome back. Let's get you the highlights from RBI's financial stability report that flags quite a few red flags, but starting with the sharp rise that we've seen in gold loans, and it warns that this correction in gold prices can weaken the collateral value and therefore risk raising delinquencies for banks. It also says, for now, the loan to value ratios across lenders does provide a comfortable buffer. The other area of concern is retail and MSME exposures, which RBI says does require some close monitoring by lenders, and there could be some asset quality risk if the macro conditions weaken further. It adds that household debt at Indian households also has increased quite a bit, but it does remain low relative to peer emerging market economies, and that lends some comfort. Now, as far as the health of the banking system is concerned, they do seem to pass the RBI stress test. In fact, that stress test shows that even in the worst case scenario, banks will remain resilient. For instance, the total capital adequacy, which is at 17.5% as of now, in the baseline scenario slips to about 15.6%, and even in the worst case scenario at about 13%. Their bad loans, which is 1.8% currently, could go up to 1.9% in the baseline stress case and all the way to 4.1% in the adverse scenario. But no bank is going to breach the minimum capital requirement come what may. On NBFCs as well, it is a fit and proper check that's come in as well. For them also, bad loans may worsen, but as far as breaching the minimum capital requirement is concerned, there could be some stress there in the case of a very severe stress scenario. But we'll get into a short break for now. When we return, more on the macros. Welcome back. Let's get you all the macro signals for the markets, though. We're back above the 24,000 mark, barely there, just a few points off the day's high. The rupee is trading in a narrow range today. It opened slightly lower, about 94.68, and now you have it trading at about 94.73. Gains in the US dollar index, which is holding above 100, 101, and rising US Treasury yields. All of that is putting downward pressure on the rupee as well as the other Asian currencies as well. Now, as far as oil prices are concerned, you can see that, they've been edging higher. Markets are reacting to the heightened geopolitical uncertainty because of Iran's refusal to hold those direct peace talks with US envoys, as a result of which you're seeing it now at about $73 a barrel, but remains contained. It's not jumped up too much yet. The 10-year benchmark yields, meanwhile, they're trading at 6.74%, flattish compared to yesterday. Remember, the 10-year yield has seen its steepest monthly fall since July 2019. It was down about 26 basis points in June 2026 alone. So hopefully markets hold steady from here. But Hormaz, that's all the time we have.
Indeed, and it's been a good session for the market so far. The Nifty bulls fighting to hold that 24,000 mark. We move into the second half of the trading session. Ritu and I take your leave. Halftime report takes the action forward.
A cut in ATF prices and lowering of duties on export of diesel and ATF drives optimism about a return to normalcy. Realty and FMCG are big gainers, while pharma and metals are the big drags.
RBI imposes curbs on proprietary trades by stockbrokers from today by calling for 100% security for bank guarantees. Experts see this limiting leverage, hurting liquidity and giving an unfair advantage to foreign players.
M&M Pips estimates for June sales with strong PV and tractor offtake escorts Kubota to post healthy tractor numbers, while pure EV two-wheeler maker Ather sees a sharp jump in registrations. Even Ola Electric sees an uptick.
KPIT Technologies warns its Q1 revenue and profit will dip on weak outlook for European OEM customers. It, however, hopes for a revival in outsourcing as cost-cutting kicks in. Shares of the company and its peers take a dive. Hello and welcome to Halftime Report live from the CNBC TV 18 Motilal Oswal studio. I'm Ekta Batra and with me Sonal Bhutra. Well, it is turning out to be a session where we've managed to recoup back to around 24,000 for the Nifty. First day of a new series, we have the midcap index, which is managing to hold on with a gain of around 0.3%. But what stands out is the advanced decline ratio, which has been positive for the second day on a trot. So the advanced decline ratio, 2,400 stocks advancing to around 1,600 stocks declining at this point in time. Just watch out for a couple of these pharmaceutical stocks because that seems to be a theme which is playing out. A lot of them are just about close to their fresh 52-week highs. So Ajanta Pharma, JB Chemicals, Ipca Labs, Laurus Labs, all of them from different sectors within that space seem to be hovering at those levels. But nonetheless, it is turning out to be a steady session for the markets. The Bank Nifty doing quite well, up around 0.7% currently. Hi, Sonal.
Hey, Ekta, normalcy is the word, right? That's what we used in the headline as well. And who doesn't like normalcy? The markets for sure, because they are doing really well in trade today. The Bank Nifty is at the day's high. So is the Nifty. Those price cuts that have come by after a very difficult state on the supply side and demand side, largely on the supply side. We do have the FMCG pack, which is doing really well. So the top gainers on the Nifty as well are largely these FMCG names, be it Nestle, be it Asian Paints. There's HUL as well. M&M is the other stock that we are tracking, and we'll be speaking to the management in just a bit. But yes, a couple of names which are doing really well in trade. The broader market's also looking very strong. So let's tell you what we do have on the show today for you. M&M reported auto sales for the June, which was above estimates, and their total passenger vehicle sales rose 28% on a YY basis. The management will connect with us on the numbers and the demand outlook as well. Stay tuned for buzzing stocks and big movers in trade today. We'll talk about that. We'll also talk about the latest cryptocurrency trends with Chen of Yvonne Chen of Binance in our Crypto Corner segment.
Okay, so that's what we have lined up in the next 1 hour, 60 odd minutes on Halftime Report. Like we've been pointing out, the mid-cap index is a little bit subdued today. It's up around 0.4% as we speak. Even the small cap index, the Nifty small cap index, should come up for you. That too is just about holding with a gain of around 0.4% at this point in time. So overall, we have the Bank Nifty, which is up around 0.7%. A couple of the banks which are managing to hold up quite well within the banking space and within the Nifty space should come up for you. So IndusInd Bank, for example, is up around 2% odd. We have Axis, which is doing well as well, up around 2% odd currently for Axis Bank. Joining in the party are a couple of these FMCG stocks which have been doing extremely well in today's trading session. So that's a big theme which is playing out today. Eternal is your top gainer on the Nifty. It's up around 3.6%. Asian Paints, Nestle, both these stocks up anywhere between 2.5% to 3% odd.
Okay, all right. So that's all about some of the stocks which are on our radar. We'll keep discussing that. But before we do that, we have to talk about the auto sales, because the auto pack, the consumption pack, that continues to do well in trade today. The M&M June sales have come in above estimates. So let's get going with that conversations, because the stock is higher post-June numbers, but still down 15% from 2026. So this is our What's Trending segment, where we put the spotlight on the auto sector. The shares of M&M are higher after company released sales number for the month of June. Overall sales have come in better than expectations, with SUV reporting a growth of 28% and the commercial vehicles in focus as well. We are now joined by Nalini Kant Golaganta, who is the Chief Executive Officer, Automotive Division, Mahindra & Mahindra, to discuss the key takeaways. Nalini Kant, good afternoon. Thank you so much for joining us. We'll, of course, be discussing the three focal points: SUV growth trend and waiting period, EV monthly run rate, and commodity cost trends as well. The last time we spoke to you, we did understand that there is some issues on manpower and supply chain as well, which you expected to be okay by the end of June. What is the update right now? What's the demand looking like on ground?
Yeah, absolutely. Thank you for having me on the show. So the labor areas we talked about earlier, those have been largely solved by end of June. So we don't expect that to be an issue going forward for us as well at this point in time. Demand continues to be quite robust, and that kind of reflects in the numbers that we've had. 60,393 SUVs in the domestic business for us, which is 28% growth. So robust growth. And overall, we are quite enthused with what we have seen. The growth is broad-based across the portfolio. The growth is broad-based across rural and urban as well for us. So quite a good set of numbers in June.
Okay, quite a good set of numbers in June. But if you could just tell us about the supply chain issue. You had indicated that it would probably be resolved by the end of June. Are we completely on track when it comes to, say, any kind of glitches with regards to manpower, with regards to supply chain? And what is the rest of the year looking like for you all?
Yeah, no. Like I said, I think the supply chain issue specifically around labor is behind us at this point in time. Of course, as an industry, we all have significant growth coming in. So most of us are at close to capacity and working at very high capacity utilization levels. So that's something we'll have to work for, and we have new capacity getting added by end of this second quarter as well. So we're good there. For the overall year, we are targeting mid to high teens growth in the SUV business and double-digit growth on the CV business as well, our light commercial vehicle business. So that's in line with what we had originally projected for the year. And all the trends we are seeing give us confidence that we'll be able to hit these numbers.
Okay. You did mention CV, and that's something that I just wanted to touch upon. In the month of June, one of the things that did stand out was basically your LCV strength, or the strength that you saw within that particular segment. Can you just tell us what led to the growth that we saw in the LCV segment this time round, and what are you guiding for? What are the key growth drivers?
Yeah, absolutely. So this trend has actually started post-GST. And as you know, this LCV business and CV business in general is driven by the math itself, the economics of running it and getting the viability going for anybody who owns a CV vehicle. And GST added an impetus to that segment. And since then, we have had significant growth across the industry, especially for us as well. So it's a continuation of that trend in some form or shape. We, of course, see some movement within it based on the tonnage itself. 2 to 3.5 ton is doing extremely well, and that's where we see the growth coming in. And so far, what we have seen, the walk-ins, the inquiries, we expect this trend to continue at least well into festive.
Sorry, I didn't get that point. You expect this to continue for the rest of the year as well?
Till festive, I said.
Until festive. Okay, get that point. Your average EV sales per month, have you seen an increase on the back of major government push? We spoke about this EV policy by Delhi government. If it is extended to, more segments, do you think that is a big opportunity for the company?
Yeah, so I think there's 3 or 4 big trends in the EV segment, which is helping the overall industry. Firstly, EVs in category creation, in the sense that anytime a new product comes in, it adds new volumes to the industry, doesn't necessarily cannibalize the existing products in the market as well. So we see that happening when we put out our 9S. We were averaging around 4,000 vehicles per month before that. And with the 9S coming in, we are now close to 7,000. We've reached the 7,000 mark on a monthly basis, 2 months now. And we see that with every launch, this is driving more adoption. We are now well into 10% plus penetration for us. We have other players who are even higher to that extent. So I think the penetration is playing out as well. The policies certainly help. The central government policies have been very supportive for the industry. And now most of the state governments are starting to support this as well, with road tax benefits and a few other things coming in, depending on which state you're looking at. So the Delhi government policy is definitely a welcome step in that direction. And we see most of the state governments that we are talking to aligned with a similar set of policies being put out there as well.
Do you think 10,000 per month will happen sooner than you expect? Is it possible in this fiscal itself? Is that something that you're expecting in this fiscal? 10,000 EVs per month in this fiscal itself?
No, I mean, it all depends on when new products come in. Right now, we're projecting somewhere in the 7,000 to 8,000 range is what we're projecting on a monthly basis.
Okay. 7,000 to 8,000 EVs per month is what you're projecting, at least in this fiscal. But the other question which I really wanted to touch upon was any kind of price increase that you're talking about. You did take one earlier in the year. Commodity costs have softened in the past couple of weeks. How exactly are you placed in terms of the costing at this point in time? Do you need to take any kind of price hikes or maybe any kind of price cuts at this point in time?
Yeah, so while some of the commodity costs have come down, but a lot of the costs that we have seen build out in the last 6 months, we have passed some of it as an industry to customers, but we'll have to go take a price hike. We have seen some of the OEMs announce it as well, and we're looking at seriously taking a price hike in the next couple of weeks or so. This is something which is impending for us as well.
What is the extent of the price hike and by when?
It's something we will probably be rolling out in the next couple of weeks is what we're thinking about at this point in time. We've taken a look at it. It's not something we do. We look at the numbers very closely before we announce one, so we're looking at it closely. My expectation is we should be taking a price hike sometime in the July timeframe right now.
Okay, in the July timeframe itself. And what is the waiting period currently that you've been witnessing? Has it increased? What's the sense right now?
Yeah, so we are on average anywhere from 3 to 5 weeks is what we see. There could be 1 or 2 variants, odd variants, which might be higher than that, but we're largely where we want to be in the 3 to 5 week range. My sense is as we get closer to festive, it can tighten a little bit. But at this point in time, we have new capacity which is coming in right in time for festive as well. So we expect to be somewhere in 3 to 5 week range in waiting periods.
Okay. All right, we're going to leave it on that note. Thank you very much. Always a pleasure speaking with you. Thanks very much for joining in and speaking with us. So that's the management of the M&M Auto division talking about the June sales. They're possibly looking at a price hike in the next couple of days or maybe weeks. That's something to keep on your radar with regards to M&M. But just want to point out Dr. Reddy's is the other stock in focus. So maybe we can just pull that up. We do understand that Apotex has received approval for semaglutide in Canada. So that's maybe one of the reasons why you're seeing this little downtick come in. Remember that Apotex was expected to get approval, but nonetheless, now that it is going to enter the market, there is a negative downtick which Dr. Reddy's is seeing. Remember, they had received approval for semaglutide in Canada. It is expected to be a big opportunity for them. This took place a couple of months ago, and now there will be incremental competition which is coming in. So maybe that opportunity will be diluted. But nonetheless, we'll take a short break on that note. We'll get you more details with regards to Dr. Reddy's as well as other stocks. On the other side, in fact, we'll be focusing on our buzzing stocks and big movers in trade today. Stay tuned.
Welcome back. You're still tuned into Halftime Report. The broader markets continue to do well. A lot of stocks which are buzzing. So let's go across to Vivek. He's here to take us to the stocks that are moving around in trade. Vivek.
Well, thank you so much for that. Well, we've started off the fresh series on a good note. We've started seeing some quarterly updates trickling in, auto sales trickling in. So there's quite a lot of action as far as the broader end of the markets are concerned. In terms of individual stocks and sectors that we're tracking, the entire FMCG back, remember, cooling prices and inflation is cooling. That is something that's seen as quite positive for the entire margin territory for FMCG names. Most of the stocks today, look at God's Consumer, Nestle, Dabur, all of these stocks higher significantly in the session today. MCX is the other stock on the radar. Jefferies today has initiated coverage on the stock with a buy rating, surging higher, almost 4.5% higher for MCX. Havells, again, after a while, we've actually seen an upgrade coming in on the stock after the sharp underperformance CT seals that at current prices, it's quite attractive. Stock higher by almost 2.5%. Page Industries, again, City here has initiated a 90-day positive catalyst watch. That particular stock have almost 3.5%, and rights on the back of the order win cheer. This particular stock is the top NSE 500 gainer in the session today. On the other hand, quite a few laggards as well. Can't look beyond KPIT-Tech and the auto ER&D names. So KPIT-Tech, Tata Elxsi, Tata Tech, all of these stocks under significant pressure after the profit warning that came in. DMart, surprisingly compared to its peers that are doing quite well in the session today, one of the top underperformers today. Metal stocks under a bit of pressure. Nuvama has come out with talking about worries as far as pricing power is concerned. Most of the metal names are under a bit of pressure. And Apar Industries today, the top small cap laggard in the session.
Okay, all right. Thanks very much for that, Vivek. Maruti's shares should be on your screen. The units totally have come in with a growth of around 19% this time for the month of June. Exports up 13%, domestic PV up 24%, largely in line with what the street was anticipating. Maybe we'll get Sudarshan to give us more granular details on it. The stock holding up with a gain of around 1% at this point. But let's talk about KPIT-Tech. It is in focus after the company issued that profit warning for the month of for the June quarter. And the weak outlook has prompted JP Morgan to downgrade the stock as well. Reema's here with more details on this. Reema.
So basically what KPIT-Tech has done is they're saying in Q1, they're expecting the revenue growth to decline by 1% on a year-on-year basis. To put that in context, a brokerage like Motilal Oswal was anticipating a growth of 2%. So a growth of 2% year-on-year has become negative 1% on a year-on-year basis, according to the company. And JP Morgan says if you look at it on a quarter-on-quarter basis, we are looking at a drop of 4% in constant currency revenue terms. Now, what has changed for the company? Well, anyway, the company had said that H1 is going to get impacted because two of their large programs come to an end. But what's changed is the company says the performance has been impacted by a sudden drop in revenues over the last few weeks, and they attribute it to the recent profit warnings and a deteriorating outlook by the European auto companies. Particularly, I think it's the BMW profit warning, which was issued in June. Even JP Morgan says that BMW is one of the top clients for KPIT Technology. According to them, it contributes about 12% to their top line. And if you remember, in June, JP Morgan had cut their profit growth guidance, the profit margins, quite sharply. And I think that is the big change that's taking place. And what's also very disappointing is that the company is now saying Q2 will be similar to Q1 in the same range, which basically means that we're not seeing too much of a recovery. And KPIT-Tech has anyway gone through a period of slowdown. The growth rates have been coming down for close to about 18 months. But when we spoke to them in April, the company sort of indicated that maybe FY26 would be a trough and things will start picking up in FY27. The outlook, they said, was promising for FY27, but that doesn't seem to have played out. Now, what's the way forward? As I said, because the company has been slowing down, the stock is corrected. It's fallen close to 65-70% from its all-time high levels. But it's currently trading at, it was trading at about 20 times forward multiple as of yesterday's closing level. And JP Morgan today, when it downgrades the stock, is further lowering the target multiple to 17 times, and they've downgraded it to an underperform rating. So disappointing news. Q1 is going to be much lower than the expectation. No recovery in sight, even for Q2, and the stock is taking a beating.
Big beating, 16% lower on that particular stock. But let's get back to the auto sector. Maruti just reported their June numbers. Let's go across to Sudarshan. He'll tell us what he makes of this one. Sudarshan?
So Maruti's numbers have come in largely in line with expectations. What has worked for the companies, the entry-level segment numbers have almost doubled if you take a look out on YY basis. For this month, that is of June 2026, entry-level sales have come in more than 11,000 units versus around 6,004 units in the same period last year. And the reason might be that company had earlier announced the price increase, but for the entry-level segment, company had paused that they had announced that they would not be taking the price increase, considering the demand for the entry-level segment, and that might be supporting the entry-level segment. All the other segments on the domestic front has done well, and that's the reason the growth is almost 19%. Another drag that might be for Maruti is the export segment. While the domestic segment, the growth is 24%, export segment growth is just 13%. That's the reason numbers have come in just largely in line.
Okay, all right, that's on Maruti. But tell us, MCX, that is also buzzing in trade on the back of positive brokerage note from Jefferies. Tell us more.
So Jefferies today has come out with a note on MCX and initiating the coverage on the stock with a buy call and target price has been mentioned of rupees 3,600 per share. That implies an upside of almost 25% from current levels, and it believes that commodity market lags equities, and going forward there is a possibility of increase in the penetration, and one company or one stock that might benefit the most is MCX, and it forecast MCX revenue to grow at a 20% CAGR despite the elevated base that company has, and along with 260 basis points margin expansion, earnings CAGR Jefferies forecasting is of 22% till FY29, and because of that there's a sharp uptick in the stock price.
Okay, all right. Thanks very much for that, Sudarshan. So MCX as well as Maruti is what he's looking at. We'll take a short break on that note, but Jay Thakkar of ICICI Securities will join in with some trading calls. Stay tuned. Welcome back. Well, picking up slight bit of pace for the market, so above 24,000 as we speak. So 24,034 is currently where the Nifty is at, and courtesy the Bank Nifty, which is at the high point of the day. So the Bank Nifty itself is up around 0.8%. Let's get in a technical check then. We have Jay Thakkar joining in to discuss what he's strategizing this afternoon. Jay, hi, welcome to the show. Well, for the Nifty, holding above 24,000, doing well for the banks as well. What is your call today?
Hi, very good afternoon to you, Ekta and Sonal. Well, I would say that, see, as far as the Nifty is concerned, it has been, Ekta, I would say, pretty much trading within that range of, say, 24,200 on a closing basis to 23,800. I mean, that's been a 400 points sort of range on Nifty since past almost 2 weeks now. And I think that the probability of this range getting, or providing a breakout on the upside is higher because of the various factors which we generally look at is the India VIX, which has fallen significantly. The crude oil prices have fallen significantly. We haven't seen much of short covering happening by the FIs in the index futures, although most of this positive sentiment, I would say, globally or geopolitically, which has happened. Despite that, we haven't seen FI short figures actually falling below 1.5 lakh contracts. Otherwise, we would have seen that happening, and because of which I think, and that may be because of the selling pressure which we recently saw in Nifty IT, wherein the FIs have good positions or holdings, and as well as some profit booking coming in the Nifty Metal Index as well. But apart from these two, sectors, broader sector or broadly, if we see, overall markets have been trading quite positive. In fact, the overall breadth relatively, when we check in the month of March or something like that, is relatively better. So I think the upside breakout is or possibility of the same is higher. And Bank Nifty, which you were actually mentioning, is relatively trading quite stronger as that compared to 1 quarter behind. So things are positive. Once it breaks about 24,200, I think we will see that momentum getting built up till 24,600 and eventually 24,800, which are our medium-term targets. So Ekta, I have 2 buy recommendations. We have seen Nifty Realty Index doing significantly well. We have seen good long additions in the Nifty Realty names. So one of which is Oberoi Realty. I think one can buy at the current market price. It's trading around the levels of 1775, placing a stop loss below 1740. One can go long on Oberoi Realty for the short term target of 1850 to 1880. The second buy recommendation, which I have is from the FMCG names, which are also doing good, and Nestle, I think, has a very good breakout on the upside, and then Nestle from the current levels looks pretty attractive because we have seen good long additions here as well. So 1550 would be my target on Nestle. One can place a stop loss below 1400.
Okay, take that point. So those are 2 of your technical picks, but we do have some queries from our viewers which we would like you to answer. Jay, the first one is coming in from Rajesh Srivastav, who's writing to us from New Delhi, holds 400 shares of Ola Electric at 60 rupees a share. He wants to exit the stock and invest in some other profitable stock. If you look at it from a chart perspective, how does Ola Electric look? And if you have to suggest another stock where the viewer could make some profit, what would you suggest?
Sure, Sonal. See, Ola definitely has been a real underperformer, and there has been a good bounce back. We have seen it actually reversing back to its long-term moving averages, and that in fact helps someone to exit or make a exit and loss out here. The relatively better stocks within the same sector, which I would like to recommend from the 4-wheeler pack, I would say that Mahindra and Mahindra or Ashok Leyland, these could be the 2 stocks he can get into or switch within the same space. I think they are really likely to perform quite well. And if he wants to actually, switch into a 2-wheeler name itself, then it would be Hero MotoCorp, wherein in the past we have seen good long additions. Recent fall has been on account of profit booking, but overall medium to long-term positioning looks relatively better.
Okay, all right. We have one more query. Kamini Jain writes to us from Mumbai. She wants to know if she can buy Vedanta Aluminium for the short term. What's your call, Jay?
Well, see, overall, we have seen some profit booking coming in the aluminum prices as well internationally recently, and we have seen the DXY also moving higher, because of which in the very recent past we have seen the metal prices getting corrected, and generally that happens. It has a inverse correlation, but structurally, otherwise, we haven't seen much of the short build-up happening in the metal names. So I think that this dip should definitely be used as a buying opportunity. Vedanta, medium term to long term positioning as far as the derivatives data is concerned or the quantitative data is concerned looks relatively better. So I think 430-35 in the near term is a very critical support for it. Till those levels are held, the stock is should be traded as with a positive bias, and this dip should be utilized as a buying opportunity.
Okay, all right, take that point. That is about Vedanta Aluminium. But we do have actually one more query for you. Yukti Sharma is writing to us from Pune, holds 250 shares of Delivery at 256 rupees a share. Wants to know whether she can book profits in this particular script. What do you suggest?
Sunal, I think that if someone's view is relatively short term, then definitely one can book out the profits at the current levels, because 490-95 levels are the one wherein the stock in the past has reversed quite I would say well, and in fact has corrected by almost 5 to 7%. So a short term trader definitely could book out. Otherwise, what we have seen is that we have seen a good long addition in this particular stock, and if at all it managed to surpass 490 and someone is having a positional view on it, then Delivery could see at least 10 to 15% kind of a rally from these levels as well. So positional trader could continue holding it. Short-term trader can book it out right now, and maybe look at it again if it breaks or surpasses 490 to 495 again.
Okay, all right, Jay. We're going to leave it on that note. Thanks very much for joining in. We'll take a short break. On the other side, Manisha Gupta will join in. She has with her Anant Padmanabhan of NEC Jewelers, and will focus on the gold space. Stay tuned.
Welcome back. Joining us now on the show is Ananta Padmanabhan. He's Chairman and Managing Director at NSE Jewels. Mr. Padmanabhan, hi, thank you so much for joining in. First of all, your sense on the gold prices, a very sharp decline that we have seen for the month of June and for the quarter gone by, where we've seen prices decline by nearly 13%. How are you looking at, first of all, the gold price moves from here on?
Everybody is shocked the way gold prices are going down. Luckily, if not for the rupee depreciation and a duty of from 6% to 15%, otherwise the gold prices should have been 10,500 or 11,000 rupees. That way, prices are a bit higher side when compared to the international prices. For time being, I think prices will be on the lower side only, because all these months it's been fluctuating a lot because of the Iran-US-Israel war. But now things are settling down, so I'm confident the prices will be around 14,000, 14,024.
Mr. Padmanabhan, also, when you look at the Indian demand, how has that been? Because we do understand that May and June were slow. Are you looking at July going the same way? A pickup perhaps would come in from the month of August?
Yes, now the NRIs will be coming July, August. So we expect some goodness. But unfortunately, because the prices are going down with all the experience that I've gone through this many years, I've seen whenever there is a fall in the prices and it continues to go down, customers restrain themselves from buying gold. So that's another disadvantage. When the prices are going up, they rush because it's going to go higher and higher. That's another thing. And because of social media, Instagram and all these people start saying that prices may come to 12,000, 11,000. So many news are coming. So that keeps them away from buying. So that's another disadvantage for us.
Absolutely. Mr. Padmanabhan, what is the kind of exchange gold jewelry that you are looking at, as in sense of percentage terms, which is coming into the market? And the second part of my question is that a lot of jewelers tell us that the markets are moving to lower caratages, but I'm assuming that is not the case. That's how it's in South India.
Yeah, South India, it's very difficult. To the first question, I would like to say that a lot of old gold is coming in after the request made by our Honorable Prime Minister. People have accepted it and they are coming in for more exchanges. We see the proportion right from 30%. At times, it's going to 50 to 60%. And even in the retailers level, even the jewelers are offering more incentives, asking the consumers to come forward for more exchange. So that's also keeping the shelves moving. And for the second question, sorry, what did you ask about the second?
I asked about the hallmarking and the caratages.
Yes, lower caratage.
Yes.
Yeah, when it comes to lower caratage, it's very difficult in South, Even a 5%, 10% shift also is not happening. Personally, I have tried 18 carat necklaces and bangles, but customers still prefer the 22 carat. The love for the 22 carat gold, it will take a longer time for people to accept 18 carat and 14 carat. So that's what, and that too in South India. Yeah.
Oh, absolutely.
North people may be shifting.
Mr. Padmanabhan, when you look at the gold import numbers, are you looking at a slight decline onto that one as well? Because the data from Metal Focus shows that the first quarter, the quarter just gone by, has seen just about 100 tons of import coming. Are we looking at a lower number this time around?
This time around, it may be a little higher than that because, okay, you're talking about first quarter, April, May, June, or international
That's right.
Jan, February, March?
April, May, June.
Oh, okay. April, May, June. April, May, June, definitely, because prices were high, and in spite of Akshaya Tritiya and all that, there was no business at all. But July, August, September, we accept it must go a little higher. The disadvantage is gold has started coming in through other channels because the duty has gone up to 15%. After representing to the government for so many years. Now again they've increased it, and we don't know how long it will take for them to withdraw. But for time being, increase may not be great because gold is coming in from all sides.
Mr. Padmanabhan, a final question then. Apart from gold as well, diamond really seems to be making a lot of inroads now. The last 3 years were not so good, but this year a very strong, newer and an aggressive push is what we see for that.
Yes. Thanks to De Beers and Diamond Trading Corporation and all these people, the prices are also stable. Diamond prices have been going down when it comes to solitaires, and customers' mood is also changing. From gold, they also want to move to diamonds. All these years, it was only gold. Now they have another portfolio like diamond jewelry. In South, normally people won't go for diamonds immediately. But now the shift is that with the next generation, people are coming forward to buy lightweight diamond jewelry. And we are also pushing from our side how to promote diamond in a big way. So that's attracting a lot of customers. Diamonds are going in the right direction.
Okay, all right, Mr. Padmanabhan, thank you so much for joining us with your insights. Thank you, Manisha, for taking us through this conversation. So social media actually is, talking about gold price, and that's impacting gold sales as well. So that's a big takeaway from this conversation. But thank you for that conversation. By the way, Ashok Leyland sales are much better than what the street was working with. It's a 25% growth that we have seen, much higher than CNBC TV 18 poll. Even M&M did see strong CV sales this time around, and that's the case across the industry. So at the day's high, there's a sharp spike in Ashok Leyland stock as we speak. We'll get in Sudarshan as well with his insights on this one. But with that, we'll slip into a short break. When we come back, we'll get you more on the cryptocurrency space on the other side.
CNBC TV 18 presents Crypto Corner, powered by Binance.
Welcome back. And on Crypto Corner segment today, we have with us Ewen Chen, who's Chief Marketing Officer at Binance. Ewen, hi, thank you so much for joining in. And you've led major platforms across both decentralized and centralized Web3 infrastructure. As we watch traditional equities trade today, capital allocation is visibly shifting. Are we moving past the era of pure crypto speculation into a more structural phase of asset diversification?
I think we definitely move from speculation to more financial infrastructure integration as well as institutionalization. So from the first integration aspects, we have seen the stable coins on the crypto format now passing $33 trillion per year. What that means is that it's double the size of the Visa network globally. So as a result, we've seen those major payment companies are also coming down into further building, and that's a proof that there's a structural shift. And secondly, we also have seen that it's no longer retail doing speculation, but institutional balance sheet has increased significantly. So we've seen about 9% of the total supply, about $120 billion US, which amount to 5 top IT companies in India combined are holding by the corporate balances. So this is also a show that it's a lot of maturity that's coming into this field for effective asset allocation rather than speculation. And something I think is also extremely interesting is the institutionalization makes the market capital market healthier. So before SpaceX went IPO, we see a pattern in the pre-IPO market on the crypto blockchain, which is for price discovery. So when we launched the futures of SpaceX, we captured about 60% market share for all the on-chain markets combined. And this actually significantly pointed to what the price could be when SpaceX actually go IPO. So I think that's very fascinating, exciting.
And also, let's move on to the traditional equity infrastructure, which is tightly bound by opening bells, meaning that the asset risk gets trapped over the weekends. How does continuous on-chain trading change the rules of the game for real price recovery?
Yeah, I think this is where the excitement really comes into play, is because of thanks to the technology, we are potentially seeing a complete new game that can modernize the capital markets to the next generation due to the blockchain. And then it allows the market to actually work at an atomic speed that was not possible before. So what that means is that, as you pointed out, there's a huge opportunity that with the capital allocation and risk management happening on chain in off-market hours. That means 24/7 rather than 9 to 5. And then what that means to a lot of the institutions and market participants is that when a macro shock happens, let's say on a Saturday, people can do on-chain capital allocation instantaneously without having to worry about on the Monday bell that they can do something. So this can significantly change the risk profile and allow much faster and better response for the market participants as a result of healthier capital markets. So I think this is really where the game has been changed due to this new paradigm, thanks to the technology.
When you look at the retail demographic data for these tokenized instruments point heavily towards emerging economies. Is this fragmentation just a temporary retail wave, or are you seeing a permanent structural demand to bypass the legacy financial barriers?
Yeah, I think that's another exciting area that we're seeing is because of the infrastructure change, we think structurally this is a permanent bottom-up financial inclusion for the opportunities of everyday users. And especially a lot of those asset classes that can now be tokenized to putting on chain is probably for the first time available for savvy everyday users that traditionally was institutional and only at a local scale. So just an example of the growth of the size of the market, right? So real world assets, which is the tokenized asset format for valuable assets, surged 600% to 31 billion. And then people actually, we see that they want one account for all their financial lives, no matter that's in traditional capital markets or that is for the crypto markets. And this is going to empower the people a lot better with better strategy, better opportunities, and then better options to make them making informed decisions for themselves. So we're very passionate about the technology, not just changing the markets, but making meaningful impact to people through this approach.
Also, when we look at the overall market therein, how would you look at rapid scaling that has its challenges as well? How would you see to balance this massive user appetite with strict compliance and risk management?
I'll talk about the second part of the question, the compliance and the risk management portion, and then come back to the geopolitics. I think ultimately, when as a platform like ours, we have to really take those as a foundation very seriously. When you serve 320 million users, security and compliance and risk management are the product itself. So to do so effectively, and because of the fastly shifting technological paradigm, we have to catch up or leading in that front to ensure that securities for platforms are leading in front of the hackers. So we are heavily relying on AI to empower the systems better to do so. So we have seen that even just in 1 year up to date, the AI empowerment can help to block $6.7 billion to prevent it from being hacked or theft from the hackers. What that means is that those money can stay in users' pockets. And on the compliance front, I think the core principles behind is how to protect the users, how to ensure the market integrity. So to do so, we put a lot of investment in there, like 1,200 people globally. And then for us, that's just the baseline because we have to take it to the next level. So we also invested $1 billion out of our own pocket to ensure some of the insurance reserve for people in case black swan events happen. That's going above and beyond for what a compliance or regulatory requirements were otherwise asked for. And as to your first question about geopolitics, how to navigate through this, I think it's especially because right now it's a very uncertain times in the world, how to actually have the correct global systems to empower institutions, organizations, individuals, to give them more opportunities and toolkits to manage risks, having more options, is exactly to give people the empowerment that they can navigate and survive and thrive in an uncertain and changing environment. So how we do that is to stay faithfully to make sure that we're building that global infrastructure platform, holding our integrity high, doing our security risk management and the options for people correctly, and then informing our user base, no matter they are business users or individual users, to do the best decision for themselves.
Point taken, Arvind. Thank you so much as always for joining in. So there's a lot that Binance itself is doing in sense of implementation, spending and funding, security and analysis into the global markets. And as she said, it is about the real world asset tokenization, stable coins, all of that really seems to be growing, not just in the emerging economies, but various other sectors as well.
Okay, all right, Manisha, thanks very much for that. I just want to turn back to the equity markets. While the Nifty is holding above 24,000, just an incremental piece of update with regards to Dr. Reddy's. I had pointed out that Apotex has received approval for semaglutide, but it's important to note that they've received approval for Wegovy generic, which is basically semaglutide, which is used for weight loss in the Canadian markets. Now, why is that important? Is because Dr. Reddy's has received approval way back in May for Ozempic generic, which is basically the semaglutide, which is used for diabetes. So Apotex has also received approval for Ozempic generic, which they launched in the month of May, but now they've received approval for Wegovy generic, something that is not even filed according to analysts by Dr. Reddy's as of now. So it is an opportunity which is only around 10 to 12 months away and not something which would impact them immediately because it wasn't on the horizon for Dr. Reddy's in any case. So that's important to note. We'll take a short break on that note, but we'll get you a lot more on this, on stocks as well as the markets once we're back. Stay tuned.
CNBC TV 18 presents Crypto Corner, powered by Binance.
Welcome back. Well, earlier today, Sanjeev Prasad, MD and co-head at Kotak Institutional Equities, told us that the markets are pricing in 2 to 4% deflation and that it is too early to gauge the impact of AI. Listen in to his views.
Given the issue around deflation and realization, which everybody is talking about, the big billion-dollar question is what kind of deflation one is looking at. So far, the market has congregated to around 2 to 4% average deflation pricing for the next few years. Now, I don't know whether that's the right number, if it is sufficient, or it could be significantly higher. Who knows? Given the impact of AI is still very early in a way, very hard to assess what it could be. And look at retail stocks 2 years back, exactly the same thing is playing out over there. Where are retail stocks now? Now that the government capital slowed down, nowhere to be seen. 50% cut from 2 years levels. Look at how much the stock has performed of railway companies. I mean, yes, I understand there's a big electrification theme that is there for the next several decades. India will rely more on domestic energy going forward, which can only come to the solar route. So there is a big electrification theme. But the question is, how much you want to pay for it upfront? Is the 80p enough or 100p contours? I mean, people try and do some sort of a reverse DCF, etc., to try and justify the valuation. The kind of market size they're looking at 3, 4, 5 years later would be humongous. I don't deny that there will be growth, but then it has to put in some context, whether it makes sense, the kind of growth that we're talking about, and whether the multiples or the valuation that have been recording currently, fall somewhere in a reasonable, ballpark.
Okay, on that note, it's also a wrap on Halftime Report. Business Lunch will take all of the action forward. Stay tuned.
A cut in ATF prices and lowering of duties on exports of diesel and ATF drives optimism about a return to normalcy. Realty and FMCG are the big gainers today, while pharma and metal stocks are the big drags.
RBI imposes curbs on proprietary trades by stockbrokers from today by calling for 100% security for bank guarantees. Experts see this limiting leverage, hurting liquidity and giving an unfair advantage to foreign players.
Mahindra and Mahindra pips estimates for June sales with strong passenger vehicles and tractor offtake. Escorts Kubota too posts healthy tractor numbers, while pure EV two-wheeler makers Ather sees a sharp jump in registrations, even as Ola Electric sees an uptick as well.
KPIT Technologies warns its Q1 revenue and profit will dip on weak outlook for European OEM customers. It, however, hopes for a revival in outsourcing as cost-cutting kicks in. Shares of the company and its peers take a dive.
Good afternoon, you're with us here on Business Lunch. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Hormuz Fatakia. Joining me as always, Arundhati Ramanan. Arundhati, good afternoon.
Hi, good afternoon, Hormuz. You know the Nifty doing well today above that 24,000 mark near the high point of the day.
You know, always start off something new on a positive note, right? So you're starting off the new quarter, a new month and a new series, all of it on a positive note, at least as of now. The good part is the fact that the Nifty is above the mark of 24,000 and the bulls are doing everything possible to ensure that the index stays above that level and ensuring the fact that there are two sectors that are doing so. The Nifty Bank is one, of course. It is back at the higher end of the trading or the midpoint of the trading range, shall I say. 58,000 now on the Nifty Bank, almost there, a 400-point uptick. And of course, the FMCG stocks are packing a bit of a punch in today's session as well. So these are the ones that are leading the markets higher. No prizes for guessing. IT is taking the keeping the gains in check in today's session as well. It's just one bad news after another for IT. They just can't seem to catch a break.
Absolutely, as you pointed out, right? FMCG stocks doing well. HUL and Nestle up over 2% in trade. We've got ITC that's also doing well, 1% higher as we speak. In fact, HUL and Nestle 3% now higher, and they're continuing their up move. Realty stocks also doing well. DLF, Prestige, Phoenix Mills, all of them clocking gains of over 2% in trade as we speak. As Hormuz pointed out, private banks and PSU banks, both those indices, both those stocks continue to help the Nifty's up move. Now, on the downside, we've got those metal names. That's the top losing index. Hindalco, Zinc down 1.5% in trade. And we've got SAIL, that's about 3% lower in trade. And as Hormuz said, IT stocks don't seem to be catching a break. They continue to fall. Tech Mahindra down 2%. Coforge down nearly 4%. HCLTech down over 2%.
What worse, if I could say that, than KPIT Tech. That's the one that's been the casualty of the day. And the stock, not before this session, was already down 10% in the over Monday and Tuesday. And another 16% knock that the company has taken in today's trading session. Rima is here with the breakdown of what exactly transpired, what was the profit warning that the company issued, and a clarification that came in today as well. Rima.
So basically what KPIT Tech has done is they're saying in Q1, they're expecting the revenue growth to decline by 1% on a year-on-year basis. To put that in context, a brokerage like Motilal Oswal was anticipating a growth of 2%. So a growth of 2% year-on-year has become negative 1% on a year-on-year basis, according to the company. And JP Morgan says if you look at it on a quarter-on-quarter basis, we are looking at a drop of 4% in constant currency revenue terms. Now, what has changed for the company? Well, anyway, the company had said that H1 is going to get impacted because two of their large programs come to an end. But what's changed is the company says the performance has been impacted by a sudden drop in revenues over the last few weeks, and they attribute it to the recent profit warnings and a deteriorating outlook by the European auto companies. Particularly, I think it's the BMW profit warning, which was issued in June. Even JP Morgan says that BMW is one of the top clients for KPIT Technology. According to them, it contributes about 12% to their top line. And if you remember, in June, JP Morgan had cut their profit growth guidance, the profit margins, quite sharply. And I think that is the big change that's taking place. And what's also very disappointing is that the company is now saying Q2 will be similar to Q1 in the same range, which basically means that we're not seeing too much of a recovery. And KPIT Tech has anyway gone through a period of slowdown. The growth rates have been coming down for close to about 18 months. But when we spoke to them in April, the company sort of indicated that maybe FY26 would be a trough and things will start picking up in FY27. The outlook, they said, was promising for FY27, but that doesn't seem to have played out. Now, what's the way forward? As I said, because the company has been slowing down, the stock is corrected. It's fallen close to 65-70% from its all-time high levels. But it's currently trading at, it was trading at about 20 times forward multiple as of yesterday's closing level. And JP Morgan today, when it downgrades the stock, is further lowering the target multiple to 17 times, and they've downgraded it to an underperform rating. So disappointing news. Q1 is going to be much lower than the expectation. No recovery in sight, even for Q2, and the stock is taking a beating.
The stock down now 16% in trade. Thank you so much for those details, Rima. Now, automakers are reacting to sales numbers for June. Sudarshan Kumar is here with a roundup of all the numbers that have come in. Sudarshan?
It's been a mixed bag so far. We'll start with Mahindra and Mahindra. Both the segments, auto and tractor segment, sales have been largely above expectations. In the auto segment, SV continues to do well. Growth has been more than 28%. LCV was the surprising part. Growth there was more than 35%. And the tractor segment, overall growth was 12% versus our expectation of 7%. Maruti sales were largely in line. The positive part was the entry-level segment where sales have almost doubled. And for Maruti, SUV has seen growth of more than 28%. What has not done well for Maruti with the export segment where growth was just 13%, while domestic segment continues to see a healthy growth, and in the month of June the growth was almost 20%. Hyundai sales were largely in line. Company has seen a decline of 16%. That's what our expectation was, and sales have declined because of the production loss that company has seen in one of the manufacturing facilities in Chennai, and that was because of fire incidents. Ashok Leyland, very strong set of numbers. Both the segments, commercial vehicle segment, LCV and MNSCV segments have seen growth of more than 20%. And if we just talk about the MNSCV truck segment, growth was more than 40%. Amongst two-wheeler names, Hero Moto has come out with the numbers and sales were below expectations. Total sales have slipped more than 2%. We were expecting almost flat YOY, and the main reason was decline in the motorcycle segment where sales have declined by 6%. In resultant, domestic sales were down 4%. Export contribution is very negligible, and there the growth was 32%. So overall, it's been a mixed trend so far, whichever companies have reported numbers.
Sudarshan, thank you for those updates there. Mixed bag so far in the auto sales that have been reported so far. Moving on then, the new RBI rules to raise funding costs for proprietary trading firms came into effect from today. Under the new rules, the guarantees for trades must now be fully collateralized with at least half of the collateral required to be either in cash or in fixed deposits. Now, this is a change from the earlier framework where proprietary desks could access bank guarantees with significantly less cash set aside. Now, the new norms are expected to raise the cost of doing business and reduce effective leverage with high volume, high leverage players in futures and options, particularly in options, which are likely to see an impact. Now, earlier today, we spoke to some experts on these new norms. Listening to what they had to say.
It's very, very significant. I think it's the most significant death knell to the prop trading industry since the NSE came into existence. Just to give a background, these products by the banks have been in existence since the time NSE started. These products have had as low as an NPA in the system as anything else the banking sector has seen. And these products were not vended by the so-called cooperative banking sector credit move or a credit risk move by the RBI. This is an ambush to shutter down an industry that was really growing with the market.
There'll be no knee-jerk reaction. Whether capital market intermediaries are prepared or not prepared, I think 3 months was good enough period for them to look at their own business model and how they would want to focus on the business. And that's where I believe that they are may not be fully prepared, but reasonably prepared to deal with this thing, and they've been quite resilient.
The thumbs up from the market has to come from systemic long-term capital. For example, the SIPs and the regular investors. Prop trading is primarily a trading book which takes care of short-term advantages in prices. And I think the RBI wants to say that let that not happen in the market and let there be systemic investment. I think that the intended consequence is to reduce those levels and make sure that realistic valuations stick in our markets and are not propped up by funding which otherwise comes from the banking system to create systemic risk.
RBI financial stability report shows that the banking system remains resilient under adverse scenarios. But the report flags sharp growth in gold loans. Ritu Singh is here with all of those details. Ritu?
Well, RBI's latest financial stability report says India's financial system is resilient. But yes, there are a few red flags that they have highlighted. The biggest watch point is the sharp rise in gold loans, which RBI says warrants cautions. They warn that a sustained correction in gold prices that we've seen, that could weaken collateral coverage, which may risk borrower stress and raise the risk of loan defaults, although the loan-to-value buffer remains comfortable among lenders for now. Now, the central bank has also asked banks to closely monitor retail and MSME loans because asset quality, it says, could come under pressure there if macroeconomic conditions weaken. Another worry is the rise in households. It remains low relative to peer emerging market economies. And overall, it says the health of the system remains in good shape. And RBI's macro stress test reinforces that view as well. So, for instance, for the banking system, the gross NPA ratio is currently at 1.8%, and it is seen rising only to 1.9% by March of 2028 under the baseline stress scenario. But it could rise all the way to 4.1% under the worst case scenario. Capital adequacy for banks stands at 17.5%. That could moderate all the way to 13% in an adverse scenario. But even then, only one or two banks are projected to breach the minimum capital requirement. For NBFCs, again, the gross bad loans, which is 2.4% currently for the system, could rise all the way to 5.2% by March of 2027 in the absolute worst case scenario, while the capital adequacy remains healthy at more than 20%. But RBI does warn that 7 NBFCs could breach the minimum capital requirement even in the baseline stress scenario, and as many as 15 NBFCs in the worst case scenario. But, before I end, keep in mind, though, this is just model testing under hypothetical shocks, and it is not to be taken as a forecast by RBI.
Ritu, thank you for those updates there. Take a short break. Back with more on the other side.
Welcome back. You're still with us on Business Lunch. The monsoon seems to have set in Mumbai, with citizens waking up to heavy rainfall over the last 2 days. However, the forecast from the IMD remains cautious, expecting below normal rainfall across the season this year. Santhya Gora is here with all of those details. Santhya?
So finally, it is raining in Mumbai. Heavy rainfall in the city began on Sunday night, and over the last 48 hours, Mumbai has received a good rainfall. As a result, the lake levels have improved slightly. The lake levels have risen up from 6.75% to 7.18% since yesterday. According to the IMD, for the next 1 week, Mumbai will continue receiving this good rainfall activity. And it's not just Mumbai. Monsoon has finally picked up some momentum across many parts of the country, including the worst affected regions of central India. While the revival of monsoon is long awaited and welcome, but the IMD has cautioned that July is going to be warmer than normal and drier than normal. According to the IMD, the long period average the rainfall in July is going to be 94% of the long period average, which means it will translate into a 6% deficit. IMD has also said that El Nino conditions are likely to strengthen further, and the Indian Ocean dipole is going to remain in its neutral phase till the end of the monsoon season, which means it won't be able to offset or dilute the impact of El Nino. However, thanks to other favorable monsoon systems, it is going to rain in the first half of the month in multiple parts of the country. Experts say that this is going to be the best period of the season and also the ideal window for farmers to sow their kharif crops.
Santhya, thank you for that update there. Some relief for the Mumbaikars, at least, in terms of the lake levels rising. Well, let's now also listen in to what HSBC's Chief India Economist Pranjal Bhandari and Nomura's Chief Economist Sonal Verma have to say with regards to the impact of these weak monsoons.
My sense is that what we are going to see, perhaps not in the June quarter, but rather after that, is growth slowing on the back of El Nino. That is the growth shock that I'm talking about at this point of time. And, you know, we all know about rains, but I'm more worried about temperatures. We have a lot of irrigation facility to take care of rain shortfall, but no magic wand for temperatures. Today, temperatures have crossed previous thresholds. They are not just impacting and disturbing fruits and vegetables, all of these sensitive crops, but a lot of the hardy crops like edible oils, pulses, rice, wheat, and also livestock, egg, meat, fish. So my worry is that that is going to weigh on growth, and we will see that in weak growth numbers, perhaps around the December quarter.
Food inflation, yes, it is likely to pick up. We're expecting on average around 6% in FY27, starting out on a low base. Production is likely to be negatively impacted on rice, pulses, oil seeds, and potentially also wheat. Now, rice, we do have some buffer, so that can potentially get managed, but we do anticipate a higher inflation trajectory in pulses, edible oil going forward. And as Pranjal was saying, the heat wave also means higher vegetable price inflation this fiscal year. So we are building in the higher food inflation trajectory in our base case.
Japanese Prime Minister Sanae Takaichi will arrive in New Delhi this evening for a 3-day official visit to India. This marks her first visit to the country since assuming office. During her visit, the Japanese Prime Minister will take part in the 16th India-Japan Annual Summit with Prime Minister Narendra Modi. Takaichi's visit to India is expected to boost investment and innovation opportunities, strengthen economic ties, and bolster efforts to build resilient supply chains in areas like semiconductors and critical minerals.
Take a short break. More news and updates follow on the other side. Stay tuned.
Welcome back. You're still with us on Business Lunch. Now straight to all the updates from West Asia. Qatar's Prime Minister met with US envoy to the Middle East, Steve Witkoff, and US President Donald Trump's son-in-law, Jared Kushner, who are in Doha to discuss the US-Iran agreement. Iranian negotiators are also in Doha, but there are no plans for face-to-face talks with the US just yet. Qatar's foreign ministry says technical-level discussions are continuing between Washington and Tehran, either directly or indirectly, adding that any high-level meeting will depend on results they produce. Iran's parliament speaker insists Tehran will not begin talks on a final agreement with the US before Washington implements provisions on ending hostilities in Lebanon, reopening the Strait of Hormuz, waivers on Iran oil exports, and the release of frozen Iranian funds. Meanwhile, US Vice President J.D. Vance says oil traffic in the Strait of Hormuz has reached its pre-war height.
Now, US President Donald Trump reported more than $1.4 billion in his income from his family's crypto ventures last year, showing how Trump derives most of his income from digital assets that have benefited from his policies, according to a review of his latest financial disclosures. Take a look at this Reuters report.
U.S. President Donald Trump reported more than $1.4 billion in income from his family's crypto ventures in 2025. That is according to a review of his latest financial disclosure released on Tuesday. The filing shows that Trump now derives most of his income from digital assets, which have benefited from his policies that the industry sees as beneficial. The filing shows his company received nearly $800 million from World Liberty Financial, a crypto project he co-founded with his sons. The income, which is split with family members, includes more than $520 million from token sales and over $250 million from selling business interests. He also made $635 million from sales of the Trump meme coin. The filing highlights a significant jump from his disclosure a year earlier, when he reported just over $57 million from the same token sales. Since Trump's return to the White House, his family has made at least $2.3 billion from crypto-related projects, according to a Reuters estimate. A White House spokesperson said, quote, "Neither the president nor his family has ever engaged or will ever engage in conflicts of interest." A spokesperson for World Liberty Financial declined to comment. Aside from crypto, the president's traditional businesses such as golf courses and resorts also performed well, generating more than $500 million last year. The strongest increases were at clubs where the president has spent considerable time since his 2025 inauguration.
After a series of upsets and unexpected results, the overnight round of FIFA World Cup round of 32 fixtures saw a return to business as usual. Norway booked their place in the round of 16 with a dramatic 2-1 victory over Ivory Coast, thanks to a last-minute winner from Erling Haaland. France looked dominant as Kylian Mbappe starred with a brilliant brace in a convincing 3-0 win over Sweden. Meanwhile, host Mexico thrilled the home crowd with a commanding 2-0 victory over Ecuador, securing their place in the next round.
Well, the Nifty is still above the mark of 24,000. It's exactly the place at where we began the show, still around that mark of 24,020. So no significant moves there on the index, but there is plenty of activity in the broader markets today. Look at RITES, that continues to remain the top gainer on the Nifty 500 today, 14% higher now on the stock. And most of the other railway-linked names are also doing well for themselves. BEML is up 4.5%, and a lot of the others as well. Kernex Microsystems was one such name as well that was doing well. And Latravenues Tech, or Ixigo, that too is trading with gains of around 9% and doing well for itself today. Take your leave on this edition of Business Lunch from Arundhati and me. Thank you for watching. Midcap Radar on the other side.
Good afternoon. Welcome to Midcap Radar live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra and with me as always Vivek Iyer. First day of July, first day of the new series, and it has started on a good note. And the price cuts that have come by, they are talking about maybe some normalcy which is returning after the West Asia crisis. That is something which the markets are really liking.
That's right, and that's boosted the entire FMCG pack. The fuel price cuts that's been spoken about is what you're referring to, and that's aided the rally as far as the entire FMCG pack is concerned. IT, however, continues to be a drag today, but we have a lot lined up on the show, so let's start off with the top headlines. Market continues to trade with gains, with Nifty trending above the 24,000 mark. Realty, FMCG and financials lead gains, while IT and metals lag. Mid-caps underperform.
KPIT Technologies warns its Q1 revenue and profit will dip on weak outlook for European OEM customers. It, however, hopes for a revival in outsourcing as cost-cutting kicks in. Shares of the company and its peers take a dive.
Page Industries and Havells rally as Citi upgrades both to a buy rating. Sees risk-reward turning favorable for Page Industries 3 years after a downgrade. Citi also sees the price correction in Havells offering a good entry point into the stock.
Hindalco kicks off FY27 on a strong note, seeing a 93% uptick in loan sanctions and 27% rise in loan disbursements. Paisa low as well hits upper circuit as the company reiterates 3-year target to double AUM, total income and profit.
Jefferies initiates coverage on MCX with a buy rating and a target price of 3,600 rupees a share, expecting higher penetration in the commodity market. The stock rallies over 4%.
All right, those are the top headlines that we are tracking in trade today. But the broader markets, the mid caps, the small cap index, the Nifty, all of them are doing well in trade. The FMCG pack is one of the top gainers. We have continued to stay at that mark. For the Nifty, we continue to edge higher above the 24,000 mark for now. The Bank Nifty is the one which is fueling the rally as well from the start of the trading session. But it's time to talk about the mid caps then. This is our special segment, Mid Cap Movers. We have Ria to take us to the mid caps that are moving around in trade. Ria.
Well, yeah, starting off with the gainers first, we have Rights Limited seeing a very strong move today after a 175 crore order win. And more importantly, the stock is gaining on the back of very strong volumes, nearly 148 times the 30-day average volumes traded today on this one. Reliance Power also seeing a strong move today, although the stock is down nearly 60% in the last 1 year. Hexaware Technology is also seeing a move today. This stock also down nearly 27% on a year-to-date basis. Even CE Info Systems, although it is seeing a good move today, it is down nearly 50% on a year-to-date basis. And also on the gainers list today is Ideaforge as well as Home First. Also looking at some of the stocks that have hit their 52-week highs today, there's Delivery as well as Phoenix Mills and Chem India Projects, Aegis Logistics as well as Kim's have also hit their all-time highs in addition to their 52-week highs today. Moving on to the top sectoral gainer today, which is the Realty Index, up nearly 2%. AB Realty, Godrej Properties as well as DLF are the top gainers in the sector. And on the flip side, looking at the losers in today's trading session, there's Apar Industries. Although the stock is up nearly 75% on a year-to-date basis, it is seeing strong cuts today. HCL also seeing a move today after gaining nearly 45% in the last 3 months. Welspun Corporation continues its strong rally. It's up nearly 90% in the last 3 months. KEI Industries also on the losers list today, as well as Syngene, which is down nearly 35% on a year-to-date basis.
Well, thank you so much, Ria, for joining us, giving us a list of all the top movers as far as the broader end of the markets are concerned. But it's a good time to get a quick technical check on the market. Nagaraj Shetty, Senior Technical Research Analyst at HDFC Securities, joins us for a quick technical check. Good afternoon, Nagaraj. Well, we've started off the July series on a strong note. Where do you see markets headed from here on?
Hi, good afternoon, Vivek. Yes, market has been in a range-bound action over the last few weeks. The narrow range is around 24,200 to 23,800 levels, having declined from the highest upper range of 24,200 recently, and Nifty should hold around 23,800 or 750 levels at the lows. I'm expecting today's bounce back is likely to continue. If there is any consolidation at the lows, 23,800, 750 is likely to act as a strong support. From here onwards, I'm expecting Nifty to reach up to 24,200, 300 levels in the short run.
Okay, all right. What about individual names, Nagraj? What would you bet on?
Yeah, I have two stocks from the on the longs perspective. First one, Aventel Limited. Aventel has been in a phenomenal up move. High tops and bottoms on the long-term charts indicates a strong upside momentum. currently placed within a narrow range, kind of a triangle pattern, and today made an attempt of breaking above the triangle around 181 and 182 levels. The overall chart pattern is looking positive. Currently trading at 180.50, one can look to buy at this point of time. Immediate target would be around 190, 191. One can place a stop loss at 175. Second one is IFCI. IFCI has been in a decent downward correction from the high of 95, almost reached to 75 levels, 20 rupees downward correction in the last couple of few weeks. The overall chart pattern is indicating there is a placement of strong support somewhere around 75.50, 76 levels, currently trading around 76. I'm expecting a strong bottom reversal from here onwards and an upside bounce from here onwards. So one can look to buy at 76.10, which is the current market price. The immediate target would be around 81, and one can place a stop loss at 73.
Well, Nagaraj, a quick word as far as the IT pack is concerned, especially mid-cap IT names, KPIT Tech, Tata Elxsi, Tata Technologies. Do you have a view on any of these names? Significant price correction today.
Yeah, I think IT is still not out of woods. More correction is likely. The patterns are still continuing the decline. Even if you can take a frontline IT, mid-cap IT stocks, I think more weakness is likely, at least for the short term.
Okay, thank you so much, Nagaraj, for joining us, giving us a view on the markets and as well as the individual trading calls. Well, we'll now slip into a short break. We'll get you more on the markets and stock-specific action on the other side. Stay tuned.
Welcome back. You're still tuned into Midcap Radar. The midcaps are doing well, though underperforming the benchmarks for now. But we do have a lot of stocks which are on our radar. So let's talk about that. This is our special segment, Midcap Spotlight. We're going to be talking about Viatech Wabag. Vivek, what's happening here?
Well, a very interesting order win that the company has spoken about. So this is a large waterworks expansion order in Austria, and this particular order is from Vienna for the expansion of one of the waterworks that is present in Austria. The order value is in the range of $30 to $75 million, close to 250 to 700 crores. So the company classifies this as a very large order. Now, the order involves providing a complete technology package, and it is scheduled for both completion as well as commissioning by 2030. Now, the total order book, remember, that the company currently is enjoying or sitting on is over 17,230 crore. So while this particular order is not very large, given the fact that it's coming in from newer geographies, especially in Europe, is something that the street is taking quite positively. Remember, the FY26 order inflow stood at almost 7,500 crore, and along with the fact that the company, when they met us last time, reiterated their medium-term guidance of 15 to 20% on the top line and an EBITDA margin guidance of 13 to 15%, this particular stock has been a significant outperformer, even from the end of Q4 till Q1 currently.
Okay, all right. That's about VATech Wabag. We are starting to get quarter one updates now. It is coming in from APL Apollo for now. So we'll keep watching out for some of these stocks where we do get a lot of quarterly updates, be it realty companies, pipe companies, FMCG companies, and banks as well. Talking about financials, we do have Hindalco and Paisalo, which are also trading hard in trade today. Ananya is joining us to tell us what's happening here. Ananya.
So let me first start with Hindalco. So they have released their Q1 business update. It was a very strong start to FY27, we can say. So for the June quarter, the loan sanctions nearly doubled, surging 93% year-on-year to 65,485 crore, while loan disbursements increased 28% to 16,377 crore. This follows a record FY26 when Hindalco achieved its highest ever loan sanctions, loan book and disbursements. Importantly, asset quality remains robust, GNPA at 1.04% and an NPA at around only 0.05%. So we can see a strong underwriting going here with the increasing loan book growth. Now, meanwhile, coming to Paisalo Digital, the stock surged around 20% in the trade today after its promoter increases stake by 4.97% through open market purchases, taking the total holdings to 46.72%. Now, this increase in promoter ownership is being viewed positively by the investor as it reflects the confidence of promoter in the long-term growth story of the company. So Paisalo also reiterated its 3-year roadmap to double its AUM, total income and profit driven by AI-led lending, disciplined risk management and an expanding distribution network across India. So we can see positive developments coming in for both the companies.
Well, thank you so much, Ananya, for joining us and giving us a sense of the developments as far as some of the names in the BFSI space is concerned. Well, we'll now slip into a short break. We'll get you more on the markets and stock-specific action on the other side. Stay tuned. Welcome back to Midcap Radar. Well, the broad end of the markets has clearly seen a bit of an uptick. Names like SBI Life has moved to the high point of the day. Jio Financial Services too, up over 1%. And Page Industries has built on to its opening gains. But one sector that's not doing very well, and on account of the profit warning from HCLTech, the shares are in focus, and this is a profit warning that came in for the June quarter. The weak outlook prompted JP Morgan to downgrade the stock as well. Rima now joins in with more details.
So basically what HCLTech has done is they're saying in Q1, they're expecting the revenue growth to decline by 1% on a year-on-year basis. To put that in context, a brokerage like Motilal Oswal was anticipating a growth of 2%. So a growth of 2% year-on-year has become negative 1% on a year-on-year basis, according to the company. And JP Morgan says if you look at it on a quarter-on-quarter basis, we are looking at a drop of 4% in constant currency revenue terms. Now, what has changed for the company? Well, anyway, the company had said that H1 is going to get impacted because two of their large programs come to an end. But what's changed is the company says the performance has been impacted by a sudden drop in revenues over the last few weeks, and they attribute it to the recent profit warnings and a deteriorating outlook by the European auto companies. Particularly, I think it's the BMW profit warning, which was issued in June. Even JP Morgan says that BMW is one of the top clients for KPIT Technology. According to them, it contributes about 12% to their top line. And if you remember, in June, JP Morgan had cut their profit growth guidance, the profit margins, quite sharply. And I think that is the big change that's taking place. And what's also very disappointing is that the company is now saying Q2 will be similar to Q1 in the same range, which basically means that we're not seeing too much of a recovery. And HCLTech has anyway gone through a period of slowdown. The growth rates have been coming down for close to about 18 months. But when we spoke to them in April, the company sort of indicated that maybe FY26 would be a trough and things will start picking up in FY27. The outlook, they said, was promising for FY27, but that doesn't seem to have played out. Now, what's the way forward? As I said, because the company has been slowing down, the stock is corrected. It's fallen close to 65-70% from its all-time high levels. But it's currently trading at, it was trading at about 20 times forward multiple as of yesterday's closing level. And JP Morgan today, when it downgrades the stock, is further lowering the target multiple to 17 times, and they've downgraded it to an underperform rating. So disappointing news. Q1 is going to be much lower than the expectation. No recovery in sight, even for Q2, and the stock is taking a beating.
A big one, 16% lower on that one. But the other stock which is on our radar is MCX, buzzing on the back of a positive brokerage note from Jefferies. Sudarshan is joining us now with more details on this one. Sudarshan.
So Jefferies today has initiated coverage on MCX with a buy call and target price is 3,600 rupees per share, and that implies an upside of almost 25% from current levels. It believes that commodity market lacks equities and the penetration going forward is expected to be increased. And if one stock that is going to benefit the most, that is MCX, and it forecast MCX revenue to grow at 20% CAGR despite the company is having the elevated base, and along with 260 basis points margin expansion, earnings CAGR forecast is of 22% till FY29, and that's the reason this stock is buzzing, currently up more than 4%.
So much, Sudarshan, for taking us through what exactly Jefferies has to say as far as MCX is concerned. But do stay on with us because automakers are reacting sharply to sales numbers for June. Give us a quick roundup, Sudarshan, of all the top movers as far as the auto pack is concerned. Ashok Leyland clearly stands out.
That's correct. So it's been a mixed bag for the companies that have reported numbers so far. So I'll start with Mahindra and Mahindra because both the segments, auto and tractor segments, numbers have come in largely above expectations. So talking first about the auto segment, SUV continues to see a healthy growth. Their growth has come in more than 28%. And this time, surprising part was LCV. And the focus point LCV between 2 to 3.5 tons growth is more than 35%. Now coming to the tractor segment, growth has come in at 12% versus our expectation of 7%. Companies saying it's very early to assess the impact of El Nino, but so far growth remains healthy. Coming to Maruti, sales were largely in line. Good part this time for Maruti was the entry-level segment where sales have almost doubled, and SUV continues to do well. This time also growth has come in at more than 28%. One segment that has kind of disappointed was the export segment, where growth was just 13% against the almost 20% growth registered by company in the domestic segment. Hyundai sales were largely in line. It has seen a decline of almost 16% because of the production loss that company has seen because of the fire incidents at its manufacturing facility in Chennai, and that's the reason sales have declined. Company is saying that it will recover the production loss that it had seen in the month of June, and that will happen in Q2 of FY27. Ashok Leyland, as you have said, it's a very strong set of numbers. Both MNCV and LCV segments have seen growth of more than 20%. And if you just take a look at MNCV truck segment, their growth has come at more than 40%, much above our expectations. And largely amongst all the two-wheelers, Hero Moto has come out with the numbers. We were expecting flat YY, but company has seen a decline, and their decline is 2.4%. And the main reason is the decline that company has seen in the motorcycle segment, where the decline was almost 6%. Export contribution is negligible, but their growth has come at almost 32%. On the domestic part, growth was down 4%. So far, it's been a mixed bag, whichever companies have reported numbers.
Okay, a mixed bag from the Auto Pack. Thank you so much for joining us, Darshan, with all those details. Let's get some market opinion now. Earlier today, Sanjeev Prasad, MD and co-head at Kotak Institutional Equities, tells us that markets are pricing in 2 to 4% deflation for IT sector, and that it is too early to gauge the impact of AI. Listen into his views.
Given the issue around deflation and realization, which everybody is talking about, the big billion-dollar question is what kind of deflation one is looking at. So far, the market has congregated to around 2 to 4% average deflation pricing for the next few years. Now, I don't know whether that's the right number, if it is sufficient, or it could be significantly higher. Who knows? Given the impact of AI is still very early in a way, very hard to assess what it could be. And look at railway stocks 2 years back. Exactly the same thing is playing out over there. Where are railway stocks now? Now that the government capital slowed down, nowhere to be seen. 50% cut from 2 years levels. Look at how much the stock price of all the railway companies. I mean, yes, I understand there's a big electrification theme that is there for the next several decades. India will rely more on domestic energy going forward, which can only come to the solar route. So there is a big electrification theme. But the question is, how much you want to pay for it upfront? Is the 80p enough for 100p contours? I mean, people try and do some sort of a reverse DCF, etc., to, try and justify the valuation. The kind of market size they're looking at 3, 4, 5 years later would be humongous. I don't deny that there will be growth, but then it has to put in some context, whether it makes sense, the kind of growth that we're talking about, and whether the multiples or the valuations that have been recording currently, fall somewhere in a reasonable, ballpark.
Well, that's Kotak Sanjeev Prasad being concerned, especially as far as the high valuation multiples that the industrial stocks are currently trading at. But remember, new RBI rules to raise funding costs for proprietary trading firms have come into effect today. RBI now requires bank guarantees issued to firms trading in the capital markets to be fully backed by collateral with at least half in cash. Earlier today, Rajesh Baheti, Managing Director at Crossyears Capital Services, says the new collateral rule is a death knell for prop trading. Let's listen in.
It's very, very significant. I think it's the most significant death knell to the prop trading industry since the NSE came into existence. Just to give a background, these products by the banks have been in existence since the time NSE started. These products have had as low as an NPA in the system as anything else the banking sector has seen. And these products were not vended by the so-called cooperative banking sector credit move or a credit risk move by the RBI. This is an ambush to shutter down an industry that was really growing with the market. This hit is disproportional because it hits only the Indian prop houses. The foreign prop houses will get everything they will get from their banks overseas with no control of RBI. So they will continue to thrive at the cost of Indian firms. So we are not exporting our markets this time. We are exporting our income that will be converted into dollars and taken out of the country. So I think the Indian broking houses on the prop side and the Indian HFTs would have contributed at least 30 to 35% of the exchange turnovers, and I think 30 to 35% of that will be hit.
Okay, that's the word coming in from expert, but let's take a look at the markets for now. There are a couple of stocks which are at the day's low. We do have IGL, which is not doing so well. Since the time we have this EV policy in Delhi has been announced, there has been some impact on IGL. However, important to note that they don't have such a big exposure to this particular segment. It's the four-wheelers, the cab aggregators, which are a bigger 65% of the volume play for IGL. We do have Himadri Chemicals, which is also down 4%. There's Tata Chemicals, which is down 4% in trade as we speak. Shilpa Medicare is the other one, which is down around 4.5%. There was a damn capital note on Shilpa Medicare yesterday. But today, the stock is seeing some cut from the highs of the day. Marico, yes, of course, up 2% in trade. JK Paper is the other one, which is not doing so well. So a lot of these stocks, which had run up in the last couple of trading sessions, have come in for some profit booking. So yes, the mid-caps are doing well, but they are underperforming the benchmarks for now.
That's right. And another sector, that we'd like to point out, of course, is the entire metal pack. The metal pack today, taking it on the chin, especially, the steel stocks. Have a look at JSPL. Again, pricing concerns as far as our steel names are concerned. SAIL is the other name that's under quite a bit of pressure. JSW Steel is the other name on the radar. All of these stocks under significant pressure. Well, with that, it's all the time we have on this edition of Midcap Radar. Your stocks when we return.
and welcome to you. Hello and welcome to Your Stocks live from the CNBC TV 18 Motilal Oswal studio. I'm Arundhati Ramanan, and with me as always is Vinny Motivala. Vinny, good afternoon. You know, the market's starting the new series, the new month and the new quarter on a high. Nifty holding well above that 24,000 mark, near the high point of the day. And what's helping the Nifty climb higher? That's the Nifty Bank, right? That index is about 0.7% higher. Private banks, PSU banks, both of them doing well in trade today. If you take a look at the other sectors that are helping the Nifty's up move, we've got the FMCG pack. Take a look, HUL, we've got, ITC, all of those stocks doing really well in trade, gaining about 3%. We've got the auto names that are doing very well, M&M, Maruti Suzuki, all of them in the green today. But on the downside, we've got those metal names that are not doing very well. If you pull up that index, you'll see it's about 1% lower in trade. And we've got those IT names which have been laggards for quite a while, and that index also in the red, unable to catch or break those IT names.
Absolutely unable to catch a break, and as of now also today the top sectoral loser as of now trading at the day's lowest point is the Nifty IT sector. Today obviously we had this KPIT Q1 guidance that came in that didn't excite the street. Absolutely. But apart from that, the broader end of the market that continues to do well, and advanced decline ratio also is something that will be interesting to watch out for in terms of the trading session, more of greens versus red. And clearly, mid and small caps are doing well. Let's move on and talk about the stocks and queries that you all have sent us, right? We'll get them answered with Saumil Mehta today, head of retail research at Mirai Asset, Sher Khan, as well as Sneha Podar, VP Research Wealth Management at Motilal Oswal Financial Services, to answer all those queries. So thank you so much, Sneha, as well as Saumil, for joining us on the show, as always. First up, the first query for today comes in from Suresh, who's writing to us from Bangalore. He's holding 5,000 shares of IRFC. The price that they bought it at is 24 rupees, making a good profit on this one. The stock is currently trading at 91. Long-term investor and wants to know whether to hold or sell and book out the profits at current levels. Sneha, what's your view?
Hi, good afternoon. So see, IRFC is a good fundamental stock wherein the company has absolute monopoly on financing the Indian railways. Plus, if we look at their asset quality and all, I mean, it's a very strong track record that they have. Valuations are pretty, decent, good dividend yield. But somehow there's a kind of a slowdown in the overall the railway projects, and thus the growth has moderated for the company over last 1 year. So looking at the current price to book of 4 times, I mean, all the positives are already priced in, and we really don't see any further a major up move from here. So my suggestion would be to book profits and move to some other sector.
So you're saying book profits and move to another sectors. Somil, if I can come to you, what about IRFC? You know, this person is making a profit. Should they continue to hold or sell at current levels? Any targets to watch?
I think I would hold to it. It is already at a very, very crucial level. I do understand that in the last couple of years, it has been, in the downtrend, the tops were around 220 and now it's trading at 91. So we've seen a lot of correction here. However, overall, if you see in the medium to, in the medium term outlook, there's a very crucial support around 90, 88 levels. I'll hold on to it for a target of 110. Probably if it sustains above 110, we'll see 125 as well. But at this point of time, there's no point selling it off. Probably hold it for a little while with a stop loss of 88.
All right, with a stop loss of 88. All right, the next query is coming into us from Hyderabad. This person holds 100 shares of Happiest Minds at 404 rupees. He is making a loss. The stock is currently at 339, and he wants to know whether to hold or sell the share at current levels. So, Sneha, let me come to you first. What do you make of the stock? What are the fundamentals looking like? Should he continue to hold?
Why we do not cover the stock, but see, fundamentally, if we look at it, the growth has moderated for the company, and the costs are elevating given the heavy investments that the company is doing in building a separate Gen AI business. So that investment will continue for few more quarters. So the cost will remain elevated while the growth is moderating down. So at the current valuations, which looks a little elevated, my suggestion would would be to exit from this stock in particular, and probably move to some other investment idea, and not only in IT. I mean, IT, my overall suggestion would be to exit at the current juncture.
Okay. Exit at the current juncture. That's the word coming in on the fundamentals, at least for the IT pack. Soumil, what's your view? Happiest minds, what should the viewer do with the stock as well? Last 6 months, we would say the stock is down 25%. Obviously, IT is something that has not been doing well in the last year as well. Now, does it merit continuing to hold it? They bought it at 404 levels, today at 339 the stock.
See, it's in a downtrend. Very clearly, it's in a downtrend from the highs of 1500, 1600 levels in 2021. Since then, it has been falling, and now it is at 339. Clearly, it's in the downtrend. The fundamentals probably would not be that great as well. I would say that whenever you get a bounce, I'm expecting a bounce here till 360, probably 380, and that will be an exit opportunity. Definitely, I would say that you can exit the stock and probably try to get into some large cap names in IT, and for a long term, long term scenario, not in the short term. But yes, IT side of stocks are not looking that great. Happiest mind, exit and probably get into some large caps.
Okay, can look at some large caps also on the IT front. That's a word on the technicals. Let's move on then to the next query. This is coming from Kumud, who's writing to us from Dehradun. It's an investment query. She wants to know if Aegis Logistics is a good stock to enter at current levels. Also wants to know the target price. So, Sneha, on the fundamentals, how is this logistic company actually looking like? Is it a good bet on the logistic front, or would you say there are other names that you would suggest?
Aegis is a good bet on the logistics front. Basically, it is involved in the oil and gas and the chemicals logistics. And recently, their JV with Vopak is expanding their capacity significantly, and thus, it positions them as a prime beneficiary of the India's overall, increasing clean energy focus. For the next 1 year, for next 4-5 years, the company has outlined a very aggressive investment pipeline, and they really want to expand into the LPG and the ammonia distribution side. So they're expecting huge volume growth to happen. So given the capacity expansion plans and given the strategic partnerships that they have in place, we are looking at a good earnings growth over the next few years. So this stock has run up a lot in the recent past. So my suggestion would be, on any market dips, whenever we get the opportunity, the stock can be accumulated. But at the current levels, the valuations are a little stretched. So do adopt a strategy of buy on dips.
So adopt a strategy of buy on dips is what you're saying. Somil, the stock has run up quite a bit post its results, especially in the last 1 month, right? So is it a good buy at current levels, or, do the buy on dips? What target price should this person watch out for?
Yeah, at this point of time, the target would be, in the very short term, the target would be around 1250, 1260 levels, which is the upper end of the Bollinger Band on the daily charts. So now that would be a short term target. But if you want to enter this stock for a long term, this is a very good price to get into it, because I think the long term targets would be much higher. Now, if you are trying to get into the stock for a medium term positional type of a trade, then buy on decline should be the strategy. Probably I would buy it at around 1150, 1120 levels. That's a very crucial level to watch out for this stock. Yeah, you can buy on decline should be the strategy for positional trades, but for investors, I think it's a good buy at this level as well.
Good buy at this level as well is what you're saying. Now, the next query is coming in from Naresh Reddy, who's writing to us from Tirupati. He holds 1,200 shares of REC at 391 rupees. He's making a loss. The stock is currently at 370. He wants to know whether to hold or sell the share at current levels. So, Sneha, what are the fundamentals looking like for REC? Do you expect the stock to run up, and should he continue to hold?
In case of REC, I mean, the near-term outlook at least, looks very subdued because the overall growth momentum is, pretty muted given the weak disbursements that the company is witnessing. And given the rise in the competitive intensity, there's a lot of pricing pressure that the company faces. So, though the asset quality and all remains quite resilient, so that, really showcase the overall strength in underwriting. So, from the medium to long-term perspective, the stock is definitely good, but in the near term, because of the rising competition and a little a cautious demand, I mean, my suggestion would be to sell on rise. But if the investor is ready to hold on from the long term point of view, then probably he could benefit from the PFC REC merger.
Absolutely. That PFC REC merger is also that's something that has been coming right in the recent announcements. So that will be interesting to keep an eye on. Long term on the fundamentals, if you wait for it, then maybe you'll reap the benefits of this. On the technicals, how is it looking like?
Yeah, I'm positive on the stock. You can keep a stop loss around 360 and hold on to the stock. It has just very recently today broken out of a small consolidation, taking support at 10 daily and 200 daily moving average put together. And now I'll be expecting the stock to go till at least 390. 390, there are multiple resistance there from the last 4 to 5 months. Once it is above 391, I think the next move on the upside starts in the medium term outlook, which has a very good target around 450. So I'm very positive on the stock. Keep a tight stop loss in the short term, which is around 360, and 20 daily moving averages at 350. So that will be a crucial level to watch out as well.
Okay, we'll keep an eye on those levels over there for REC. But on that note, we're going to slip into a very short break. Don't go anywhere, viewers. We'll come back and we'll answer more of your stock-related queries after the break as well. Stay tuned in. Welcome back to Your Stocks in CNBC TV 18. We still have with us Somal Mehta as well as Neha Poddar to answer all your stock-related queries. The next query for today is coming from Vinod Kumar, who is writing to us from Kerala, holding 4,500 shares of Spark, and this is at a price of 145 rupees per share. Wants to know if they can continue to hold at current levels, which is at 237. They're making a profit, or they could sell out right now, book some profits, and hold. What's the strategy from here on, Sneha? R&D company, the focus of India's story also on the pharma side is moving to that R&D side as well. And in Q4, the numbers had some one-off as well, which led to a very good number. So what's the story from here on now? Should they continue to hold?
As you mentioned, Spark is a pure play R&D company, and it's not anything like traditional pharma company. So here, their entire business model really revolves around the clinical trial data and the pipeline approvals or the licensing deals. So it's a very high risky stock. Since the investor is making good amount of profit in it, so my word of caution would be he should view this stock as a high beta stock, and the stock volatility from time to time cannot be ruled out, because it really depends upon the success ratios in their clinical trial data, and that results in sharp spikes or fall in the stock. So the volatility is the nature of this stock, but then from the long term point of view, because it's a good R&D business to be in. So if the investor is a long-term investor from 3 to 4 year perspective, then definitely hold on. Otherwise, it's a good time to book profit and move out.
All right, good time to book profit and move on if you're not a long-term investor. Somil, what do you make of this stock? Making a profit on the stock. Do you see more upside? Any targets to watch?
Even I would agree. Book some profits if you are a short-term trader. If you are a medium-term trader, book some profits, because I'll be looking for a short correction, small correction till 210, 205 levels. So that would be my targets in the very, very short term. But yes, in the long term, definitely it has broken out of ending diagonal. It is trading above averages. Great setup for long term. No issues at all. I'll be expecting the stock to go till 275 to 80 levels in the medium to long term outlook. But in the very short term, I would book profits.
All right, in the short term, you would book profits. Now, the next query is coming in from Sri Vallabh, who's writing to us from Bangalore. Now, this is an investment query, and he wants to invest in the real estate sector and wants to know some stocks that he can invest in for the long term. So, Sneha, for the long term, India's real estate sector, what are the stocks that stand out for you that he could invest in?
The real estate sector is, over the past few years, the sector really got re-rated because of the rising urbanization and the strong luxury housing demand. But at the onset of the war, the demand moderated a little. But then once again, with the war settling down and the demand coming back, what we believe is that this will continue to be driven by the demand for the luxury housing, and thus among large players, we like Lodha, and among the mid-sized players, we would prefer Aditya Birla Real Estate and Prestige.
Okay, some of the names you can look at for the long-term story mentioned on the fundamentals. On the technicals, Somil, what would you be watching out for? Any specific names?
I think I would go with the large caps, the DLF and the Oberoi. These two stocks are definitely looking good. They've corrected sharply. They've made a base. The basing out pattern is already there. Oberoi Realty is already broken out of that basing out pattern. DLF is trying to break out above 200 daily exponential moving average. Great setup. I think Oberoi and DLF would be my pick.
Okay. We'll keep an eye out on those names, Oberoi and DLF on the technical front. Next query for today. This is coming from Prashant, who's writing to us from Tamil Nadu, holding 650 shares of NHPC. Price is 99 rupees, asking whether to hold or sell at current levels. Sneha, your view for NHPC?
NHPC has witnessed good turnaround in FY26, and going ahead, they have some of the assets which in the pipeline which would commission in FY27. So that will provide further support to the numbers, and also it's planning to add almost 3,000 megawatt of hydro assets and about almost 1,200 megawatt of solar capacity. So that's a massive addition which is expected to happen in FY27. So if the derailment doesn't really happen or it doesn't get delayed, then definitely that will be a major growth which will come to the revenue from these projects. So one should hold on. At least there are many positive triggers, and I don't really see any red flags so far. So from my side, it would be a hold.
So from your side, it is a hold. Somil, should he sell at current levels or continue to hold the stock for now?
NHPC definitely hold. I think 70 levels are very crucial for the stock, and it's been holding on to these levels like 70 level for a very long time, and it's been consolidating. Of course, not performed really well, but I would hold on to the stock, and I'll be expecting a target of 90 and above 90. I think the next level would be 502 levels.
All right. The next query is coming in from Shiv Bandhu Mittal, who's writing to us from Noida. He holds 6,000 shares of ONGC at 273.25 rupees. He is making a loss on it. He wants to know whether he should continue, whether he should hold the stock or sell at current levels. We've seen oil prices be volatile, and the stock hasn't done much in the last 1 year. So, Sneha, what are the fundamentals telling you?
My suggestion would be to exit ONGC, because normally the upstream companies don't do well in the falling oil price scenario. And I mean, the valuations are pretty supportive. It's a good dividend yield stock, but only hold on to it if the investor is looking from the dividend yield perspective. Otherwise, not much is expected from the company. The medium-term prospects look pretty decent, but if the oil prices continue to hover at the lower levels, then probably not much can be expected from this stock.
Not much that you're expecting, but on the technicals, what is the view coming in here, Somil? 273 is the buy price.
Yeah, I agree as well. But it's in the downtrend. Definitely, it's at a very crucial levels, around 230, 235 levels, a very crucial level for the stock. It probably would bounce back till 260, 265, but that will be an exit opportunity. I would exit this stock and try to get into some other sector where things are looking good, like pharma and defense are looking good as well at this point of time. So ONGC, I would exit at bounce.
Okay. ONGC, you would exit at bounce. That's a word on the fundamentals and technicals for ONGC. Let's move on then to the next query. We have this coming in from KS Rao, who's writing to us from Andhra Pradesh, and not a stock that we discuss regularly, but he's holding 1,000 shares of Avenues AI, which was previously known as Infibeam. We bought it at 30 rupees, long-term story. Sneha, or does it merit holding this for the long term from here on as well? 2 years time period?
We do not cover the stock, but the company is transforming itself from the the transactional payment gateway towards the AI-led business model. However, this transition is resulting into a lot of expenses, which is kind of putting pressure on the overall numbers. So from the at least near to medium term perspective, my suggestion would be to exit from the stock because it will continue to put pressure on the profitability of the company.
All right. Somil and Sneha, thank you so much for taking time out and answering all of our queries on your stocks.
Absolutely. And, with that, we're actually absolutely out of time on this edition of Your Stocks. Remember, you can always email us your queries or send it to the phone number that'll be on the screens for you all as well. But it's a goodbye from both of us. Up next, your closing bell to take you through the last hour of trade.
beyond market headlines. To understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Bit of a mixed opening is what we could say that's coming for the Asian markets as well.
The 10-year yield went up 9 basis points to 4.46%.
I think it's the most significant death knell to the prop trading industry.
0.25% higher on the Nifty, and the Nifty Bank up about 0.14.
The US guys understand whatever is the AI story much better than what the domestic community understand.
We are trading below 200 and 100 days moving average as well when it comes to the gold prices.
Talking about the auto SUV, continue to see a healthy growth even in the month of June.
It's a strong start to the July series for the markets, at least as of now.
HCLTech has done is they're saying in Q1, they're expecting the revenue growth to decline by 1% on a year-on-year basis.
The labor areas we talked about earlier, those will be largely solved.
Jefferies today has come out with a note on MCX and initiating the coverage on the stock.
First day of July, first day of the new series, and it has started on a good note.
Okay, it's a good session, 160-odd points higher on the Nifty, 24,000 back on the table once again. This is Closing Bell, last hour coming up. We are coming to you from the CNBC TV 18 Motilal Oswal studios. I'm Prashant. Rima, with me. Rima, hi.
Hi, and in the driver's seat today are the consumption names. Auto, as the auto sales numbers trickle in and so far look pretty good. Banks are performing in line with the index. The Nifty Banking Index up 400 points. IT is lagging. We'll discuss that. The only thing is the advance decline ratio for a market which is up 500 points in the Sensex. It's not wow. It's still in favor of the advancing side. We've got about 1,700 stocks advancing for 1,300 stocks declining. But the gap between the two has narrowed even as the markets are consolidating above that 24,000 mark.
You know, lots and lots of stuff happening, right? So consumer, of course, is doing well. And there is, we'll have Mangalam come up in just a bit to talk about that. So actually, it's two halves. Consumption doing well. On the other side, of course, is IT services, which Rima will address once again in a bit after KPIT's profit warning, which came through. Autos is the other area with the auto sales numbers, which are coming through. Let me just quickly run you through, what we're going to talk about. So Nifty, of course, 24,000 plus. FMCG is leading. IT metal stocks under pressure. Broader markets, of course, slightly underperforming. Market breadth, though, is positive. IT deep dive with Rima coming up in just a bit. As I said, consumption is very much in the under the spotlight. So all of that coming up as we go along. Well, let's just quickly get a sense from what the charts are telling us. So Mitesh is with us to help us with that. Mitesh, good afternoon. Good to have you back. How does it look?
Prashant, I think the markets are up there, but it's still not showing any signs of breaking from this range. So as I said in the morning, in case we don't decline, then I think we might head towards the upper end of the range, which is 24 to 5,300 zones. And now it looks like we're heading towards that. So on the index, nothing much, but on the stock side, I think you were discussing auto names. I think Ashok Leyland has finally given a breakout above 160. So that's a buy with a stop below 160 for a first target of 170. And then CDSL is something, which after a few days of pullback is re-entering an up move. So that's a buy as well. Keep a stop below 1319 for targets of around 1,400.
Anything in the consumption space? We'll get to Mangalam to talk about the fundamentals, but Eternal 5% up. Nestle is crossed the 50-day moving average today. HUL is looking up 2.5% large volumes.
Eternal looks the most interesting. In fact, it kind of gave a breakout on the 19th of June, and then 4 or 5 days were spent in a pullback. The momentum was looking like lost, and then today again it's picked up, getting past those 263, 264 highs. I think it's heading towards 300 levels. So very positive on Eternal. That apart, I think the rest of the pack, it can give a trading move, but what is also catching my eye is Dabur. Dabur, after a good consolidation around 420, has broken on the upside. So keeping a stop at about 430, Dabur I think is heading towards 470, 475 zones.
I see. So Eternal and Dabur, basically, right? I just want to quickly, thanks very much, Mitesh, for that. Just one pack of group of stocks, actually, which is doing very well. which is actually all the demerged Vedanta entities, right? And just look at this. Vedanta Power is up 9.5%. They should come up one by one. It's stocks at about 44. It's come off the highs, but still looking very strong. Vedanta Iron and Steel is locked up 10%. Some 15,000 crores in market capitalization on this one. And look at Vedanta Oil and Gas. Vedanta Oil and Gas is up, not this one, Vedanta Iron and Steel. Yeah. Oh, yeah, this is the one. So 20% on oil and 10% as far as the iron and steel business is concerned. The largest of the lot, of course, is Vedanta Aluminum, which is back at 460. So it dithered, fell about 20 rupees or so. And today it's back at about 460-ish kind of levels on it. So that's another pack which we will address. Prima facie, of course, these stocks were in the T2T segment. That's trade for trade. They are out of the trade for trade. So I guess you can build positioning and opens up freedoms for all kinds of market participants. But I think there are some individual catalysts as well, especially in the case of Vedanta Oil and Gas, where I think there has been a update to investors yesterday. So more later. But consumption is back, right? And we discussed with Mitesh some of the ideas. He likes Eternal, Dabur, but Mangalam is here with a snapshot view of what's getting the street a little excited here. Mangalam, take it away.
Well, Eternal and Dabur, two ends of the same spectrum. You have high-end consumer, urban discretionary, and a fair amount of rural. All of that doing well. The FMCG index itself is up 2%. So we speak about both staples and discretionary. Staples are doing a lot better in today's trading session after underperforming, and discretionary has been doing well lately, but saw some underperformance recently and now is coming back as well. I'll give you an anecdotal reason and I'll give you all the other factual reasons as well. For staples to do well, anecdotally, every time there is more than just a pitter-patter and it rains a little more, and the street believes that maybe in Mumbai there has been monsoon which has set in, all these consumption stocks start to do well. But if you look at, just factually, growth is expected to pick up in the first quarter. That's largely led by volumes and, more importantly, price, because price growth after 3 years has come back. We've heard from all the companies saying they've taken price hikes anywhere between 5 to 7% in most cases, in double digits as well for those who are very sensitive to crude. So price growth along with volume growth would mean that there would be high single digit to low double digit growth, at least on the revenue front. So this sector was parched for revenue growth. Secondly, the street was worried, okay, if revenue comes, maybe margins could be under pressure because raw material prices have seen a lot of inflation, which is why these companies have taken price hikes. Turns out that now going forward, that pressure has been dissipated as well because crude and other input costs have receded from highs. So barring a couple of quarters, margins would not be that big a pressure either. And finally, monsoon pickup from here on will be an extremely important monitorable from here because yes, monsoon has set in late, but can July make up for the shortfall? Can rural demand improve or not as well? But above everything else, these staple stocks have done nothing over the last 3 years, if not given negative returns. At best, they've seen some 1.5 to 2% sort of CAGR moves over the last 3 years. So in the last 3 years, Nifty FMCG is actually down 5%, with the Nifty having risen about 30%. And this accounts for the Nifty correction that we've seen in late 2024 as well. So multiples have corrected, seen both price and time correction, which explains why these stocks are doing well. And finally, discretionary stocks. We have Eternal, Swiggy, Page Industries, Delivery, Ixigo, all of them doing well in today's trading session. They're actually a barometer of what the market sentiment is. Typically, when the market sentiment is sad, these stocks see underperformance. When the market sentiment is slightly upbeat, we see these stocks come back with vengeance as well. Limited impact of LPG shortage on quick commerce and food delivery ordering. That's what brokerages are expecting from the first quarter. In fact, the company itself, Eternal, has guided for at least 60% NOV growth for Blinkit. And they believe that, if the company does go ahead and outperform that, then there is case for upgrades coming in. There is higher focus on profitability because Zepto is listing as well. So lower competitive intensity in the quick commerce space. And finally, for names like Ixigo and a lot of the hospitality names to buzz around, domestic travel in the first quarter did a lot better because of lower foreign tourism as well, the weaker rupee, the Prime Minister's appeal, etc. And alongside that, remember, same time last year, we had the twin tragedies. One was Operation Sindoor, and the other one was the Air India crash. So the tourism industry actually is facing a low base in the first quarter. So to that extent, optically, these numbers would look a lot better this time around as well. And finally, a word on all the jewelry companies. Remember, ever since the government increased the customs duty on gold import, we are likely to see one-time gains coming in for all these companies over the next couple of quarters as well. The ones who are sitting on old inventory and now, will benefit from that. So all these factors are leading the consumer space across the board see some traction.
Thank you very much for that. Dilip Bhatt, founder of Pedigree Advisors, is now joining in. Dilip, you want to weigh in on consumption? Is it a good bet, or do you think markets are just excited that you feel monsoon is here right now and it may not stay?
Good afternoon, Rima. I think the much-awaited move in the consumer space finally seems to be happening. But one thing really, the apprehension certainly remains on the kind of the volume growth that we are talking about, because the volume growth was conspicuously missing in the last couple of years. And hopefully that the way the things are panning out, the macro headwinds, except for the fact that the rains may act as a spoiler, but otherwise the macro tailwinds, not headwinds, are very much in favor of the consumption at the moment. So I would say that, yes, they have taken price hike, the GST has come down. So I think a little volume growth will result in a good overflow into the operating margins as well as in the PBT. But I think the markets, for them to take this, invest on a sustainable basis, will be keenly watching the volume growth. And I'm not too sure whether anybody has given a very exuberant volume growth forecast, even for this quarter or maybe for the whole of this year. No doubt everybody is expecting improvement. But I would say that that will still be very keenly watched, and the way the management comments will be one will be looking forward to.
What do you own in the space? Mangalam talked about delivery. I was looking at another name, Shadowfax, listed earlier this year, 2026. If you can have the name up. And it's doubled, basically, from 100, I think listed at about 100 rupees and 233, 6 months. But there have been lots of doublers this year. This, of course, just happens to be from the sort of parcel/logistics delivery kind of space. Sorry, Dilip, what do you own in the consumer space? I mean, there's the old staples, there are newer companies, there are more technology-oriented names.
So I think in the platform space, we certainly own Swiggy. I think that's one company which we like. And possibly we'll be looking to buy even if it comes down a bit. I think that's one thing, because they're adequately, in terms of the cash in the books, they have a good amount of cash in the books. I think the profitability also seems to be coming back in a big way. Of course, there is a very intense competition that we are expecting. The competitive intensity is only going to increase. What with even Amazon also planning to come into this, Walmart planning to come into this space, I think it's going to be much more competitive as a landscape. But still, I think Swiggy is one that really stands out for us. And as far as other names are concerned, I think more as a resilience or more as a defense to the portfolio, something like an HUL or Nestle is what we are certainly holding on at the moment. But not very keen to buy some of the names at the moment, because we feel that without any doubt, the entire space is exorbitantly expensive at the moment. And only hope is that there will be some kind of momentum that we may see.
Yeah, got that. Swiggy actually has, of course, if you just look at the price chart, it's taken the bulk of the competitive intensity from Zepto. It's came to the market in late 2024. And it's, went up all the way. Swiggy high was about 600 rupees or so. It's about 245. So it's actually come off quite a bit. So Dilip saying that this is the name he'd look to buy. We'll see. Amazon, of course, lots of news flow around how Amazon is picking up with more competitive intensity and whatnot. There is, of course, Zepto, which continues to power ahead. The IPO, of course, is on the anvil. Blinkit is, of course, clear number one. I think 2x, 2.5x the number of dark stores compared to the second nearest competitor, which, of course, puts Swiggy, which has been in a bit of a tough spot. All right, well, let's just talk about autos as well, right? June auto sales numbers coming through, and Sud's got the details here. Just a compilation of who's done well and how. Sud, take it away.
So it's been a mixed bag, but more positives than negatives. So we start with Mahindra and Mahindra. Both auto and tractor segment numbers have been largely better than expectations. For auto segment, SUV continues to see a healthy growth. Growth there was more than 28%, but this time the surprising part was the commercial vehicle segment. LCV, which is between 2 to 3.5 tons, their growth is more than 35%. Tractor segment growth has come at 12% versus our expectation of 7%. Company is saying that it's too early to assess the impact of emerging El Nino conditions, but if things progress well, it's going to achieve the estimates that company has given for FY27. Coming to Maruti Suzuki, sales were largely in line. Here, the positive part was the entry-level segment. Their sales have almost doubled YY. In the month of June, sales were more than 11,000 units against 6,400 units in the same period last year. And SUV segment continues to do well here for Maruti too, and their growth was more than 28%. One negative part was export segment, where growth was just 13%, and in comparison to that, domestic segment's growth was more than 20%. Tata Motors PV, healthy growth on a low base. Total sales have increased by 69%. EV segment, where company is a market leader for this, sales have almost tripled YOY. One company that has underperformed its peers is Hyundai, but sales were largely in line. It has seen a decline of almost 16%, and that's because of production loss that company has seen. There was a fire incident at its manufacturing facility in Chennai. Company is saying that it's going to recover that production loss in Q2 FY27. One segment where both companies, Ashok Leyland and Tata Motors Commercial Vehicle, have given very strong numbers. That's your commercial vehicle segment. For Ashok Leyland, MNHCV and LCV sales have seen a growth of more than 20%. MNHCV sales have increased by 24%, and LCV sales have increased by 28%. And just if you take a look at truck segment, their growth was more than 44%. For Tata Motors Commercial Vehicle 2, it was a strong print for June. Total sales have increased by 35%. Our expectation was 26% increase, and it was led by domestic segment, where the growth was 31%. Amongst two-wheeler names, Hero Moto has come out with the numbers. We were expecting flat YY, but company has seen a decline of more than 2%. And the reason was company has seen a decline in the motorcycle segment, where the decline was 7%. And because of that, domestic sales have declined by 4%. Export contribution is negligible, but their growth company has registered of 30%. So overall, it's a mixed bag, but more positives than negatives.
Okay, and it's getting reflected in the stock price. The numbers that we're awaiting are from Bajaj Auto and Eicher Motors. That perhaps will come tomorrow. Dilip Bhatt, founder, is still with us. Dilip, your preferred bet in the automotive pack, and globally, just going by what KPIT had to say, you know, companies like BMW, etc., are hurting. They're giving profit warnings. They're cutting their guidance. This also has implications for an European auto OEM company like a Motherson Sumi, which also caters to the same clientele. What is your read-through for a company like Motherson Sumi based on what's happening with KPIT and their clients?
I will just come back to it. I think only on one observation. I think with the kind of auto numbers that we have seen, one thing is certain, that the economic growth in terms of the GDP number should continue to look good, because I think we are seeing a good offtake in commercial vehicles, and auto segment as such has been, though a slightly mixed bag, but I think they have been largely very positive. And I think auto sector is the one which, along with the real estate and infra, gives a good multiplier impact to the economy. Coming back to your question about KPIT, I think certainly the way the European companies are cautioning as far as the auto industry is concerned, I think we can see the immediate impact on somebody like KPIT or Tata Elxsi, or maybe even Tata I think Tata Technologies. I think some of those companies will take it on the chin in terms of the volumes. So what I would say is that, yes, as it is, the software sector was, there was a shadow of AI. And I think some of these sectors really cautioning should have an impact on the revenue, and KPIT has rightly warned, and maybe that is leading to a very contagious impact across the software companies. So I think as far as Motherson Sumi is concerned, yes, it will sentimentally, even they might get impacted, but Motherson Sumi, I mean, they're very broad based, they're very broad basket. So maybe they may not be so much impacted in terms of the numbers, but yes, sentimentally they will remain under cloud.
Okay, got it. Well, let's just get back to the big story today, right? Which is IT services, and this is, of course, not turning out to be a great week at all. We're just midweek, and the IT index, I think, is down over 5%. Rima is here with a detailed view on what's happened. The latest trigger, which is KPIT, but it's only the latest trigger. It's basically been, a long journey on the way down. Rima, take it away.
Well, this is the worst half-yearly performance for the Nifty IT index since 2001. From January to June, the Nifty IT index is down 30%, and even today, it's under pressure. In fact, the index is now trading at a 3-year low. Let's just quickly do a scoreboard first of the year-to-date performance. And as you can see, large cap IT is down close to 35-40%, and mid cap IT names have fallen close to about 50%. HCLTech particularly with today's crash. Now, with this, valuations have also come off. So roughly now, large cap IT companies are trading about 13 times forward multiple, FY28. The 10-year average would be 15 to 20. Companies like TCS would be trading higher. Companies like Wipro, HCLTech historically traded at lower valuation multiple. But despite Indian IT now trading at a deep discount to what it used to, it's still trading at a big premium to global IT companies. So here's, these are some numbers. So Goldman Sachs says, so according to their analysis, IT is trading at a 14 times forward multiple. Again, this is at a discount to the 10-year average, a 35% discount to the 5-year average. But now compare it to Accenture, Cognizant, and Capgemini. Their average multiples are just 8 times. So India is at 14 times. Global peers exactly doing the same thing. It's trading at 8 times. So they're saying that Indian IT companies are trading at a 90% premium to global peers, and historically, Indian IT commanded a premium of 20-30%. So in a nutshell, according to them, Indian IT is still expensive relative to their global counterparts, and considering that this industry is going to see a low single-digit kind of growth, they don't sort of see it compelling. Morgan Stanley goes on to say the derating is not over. In the past, large cap IT bottomed at 11 to 13 times for 2-year forward multiple, so they see room for further downside. Now let's get to the fundamental trigger behind all this. Now, FY27 is going to be the 4th consecutive year of anemic growth for the Indian IT industry. KPIT today, of course, issued their profit warning for the current quarter. They're saying growth will just be, it'll be a 1%, negative 1% USD on a year-on-year basis, so minus 1%. And even for Infosys, I was looking at the brokerage estimates. It seems like the company in 3 months will be cutting the top end of its FY27 organic guidance. So the current guidance for Infi is 1.5 to 3.5%. But there are many brokerages who believe that 3.5% will come down to 3%, maybe 2.5%. The brokerage view is that organic demand recovery up until now is too slow to justify holding on to the upper end of the premium multiple. And even for the, all the other companies, Goldman Sachs has already cut the aggregate forecast for the industry to 2.4% revenue growth in the current year. Morgan Stanley too has lowered the FY27 growth numbers very sharply. For TCS, for example, it's a sharp 250 basis points correction. So what are you going to, watch? We're going to be watching, for one, whether organic growth this year will be more or less compared to what it was in the prior year. We're going to watch for discretionary spending, whether the BFSI resilience is holding on and can it offset the continued softness in telecom manufacturing. AI-led deflation, that's important. Currently, expectations are for a 2 to 4% AI deflation. Is it more than that? And is money coming in from AI-related revenue streams? AI investments, we've already seen a step up in terms of acquisitions. So how much are companies willing to plow into their AI offerings? And cost efficiency programs have been running. You've got a Project Maximus at Infosys, Fortius at Tech Mahindra, Ascent at HCLTech. So this is something which perhaps is going to accelerate, and headcounts are likely to remain muted. I think the bulls will tell you that maybe IT is cheap at 13 times. The bear tells you that cheap is relative. But it's surely going to be a very interesting earnings season for the IT sector.
Okay, well, good, bad, ugly. We will see how it goes, but that's pretty exhaustive as the report coming through on what IT has done. Dilip, your thoughts here? I mean, it's they say beauty in the eyes of the beholder. So the question is, what we had Sanjeev Prasad in the morning. He was talking about Cognizant Accenture multiples at 7 times, 9 times. So, yeah, I mean, what do you do here? IT stocks.
So, Prashant, I must say that Rima really summed it up so well in this particular analysis of hers. But I think certainly, unless and until there is a clarity on the volume growth, I think there will not be any sustained buying or interest in IT stocks, howsoever cheap they may get. You know, the analogy can be something like what happened in FMCG, that the volume growth continues to be very anemic. And despite they having a very high ROE, have very good cash flows, they refuse to go anywhere in the last 3 to 4 years. And possibly the IT companies, possibly we are staring at that. Here, there is a double whammy. One is the AI factor. Other is some of the industries that they're catering to have also sounded some red flags at the moment. And also not to forget that most of these IT companies, the frontline IT as well as the midcap, is also, even after the FI selling, they still continue to hold a good number in that. And if they were to do a comparative analysis with their international peers, obviously they would look to sell further. Even if they don't want to sell, they will certainly not come to buy. So it's a very challenging thing, but I still feel that IT will continue to move sideways or downwards. Unless, and there may be some intermittent opportunities where there may be some news which may trigger some buying or particular level. But on a sustained basis, I think IT will remain on the downside.
Yeah. Dilip, we will take a quick break. Thank you very much for all those insights, ideas, and that conversation is always here on CNBC TV 18. Thank you.
Thank you so much.
Okay, take a break. We will come back in just a bit from now. And we'll have Amit Gupta of Muthoot Oswal Private Wealth on the other side. Stay tuned, coming up.
Welcome back. Let's put the spotlight now on some of the top movers in the market at this hour. Hormis joins in.
Lots of them in the broader markets today, and RITES is one such name. In fact, the entire railway basket has been buzzing in today's trading session, but no better than RITES. 14% higher on the stock, the biggest single day gain since May of 2025. The highest volumes on record for the stock today. They had close to 9 crore shares that have been traded on RITES. The 20-day average is only 7.5 lakh shares. And in these 9 crore shares, 8% of those have been marked for delivery. And in fact, today the stock is the the most traded on the Nifty 500. And back in February of 2024, the stock had made a record high of 413 rupees. It's down around 44% from those levels. Eternal is another name that's doing well today among the top gainers on the index, 5.5% higher for the stock. The third straight day of gains now, during which it has gained 9% in this 3-day period. Even on the FNO side of things, the 280 call option has seen its premiums go up by 95% in today's trading session, and the stock is gaining on fairly decent volumes as well. It had 5.5 crore shares that have been traded on Eternal. The 20-day average is just over 2 crore shares, and more than half of those shares are marked for delivery so far as well. And the stock is coming on the back of 3 straight months of gains, although single digit, but they were gains nonetheless, and rebounding from its 52-week low is Eternal. And lastly, Delivery is a stock that has been making moves on the upside very recently. 7% higher in today's session, the biggest single day gain since August of last year, the second straight day of gains. And in today's session, there was a very sharp spike in volumes after 12:45. And since then, there have been more than 1 crore shares that have been traded on Delivery. The 20-day average is around 35 lakh shares, so around 3x its 20-day average, and more than half of those are marked for delivery so far. And the stock, for the first time after its listing, is today trading above the mark of 500 rupees and also trading above its IPO price, which was also incidentally its record highs. Back to you guys.
Thanks very much, Hormuz, for that. Always interesting. We'll talk more with some of these individual names. But I think Eicher numbers are there now, 0.8 higher. Eicher had sold off pretty aggressively yesterday, and it's coming back up a little bit. Not much though, 0.5%, 1%. Amit Gupta is head of equities at PMS at Motilal Oswal Private Wealth. Amit, good afternoon. Good to have you with us here. So should we start with consumer? Should we start with IT? Let's start with IT, Amit. I don't know if you heard Rima's masterpiece on what's happened with IT names and the factors and valuations, etc. And we've done this often. The only thing is, every time we put this piece out, it's another 1,000 points gone on the IT index, right? What's the right value here? I mean, the question is, how much deflation will there be? We don't know at this point. Is it just too hard to try and figure out? So leave it be. Look for ideas elsewhere.
In terms of valuations, I think we have not seen such a attractive valuations in IT large caps before. 13, 14 times these stocks are trading now, and I think, but you need to see that this is not a value market. The market is looking for future earnings growth. And this is where all the categories which are performing right now, they are actually on the back of that. If you see, large caps have not performed. I'm not talking about only IT, the other large caps also, because the earnings growth expectations were in single digits. And in financial year 27 also, it is actually in single digits. So if you look at the mid-cap category, right? So mid-cap, they were growing in more than double, more around 24-25% of earnings growth was coming. And that's why the mid-cap index is almost making the new life highs. I think the going forward, where we need to focus is more growth. And this is where, when the crude oil prices have come down, I think we need to start looking at some of these small cap ideas also, where earnings growth can go into double digits. I think maybe more than 24-25% going forward in financial year 27. So I think that is where the major delta is going to come out. But I'm not picking the small caps still from the IT pack, because the future growth is still missing. So we have to see the volume. So it is only the currency tailwind which came actually in favor of them. And in fact, in the Q4 financial year 26, that dollar revenue guidance also again was very muted. So we have to see the commentary going forward. Otherwise, we have to pick those ideas only which are moving more into artificial intelligence. Yes, already the inorganic growth already started. You have seen the likes of Coforge, Persistent moving into that direction. So I think the day will come when finally, as per the valuation and as per the earnings growth going forward with the AI book, we can start giving some value to these companies finally.
So you said you would bet on companies, small caps, where you are seeing about a 25% earnings growth. Can you name some companies where we are seeing such strong growth?
I can tell you certain sectors for sure, because if you see going forward, a lot of FTA agreements are also going to be signed. So our competitive strength will come up So I think textile is one of the space where you will find some of these small cap ideas which can do much better. In fact, now the government has reduced the import duty on cotton. So those which are in yarn to fabric, their spreads are widening. I'm not talking about those which are taking input as polyester, but basically from the cotton side, I think the spreads are widening. And when the market is opening up now for the garment players also, I think those companies are the vendor to all these garment players and they are going to be benefited. So this is where the textile may be one space. I think automobile we have been talking about now. After the GST cut, you have seen the numbers are coming good. In fact, this month numbers again have been very good. That shows that the consumer discretionary as a theme is going more into the automobile space. But my sense is more money can be made in the auto ancillary space, because that is also linked with the FTA agreements getting signed either with UK or Europe or extra or somewhere else. I think you will get a good tailwind in auto ancillary as an export opportunity also, when the rupee is also is not at 82, 83, rather it is at a 94, 95.
Top ideas, Amit, in both textiles and auto ancillaries. What are the picks?
So I will not be able, because of the compliance, I will not be able to take the the stock names. But I think sector specific opportunities are there, Prashant. In fact, not only this, if you see from the transformer, because that is what people have already been talking about. I think if you see the solar 25 gigawatt that we created, if you see 30 gigawatt we are going to create now next year. And if you just imagine power grid in the entire lifespan, they have around 5 to 5.5 lakh square kilometer of transmission line in India. But now with this 30 gigawatt, you need almost 1 lakh square kilometer, because Rajasthan and Gujarat, that is where this solar is coming up. Or you can count Maharashtra also. But where you are transmitting, you are transmitting to UP, Bihar, West Bengal. So almost 2,000 kilometers of lines are there. And one thing now, the government is very, very focusing that there should not be transmission losses, because we used to have 7-8% of transmission losses, where they are trying to reduce to 1 or 2%. And that is where the new opportunities of HVDC, transformer oils, oil-filled cables, a lot of opportunities are coming up, where I think a lot of vendor companies in India from the manufacturing side, it's a good time for them to start performing. And that is where the future growth is imbibed.
So you make about transformer makers like your CGs of the world, and are you talking about electric tower EPC companies like KEC? Which segment, or there are others as well? Which category?
So one is obviously the transformers, where I think if you see the transformer prices have already zoomed up, especially in the step-up transformer, by almost 78 to 95%. That is one category for sure. But there are vendor companies to transformers, which are giving, transformer oils or etc. etc. I think those vendor companies one should start looking at. Opportunities are there. Yes, because when you are doing your maths, sometimes the stock prices have already moved up. And that's why if you see market is giving opportunities, market is seeing some intermediate corrections, and that is where the opportunities are coming to, start looking at those companies. I think AI infrastructure as a theme is really building up, which is linked to data centers, because you know that Air Trunk, for example, from US is expanding big time. They are going to bring out of the 9 gigawatt that India is coming out in data centers, 4 to 5 gigawatt is going to come from that. And I think ultimately, that what kind of services, what kind of things are required for data centers. I think that the whole ecosystem, I think whenever the corrections are coming, we should look at, because earnings growth is imbibed over there. And I think this is what market is going to value.
Okay. Thank you, Amit, for joining in. For the markets, we're at the 24,000 mark. And while Infosys today has slipped below the 1,000 rupee mark, TCS too has slipped below the 2,000 rupee mark. And that's happened for the first time since 2020. So the bleed continues on IT names. Let's get to D Street Chatter now. Nimesh joins in with an insight. Nimesh.
Hi, Reminder. So it's a very strong start to the July series, and my sense is large part of today's rally could be the fact that there is lack of selling pressure from institutional investors. All of June, there was a bit of selling pressure from one of the largest insurance companies, and of course the FIs were net sellers as well. Also, the supply of paper will dry down because of the cool-off period for promoters, and also maybe that explains that there is a big move in today's market, especially led by the FMCG names. The index has gained nearly 2%, big moves in the individual names as well. I think large part of this rally in FMCG is because of the upgrades coming in and the fact that this quarter could be quite strong in terms of earnings for the FMCG names. So that's the reason why that one market is holding up very strongly, and those stocks have done well. On the other side, IT, of course, you've been highlighting it's under pressure on expectation of fears of weak earnings, and to some extent a bit of selling as well. Apart from IT as well, there are some names in some sectors which are, for instance, metal is under pressure today. So a divided market, so to speak. But I guess today's rally seems to be a fact that there is lack of selling, and the fear of big supply is going to be not there, at least in the earnings season. So maybe that explains a bit of up move in today's market.
What about stocks, Nimesh?
Well, so the first stock is Sedimac. Again, a big outperformer within the auto ancillary name since the listing. But there could be a small block in this particular stock very soon. All the potential blocks which can happen should happen in the next 1 week or so if the promoters have to sell. So there's a small window still left, so maybe you'll see a small block there. So that's the first name. The second name is Execo, late Travelers Technologies. Again, it's been buzzing in trade today, but there could be a potential corporate development in this particular name very soon. A potential acquisition is on the cards. It's been widely reported as well, but could get announced very soon. So that's the buzz in Execo. The third name is Lodha Developers. The entire real estate pack has done reasonably well today, but Lodha stands out in terms of strong FI buying. Remember, last week there was a large block, and FMR bought a big stake. So post that, you're seeing a bit of incremental buying from large institutions in Lodha Developers. And the last one is Delivery. This came as a bit of a surprise as well. A big up move in that name, up 7%. Largely, my sense is it's more to do with the HNI activity. Ahead of the earnings, maybe some bit of buying is happening in Delivery at current levels.
Thank you very much for that. We will get into a break. On the other side, we'll get you a few BTST calls from our experts. Stay tuned. Welcome back. Mitesh is now joining in for a few BTST calls. Mitesh?
So I think, Nimesh was talking about Lodha Developers. I think a very good contracting pattern breakout over here. So BTST with a stop at 982 for targets of 1015, 1020. And CG Power is another one, which after a few days of consolidation is breaking above its previous intraday highs. So that's a BTST with a stop at 966 for targets of 990.
Delivery and CG, right?
Lodha Developers and CG.
Sorry, Lodha and CG, yeah, okay. 1850 stocks are higher, about 1420 stocks are lower. And I mean, there are a few outsized moves. IKS, which has been a very, very sluggish name since listing, is making a sharp move higher. IKS is at about 1800, which is a 7% pop at this point. And Viatech Vavag is another one. Was up 6 in the morning, is up about 3% right now. WeWork is starting to climb again. The low this year was about 400. Stocks at about 720, 730 or so. So lots of action. Car trade, 5%. Page Industries, Mangalam was talking about, that's a 5% mover today. CDSL is up about 2.5%. TBO Tech, we were talking about rate gain earlier. TBO Tech is come up a long way. I mean, low this year was 1,000 rupees, and it's at about 1,600 now. So strong mover, especially I think after the Iran conflict came to an end. I think the price was about 1,200, 1,250 then. From that point, it's moved up another 250, 300 rupees or so. Well, let's just talk about the oil segment here. And let's look at where jet fuel prices are, commercial LPG prices are, because there is a downward indication across all these segments. They're getting cheaper. So for user industries, it's great news. What does it mean for oil marketing companies? On the other side, Sonal is here to tell us more. Sonal.
Well, a lot of things are happening. The first thing that happened is that crude oil prices at that $70 per barrel mark, the Indian crude basket as of now, is below the pre-West Asia war levels as well. In fact, yesterday, crude prices saw the biggest monthly and quarterly losses since the COVID-19 pandemic. So that's the kind of fall that we've seen in crude oil prices in the month of June itself, which is, of course, positive for a lot of these companies in the country. There are a lot of changes that happened today. The first one being government revising special additional excise duty for July. For for petrol, it is increased, while for diesel and ATF, it has seen a reduction. Petrol has increased to 4 from 1.5. Diesel has been cut to 8.5 from 14, and ATF has seen a cut as well to 7.5 from 12.5. Now, which are the stocks which will be in focus on the back of that? Reliance Industries, because it is one of the biggest exporters of diesel in the country. Around 55 to 60% or 45 to 50% of their total exports are from diesel. MRPL is the other one. It does not have as big an amount in terms of diesel exports, but it does have around 9% as per reports, and it is one of the major exporters as well. The other thing that happened is LPG prices have been cut. This is for commercial cylinder. It has been cut by 183 rupees to 2,930 rupees a cylinder. The jet fuel prices have also seen a cut from 115 rupees per litre to 110 rupees per litre. Additionally, private retailer Nayara Energy has cut petrol prices by 5 rupees per litre. They've also cut diesel prices by 3 rupees per litre. The indication is that maybe oil marketing companies could go ahead and cut prices as well. But of course, it's a big maybe that we are talking about. All of this, of course, impacts oil marketing companies. The biggest positive for them is that sharp fall that we've seen in crude oil prices. ICICI Securities came out with a note today, and they spoke about how crude in the current range is quite positive for those companies, and it ensures that retail margins could remain at those elevated levels of 8 to 10 rupees per litre. Earnings profile for oil marketing companies could change materially over the next 12 months, and that's why they've upgraded HPCL to a buy, while they've reiterated buy on IOC and BPCL. But of course, the first half of FY27 will continue to be weak. But of course, there's a risk that we have to talk about, because there was an excise duty cut for OMCs. This could be rolled back by the government. And if that happens, CLSA says at current stock prices, all these three stocks are factoring in auto fuel marketing margins of 3 rupees per litre. So if there is this 10 rupee per litre excise cut as well, they will require Brent crude prices to be at that $70 to $75 per barrel mark to maintain margins at current levels and not go back into losses. So it's very important for Brent prices to sustain at current levels for these companies to continue to enjoy profits, or at least ensure that they are not making losses.
Okay, thank you very much for that, Mayuresh. Okay, we'll get to Mayuresh Joshi. Okay, we've got Mayuresh Joshi now joining in on the show. Mayuresh, thank you very much for joining in. Let me begin with auto and the auto sales numbers that have come through. I believe in the past you've liked Uno Minda because that was a bit of an EV agnostic play. But have you expanded your list considering that the sales numbers continue to be very strong this time, particularly CV has been quite robust?
Afternoon, Rima. I think the CV cycle is turning for the better, and that is probably getting exhibited in terms of numbers. Ashok Leyland, I think, had a stellar set of numbers for the month gone by. And therefore, I think the expectations largely getting built in for an uptick in the CV cycle will largely translate into better volumes when it probably comes to the entire CV ecosystem, whether it's HCVs, MHCVs, or the LCVs that Ashok Leyland does as a last mile connectivity. So I think if this trend probably continues, I think CV players might probably in a very, very sweet spot. Auto Angs is something that we have liked consistently over the past few quarters. We did add a couple of more names. Sansera Engineering is something that we added a few quarters back. We recently added Shriram Pistons that has done phenomenally well over the past few days. Our own sense is that these select niche auto ancillary companies get the benefit of a steady state OEM cycle, but a good replacement cycle with better margins actually augments the overall numbers going forward. The EV mechanisms that they're probably getting into without creating too much of leverage on their balance sheet acts as a further kicker, because as the entire EV ecosystem probably starts coming in play over the next few quarters, they're both the capacities and the capabilities ready from a balance sheet perspective to probably serve, again, both the OEM and the replacement markets as far as these segments are concerned. So yeah, auto anchors as a pack is something we continue.
Sansera, right? Some of these stocks have just gone ballistic, right? It's this Sansera is another 90% mover this year. Just crazy, absolutely. But so no takers at 1100 rupees and all the way straight without a stop to where we are right now. Actually, it started this year at about 1600 or so. So even from those levels, it's basically doubled, and a big one coming through. Do you have a view on MCX? It's corrected from the highs, and this Jeffries note saying, well, earnings should compound at 20%, and they're kind of sort of making comparisons with the equity segment, saying participation at MCX and commodities is about 1/5 of NSE. I don't know if it makes sense to you. MCX, to your mind.
Afternoon, Prashant. No, again, I think we covered both exchanges, both BSE and MCX were part and parcel of our portfolios, and we had bought them at very lower levels. I think we booked out of both these positions a couple of 2 or 3 weeks before. But the logic remains very, very, very simple, Prashant. I think the expectations in terms of the average daily traded turnover, the ADTO, which is extremely crucial for a commodity exchange, that is expected to continue growing at a very steady pace. Obviously, I think the volatility in commodity prices is something that props up these volumes even more. And the optionalities that the exchange is probably adding in by adding in new contracts for newer commodities and probably having a lion's share as far as the existing commodity or market making is concerned. I think the kind of numbers that can probably still keep on coming through and the expectations with more contracts, more commodities, more options being probably added, more institutional turnover also probably coming in and chipping in because of all these factors at play, might actually prop up numbers quite significantly over the next few quarters. But I think we had our fair share of run, and therefore we probably booked out.
Okay, got it. What we're going to do is stay with us, Mayuresh. Sanjeev Prasad of Kotak Equities was with us in the morning, and he basically touched upon, we talked about a range of subjects, but 2 areas. One, his point is most things in industrials, the segment which is going gangbusters is very expensive according to him, and he kind of made the comparison with railway and what happened there a couple of years back. That was the bigger part of the comment that he made. And of course, the other one was IT, where he's unsure of the amount of price deflation that IT is likely to see. So is there really a call that one can make according to him? Not really. So listen in.
Given the issue around deflation and realization, which everybody is talking about, the big billion-dollar question is what kind of deflation one is looking at. So far, the market has congregated to around 2 to 4% average deflation pricing for the next few years. Now, I don't know whether that's the right number, if it is sufficient or it could be significantly higher. Who knows? Even the impact of AI is still very early in a way, very hard to assess what it could be. And look at railway stocks 2 years back, exactly the same thing is playing out over there. Where are railway stocks now? Now that the government capital slowed down, nowhere to be seen. 50% cut from 2 years levels. But the question is, how much you want to pay for it upfront? Is the 80p enough or 100p contours? I mean, people try and do some sort of a reverse DCF, etc., to try and justify the valuation. The kind of market size they're looking at, 3, 4, 5 years later would be humongous. I don't deny that there will be growth, but then it has to put in some context, whether it makes sense, the kind of growth that we're talking about, and whether the multiples or the valuation that have been recording currently, fall somewhere in a reasonable, ballpark. Whether it is, see, we used to like ABB Cummins until recently, but I had to take them out of the model portfolio because they were just looking too expensive. ABB at about 75 times 1 year forward. Cummins is now reaching about 60 times 1 year forward. I mean, I understand the electrification theme, the digitalization theme on, which is companies play on the data centers and all that stuff. But how much multiple you want to pay for that? That's a big issue.
One midcap IT stocks which is divergent from the rest is Hexaware, and that is scaled to the day's high. It's a 7% up move on Hexaware today, on a day when its peers, whether it's KPIT for news, but even others like Coforge, are under severe pressure. So for Hexaware, Q4 of last calendar year and Q1 was weak, expectedly weak. But the company had guided for things to pick up in Q2. And going by some brokerage estimates, Q2 is likely to see a 4.5 to 4.8% revenue growth on a quarter-on-quarter basis. So revenue growth for Hexaware could lead in the current quarter, that's April to June, and that maybe explains why this one is standing out versus the others. Mayuresh, quick one word on one stock that you like right now that you'd like to recommend?
One recent addition that we've done, Rima, in our portfolios is Skipper. And obviously, I think it's a huge proxy in terms of the entire power value chain. Expectations of power grids capex is expected to be significantly higher this year. The second element, obviously, is that the kind of numbers that they've posted, highest ever revenue at 5,500 crores. The order book stands in excess of 8,500 crores. There is a huge potential as far as the entire transmission lines are concerned. They're actually expected to go up from 4.85 lakh circuit kilometers to almost 6.5 lakh circuit kilometers, with an equal share that probably goes through in terms of how the transformers and the entire ecosystem goes through. So I think as an EPC player, as a player within the system where margins have actually improved on a year-on basis to 10.5%, ROEs to 14.5%, there is expectations that ROEs will keep on inching further to our benchmark of 17.5 over the next few quarters. We've also got a polymer business, the pipe business, which is doing reasonably okay as we speak, and is expected to pick up steam in the next few quarters, and reasonable amount of debt equity at 0.62 times. Our sense is that earnings might actually hold up for a few players within the space. Skipper is something we like.
Thank you very much for that. Winding down today's trading session, just shy of the 24,000 mark, but it's been a strong trading day. With a gain of about 0.5% on the Nifty and the Sensex. In the leading position today are realty names. You've got FMCG with an up move of 2%. And in that, Eternal is right on top, 6% gain. But Nestle, HUL also seeing some buying. Banks did very well. So Kotak Mahindra Bank rebounds, SBI higher. Axis Bank up more than 1%. And then you had auto. Throw that in on the back of auto sales numbers. So you've got strength in M&M, Maruti. Bajaj Auto numbers are awaited, but the stock held up well. On the way down, it was IT and metals. The top three Nifty losers are HCLTech, Tech Mahindra, TCS, and then you've got a Hindalco, Tata Steel, Infosys closing below the 1,000 rupee mark and TCS below 2,000 rupee. And this is after KPIT issued a profit warning for the current quarter, and that spooked a sell-off in the IT names.
Yeah, IT is the index is down 6%, I think. Yeah, 5.7 odd percent lower for the Nifty IT services index, so complete washout. But broader markets did much better. I mean, and so many names which participated. Some of what, of course, Rima mentioned, but the Adani Group stocks continue to do well. Yesterday they participated in the upside, and today again, Adani Green, Adani Solutions, Adani Enterprises, all three sort of locking in strong gains today. But also, I mean, names like Delivery, which did well, Paytm, Car Trade, all you can call them platform companies. Actually, they are platform companies, but all they're doing very well. VTech Vabag was, there was an early morning order, 3.5–4% higher today. DLF and Loda were the real estate names which did quite well. Actually, the Nifty Real Estate Index was the top gainer today by the end of it. Page Industries, Nestle, the consumption names, as Mangalam was pointing out earlier, which did quite well. Some of the dark horses, I mean, IKS, which is, a healthcare, a platform services company, 7.5%. It's been an absolute underperformer since listing, but, seeing some gains and back to, I guess, highs a couple of years back. And many more names. Policy Bazaar is back at about almost 1,700 after selling off to about 1,600, even as we await the distribution paper from IRDAI. So lots of single stock action, news related, some of course reacting to stuff and some reacting to anticipated news flow out there. It's a wrap on this edition of Closing Bell. Thank you very much for staying with us. More comes up on Markets Forward in just a bit.
Market snap 2-day losing streak, but end near the day's high. Nifty ends near the 24,000 mark. FMCG and realty bat for the bulls, but IT stocks sink. IT index falls for the 4th straight session.
Auto sales in June largely on track. Mahindra and Mahindra beats expectations. Maruti is in line. Hyundai reports a 16% drop, while electric two-wheeler makers shine along with healthy tractor sales for Escorts Kubota.
KPIT Tech tanks 16% after issue of a Q1 warning, says revenue and profit will dip on a weak outlook from Europe OEMs customers that are there, but hopes for a revival in outsourcing as cost cutting kicks in. JP Morgan downgrades the stock.
You're with us here on Markets Forward, your go-to show where we get you all the key data points to gear up for the next trading day. I'm Hormuz Patakia. With me is Vinny Motiwala. Vinny, good afternoon. It's a good start to the new month and the new quarter and the new series as well. The index finally managing a close above the 24,000 mark. The bulls will hope that it sustains in the new series.
Absolutely. We hope for the sustenance as well. And, obviously the broader end of the market today also fared quite well in the trading session as well. Nifty just around the 24,000 mark is what the close came in. Look at the broader end of the market. Mid-cap doing well, 0.3% of gain. Small cap also managing to hold on to very strong gains in the trading session as well. What didn't do well was obviously the IT pack as well. So that was something that saw a muted performance in the trading session. FMCG did well. We have names like Eternal, Asian Paints, HUL, all of them among the top gainers, as well as Nestle India also managing to hold on to very strong gains. So yes, that's how the market setup looked like today. A bit more of green on the screen coming in, but a very exciting lineup for you all on the show today is what we have in store. We have the top movers and shakers of the day with Vivek Iyer. Then we'll decode the auto sales numbers for the month of June as well. Put the spotlight on KPIT Tech, the quarterly warning that came in. What does it mean going forward? That is what we'll be focusing on. And last but not the least, we'll delve into the key market events to watch out for in tomorrow's trading set.
And to our first segment of the day, Vivek is here with all the top movers and shakers of the day. Vivek.
Well, thank you so much for that. Looking at the markets today, we've started off the July series on a very good note with the updates that have come in so far actually being quite positive, especially in terms of corporates. Now, in terms of individual stocks and sectors, what is it that we're tracking? FMCG stocks are lower prices, especially as far as input costs are concerned, is something that bodes quite well. Street estimates that margin pressures may be receding as of now, and the entire pack doing very well today. In fact, Dabur, one of the top gainers, over 5% higher. MCX was another stock that clearly stood out. Jefferies initiated coverage on this particular stock. They've have a buy rating, so MCX today, one of the top gainers, especially as far as the broader end of the markets was concerned. Moving on, Havells was another stock that stood out. Citi went ahead and upgraded the stock, especially as far as this particular name was concerned. And they believe both Havells as well as Page Industries were two particular names where they've also gone ahead and initiated what they're calling as a positive catalyst watch. Other than that, have a look at most of the Vedanta group stocks. Most of these stocks doing very well in the session today. All of the stocks, in fact, a few of them went ahead and hit the upper circuit. Vedanta Oil and Gas, Vedanta Power up almost 10%, Iron and Steel almost 9% higher. So again, a very good day as far as the Vedanta group was concerned. On the other hand, quite a few laggards as well. KPIT Tech and along with it, most of the auto ER&D names doing very weak in the session today. KPIT Tech, saw further sell-off in the last hour, almost 17.5% higher. DMart, again, a significant underperformance as far as the peers were concerned. One of the top F&O drags today. Metal stocks, most of the metal stocks today were under significant pressure. Rising costs as well as lower product prices is something that the street doesn't like. JSPL, one of the top drags along with SAIL. And lastly, Apar Industries. Now, this particular name on high volumes today was down almost 7%, the top small cap laggard in the session.
Okay, Vivek, thank you so much for that. Those were the stocks that were moving around in the trading session. But let's put the spotlight now on the auto sales numbers for the month of June as well. And Nifty Auto today actually managed to remain quite steady. We've seen decent numbers so far. But to get more details in terms of this as well, let's go across to Sudarshan. Sudarshan, over to you.
So it's been a mixed bag, but more positives than negatives. So we start with Mahindra and Mahindra. Both auto and tractor segment numbers have been largely better than expectations. For auto segment, SUV continues to see a healthy growth. Growth there was more than 28%, but this time the surprising part was the commercial vehicle segment, LCV, which is between 2 to 3.5 tons. Their growth is more than 35%. Tractor segment growth has come at 12% versus our expectation of 7%. Company is saying that it's too early to assess the impact of emerging El Nino conditions, but if things progress well, it's going to achieve the estimates that company has given for FY27. Coming to Maruti Suzuki, sales were largely in line. Here, the positive part was the entry-level segment. Their sales have almost doubled YY. In the month of June, sales were more than 11,000 units against 6,400 units in the same period last year. And SUV segment continues to do well here for Maruti too, and their growth was more than 28%. One negative part was export segment, where growth was just 13%, and in comparison to that, domestic segment's growth was more than 20%. Tata Motors PV, healthy growth on a low base. Total sales have increased by 69%. EV segment, where company is a market leader for this, sales have almost tripled YOY. One company that has underperformed its peers is Hyundai, but sales were largely in line. It has seen a decline of almost 16%, and that's because of production loss that company has seen. There was a fire incident at its manufacturing facility in Chennai. Company is saying that it's going to recover that production loss in Q2 FY27. One segment where both companies, Ashok Leyland and Tata Motors Commercial Vehicle, have given very strong numbers. That's your commercial vehicle segment. For Ashok Leyland, MNHCV and LCV sales have seen a growth of more than 20%. MNHCV sales have increased by 24%, and LCV sales have increased by 28%. And just if you take a look at truck segment, their growth was more than 44%. For Tata Motors Commercial Vehicle 2, it was a strong print for June. Total sales have increased by 35%. Our expectation was 26% increase, and it was led by domestic segment, where the growth was 31%. Amongst two-wheeler names, Hero Moto has come out with the numbers. We were expecting flat YY, but company has seen a decline of more than 2%. And the reason was company has seen a decline in the motorcycle segment, where the decline was 7%. And because of that, domestic sales have declined by 4%. Export contribution is negligible, but their growth company has registered of 30%. So overall, it's a mixed bag, but more positives than negatives.
More positives than negatives, Darshan. Thank you for that. Taking the conversation forward with Mayuresh Joshi of MarketSmith India and Shrikant Chauhan of Kotak Securities. Gentlemen, good afternoon. Thank you for taking out time. Shrikant, well, you're still around that 24,000 mark on the index. Is the July series data indicating that we'll finally move out of that range of 24,200, 300, and then go towards the recent swing highs of 24,600? What are the levels you're watching on the index?
Yeah, absolutely, Hormaz. I think the way the market is consolidating, and it has been consolidating since the last almost, we can say, 15 days, within the range of 23,800 and 24,200 on the higher side. Today also, despite there was weak cues, we saw quick recovery in the market, and the market has managed to close above the mark of 24,000, which is positive. So broadly, I am of the view that on the dismissal of 24,200, we can expect 24,500 or 600 sort of levels, because the market has spent a maximum time within these 400 points. So on the dismissal of 24,200, we can expect 400 points more above the breakout level. And the way these sectors are turning up, except IT, I think we are heading towards 24,500, 600 very soon. For the Bank Nifty, there also we are seeing good amount of traction whenever there is a correction. 57,000, 57,500 going to act as major support for the Bank Nifty, at least for next 10-15 days. And eventually we are expecting Bank Nifty also to move towards the levels of 59,500 or 60,000. So on both the indices, we are bullish.
Okay. Bullish on both the indices is the word coming in from Shrikant. Mayuresh, what's your thought specifically for the auto pack, right? We have the auto sales numbers that have come in mixed, but largely more positive is what Sudarshan highlighted. Anything specifically that you would watch out for as well? Yesterday, obviously, that EV policies on the Delhi front has came in as well. What are the key triggers that you're keeping an eye out on for here, and which company is something that you are liking right now?
So within the OEMs, again, I think commercial players have reported a very strong set of monthly numbers. And the expectation is that the commercial or the CV cycle is turning for the better. Now, if this trend continues, the second half will be relatively better, both in terms of an absolute volume number that these companies will probably post. But the variant that they're probably introducing whether it's the HCV segment, MHCV segment, or the LCV segment. I think it should generally benefit all three segments within the entire CV ecosystem. And therefore, our own sense is that as the cycle is turning better, I think both Tata Motors Commercial Vehicle and Ashok Leyland are stocks that can probably be kept on the radar purely in lieu with what might actually take place in terms of better volume growth going forward.
Okay, point taken there, Mayuresh. That's about the auto pack, but let's shift gears and talk about the IT pack now. HCLTech, that tanked more than 16% around by the end of the day as well and hit a 52-week low. This came in after the company issued a profit warning for the June quarter. The weak outlook prompted JP Morgan to downgrade the stock as well. Let's go across to Rima to give us details on this front. Rima, what did the company say? Take us through more of the highlights that came in here.
Thanks so much for that. So basically what HCLTech has done is they're saying in Q1, they're expecting the revenue growth to decline by 1% on a year-on-year basis. To put that in context, a brokerage like Motilal Oswal was anticipating a growth of 2%. So a growth of 2% year-on-year has become negative 1% on a year-on-year basis, according to the company. And JP Morgan says if you look at it on a quarter-on-quarter basis, we are looking at a drop of 4% in constant currency revenue terms. Now, what has changed for the company? Well, anyway, the company had said that H1 is going to get impacted because two of their large programs come to an end. But what's changed is the company says the performance has been impacted by a sudden drop in revenues over the last few weeks, and they attribute it to the recent profit warnings and a deteriorating outlook by the European auto companies. Particularly, I think it's the BMW profit warning, which was issued in June. Even JP Morgan says that BMW is one of the top clients for KPIT Technology. According to them, it contributes about 12% to their top line. And if you remember, in June, JP Morgan had cut their profit growth guidance, the profit margins, quite sharply. And I think that is the big change that's taking place. And what's also very disappointing is that the company is now saying Q2 will be similar to Q1 in the same range, which basically means that we're not seeing too much of a recovery. And HCLTech has anyway gone through a period of slowdown. The growth rates have been coming down for close to about 18 months. But when we spoke to them in April, the company sort of indicated that maybe FY26 would be a trough and things will start picking up in FY27. The outlook, they said, was promising for FY27, but that doesn't seem to have played out. Now, what's the way forward? As I said, because the company has been slowing down, the stock is corrected. It's fallen close to 65-70% from its all-time high levels. But it's currently trading at, it was trading at about 20 times forward multiple as of yesterday's closing level. And JP Morgan today, when it downgrades the stock, is further lowering the target multiple to 17 times, and they've downgraded it to an underperform rating. So disappointing news. Q1 is going to be much lower than the expectation. No recovery in sight, even for Q2, and the stock is taking a beating.
Rima, thank you for that update there. 17% lower on HCLTech in today's session. Well, Mayuresh, they can't just seem to catch a break, does IT. One gets over, the other is right behind. Now it's KPIT, the ER&D space. There are also concerns with regards to Infosys maybe cutting down its guidance when it reports numbers. Well, what do you do in a scenario like this, particularly so if you are a shareholder, and if you are not, how easy it is to stay away, or how difficult is it to not nibble in after this kind of fall?
Thomas, you're absolutely right. I think the fall that you've probably seen for the sector as a whole, I think at least 2 or 3 weeks back, I think it's probably seemed that the worst is now probably over. And then you've got a spate of new news that probably comes through. But generally, I think as a lot of market commentators have maintained that the visibility in terms of growth levers look very, very bleak for the sector as a whole as we speak, specifically when it comes to the entire AI trade, the AI model itself. And therefore, organically, inorganically, the companies need to probably ramp up their AI revenues over the next few quarters quite significantly to catch up with what is probably happening in terms of the tremendous amount of capital expenditure or capex that platform companies or hyperscalers are probably deploying across the globe. Therefore, I think A, growth vectors clearly being missing. B, I think in terms of visibility of the existing business, that might very well continue over the next few quarters. Margins might also probably persist. But is there scope of expansion that probably happens in terms of current business? I think that is the bigger question mark.
Okay, that is something that we'll watch out for, Mayuresh. But let's move on and talk about a whole host of brokerages that we had this morning. Some positive commentary came in from brokerages. Which were the stocks they highlighted? Ananya is here to give us those details. Ananya, over to you.
A few stocks were buzzing today in trade following the brokerage reports and target price revisions. So let me first start with MCX. So Jefferies has initiated coverage with a buy rating and a target price of 3,600. The brokerage believes India's commodity market remains under-penetrated compared to equities, offering a long growth runway. Now it expects 20% revenue CAGR and 22% earnings CAGR through FY29, supported by margin expansion. Now on Havells, Citi has upgraded the stock to buy from neutral with a 1,500 target price. Now the brokerage believes the recent correction provides an attractive entry point and expects growth to improve in FY27, led by cables and wires, recovery in the consumer business and the solar segment emerging as a meaningful growth driver. It also expects margins to improve with operating leverage and lower losses at Lloyd, although Lloyd's margin remain a key monitorable. Now, lastly, Citi has upgraded Page Industries to buy from sell, raising its target price to 47,700 from 34,100, citing and improving risk-reward profile. Now, Titan has also been upgraded to buy from neutral with a target price of 5,075, reflecting increased confidence in its growth outlook going forward. So these were the stocks that were buzzing today following the brokerage reports.
Some interesting upgrades coming in there. Ananya, thank you for summarizing that for us. Shrikant is very intrigued by Page Industries. The last time the stock has closed above the mark of 43,000 was all the way back in September of last year. The kind of moves that you have seen in just a matter of a month from levels of 36, 37,000 all the way up to where it currently is there more upside still in store for the stock?
Oh, yeah, absolutely. The stock is very clearly into V-shaped recovery formation. It is into pullback. It was around some 49,500 sort of levels in the month of July 2025. From there, all the way it fell to 30,000. Now, again, it is rebounding from lower levels. So I am of the view that the stock is going to complete its pullback somewhere close to 46,000 levels. So from here also, we can expect at least 8 to 10% sort of rally from current levels. But the way the momentum is there and volume is increasing, upgrades are coming, there could be a chance that the stock may even cross its previous high of 49,000. But very first, 46,000 is going to act as major resistance for the stock. And in case if there is any correction, we should certainly look for adding this stock to our trading portfolio.
Okay. Mayuresh, your thoughts for Havells as well? The story plays out cables and wire side as well. Is this something interesting for you? Would you look at Havells?
No, I think we watch out for numbers, very, very quickly in Q4. The numbers were reasonable in Q4, but I think for all their segments to probably fire at a given point of time is virtually impossible. So I think one segment does well while the other probably lags. But ideally, I think we would like to watch out for how Q1 numbers play out.
Okay. Watch out for how Q1 numbers play out. That will be key for Havells. But Mayuresh as well as Shrikant, thank you so much for joining us as always and helping us understand what we should keep an eye out on for individual stocks as well as the markets. Thanks so much for that. But on that note, we're going to step into a very short break. After the break, we'll get to top corporate voices along with the key market events to watch out for. Stay tuned there. Welcome back to Markets Forward on CNBC TV 18, a day where we saw 24,000 come back for the Nifty. We closed around that mark. The overall broader end of the market managed to do well. And some of the indices that did well today were obviously the realty index, FMCG, media, and in that we have the auto pack as well. Auto sales numbers came in and we spoke about it before, right? Decent numbers. So let's talk about the commentary that came in from the management and on to the top corporate voices of the day for today. We had Mahindra who spoke and said that supply chain disruption and manpower challenges are now largely behind it. With growth remaining broad-based across its portfolio, the automakers said that it's targeting mid to high teens growth in the SUV business and double-digit growth in commercial vehicles in FY27 with a strong CV demand, is what they're expecting to continue through the festive season. And on the EV front, M&M says that monthly sales have held steady at around 7,000 units for the past 2 months and expects that run rate to remain between 7,000 and 8,000 units for EVs. The company also indicated that a price hike is on the cards and is likely to be announced later this month as well.
Now, the management of SIS says that the recent minimum wage revisions have had a short-term impact on its business, but it remains confident of margin expansion going forward. The company expects facility management margins to gradually stabilize at around 6%, supported by improving operating leverage. SIS also sees significant outsourcing opportunities in the facility management segment, which it believes will drive further margin expansion over the medium term.
Okay, those were the top corporate voices that we had for today. But before we wrap up this edition of Markets Forward, let's bring you the key events to watch out for in tomorrow's trading session. And for that, we have Ananya to take us through that. Ananya, over to you.
Let me first start with global events. The global events will be in focus based on the US June jobs report, which will be closely watched for its impact on the Federal Reserve rate expectations and global market sentiment. Now, investors will also track the European Court of Justice final ruling on Google's antitrust appeal, while the expiry of the Israel-Lebanon ceasefire will remain a key geopolitical event for oil prices and risk sentiment. Now, on the domestic front, the Parliamentary Standing Committee on Finance will meet the RBI to discuss the future regulatory framework for cryptocurrencies. Meanwhile, Japanese Prime Minister will hold bilateral talks with PM Narendra Modi, with markets looking for announcement on investment, manufacturing and strategic cooperation. Now, among stock-specific development, IRB will consider a fundraising proposal. Apart from this, investors will also track Brookfield in Energy's commentary on the impact of the Iran conflict on India's energy security and renewable investments, along with key global data releases, including Eurozone unemployment and US factory orders.
Rania, thank you for summarizing that for us. Time to take a leave on this edition of Markets Forward. Of course, tomorrow is a very important day, considering the fact that it's the Sensex weekly contracts expiry as well. The penultimate trading day of the week, and the bulls would hope that this 150-point up move that we have seen today continues towards the rest of the week as well. From Vinny and me, thank you for watching. News and updates continue on the other side.
Good evening. Thanks for joining us on Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening: Dalal Street snaps the two-day losing streak, ending near the day's high. The Nifty reclaims 24,000. IT stocks, however, remain under pressure, with the index declining for the fourth straight day. Iran's top negotiator calls the Hormuz Strait their greatest instrument of power, insists talks on a final deal will not begin until Washington fulfills its commitment spelt out in the MOU. Trump's envoys Kushner and Witkoff meet Qatari ministers in Doha. Relief for restaurants and small businesses as oil marketing companies cut the prices of commercial LPG cylinders by 183 rupees. Prices of jet fuel also cut by around 5 rupees a litre. Sources say India's second largest private refiner, Nayara Energy, has cut petrol prices by 5 rupees per litre and diesel prices by 3 rupees. Auto sales in June largely on track. M&M beats estimates. Maruti Suzuki is in line. Hyundai reports a 16% drop. Electric two-wheeler makers shine with healthy tractor sales coming in for Escorts, Kubota as well. The goods and services tax completes 9 years. Collections in June rise 14% to nearly 2 lakh crore rupees, led by Maharashtra, Karnataka and Gujarat. The government notifies daily wage rates for unskilled workers under its flagship employment guarantee scheme. 21 states, including UP and Bihar, allocated a base rate of 300 rupees. Haryana has the highest wage rate of 409 rupees, with the lowest hike of just over 2%. Daily wage rate fixed at over 400 rupees for Kerala and Goa. President Trump raked in over $1 billion through his cryptocurrency ventures in 2025, according to his own financial disclosures. Earned more than $600 million through the sale of souvenir-like meme coins. The U.S. Supreme Court upholds birthright citizenship in a blow to President Trump's agenda. The top court affirms citizenship for anyone born on U.S. soil will be constitutionally guaranteed. Kylian Mbappe scores twice against Sweden to power France through to the pre-quarterfinals of the FIFA World Cup. Haaland's winner sends Norway past Ivory Coast. Mexico beats Ecuador on home turf, winning their first knockout match in 40 years. Well, let's start with the day's market action. The market snapped the two-day losing streak, with the Nifty ending above the 24,000 mark. The Nifty's gains were fueled today by Reliance, SBI and Axis Bank. The Nifty Bank outperformed as well, led by Kotak Mahindra Bank and IndusInd Bank. So 490 higher on the Nifty Bank. The Sensex and the Nifty closing in the green. But the pressure continues to be on the IT stocks. Nifty IT down by over 500 points, a cut of 2% there. And of course, across the board, IT stocks closing in the red. Rima joins us now with more on the sell-off that we continue to see in the IT index for the first half of this year. The pressure continues, Rima.
Well, this is the worst half-yearly performance for the Nifty IT index since 2001. From January to June, the Nifty IT index is down 30%, and even today, it's under pressure. In fact, the index is now trading at a 3-year low. Let's just quickly do a scoreboard first of the year-to-date performance. And as you can see, large-cap IT is down close to 35-40%, and mid-cap IT names have fallen close to about 50%. HCLTech particularly, with today's crash. Now, with this, valuations have also come off. So roughly now, large-cap IT companies are trading about 13 times forward multiple, FY28. The 10-year average would be 15 to 20. Companies like TCS would be trading higher. Companies like Wipro, HCLTech historically traded at lower valuation multiple. But despite Indian IT now trading at a deep discount to what it used to, it's still trading at a big premium to global IT companies. So here's, these are some numbers. So Goldman Sachs says, so according to their analysis, IT is trading at a 14 times forward multiple. Again, this is at a discount to the 10-year average, a 35% discount to the 5-year average. But now compare it to Accenture, Cognizant and Capgemini. Their average multiples are just 8 times. So India is at 14 times. Global peers exactly doing the same thing. It's trading at 8 times. So they're saying that Indian IT companies are trading at a 90% premium to global peers, and historically Indian IT commanded a premium of 20-30%. So in a nutshell, according to them, Indian IT is still expensive relative to their global counterparts, and considering that this industry is going to see a low single-digit kind of growth, they don't sort of see it compelling. Morgan Stanley goes on to say the derating is not over. In the past, large cap IT bottomed at 11 to 13 times 2-year forward multiple, so they see room for further downside. Now let's get to the fundamental trigger behind all this. Now FY27 is going to be the 4th consecutive year of anemic growth for the Indian IT industry. KPIT today, of course, issued their profit warning for the current quarter. They're saying growth will just be, it'll be a 1%, negative 1% USD on a year-on-year basis, so minus 1%. And even for Infosys, I was looking at the brokerage estimates. It seems like the company in 3 months will be cutting the top end of its FY27 organic guidance. So the current guidance for Infi is 1.5 to 3.5%. But there are many brokerages who believe that 3.5% will come down to 3%, maybe 2.5%. The brokerage view is that organic demand recovery up until now is too slow to justify holding on to the upper end of the premium multiple. And even for the, all the other companies, Goldman Sachs has already cut the aggregate forecast for the industry to 2.4% revenue growth in the current year. Morgan Stanley too has lowered the FY27 growth numbers very sharply. For TCS, for example, it's a sharp 250 basis points correction. So what are you going to, watch? We're going to be watching, for one, whether organic growth this year will be more or less compared to what it was in the prior year. We're going to watch for discretionary spending, whether the BFSI resilience is holding on and can it offset the continued softness in telecom manufacturing. AI-led deflation, that's important. Currently, expectations are for a 2 to 4% AI deflation. Is it more than that? And is money coming in from AI-related revenue streams? AI investments, we've already seen a step up in terms of acquisitions. So how much are companies willing to plow into their AI offerings? And cost efficiency programs have been running. You've got a Project Maximus at Infosys, Fortius at Tech Mahindra, Ascent at HCLTech. So this is something which perhaps is going to accelerate, and headcounts are likely to remain muted. I think the bulls will tell you that maybe IT is cheap at 13 times. The bear tells you that cheap is relative. But it's surely going to be a very interesting earnings season for the IT sector.
Well, it is going to be an important quarter. Rima, many thanks for joining us. That's the IT sector's report card, the first half since 2001. Now, gold price is falling, with the yellow metal seeing little relief after logging its worst quarterly drop in 13 years in the last session. This as investors pivoted to the dollar on increasing expectations that the Federal Reserve will in fact raise interest rates. Rising US Treasury yields also weighed on the precious metal, so the gold price fall continues. From commodities to the crypto market, Bitcoin prices fell to a 21-month low below the $60,000 mark. This as the prospects of higher interest rates and concerns about the largest corporate buyer of the token weakened sentiment. A stronger US dollar index also weighed on the digital asset. But let's revisit the top story this evening. Iran insists that talks on a final deal will not begin until the US fulfills its commitment spelt out in the MOU. Here are the latest developments today. Tehran's chief negotiator, Mohammad Ghalibaf, has called the Hormuz Strait their greatest instrument of power. He's also warned that free passage through the Strait of Hormuz is guaranteed for only 60 days. Ghalibaf also told state media that the Gulf states had requested for the concession. Meanwhile, indirect US-Iran technical talks are underway in Doha, with Qatar and Pakistan serving as mediators. Reuters reports that Trump's envoys Kushner and Witkoff met Qatar's prime minister to lay the groundwork for technical talks, but are not attending the sessions themselves. The indirect negotiations are reportedly focused on releasing Tehran's funds and the Strait of Hormuz. In the oil market, Brent crude prices eased as investors remain cautious over the outcome of the negotiations between the US and Iran. According to maritime data from Windward, 23 vessels have passed through the strait. However, transit has not returned to the pre-war levels. Prime Minister Modi also held a call with the Iranian president, stressing the need for freedom of navigation in the waterway.
Under the agreement, Iran is committed within 30 days, and about 8 days of that period have now passed, to remove the technical obstacles in the strait, address navigational safety issues, deal with any mines or similar hazards that need to be cleared, and restore conditions so that the ships that had been there before the war can transit safely. For the first 60 days, we will not charge those vessels for these services.
Well, that is Iran's position. Now, the government has reduced the price of jet fuel by 5 rupees per litre to 110 rupees per litre from today. And just for context, aviation turbine fuel accounts for 40% of an airline's operating cost. This move comes as tensions in West Asia continue to ease, lowering the overall pressure on global oil prices. From jet fuel to commercial LPG, the centre has also cut prices for the cylinder by more than 183 rupees, marking the first cut this year in 2026. However, domestic LPG cylinders will continue to be sold at existing prices. The latest reduction in prices comes after a series of price hikes due to the tensions in West Asia. And staying with price cuts, sources say that Nayara Energy has cut the price of petrol by 5 rupees per litre. The private refiner, India's second largest, has also announced cuts for diesel prices by 3 rupees per litre. These cuts will come into effect from today. Sources have further indicated that the price cut will be applicable across all 7,000 fuel stations that are operated by Nayara. So, cut coming in there from the private refiners. We are going to have to wait for the public sector oil marketing companies to move next. Auto sales in June largely on track. M&M ahead of estimates. Maruti Suzuki in line. Hyundai reporting a 16% drop. Electric two-wheeler makers shine along with healthy growth. And tractor sales for Escorts Kubota also coming in strong. Sud is standing by with all the details.
So it's been a mixed bag, but more positives than negatives. So we start with Mahindra and Mahindra. Both auto and tractor segment numbers have been largely better than expectations. For auto segment, SUV continues to see a healthy growth. Growth there was more than 28%, but this time the surprising part was the commercial vehicle segment. LCV, which is between 2 to 3.5 tons, their growth is more than 35%. Tractor segment growth has come at 12% versus our expectation of 7%. Company is saying that it's too early to assess the impact of emerging El Nino conditions, but if things progress well, it's going to achieve the estimates that company has given for FY27. Coming to Maruti Suzuki, sales were largely in line. Here, the positive part was the entry-level segment. Their sales have almost doubled YY. In the month of June, sales were more than 11,000 units against 6,400 units in the same period last year. And SUV segment continues to do well here for Maruti too, and their growth was more than 28%. One negative part was export segment, where growth was just 13%, and in comparison to that, domestic segment's growth was more than 20%. Tata Motors PV, healthy growth on a low base. Total sales have increased by 69%. EV segment, where company is a market leader for this, sales have almost tripled YOY. One company that has underperformed its peers is Hyundai, but sales were largely in line. It has seen a decline of almost 16%, and that's because of production loss that company has seen. There was a fire incident at its manufacturing facility in Chennai. Company is saying that it's going to recover that production loss in Q2 FY27. One segment where both companies, Ashok Leyland and Tata Motors Commercial Vehicle, have given very strong numbers. That's your commercial vehicle segment. For Ashok Leyland, MNHCV and LCV sales have seen a growth of more than 20%. MNHCV sales have increased by 24%, and LCV sales have increased by 28%. And just if you take a look at truck segment, their growth was more than 44%. For Tata Motors Commercial Vehicle 2, it was a strong print for June. Total sales have increased by 35%. Our expectation was 26% increase, and it was led by domestic segment, where the growth was 31%. Amongst two-wheeler names, Hero Moto has come out with the numbers. We were expecting flat YY, but company has seen a decline of more than 2%. And the reason was company has seen a decline in the motorcycle segment, where the decline was 7%. And because of that, domestic sales have declined by 4%. Export contribution is negligible, but their growth company has registered of 30%. So overall, it's a mixed bag, but more positives than negatives.
All right, Sud, many thanks for joining us. Worrying news, India's monsoon woes are far from over. The Indian Met Department has warned that monthly average rainfall over India is expected to be below normal in July. The forecast comes after India recorded one of its driest Junes in more than a century, with rainfall ending 39% below normal. On the western front, Mumbai received torrential rains today. Heavy rains and waterlogging triggered massive traffic snarls across the city. The Weather Department has also issued a yellow alert in Delhi and parts of North India. The national capital is likely to witness heavy rains and thunderstorms in the coming days. The government has notified the daily wage rate for unskilled workers under its flagship employment guarantee scheme. 21 states, including UP and Bihar, have allocated a daily wage of 300 rupees. Haryana has the highest wage rate of 409 rupees, with the lowest hike of just over 2%. Santya is here with the details. Santya, the MGNREGE has now been replaced. Take us through the new wage rates across rural India, across states.
Right, Shireen. So the central government has notified new wages under the new G Ramji Viksit Bharat scheme, which was introduced last year to replace the Rural Employment Guarantee Scheme, Manrega. As per the new wages, Haryana, Goa, Kerala and 3 high-altitude Gram Panchayats of Sikkim will have a daily wage of over 400 rupees for Viksit Bharat G Ramji workers. Nicobar district, Himachal Pradesh, Karnataka and Punjab will have daily wages between 350 to 400 rupees per day. And workers in Andaman district, Andhra Pradesh, Dadra and Nagar Haveli, Daman and Diu, Lakshadweep, Maharashtra, Puducherry, Tamil Nadu and Telangana will get wages between 300 to 350 rupees per day. Workers in the remaining states and UTs will get 300 rupees per day for a maximum of 125 days every year in exchange for rural development work. Shireen, with this, the government says 300 rupees has become the new benchmark for the rural wages under the scheme. The government has said that it tried to bring states and UTs with historically low wages up to a decent level, bridging the gap among states and UTs, and that is why states like Arunachal Pradesh, Himachal Pradesh and Nagaland have received a hike of over 20%. Haryana and all southern states, barring Karnataka, have received less than a 3% hike, and Dadra and Nagar Haveli and Daman and Diu got a 0% hike. With the new wages, the central government claims there will be more equality across the country. The new scheme offers 125 days of work per year compared to 100 days under Manrega. However, under the new scheme, the nature of work will be supply-driven. Under Manrega, government needed to provide work if people demanded for it. That's not the case anymore. Shireen.
All right, Santya, many thanks for joining us. The average across India, as far as the VB G Ramji bill is concerned, the minimum wage, so to speak, is about 300 rupees in rural India. Microsoft is reportedly planning to cut thousands of jobs as early as next week as the tech giant steps up efforts to rein in costs. Reports say the cuts will impact less than 2.5% of Microsoft's global workforce. The layoffs are expected to hit multiple divisions, including sales, consulting, and the Xbox gaming unit. Nestle India has reduced the grammage of its flagship Maggi noodles by 7 to 9% across multiple pack sizes. The company's kept the maximum retail prices of these packs unchanged. The move comes as the company faces higher input costs, particularly from palm oil and packaging materials. Remember, this is something that we spoke of and discussed, that as we see input cost inflation moving higher, we will probably see an impact there on grammage across FMCG companies. We told you first, it is now official. India Ratings has downgraded Jana Holdings non-convertible debentures from stable to default. Jana Small Finance Bank has said that the promoter downgrade won't have any operational impact. Ritu's here with more details. Ritu, why was Jana downgraded and what has their response been?
Well, thanks for that. India Ratings has downgraded Jana Holdings Limited, which is the holding company of Jana Small Finance Bank, to a default rating after they deferred the repayment on their non-convertible debentures. The downgrade follows the extension of the NCD maturity, which was due end of June, now to the end of December. And India Ratings classified that extension as a distressed debt exchange, which under their criteria constituted a default. Now, according to the rating agency, Jana Holdings and its parent Jana Capital both were unable to refinance their debt or monetize their stake, which they hold in Jana Small Finance Bank, before the repayment fell due, and that forced them to renegotiate the repayment timeline with their debenture holders. Now, the key question for investors now is the impact on Jana Small Finance Bank. Now, remember, Jana Holdings owns about 16.95% stake in the bank, which has fallen over a period of time from 44% earlier. But the holding company, they still need money to repay the debt, and therefore the remaining stake that they hold in the bank could come up for sale, which could create an equity overhang on Jana Small Finance Bank. But that said, the debt event is very much at the holding company level, not the bank. Jana Small Finance Bank has had no capital infusion from the holding company since 2022. They don't rely on them for funding, and there is no Jana Holding nominee on the board either. So while the rating action could weigh on investor sentiment because of the potential stake sale, the immediate financial or even operational impact on Jana Small Finance Bank itself is expected to be limited to none.
All right, Ritu, many thanks for joining us. We'll head into a break, but up next, the U.S. Supreme Court upholds the birthright citizenship in a blow to President Trump's agenda. That and more when we return. India's GST collections remain strong in June, expanding at the fastest rate in the last 13 months. Gross collections rose nearly 14% on an annual basis to 1.95 lakh crore rupees. Gross domestic revenue rose 6.5%, while revenue from imports jumped over 34%. Today also marks 9 years since GST took effect, and it has been the most significant indirect tax reform. Ashmit joins us now with the GST regime and what the last 9 years have meant. Ashmit, it's had its shares of trials and tribulations. Decode the milestones and the wrinkles and give us a sense of the path ahead.
Well, quite a few milestones when we look back at the 9-year journey. Bear in mind, this journey began in 2017 at the time when this transition took place, beginning 1st of July 2017. At the time, there were about 6.5 million taxpayers. That figure has gone up all the way to 16 million. So that is something that is seen by many as a formalization of the economy, so to speak. Going forward, the collections also have been quite steady in terms of their growth. When we look at FY26, this was over 22 lakh crore rupees, 22.27 to be specific. That's the aggregate collection for the whole of FY26. And for the first quarter of FY27 alone, we've seen collections of over 6.3 lakh crore rupees, which on a YOY basis is a growth of about 8%. So again, a significant, steady growth there. As far as the run rate is concerned, every monthly run rate, we're averaging somewhere about 2 lakh crore rupees a month. There was a historical high of about 2.36 lakh crore rupees that happened back in April of 2025. Maharashtra, again, being a large state, being a heavily industrialized state, does take the lion's share in terms of the GST contribution, makes up for about 9%. One key reform, of course, that we saw was late last year in September of 2025, to be specific, when there was rate rationalization that took place. The slabs went down to 0, 5, 18 and 40, and that was seen as a significant piece of reform for GST going forward. So when we look back at the journey, many aspects stand out. When we speak to tax practitioners, they say it helped create a national unified market. There was formalization of the economy. A lot of aspects of this GST regime when it comes to reporting, monitoring, compliance, payment, all of that was done digitally. So that was also a marked shift. Also importantly, there was a steady pace of growth of revenues. Sharing of revenue, the GST Council, this was seen as a step forward as far as cooperative federalism is concerned, and of course, the rationalization of rates. But there are, of course, a few questions that some experts raise. Bear in mind that the last GST Council meeting was in September of 2025, so it's been nearly 9 months now. The next meeting will take place later this month in July in Kolkata. Another issue, inverted duty structures. That is something that has been flagged by various tax practitioners that is affecting various sectors, not just one. So that is something that will take some resolving going forward, a wrinkle, so to speak. Also glitches, technical glitches, technology gaps. Bear in mind the GST Appellate Tribunal went online only recently. Such was the volume of cases being filed that there were glitches as such, which in fact had compelled the government to extend the deadline from June 30th to July 31st. And speaking of the GST Appellate Tribunal, there's a massive backlog. We're looking at a backlog of over 4.5 lakh cases that the Appellate Tribunal will have to deal with going forward. So clearly, many milestones, but a couple of questions also being raised.
Yes, absolutely, Ashmit. Many thanks for joining us. 9 years of the goods and services tax. Now, the U.S. Supreme Court has upheld birthright citizenship and struck down President Trump's order to limit citizenship for future children of undocumented immigrants. The top court affirmed that citizenship for anyone born on U.S. soil will be constitutionally guaranteed. 6 justices, 3 conservatives and 3 liberal, ruled against Trump. The court's 3 most conservative justices dissented. Take a look.
Immigrants are under attack. What do we do?
I just woke up to the news that the Supreme Court ruled in our favor in the birthright citizenship case, and I'm so happy. I have been writing about immigration issues and working with the ACLU for over 10 years, and I didn't think that it was going to go our way. No sitting president in American history has ever come to the Supreme Court during while court is in session, and Trump came to try, I guess, and intimidate the justices, but it didn't work.
You are born in the United States. You are a citizen, period. It doesn't get more clear than that.
If you're born here, you're an American, period, punto, no exceptions. Am I right?
Today's decision marks a striking rebuke against President Trump's executive order that purported to limit birthright citizenship. Now, every court in the United States has ruled against the president on this issue.
Supreme Court striking down President Trump's executive order denying birthright citizenship. Now, President Trump has raked in over $1 billion through his cryptocurrency ventures in his first year that he's been back in office, according to his own financial disclosures, by the way. President Trump earned more than $600 million through the sale of souvenir-like meme coins. Rachna joins us now with more. It's been a windfall for President Trump, Rachna.
Absolutely, and it's now safe to say that for President Donald Trump, crypto is no longer a side venture because it's the largest line on his balance sheet. The number is $1.426 billion in crypto income for 2025. That's according to a 927-page filing with the Office of Government Ethics. For comparison, his golf clubs, hotels, Mar-a-Lago combined brought in around $290 million. So crypto out-earned his entire legacy real estate business nearly 5-1. That $1.4 billion then breaks into three separate entities. $635 million from licensing his name to the Trump meme coin through CIC Digital, $594 million from World Liberty Financial, the venture run by his sons Don Jr. and Eric. The Trump family holds a 38% stake and collects 75% of token sale proceeds, and further $196 million from Stablecoin Holdco, a separate Trump-controlled entity. Now, the governance angle. Presidents and vice presidents are exempt from the conflict of interest laws that would bar this kind of arrangement for any other federal employee. That's written into the law itself, which means none of this is illegal in any way. But it does mean disclosure is the only real check, and critics, including Trump's own former White House special counsel, Tay Cobb, call this the most significant conflict of interest exposure in presidential history. And there's a timing twist here as well, because this disclosure has landed the same week Bitcoin logged its worst month in over 2 years, down 20% in June, with the heaviest ETF outflows since launch. So a large share of this wealth, the WLFI tokens, the meme coin holdings, still sitting in family wallets, is worth considerably less today than it was earlier. Now compare all of this to Vice President J.D. Vance. His filing runs 17 pages against Trump's 927. Vance holds up to $500,000 in Bitcoin, a passive position on Coinbase, generating no income for now. But his real money still comes from Hilly Billy Elegy royalties, his book. The White House response has stayed consistent. Spokesperson Anna Kelly says there are no conflict of interest and calls the scrutiny a recycled narrative. Be it as it may, but the filing settles one thing. For a presidency built on real estate, the real business now is crypto.
Very clearly, it's more than $1 billion income-generating business. Many thanks, Rachna, for joining us. With that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC TV 18. Stay tuned. We're back in a minute with more.
Let's talk money.
Hello and welcome to another edition of Let's Talk Money. I'm your host Surabhi Upadhyay, and if you have been following the show, you would know that we have been marking the International Day for Insurance Awareness right here on Let's Talk Money. Very, very important milestone. Usually these days become a talking point to at least have that conversation, out there in the open. And the conversation around having proper and adequate insurance is always a very, very important conversation. Always one worth having and repeating time and again. So last week, it was all about general insurance. Today, we are putting the spotlight on life insurance. And mind you, here we're keeping it very simple. We're not talking about insurance and investments and a lot of other plans. We're keeping it very, very simple. Having the right policy that will ensure that your loved ones are well taken care of, your liabilities are well taken care of in your absence. Well, I have with me Amit Chhabra, Chief Business Officer at Policy Bazaar, joining in, and also Mr. Satishwar B. Of Bandhan Life Insurance. Gentlemen, thank you so much for being here. First of all, I must wish happy Insurance Awareness Day to both of you. Mr. Satishwar, I want to open with you because life insurance, as we know, is a product that we all need, we all know. But I want to start by getting your thoughts on how not investors, policy buyers. See, that's what comes to mind. Right now, I'm going to use the term policy buyers. How policy buyers are evolving. What are the lessons we've learned from COVID? And where the market is today.
So, first of all, thank you for having me here. And it's a wonderful initiative on improving awareness. And the biggest task was done last year when the government basically got an exemption, GST exemption on the life insurance, right? Kind of saying it's an important product to have. So, as an industry, the awareness has been continuously doing. So, two major events which has actually helped us. One is, of course, COVID. We saw an immediate spurt in the need for life insurance, kind of basically saying something can happen or anything happen anytime, right? And the family needs to be protected. So we saw a nice spurt, but it kind of, the fear went down, it kind of came down. And we currently again saw a nice interest coming up post the GST exemption, right? Which is basically kind of saying 18% discount. But the larger message, which I gathered from that, was basically it got into a lot of people's dining table discussion, right? Basically saying, an insurance premium being exempt from GST, it kind of drove a message saying it is an essential item to have, it's an essential service to have, it's an essential product to have, right? So that kind of helped. The awareness, wonderful. I think it has increased a lot, especially people, the nuclear families again, right? Overall, wherever they've started understanding that they have dependents and they need to kind of ensure that they are protected, the family is protected in case of any untoward incident which is happening. So that has come through.
So life insurance in India over the last so many decades has always been sold as a bundled offering, that it will protect you, it can also help you grow your wealth. But term is a very different conversation, and that's only come up in the last few years. So what is the rate of growth in terms of pure protection? Are people adapting towards it? At what rate? And how big is the term insurance market now?
No, so if you actually look at the number of policies there, so what we do is end up comparing it in terms of the premium number. So a savings premium will be naturally higher because there's a savings component attached to it. Term is a pure, it's a fee that you pay. For example, in the common current Gen Z language, it's a subscription, right? It's a kind of a subscription that you pay for ensuring that the earning replacement happens. So it's an earning replacement product. That's a word which I use, saying in case the earning member is no longer there, the earning still continues to come to the family. Right? The family is protected. So it's a subscription that you pay to take care of that. We have seen a good 15-20% kind of a CAGR as far as the number of policies are concerned. Okay. So quite a few people are interested. The awareness has gone well. What is still lacking is the adequacy of it. Okay. So you buy it once at the very early stage. Naturally, you are not at the peak of your career, possibly, or even it's a very early stage of your earning. Right? So you buy one, but you kind of then don't top it up or so, which is good. Something is better than nothing for sure. But I strongly believe the adequacy is something which is still kind of lacking.
Okay. Amit, come in on this. At the Policy Bazaar platform, what is the growth in term plans? Who's buying it? Is there any geographical sort of trend that you've picked up over the last 2-3 years?
So historically, Surabhi, what has happened is it's mostly the salaried people who've bought term insurance, young salaried people, say less than 45 years. And, I work at an organization. I want to make sure that my family is protected if something happens to me. That was the traditional, I would say, the way of buying term insurance. However, now that is evolving. What we're now seeing is a lot of newer segments are coming in. So what we're seeing is, for example, a lot of self-employed people are now buying term insurance. And there was a problem in, giving income documents, for example, because India is, that country. But now more and more people are able to take term insurance. So self-employed people who are rich, who have all the wherewithal, but they never thought of term insurance. So that is one. Second, we have seen an interesting category coming up, that's housewives. So that's basically people buying for their spouses who don't have income, but you want them to be protected as well. That was again a category which was never touched.
Housewives buying term insurance?
Yes, either themselves or their spouses buying for them.
For them,
but they are buying increasingly. The third interesting category is NRIs buying term insurance in India. So I live in Dubai, or I live in Singapore, or the US. But I buy term insurance in India. The reason is because, one, my roots are in India, and eventually a lot of people, for example, in Dubai or Singapore, they will come back to India eventually. So they want that when they turn old, at that time their insurance is in India and not in not in some other country. Secondly, term insurance in India is cheaper as well. So it's a good opportunity in that sense. So a lot of newer categories have opened up, and to Sir's point, also adequacy started to improve. So what was 1 crore 3 years back is now getting to 2 crores. So the average sum insured is now, I think, it's close to 2 crores now.
That's what I was going to. So most popular sum insured plans would be around the 2 crore plans.
The average is about 1.5 right now.
1.5 crores.
It's split between 1 and 2. And it's going up. It's going up as as inflation increases, as the incomes increases.
Lifestyle, all of that.
That is happening. So there is an evolution definitely that has started to happen. The last thing I would say is, as a trend, is that more and more people are also looking to buy plans where you end up paying upfront rather than paying through the lifetime of your policy, which means that, so let's say if I buy a policy where I have to pay for 30 years, then either I can pay for 30 years, month by month or year by year, or I can actually finish off my premium in the next 5 years. The benefit of that is, if you're earning right now and if you have the capacity to pay, it's better to pay now versus, let's say, when you're not earning at that time, to be paying premium becomes tougher.
So give me an example of, it could be any insurance provider, where what will be the cost if you're saying taking this upfront option versus an annual payout? And you can take the example of a prototype, maybe a 30-year-old who's looking to buy insurance.
Yeah, so typically the way to look, like I'll give you my premium example only. So I have a policy for about 40 years of a tenure, and the premium that I pay is about 4,000 rupees a month. Now this 4,000 rupees a month will, over a 40-year period, I will end up paying, let's say, amount X. If I end up paying in the first 5 years only, the total premium paid in the first 5 years versus over the duration of those 40 years, it reduces by almost 40%.
Oh, so you end up paying 40% lesser premium?
Over a period of time. Cumulative.
Cumulative.
So, yes. So here in the first case, I would have paid every month for the next 40 years. Here, I would pay only for the first 5 years. The cumulated amount will be much lesser. It will be significantly lesser, but I'm paying upfront. So the people who have the income right now, they prefer to pay it now because I don't want in the future, when I'm not earning, the burden of premium should not come to me.
Fair enough. So that's one of the options that we can definitely consider. We have to take a break now, but we come back and make it even more granular. What are the questions to ask when you're out in the market shopping for a term plan? What are the chances of you getting a very comprehensive cover? All of those details discussed after the break.
Let's talk money. Let's talk money.
Welcome back. You're with us on Let's Talk Money. And as we mark the International Day for Insurance Awareness this week, it's full spotlight on life insurance. And life insurance in its purest form, pure protection, which is term insurance. So we, of course, have Mr. Satishwar B of Bandhan Life with us. So my question is very simple. Now, let's say that you're in your 30s, mid-30s. That's when you hopefully start getting a little more mature in life, right? I mean, you realize that, okay, I'll have dependents at some point, maybe parents, maybe children, maybe a spouse, and you start thinking of a term plan. What all should you consider? What are the questions to ask? And from an insurer's perspective, we also want to know your side of the story, that are you likely to give the policy to someone who's a salaried person versus someone with business versus someone self-employed, very erratic, business or revenue sources? How does it work?
So let me first come from a customer perspective, right? What you need to take care of. The core of this product, okay? The simplest form of life insurance, it's the most simplest form. You basically pay a premium. Something happens to the policy holder, which is specifically death in case of life insurance. The family or the dependents basically are taken care of as far as the income is, because it's an income replacement product. Okay? So it basically takes care of that. The earnings continue to come for the family. So the adequacy of the cover should be something that is able to replace that income.
Sure.
Right. Now there can be a wonderful mathematics to it, but the simplest form which we say, and we can't go wrong, 99% you will get it right, is looking at it, if you are younger, look at it at say 20 times or 25 times your current income, which also takes care of inflation, plus gives the family a good 15, 20 years to come back to the normal scope of life.
So roughly 20 times your annual income.
Yeah, if you're younger.
Okay, if you're a young person.
Or if you're above 40 plus, ideally it's too late to buy a life insurance product, but still better late than never, right? In that case, a good 10 to 15 times. The other rule is basically it's supposed to be taking care of your earning age. So assuming that you will retire at age 60, 60 minus your current age, that's your multiple.
Okay.
So that's another way of doing it.
That's the math.
So adequacy is the most critical one.
Sure.
So you need to take care of that.
Okay.
Right? From an insurer perspective, as I said, it's an income replacement tool. Right? And it's an uncertain event. So we know that death is uncertain. These are the two things that we always check whenever we buy a policy.
Yeah.
So we need to know what's your current income. So somebody who's earning, say, 3 lakh rupees a year, I can't give him a 3 crore cover. Right? It's basically kind of an anti-selection. It's not, because it's not an income making tool, it's an income replacement tool.
True.
That's the reason there is a financial underwriting that we do, which basically takes care of understanding what's your current income, and naturally you will take care, kind of consider
your
the inflation
living
part.
expenses have to then
More
be
than the expenses, we are basically saying what's your income. What's your current
Assuming your
earnings?
living expenses should be, commensurate to the income, because
Again,
that's how it has to be.
Coming back to it, so basically expenses has to be commensurate to income.
That's what.
Right? I will have to spend within my means.
Absolutely.
So we are actually replacing the means in case if that means stops, and that's the reason income. So it has to be an income replacement product.
So
right? So the estimate of income is what we want to do, and two, it's a healthy guy. What do I mean by healthy guy? That I am not aware of, I am currently not suffering from major illnesses. And when I'm saying major illnesses, we are not talking about flu or something like that, right? It's kind of a critical illness which is not being said. So these are the two pieces that we do. One is financial underwriting, which to estimate his current earnings. Two is whether he's healthy. From this perspective, salaried, non-salaried, as he said, self-employed, that's a segment we actually got in.
Professional, exactly.
Correct.
It could be so many different
So we
segments.
introduced self-segment as a specific focus, self-employed segment as a specific focus, because there was a struggle in terms of getting life insurance. It was a supply side issue as an initial, because we were wanting to understand what's your current income is, and that was fine. But with all this new digital age, right? So everything is happening through, say, your UPI-based thing, or you necessarily have a bank account, and various other pieces, which has currently started giving me a wonderful, without getting into too much of documentation, an estimate of the income, right? That has actually opened up that space. So what we want, your current estimated income, various ways of doing it, whether the customer is a salaried guy, steady income, a self-employed, a little wavering, but over the years we still know the kind of income that he can generate. So that's one, and a healthy thing.
So now, I want you to put some rough ballpark numbers or maybe some examples. And I mean, with the caveat, this is only an example. Say a 30-year-old comes to you. Now, here's a 30-year-old, no pre-existing diseases, no known ailments, has a certain income, say, is earning maybe 12 lakh rupees a year. Now, this individual wants an insurance cover versus a 30-year-old comes but has already developed, say, a hypertension or some kind of a ailment, but yet also wants to buy, term cover. Then how does the whole math change in terms of the kind of cover, the pricing? Some ballpark estimates will help.
So the cover still remains the same.
Okay.
Okay. So basically saying, so giving my example or the example which I normally try to do, take till age 60, 60 minus 30, 30 times your current earnings. So 30 into 12 is the kind of sum assured that he should have, right?
Okay.
The cover he should have.
Okay.
Now the guy, whether he currently doesn't have any health issues versus existing health issues, the premium goes up a bit. Right?
Okay. What is a bit?
It can range from a 10% to a 40%.
Okay.
Based on how
The
bad
the
situation is and how are you taking care of it.
Okay.
So we also, in the sense, I am aware of it, but I'm doing nothing about it, right? Naturally, the premium goes up. But I'm aware of it and I am taking care of it, right? It's much under control. Right?
Okay.
That basically also brings down the premium. Because these are health or basically saying the example that you gave in are lifestyle issues.
Yeah.
If you manage it well, it can be controlled.
Sure.
Right? Because as a life insurance company, you're taking care of death. In case of health insurance, it might be a little different. But in case of life insurance, it's the death piece. So if you are basically showing more signs of managing it pretty well, we actually have
Just
models.
curious, how do you track that? Whether there's a 30-year-old who's becoming very responsible, improving his or her lifestyle to manage that condition versus someone who's telling you on paper.
The medical record does tell you that.
Okay, so the medical records.
The medical records, and now, for example, HbA1c, which basically gives you the last 6 months average, right? And then you also do a current one.
Correct.
So there are various means of doing it.
Enough
But
medical
these are-
testing.
So if you are taking care of yourself, the premiums naturally are much less.
Okay. Okay.
There are clear signs saying you are not, then it becomes a little difficult.
Okay, got that. So that's helpful framework. Now we understand how, an insurer thinks about these things. Now, Amit, let's come back to the customer. So when the customer goes and decides, I need to buy a term insurance plan, we've discussed the adequacy part of it. There are a lot of other features as well. What all to consider? There are these riders you can add on. So just build the whole package for us.
I think just before the riders, one more important decision is till when do I want the coverage? As I was saying, should I only get the coverage till, let's say, till I'm earning, which is, let's say, 55 or 60 years of age? Should I get a whole life cover, like till whenever I'm alive, there is cover and then there is sort of a guaranteed payout in that sense? That is one more important decision point, and there are pros and cons. A lot of people look at it, in different ways. But deciding that age till when I will be covered is one important factor while buying your term insurance policy.
And I'm glad you brought this up because now there are policies which give you your premium back if you outlive the policy term. And there are some interesting exit options as we were discussing just before the show began. So just throw some light on this.
So there is a concept of return of premium, in which case, let's say if I have a policy till 60 years of age and and I don't die, then I get the entire premium back. It's called term return on premium, which means everything that I had given to the insurance company, that comes back to me.
Okay.
Typically, the premiums are slightly expensive than the regular premiums, but then I get my money back.
You're assured that this is not wastage, like some people think. That
unfortunate, but that's how a lot of consumers do things. So this is one option. You can also look at a whole life cover, which means practically till whenever you are alive, the cover is there. So you would get get the death benefit whenever, or your dependents get the death benefit whenever you die.
And Mr. Satishwar was telling us that now there are flexible plans which are also offering some flexibility. Like, okay, now I'm 60, I don't need the policy anymore. Or maybe at 65, so I can exit whenever I want, is it?
Not whenever you want. So the option has a very specific schedule. So as you said, right, the core purpose is income replacement. So I should ideally be covering it only for the working age. But you can actually also plan legacy, and the insurance company provides for it. If you want to buy it till, say, age 80, you can buy it till 80. Now, so suppose if you bought a policy till age 70 or 75, right? And by the time you're age 50, you would have created some corpus for yourself. So that is, of course, it's kind of taking care of that. But you're now free of all your obligations. Your kids have grown up, they're on their own, right? There are no liabilities on your head. Do we need an insurance company? Insurance is basically required where somebody is dependent on you. So you can choose at that point in time, say age 55, saying, okay, I don't want my insurance cover. And the insurance company actually says, okay, in that case, I bought it till 75, but age 55, I'm saying, okay, I no longer need it. So we insurance companies also actually kind of enable that process by saying that, okay, you can cancel your policy and we will pay all the premiums that you paid till date back to you. Right. So that's an option. So it's when I'm buying it, I've decided all the way till age 70 or 75. But it also gives me an option to get my money back, saying, okay, I no longer need it. Let me take my money back.
So two important things. First of all, the amount that you need, and then for how long do you need that cover to last? Two things to think about. Amit, what else?
I think a couple of riders which are additional protection covers that you must look at. One is a critical illness policy. So just basics, right? A term insurance protects you from death. In case you die, your dependents will get money. What if you get cancer or a heart problem or a liver problem and you are actually out of your work for the next 6 months? You don't get any money from your term insurance policy. Your health insurance policy will pay for the hospitalization, but it will not pay your salary. You will be out of office, you will not get your salary. So there is an income loss that happens at that point in time. In fact, we were discussing last week as well, around the health insurance topic as well. So critical illness coverage is extremely important, and it's again one of those topics which are not spoken about much.
Because you don't plan to have suddenly like a liver issue or a kidney issue, so you don't build that in.
Exactly. If we talk about hospitalization covers, we don't talk about income replacement in case a critical illness happens. So that is one important rider that should be looked at. And the second is accidental disability. See, again, term insurance covers for death. Health insurance will cover for your hospitalization. But what if there is a disability?
And you can't earn that much
and
anymore.
You can't earn. So that is what the personal accident cover, which can be as an add-on to your term insurance policy.
So these critical illness covers or the accidental, the personal accident covers, they are usually provided by the life insurers because they're income replacement products, is it?
Both do actually. So you can take from a life or a non-life company.
And what's the advantage either or? I mean, why should you opt for a life insurance product versus something coming from general insurance?
So the structure varies a bit. Like for example, in a critical illness policy from a general insurer or a health insurer, it will behave like a health insurance product in the sense it will get renewed every year. The premiums may change every year. In case you're buying from a life insurance company, it will behave like a term insurance product. So the premiums will be capped and the same premium will be paid, through the lifetime of the product. So the structure is different, the benefits are the same.
Okay, but something to consider for sure. Quick last thoughts. I think we have just the last, 2 minutes on the show. So, Mr. Satishwar, what would you say to people out there who are finally, ready to buy that term plan? What should their checklist be like?
The very fact that they're ready to buy a term plan, wonderful decision made, right? And I strongly believe it's an essential commodity or essential product to have, right? Because you don't think about death, but it's there. The only suggestion that I have is whenever you buy a plan, one is adequacy of the cover, but the other one is talking about your identification. Please ensure that you have given the right documents for the identification. So KYC is a must. Satishwar is Satishwar. Okay. The reason why certain claims get denied at a later point in time is somebody else represented Satishwar. Okay, that happens, and which is fraud, right? So, and might be the policyholder himself is not aware of it. Could have happened, but the piece is basically again. So documentation, digital documentation is taking care of it. So as insurance companies, we have actually made that process much more efficient, much more lighter, but you'll have to spend that time on it. Right? So one is KYC, ensure that you are actually present and doing it. Two is there are specifically certain declarations that we ask in the application form. These are not very lengthy, should be in the range of 12 to 15 questions, which are simple lifestyle related questions and health related questions. Please ensure that you yourself have seen it and it's honest declaration. Because the very purpose of a term plan is to ensure that in case of death, the claim is being paid. That's one. And third is the medical pieces again, declarations. So these are the two. If these are there, there are no chance that a claim can get declined.
Okay, all right. So very, very honest disclosure, thoughtful attention to detail when it comes to your documentation and asking the right questions. How much cover, for how long do you want the cover? And I think we would be pretty much home with respect to our term plans. Not the most easy product to buy, not the same as buying a new car, not as exciting, but it's a product that will serve you, your loved ones actually very well in the event of some sort of a mishap. Well, gentlemen, thank you very much for joining us and for raising the level of awareness about pure life protection and insurance. Thank you for being with us on the show today.
Thank you very much. Appreciate this.
All right, viewers, hopefully you found this conversation on insurance helpful. Keep sending us your feedback, your comments and queries. As always, we'll see you again with more money ideas next week.
Let's talk money.
Hello and welcome to CNBC TV 18 special. I am Ashmit Kumar. Now, it's been 9 years since the government launched the goods and services tax regime. The idea was to replace multiple indirect taxes with a unified tax system under the vision of one nation, one tax. Since its rollout in 2017, GST has evolved through a continuous reforms, digitization and strong center-state coordination. The number of registered GST taxpayers has gone up from 66.5 lakhs in 2017 to 1.65 crores as of May of 2026. Now, the annual gross GST collections have also risen from 7.4 lakh crore rupees in 2017-2018 to 22.2 lakh crore rupees for FY26. Now, the latest data shows that momentum held strong into June. Collections expanded at their fastest pace in 13 months. Up nearly 14% year-on-year to 1.95 lakh crore rupees. Maharashtra takes a lion's share of the GST contributions. Its share stood at 9% in June. Now, the GST regime started out with 4 slabs of 5, 12, 18 and 28%, 5 if you count 0 as well. With the GST 2.0 reforms of October of 2025, this structure was simplified to 5, 18 and a 40% tax was implemented for luxury and sin goods, including tobacco, high-end cars, and lottery. Now, GST 2.0 also made registration and return filing easier. When you step back and take a look at the 9-year arc, however, the milestones are hard to miss. GST created a unified domestic market. It accelerated the formalization of the economy, pulling more businesses into the tax net. Reporting, monitoring and collection are now almost entirely digital. That's the digital footprint of this GST. Meanwhile, revenues have risen at a steady, sustained pace year after year, and the revenues continue to be shared between the centre and the states under the federal structure. Speaking of cooperative federalism, especially with the GST Council. Now, with GST 2.0, the Council finally moved on rate rationalization as well, something the industry had been demanding for years. But the journey hasn't been without friction, and some questions still need answering. The GST Council hasn't met since September of 2025. The next meeting is expected later this month in July in Kolkata, but that's a longer than usual gap. The problem of inverted duty structures continues to hurt several sectors. The TAT portal has seen repeated glitches, forcing the filing deadline to be pushed to July 31st. And the appeals backlog has now crossed 4.5 lakh cases, raising questions about the dispute resolution keeping pace with collections. Now, joining us now to help us decode this 9-year journey and what it could look like going ahead is with us Mr. Najib Shah, former CBIC chairman. Also with us is Mr. Prateek Jain, partner of PricewaterhouseCoopers Co. We also have with us Mr. Abhishek Jain, partner of, as well as a national indirect tax head at KPMG in India. To all of our guests, thank you so much for joining us. Mr. Shah, I'll come to you first. We all were on the field. We were reporting on the midnight of 1st of July 2017 when that transition happened to the GST regime. Tell us, when you look back at this 9-year journey, how would you rate the success of this regime, and how would you look at some of the challenges that have come up?
Momentous has been the journey, right from the day when we conceived GST to its launch in 2017, and again from 2017 till now. It has been momentous. It has been a roller coaster ride, and like you rightly pointed out, there have been multiple positives in the way GST has shaped up. Yes, the challenges are many, again, like you pointed out. I think we have set right a lot of the issues relating to rate rationalization. Inverted duty structure is going to be extremely challenging because the possibility of ensuring that there is no inverted duty structure, I can assure you, is extremely difficult. But yes, it is going to be work in progress. I think tax administration is an area where the department continues to focus and should continue to focus, because the best of laws in the hands of a poor administrator at the field can destroy all your best of intentions. GSTN is constantly work in progress. We have been putting a lot of demands on GSTN, and I think they have shaped up well, but I think more needs to be done there. Dispute resolution is a serious matter of concern, and I hope that the GST Council ensures that it also has close oversight on the functioning of the tribunal, because till now, in a lot of places, the basic infrastructure is still lacking, and it needs to come up very, very fast, because you can't have these sort of numbers pending, because they're going to be very challenging. I think another area which needs to be addressed is that we should ensure that there's no retrospective decisions taken. I speak specifically in relation to online gaming, where the council took such a decision and the Supreme Court upheld it, surprisingly. So, but yes, there are a lot of positives, and this is going to be a constant work in progress.
You've given us a very wide set of points to cover in the space of this discussion, Mr. Shah, but let's address them one by one. The first point that you raised, Mr. Shah, of course, was on the issue of rate rationalization. Let's get Mr. Abhishek Jain on this. Mr. Jain, let me get your perspective. Rate rationalization was a much needed exercise, bringing it down to 3 slabs, 4 if you actually count 0 as well. 0, 5, 18, and then now 40, the exceptional situation. Tell us, will this help resolve? We've seen previously disputes regarding classification as to how to categorize products, which slab they fall under. Will this help address some of those issues going forward?
No, definitely, Ashmit. We, as you said, we have reduced the slabs, and it's largely 5 and 18 now. 40 is only for very, very exceptional goods and services. So it's largely 5 and 18, which is a great achievement. The ideal situation would have been a single rate, but maybe in a country like India, that may not be possible. So 5 and 18, only 2 rate structures. Many of the goods which were earlier under 12 have moved to 5%. Also, some of the goods under 18 have moved to 5%. So those disputes between 5 and a 12 or a 12 and 18 are not there. So I think this will definitely help reduce complexity and disputes around the applicable rate for these goods and services.
Sure. Speaking of rationalization, let me also get another perspective on this. Again, we're looking at, of course, 4 slabs right now, if you include 0 as well. Mr. Prateek Jain, let me come to you. Just want to get your perspective. Where we stand right now, where do you see this journey going? Have we reached a final destination of sorts, or do you see perhaps further rationalization in the next 3 to 5 years, bringing it down to perhaps 2 slabs like we've seen in most advanced economies?
Yeah, so it's a journey. I mean, 9 years in a reform like this is still pretty early. So I would say that there is more rationalization which will happen at some point in time. But I'm pretty happy with the way things have panned out on the rates as of now. 5, 18, and 40. I mean, if you look at many global, large, mature economies as well, you have one normal rate and one lower and one higher. That's how it works, and that's how the structure is. I think 18% perhaps can be reduced a bit to, let's say, 15 or 16. That is one possibility that I see over the next couple of years. But the structure essentially may be similar, meaning one standard rate, one slightly lower, one higher rate for demerit products. Of course, the debate will continue that what all should be covered under 40%, etc. That I'm not going to that debate. But pretty well done on the rate front. I think at this point in time, the industry is not expecting too much of rate rationalization. The expectation is more about simplification of the law, unlocking the working capital, which is stuck, particularly because of GST 2.0, the inverted duty structure that we have, the dispute resolution that Mr. Najib Shah talked about. Those are the issues that industry has at this point in time. I think they're pretty much okay with the rates at the moment.
Mr. Prateek Jain, let's build on those 2 points that you, in fact, suggested. One is, of course, that of inverted duty structure. But before we do that, on the issue of dispute resolution, the GST 80 has just come online. It's seen a huge response in terms of people wanting to file their applications. We were just running some numbers through a few tax practitioners. What they tell us is that only about 30,000 applications have been filed. The backlog is 4.5 lakhs. Tell us, with this backlog in question, how do you see the appellate tribunal addressing this challenge? We're looking at massive numbers of appeals.
Yeah, I mean, it is a problem, right? I mean, first, the tribunal itself has been set up after a long time, and suddenly, as expected, you have a huge backlog. One of the ways to do it is to see how we can bunch the cases together. So many of these cases would be similar. Either it could be on particularly input tax credit issue, on rate, or whatever, X, Y, Z. So you can bunch it together and try and sort of resolve a lot of issues in one go. And bear in mind that after tribunal decides, it could either again go to higher courts, right? So it's not the end of the matter at that point in time. I think the other point from a structural thing is to say that how going forward you can reduce the disputes. The one is to come up with a larger and more comprehensive amnesty scheme, for example, so to clear the past and allow the industry to pay and move on. That's one way of doing it. Second is, can you have this regular mechanism of clarifications or a more robust advanced ruling, so that or arbitration, for example, those kind of things should be looked at to avoid litigation this time to start. And you're right. I mean, the backlog is humongous. It will take several years for the tribunal to clear them off.
Mr. Najib Shah, just your perspective on this issue. The litigation burden that we're looking at, 4.8 lakh cases is what we have on our hands. This is almost unprecedented in terms of backlog. How do we go about addressing this? You did talk about perhaps having enough infrastructural aids, but what would your recommendation be in terms of addressing this challenge?
No, like Prateek did mention, I think bunching is one solution which the tribunal should seriously consider. It will mean somebody going through all the appeals. It will mean distributing between the various benches and ensuring that you dispose it in bunches. Amnesty scheme, though I'm not a great fan of it, but I think it's one way of clearing the backlog, simply because, again, a lot of the taxpayer would very much like to settle and get it over with and move on. And they will be well aware of the fact that these numbers would mean challenges for the tribunal and a long wait. So amnesty scheme is something which the council, the government should seriously consider and recommend. I think it'll need great maturity. It'll need great common sense on the part of the tribunal ultimately to ensure that they try and address these numbers as rapidly as possible, ensure that appeals don't drag on, ensure that submissions are, to the extent possible, not subject to a very long debate and oral representation, so that they can sit down and start taking decisions.
Sure. Mr. Abhishek Jain, on the issue of inverted duty structure, this is one aspect that has plagued multiple sectors. Which, to your mind, are perhaps the loudest voices that are coming in at this point in terms of wanting to address, needing to address this issue?
So, Ashmit, I think the FMCG and the food sector, I think those are the ones which have largely moved from a 12 or an 18% rate to 5%. And invariably, all those companies or sectors have this inverted duty problem, unless you are into a diversified sector where you have goods under 18 plus 5 and you are able to offset the excess credit on the 5% goods against your 18% portfolio. But you don't have too many companies around that. So all sectors, all companies at a 5% rate is facing this issue. They're accumulating hundreds of crores of credit, which they don't see any possibility of liquidating. Currently, the inverted duty refund is restricted only to credit accumulation on account of inputs and not on account of capital goods and input services. There have been representations, and the industry is working very closely with the government if the government can allow refunds on account of accumulation for capital goods and input services as well. So that if that happens, I think that would be a great relief for the industry. If not, then this industry is accumulating credits and that keep on happening.
Right. Mr. Prateek Jain, similar question. Where are the loudest voices coming from on concerns regarding IDF?
So FMCG is one, which Abhishek did point to. Pharmaceuticals is another. Wherever the output is at 5%, you will have this issue. Then there are, this problem is there for not inverted duty structure per se, but huge accumulation of input taxes, right? That's for telecom, because they pay huge GST on things like spectrum and so on. For e-commerce, there is huge accumulation in different states and so on. We have been requesting the government to address both, right? One is inverted duty structure, which is coming because your output is lesser or taxed at a lesser rate. Another is genuine issues where I'm making a capital expenditure, or my business in one state is less and compared to other. Can you do something to ensure that going forward the accumulation is less? And there are a series of suggestions which have been presented to the government, including things like creating a common pool of credit across states, at least at the central GST level, maybe converting this into some kind of scripts which is freely tradable in the market, and so on. So let's see what the government does. But I'm sure that inverted duty structure is on the top of the agenda for consideration at this point in time.
Sure. I'd like to request all of our panelists to do stay on with us. We're slipping into a very short break, but we'll continue this conversation on the 9 years of GST on the other side. Welcome back. Still with us on the show is with us Mr. Najib Shah, former CBIC chairman, Mr. Prateek Jain from Pricewaterhouse, as well as Mr. Abhishek Jain with KPMG. Gentlemen, thank you so much for staying on with us. Mr. Shah, a quick set of issues I want to get your thoughts on. Firstly, when you made a reference in the very first response that you gave with respect to no retrospective taxation, you were, of course, referring to the online gaming case. Where do we stand right now? The Supreme Court, of course, has granted its stamp of approval. Does that mean it's an all clear to move ahead with retro taxation?
At least it's all clear in this particular issue because the Supreme Court gave the stamp of approval to the GST Council's recommendation, which it should not have happened, but that is fait accompli now. So yes, the department, I'm sure, will move ahead to look at all those demands. I do not know the amount involved. I've got figures suggesting it's 2 lakh crores. Somebody saying it's 50,000 crores. Whatever it is money which is not going to be available with the taxpayer because we are looking back right from 2017. It's going to cause a lot of problems for the taxpayer and for the department to collect this sort of money. I hope that going forward, as a rule, while we can clarify matters to apply retrospectively, the application itself, the collection itself of the consequential tax should be only prospective.
Well, that's an important word of advice on only needing to keep it prospective and not retrospective. Mr. Prateek Jain, let me get your perspective in terms of widening of the GST net from where we stand. We've seen a good run rate of about roughly 2 lakh crore rupees a month. But in terms of the product categories that fall under the GST net, I want to get your thoughts. What, to your mind, does it look like a realistic roadmap for putting in sectors such as whether it's electricity, real estate, petroleum? How do you see that journey?
I think the debate has to start. It'll not be easy, but to my mind, the petroleum products, few of them, like natural gas and ATF, perhaps are low-hanging fruits, which could find consensus quickly. I don't see passenger fuels coming into GST very soon. The other area of debate is on real estate. I think part of the real estate is already covered because the construction of real estate or rental of real estate is covered. But what is not covered is when you sell the property as such, which is subject to stamp duties, and stamp duties complicate things in their own way. So real estate is another one which I think happening. So ATF, natural gas, on the petroleum side. Real estate maybe is going slightly longer term horizon. And then there are issues like education sector, healthcare and agriculture and so on, which are largely outside the net of GST. And all of these things will require some consensus building. But if you ask me roadmap, the short term, I see some petroleum products covered, slightly medium term, perhaps real estate as well. Rest of all perhaps will take more time.
Mr. Abhishek Jain, again, the same question to you. How do you see this roadmap for widening of the GST net?
So I agree with Prateek. I think the debate has to start. But it seems that the states are not willing to accommodate and have more products under GST which are currently liable to do VAT. I mean, natural gas, ATF, electricity, real estate, at least the government can start, or the GST Council can start with these products getting included in GST. Because what happens is that large part of the economy is still outside the GST net, which means that the tax on tax is still there. The input tax credit mechanism is not perfect. The credit is not being available. You cannot take the credit and pay it against the output final product and pass it on to the end consumer. Until some of the low-hanging fruits, they get included. This ideal GST of everything being included and GST being a complete pass-through will never happen. So I think that should start happening. The debate should happen. Some of the products should start getting included. It's been 9 years already, but that discussion has not even started in GST Council.
Mr. Shah, is that going to be an increasingly difficult conversation to have, given as how in a post-compensation cess regime, the states may have perhaps maybe even more hesitant to ensure their share of the pie?
Absolutely. I think it's going to be a very difficult conversation. Everybody agrees that ideally at least the low-hanging fruits, like Prateek would point out, can come under GST, but it's going to be very challenging. I think the government should start debating this. Unfortunately, I think the central government also is a beneficiary of having these products outside GST. So hence, I think there's a bit of a hesitation. But I believe that some debate should be there because these are only adding to costs. Again, like it has been pointed out by Abhishek, it's not good for GST as a concept.
We're running out of time, so I'll come to all of our panelists for a quick final comment. Mr. Shah, we've completed 9 years. As you look at the next 9 years of this journey, what, to your mind, would be the biggest recommendation that will help take this GST 2.0 momentum forward?
Keep looking at tax administration closely. Keep looking at inverted duty structure. A lot more debate and discussions with the state governments because they continue to keep having grievances, which needs to be addressed. And let the GST Council be a wonderful example of cooperative federalism.
Mr. Prateek Jain, again, your 2 cents on what will help take the journey forward? You've highlighted many concerns that the industry has. What, to your mind, are the biggest issues that perhaps need to be addressed in the short to medium term?
So I'll just say that, look, for a tax reform of this nature, 9 years too small a period for us to really critique it too much. I think simplicity, certainty, and transparency are the 3 cornerstones of GST, and that's where one should continue. I'd maybe expect the government to start looking at a white paper of how GST should look like after 5 years or 10 years. And I think that is where we should say that, okay, this is what we want to achieve, and now let us work backwards. I think the law requires a comprehensive review to simplify some of the provisions, particularly related to input tax credit provisions. That needs a huge simplification. Dispute resolution is another thing which Mr. Nadeep Shah has highlighted. So these are the 2 focus areas to my mind, but time has come to start thinking about what after 5 years, what after 10 years, what kind of GST do we want?
Let me take that question across to Mr. Abhishek Jain. Mr. Abhishek Jain, if I were to ask you that question, what after 5 years? The 9 years have been marked with formalization and widening of the net. What to your mind, do the next 5 years look like? Will it be marked by perhaps technology, greater ease of compliance, the biggest points to your mind that should be addressed in the next 3 to 5 years?
I think technology is largely sorted now, Ashmit. I would say 3-4 other things. One, as we discussed, expansion of the tax base by covering more and more excluded sectors within GST. I think that will help a lot. Second, I think, is tax administration. There's still a lot of pain in audits, assessments, and litigation. If the government or the GST Council can also look at a single audit and assessment for multiple GST registrations. We know that we don't have a single national GST. The businesses need GST registration in each state where they are present. But if the government can still look at a single audit and assessment, that will ease a lot of pain at the ground level. Inverted duty problem, if the government can resolve, that's the third thing. Fourth, I think we did touch about the GST tribunal and about 4.5 lakh cases to be filed. And that's all from the industry that is waiting to file those appeals. We mustn't forget that it's also the cases where the industry has won. The government or the revenue authorities have a right to file appeals against favorable orders passed in favor of the industry. I think the government should carefully look at all those cases and only file appeals where there are genuine legal issues which the government feels need to be litigated. Otherwise, if that opens up, it will only add to these 4.5 lakh cases and complicate and burden the entire system. So I think government should be very, very pragmatic out there. So I think these are the 4-5 things I would think that if the government can do in the next 4-5 years, that would be great.
Right. Right, Mr. Abhishek Jain, Mr. Prateek Jain, Mr. Shah for joining us for a lot of color and perspective on what the key milestones have been and importantly, what some of the immediate challenges could be in taking GST 2.0 forward. I'd like to thank our panelists once again for joining us with their perspective. But that's all the time that we have. It's a wrap on this edition of News Center. More news and updates will continue right here.
India's private banking space is seeing a big talent churn. In fact, there is a musical chairs of sorts playing out at the CFO's desks of some of India's top private banks. Axis Bank's loss is HDFC Bank's gain, with Puneet Sharma being appointed as CFO. On the same day, Bandhan Bank announced the resignation of its CFO Rajiv Mantri, who is likely to fill the vacant CFO slot at Axis Bank. This is, of course, yet to be made official. These two exits are only the latest in the leadership churn at India's banks. And it's not just CFOs, by the way. HDFC Bank has named former Finance Secretary and the former Chief Election Commissioner Rajiv Kumar as the next part-time chairman after the controversial exit of former chairman Atanu Chakrabarti, who resigned citing differences in values and ethics. HDFC Bank has the added uncertainty of CEO Sasi Jagdishan's reappointment, which is yet to be finalized. In another surprise move, Kotak Mahindra Bank has said its CEO Ashok Vaswani will not seek a second term, and the search for his successor is currently underway. So what is behind this big bank churn, and will more follow? What will the next set of leaders have to shoulder in terms of growth priorities coming off a Goldilocks period of strong profitability, healthy balance sheets? What will need to be the recipe to grow in a competitive and challenging environment? Well, those are the questions that our editors will answer on the playbook today. Joining me is, of course, our banking expert who had a breaking and a banking evening yesterday, Ritu Singh. She joins us from Bangalore. We're disrupting the boys club today. And, of course, also with us, Prashant, Nimesh and Sriram. Yes. Guys, thanks very much for joining us. Well, musical chairs, no musical chairs, at least in our studio today. But let's decode the CFO chair that Indian banks, and more importantly, HDF.
We should also do a musical chair.
Are we doing it or not doing it? What are we doing?
Not doing it. So let's do this.
Okay. Our own version of musical chairs going on.
Now you decide who the question was.
So Ritu, as the boys settle into their new roles, let's decode the changes that we've seen. HDFC Bank choosing yet another bureaucrat to lead its board.
Yeah, and I hope, our boys have left one chair empty for poor Bandhan Bank that still doesn't have a CFO appointed. But, actually, Shireen, I think there are three. Okay, there is space on the table.
But not enough bureaucrats left.
Okay, yeah, I think there are three different stories that are playing out here simultaneously. And, together, I think they fit together quite beautifully. I mean, one, of course, is governance. That is the HDFC Bank story playing out. The second is the question of succession planning. There you have your Kotak Mahindra Bank. And the third is this scarcity of proven leadership talent. And that explains that CFO musical chairs we've been seeing, across Nimesh, Prashant, Sriram, and in the banking system, of course. But let's start with the CFOs, because I think that is actually a talent story. The right question to really ask, Shireen, is why are banks just going around hiding from each other, not looking outside? And I think the answer is because there's very few experienced bank CFOs that fit the bill today. A modern banking CFO is not your accountant. I mean, their role is just across, capital, liquidity management, your Basel norms, your investor relations, looking at treasury with all that's happening, interfacing with RBI, looking at audit and supervision, technology investments, even M&A, and I can go on and on. I mean, effectively, they're the CEO's co-pilot, and there are very few executives in the country with that breadth of experience. So, banks largely hiring from each other because talent pool, I believe, is limited. Now, coming to HDFC Bank, your question on the choice of Rajiv Kumar as chairman, and I think it's quite interesting, opting once again for this seasoned bureaucrat as chairman rather than, someone from banking or corporate, as many in the market had expected. But look at Rajiv Kumar. I mean, he understands government, of course. He's been in the finance ministry intimately. Regulation, he served on the RBI board. Banking, he was the DFS secretary. He was on SBI's board. Governance, of course, and having overseen all of these big banking policy changes during his time at the finance ministry. So, yeah, on paper, he checks all the boxes and pretty much what HDFC Bank needs today. But then, of course, there's this other school of thought. If you had such problems with a bureaucrat like Atanu Chakrabarti, why bringing in another one? Interestingly, let me also point out, Rajiv Kumar and Atanu Chakrabarti, by the way, were contemporaries in finance ministries, I think around 1920 or so. Both were serving at the same time. Rajiv Kumar as finance secretary and Atanu as the Economic Affairs Secretary. I just want to add that, governance also seems to have become a valuation issue, which was probably not the case 10 years ago so much. But now governance directly impacts your market cap. I mean, look at Yes Bank, look at IndusInd or RBL Bank, and now HDFC Bank even caught up with their embargo. So markets price governance almost like NPAs. So appointments are very, very significant.
No, you're absolutely right, Ritu, and many important issues that you brought up there. And I think the talent issue that you brought up in terms of why we're seeing actually this musical chairs playing out is an important one, because it's not just being reflected at the CFO desk. It's also being reflected at the CEO desk. And we'll come to that in just a bit, because that's the other big issue. And that's the other leadership change that we are going to have to contend with. Shashi Jagdishan's reappointment, of course, is still a pending issue. And then, of course, you have a whole slew of other banks that are slated to see leadership changes in 27, well into 2028. And of course, the big one that's coming up again in the private sector space is Kotak Mahindra Bank, that surprise decision of Ashok Vaswani not to seek a second term. But, we'll address that in just a second. But Nimesh, let's also look at it from a valuation point of view, because Ritu was pointing out that we've actually seen all of this being reflected in the stock performance as well. But let's change the lens and the color a little bit. We're talking about private sector bank leadership changes. Let's look at the market performance now. Stock performance of private sector banks versus public sector banks. And that story is actually interesting, because it's the public sector banks that have the edge.
Oh, absolutely, Shireen. So I just looked at the last 5-year return CAGR for PSUs versus the private banks, and it is shocking. Hands down, PSU banks have outperformed the private banks, and the chart will come up. All the PSU banks in the last 5 years have minimum given, 15, 20, 30% CAGR returns. This is a stock price movement in the last 5 years. And if you compare that to the private banks, it's been a rank underperformance from the private banks. Imagine HDFC Bank has given virtually zero returns in the last 5 years. Kotak Bank, hardly any returns. There were some banks which have given negative returns as well. This is a list of PSU banks, all in double digits. And look at private banks. Axis Bank and ICICI Bank, the only ones who have given 10 to 15% returns. The rest all are either negative or flat. So, that speaks for the volume that in the last 5 years, and it's not only the stock market returns, even in terms of performance, if you look at the PSU bank's performances, it's been much, much better, and they've improved on all metrics in the last 5 years. So again, from a performance point of view, of course, PSUs have outperformed. But the big question now is, which I keep asking to a lot of investors as well, is the best of PSU priced in, and is the worst of private banks priced in? You're seeing a lot of churn in the private banks. It looks like they're all now, coming to the terms of taking the right person and starting to deliver. So from a valuation point of view, it looks like the worst of private is priced in and the best of PSU is priced in.
Shireen, I looked at, just to amplify Nimesh's point,
yeah.
I looked at the Nifty, there's a private bank index, there's a PSU bank index. So Nimesh talked about all these stocks, right? But if you just take the index close as of 2020, and today's close, today intraday rate, not very different from the close. The private bank index CAGR is 10%.
Yeah.
That is from 2020 to today. The PSU bank index CAGR is 37 point something. 10, 37 is humongous difference.
In the private banks, if HDFC Bank and ICICI Bank don't perform, it's going to show up in the Nifty index as well. So it clearly shows up that PSU banks have massively outperformed the private banks.
Yeah, but Prashant, let's just take that conversation forward, and we'll get Ritu to chip in as well. Nimesh raising a very interesting point there, which kind of also takes me back to the conversation that I had with Uday Kotak, and he said, the era of lazy banking is over, and we're all going to have to fight for our business. We're all going to have to fight for relevance and market share and growth and profitability as well. So to Nimesh's point, is the best of public sector banks behind them, and is the worst of private sector banks behind them? Things stabilizing now as far as IndusInd Bank is concerned with the leadership change. The hope is that will, there will be certainty now with the chairman being appointed at HDFC Bank, with the reappointment of the CEO as well. What's the street penciling in there, Prashant?
Shireen, I was thinking where to begin, right? Should we begin in 2014, 2015? I think we should begin in 2015, right? This is when the famous AQR, Asset Quality Review, started. But the point is, we did not, I mean, and of course, these PSU banks have been doing this in a way. The program itself ended, but they've been kind of, on the mend, so to speak, fixing their books, recoveries, etc. for the last, I mean, actually since that time, since 2015. And I'll come to why that is also, the recoveries part is also a big portion of why PSU bank earnings have grown much faster. 2017-18 was, of course, ILN affairs, then there was COVID. And it was not as if by that time the PSU banks had fixed all their problems. I mean, the AQR, etc., was still going on. And then there was recapitalization. Then the interest rate cycle turned sometime in 2021, 2022. And of course, I mean, we all know what has happened since. If you just sort of distill it through three things, why the PSU banks have done so well compared to compared to private sector banks, it's three areas. Market share gains. This is a point where which many have made forcefully, and I think it's well acknowledged. People like Sridhar Sivaram has been making that point on our channel and others as well. That if you look at home loans, if you look at retail assets, basically, there has been 10 to 15% swing in market share between what was with private, which has now gone to PSU. That is number one. Number two, credit costs was this problem, right? When there were phone banking and NPAs, and I mean, just go back 10 years. It's now completely changed. Yeah. Actually, if you look at credit costs, they are across PSU banks, they are comparable to what we see with private sector banks. And the third, which is return ratios. If you look at return on assets, I mean, it's like almost, it's incredible. Any PSU bank, and we speak with so many PSU banks on every quarter, right? The 1% number is almost universal now. Most PSU banks are at 1%, getting to 1% or above 1%, right? So I think these are the three areas. And the ROA point is important because it kind of conveyed to the market that the PSU sort of model is sustainable and it is profitable, it is doing well. And I think these are the three areas why they kind of outperformed in such a large way. Now to the question, right, is the outperformance here to stay? I'll just make a couple of points, which is not anti-PSU, but maybe, this is, I mean, the better way to put it is, everything in markets is at some level cyclical. So is the cyclical, is that going to play out here between PSUs and private sector, and maybe private sector rotates back into the limelight once again? So 3 or 4 points. PSU banks funded the credit growth, the market share gains that we were talking about, right? Where did that come from? So one argument is that PSU banks funded these incremental credit growth by drawing down on SLR buffers, right? Which is essentially, government bonds, which they have to hold on their books by law. So if you look at the PSU bank SLR levels, in FY22, that number was 25%. It's close to 20% now, which is they can't go very much below that number, 20%. So that buffer of funding credit growth through these cheaper SLR deposits is no longer exists. Yeah. Number two, the ROA, headline ROA, 1%, great. But if you look at the composition of PSU and private bank earnings, the PSU bank earnings are a much larger proportion of these PSU bank earnings is treasury profits and recoveries, which they have been undertaking from written off assets, etc., right? So the core ROA, if you compare private and PSU, while the PSU is still 1%, but the core ROA is, some would argue, is structurally better. I mean, it's not dependent on, the movement in GSECs, government security, GSEC yields, GSEC prices, or recoveries, etc. Number 3, PSU banks operate at a much higher leverage, 12 to 17 times, which means that a small increase in credit costs can have an outsized impact on the return on equity, return on assets, etc. And of course, the last point is pretty clear, which I think Nimesh has been making as well, which is valuations now. PSU banks, compared to their own history, which is 10, 15-year history, they're about 1 standard deviation above their, that mean. And the private bank index is, of course, now almost 1 standard deviation below the 10, 15-year mean, so to speak. So I think, as I said, this is not to say that this is, the era of PSU bank outperformance is over, but maybe it's...
we should also remind that it's not always just a binary of PSU versus private, because there are now umpteen new sources of credit. NBFCs are there, so many other. Ritu's story from a couple of weeks ago, I think, 3 out of 4 personal loans are coming from
So the
NBFCs.
financial landscape has changed in the last 15 years. I think the data will come up.
You said it last week, right? The branch is not a moat.
No, exactly. The branch, that is still done now. It's over. But the amount of NBFCs which have gone up in the last 15 years from 30 to 130, that's the kind of, landscape has changed. So,
and also, if you look at NBFCs, right? 10 years back, maybe 15 years back, 10 years back even, most NBFCs were like single segment NBFCs, right?
Absolutely.
There was Shriram Transport doing truck financing, Shriram City Union, which did, other kinds of loans. There was Chola. There was
only doing gold.
There were sector champion, sector specialists. Now everyone is doing everything.
Everything, yeah.
Everybody's
Much like
chasing
all of
gold
us.
loans. Everybody's chasing.
Much like all of us.
I would just add to this, PSU versus private debate. I think even COVID, you brought up the AQR and that cleaned up this corporate banking stress for the system as a whole. And I think following that, the COVID period, I think it brought some sort of leveling across these two banks. I mean, for instance, if you look at it, private banks, during that phase, very focused on retail banking, heavily focused on retail banking. Of course, there were niche banks like IDFC, etc., that were looking at corporate. And for public sector banks, the advantage, to my belief, has also been a wider base, so to speak. So when we saw that cycle of unsecured stress, for instance, playing out, the MSME stress playing out, private banks were, disproportionately hit. And that's why you're seeing some leveling coming in there. And while you say the branch banking method is probably dead, I disagree. I mean, the fact that public sector banks have this wide reach into every nook and corner of the country, the private banks today cannot really compete with fintech or no fintech, reach. That's helping in the CASA mobilization story. So the deposit competition is very much alive in the system. Feet on street, all of that is also making the case for these PSU banks come back. And, of course, the pressure on margins.
As we see this talent churn, as we see this leadership change taking place at India's private sector banks, what will the leadership challenge really be? What will they need to prioritize? We've talked about the competitive landscape changing. We've talked about the rise of NBFCs, the emergence and dominance now of fintechs and so on and so forth, the fight for deposits, the financialization as far as, assets are concerned. What will the priorities need to be as these new leaders get down to business?
Well, exactly as Uday Kotak said, right? The days of lazy banking are over. It's not going to be that branch strategy and the deposit strategy alone that's going to get them there. I mean, look at payments, for example. That's been completely taken away from banks. I mean, not only do they lag behind, I mean, it's been cornered by players like PhonePe, like GPay, like Paytm. I mean, banks are nowhere in the picture in the top UPI players and the top payment players. So, the days of lazy banking, yes, they're over. And I think technology, that's the biggest moat is, people like KV Kamath have repeatedly ad nauseum been saying, if you're not going to innovate with the times, I mean, you can forget about being the stars of the yesteryears. So, I think the expectation of these new CEOs is very much changed. And that also gets us to the point of how the kind of transition we're seeing in what was the face of banking. I mean, for almost 20 years, if you look at it, from the HDFC banking giants, Aditya Puri, Deepak Parekh, your Uday Kotak at Kotak Mahindra Bank, Chanda Kochar at ICICI Bank, then Sandeep Bakshi later, Shikhar Sharma at Axis Bank. I mean, there was very little movement for, more than a decade or so. And now almost every large bank is looking at changing leadership, suddenly. Kotak Mahindra Bank, that's one we're talking about in the midst of that CEO churn. Axis Bank, Amitabh Chaudhary's term ends in December 2027. IDFC First Bank, B. Vaidyanathan, again, his current term will end in December 2027. ICICI Bank, Sandeep Bakshi goes away in 2028. And of course, Sashidhar Jagdishan, he's up for renewal in October. So all of them face CEO renewal discussions. And, PSU banks have always had to deal with this challenge, of very short 3-year, 4-year CEO tenures. Yeah. But for private banks, I think this is unprecedented churn. So, for 2 decades, you had this sector defined by these iconic founders and iconic banks, the Puris and the Kotaks of the world. But, I think a Big Four story has moved on. I think Lata very beautifully, just to wrap this, captured it beautifully in her piece. She said these HDFCs, Kotaks and Axis, they're seeing their dominance dilute because performance, because governance issues and succession, all of that is weighing on valuations. And increasingly in brokerage notes, as Nimesh will also point out, you're seeing, these new names emerge. Federal, RBL, CSB, these are the next winners. These are the names that Dalal Street is looking at and betting on as favorites.
Just to add to what Ritu is saying, Shireen, the other thing
and just before you come in, Nimesh, I think that point is often underappreciated. The fact that at public sector banks, like all government organizations, you have a leadership change every 3 or 4 years. So it's inbuilt into your DNA, and there is no one person who kind of becomes the glue that holds everything together. You have the system learns to move on, and perhaps that has been the advantage and the disadvantage, both as far as the public sector is concerned, but clearly as far as the private sector, across sectors, not just banking, but succession has been a challenge, for Indian corporates, Indian corporations, and that seems to be playing out even as far as the private banking story is concerned. Yes, wrap-up comments from each of you. Nimesh, I'll start with you.
Shireen, the other point which we haven't discussed, but that's going to be a big challenge, is the fact that in the last 1 year, we've seen massive FDI inflows into the Indian financial sector. Now, RBL is sitting on, Etihad is sitting on RBL Bank, basically Emirates. There is, Shriram Finance sitting on $4.4 billion of FDI capital. And that's going to be another challenge for the private banks, right? So, again, my point is, when we look at from a market perspective, forget those days of four times price to book for HDFC Bank, 9 times price to book for Bajaj Finance. Those days are over. That's history now. At best, what they can do is from 1 to 1.3, they can go to 2x or 2.5 times price to book. So that is something which investors have to keep in mind, that those glory days of 4x, 5x price to book is done with. And there's going to be massive competition in the financial sector from here on.
Shireen, I was talking to one of the entities which got money off the thing. And I said, well, you've got money. And there was one leg of re-rating which happened. I said, what next? He said, ab bada mushkil hai yahan se. Ab time lagega. Because, and the basic reason was, they said, bahut competition hai. So it's not going to be easy.
It's not going to be easy. Look at the landscape now. The entire landscape has changed so much. I mean, there are so much of listed entities, small finance bank, NBFCs, housing finance companies, fintech companies.
Yeah.
There's so much of choice. Investors are spoiled for choice now in the financial space, Shireen.
But
and one more googly.
That's what separates. That's what separates the winners, right? When it's never easy, to actually get going, I think that's what separates the winners. Yeah, you were saying, Prashant?
I was just on a lighter note. Ritu was listing all the names, right, from the yesteryears, and of course, they're all active now. But I remember this is. A friend who's now pretty senior at one of the banks. He once told me long back. He said, bank CEO should be the banks which do well. You will notice the CEOs are always Punjabi, So I asked him why. No doubt he was a Punjabi himself. So he said, you need that aggression. You need to go out in the market, sell. Of course, he was talking to South Indians, so I took that point.
But that is the problem that a lot of people are also citing, right? Like bringing these bureaucrats on board one by one. I mean, there is nothing. I personally don't think anything wrong with it, except that they will probably ask for 3 Xerox copies of everything. Beyond that, I think but there is one problem in the message that it is sending, that there is enough room for subjective sort of interpretation of the regulations, so much so that only a person who has the contacts and the context can navigate this, right? Somebody cannot grow into that position and be able to navigate the regulations. I think that's not a great message to send, because if bank after bank is hiring a bureaucrat, a former bureaucrat, I think that's not a great message to send. We need to have more transparent, regulations. And second thing that Ritu also hinted at, right, the CFO nomination, the hirings, right, trying to hire from everywhere else. We really need this. Grooming should be a part of it. Because you need to have, I think, Srinath Sridharan, banking veteran.
I'll just tell you one thing, Sriyam. In HDFC Bank's case, right, it's not as if this is not a new. By the way, the current the new chairman was a financial services.
No, I agree. What I'm saying is,
in his early years, it had Shamala Gopinath as.
But like we have been discussing, the landscape is changing so fast. You have your Jupiter and your FI money, etc., coming out with products which like absolutely reimagining the finance as an industry. At that point, like I said, we can avoid with 3 Xerox copies for everything.
No, and I think that links back to the point, the first point that Ritu made, that you may perhaps have to look at talent very differently as this landscape changes. I mean, and I go back to that point that Uday Kotak was making. He said, look, why should you consider only banks as your competition? Why do you not consider an Apple Pay or a Phone Pay or a Google Pay equally as your competitor, as your competition? So perhaps we need to change the lens, and maybe that, the point about regulation, etc., comes in there as well. And maybe get people who are not necessarily bankers, to play with this ecosystem as well and be a part of this ecosystem as well. But all of that is up for discussion and debate. But I can tell you, the last 24 hours, it felt like fast and furious. There was breaking news. There was plenty of changes that we had to deal with. All of that in real time, and I'm glad that we broke it first, courtesy Ritu here on
back to our own
Yeah, I know.
And of course, you heard,
all should be back.
Yeah, actually, let's do that. Let's go back to our places. Yeah.
And okay, fine. They're swapping places.
We will see you next week from these
positions. We started with musical chairs. We'll end with musical chairs. No musical chairs on CNBC TV 18. We're all pretty much still here and have been for many, many years. But for all of us, for now, thanks very much for watching. Stay tuned. Join us again on another episode of Editor's Playbook. We'll see you then. Good evening. Thanks for joining us on Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening: Dalal Street snaps the two-day losing streak, ending near the day's high. The Nifty reclaims 24,000. IT stocks, however, remain under pressure, with the index declining for the fourth straight day. Iran's top negotiator calls the Hormuz Strait their greatest instrument of power, insists talks on a final deal will not begin until Washington fulfills its commitment spelt out in the MOU. Trump's envoys Kushner and Witkoff meet Qatari ministers in Doha. Relief for restaurants and small businesses as oil marketing companies cut the prices of commercial LPG cylinders by 183 rupees. Prices of jet fuel also cut by around 5 rupees a litre. Sources say India's second largest private refiner, Nayara Energy, has cut petrol prices by 5 rupees per litre and diesel prices by 3 rupees. Auto sales in June largely on track. M&M beats estimates. Maruti Suzuki is in line. Hyundai reports a 16% drop. Electric two-wheeler makers shine with healthy tractor sales coming in for Escorts, Kubota as well. The goods and services tax completes 9 years. Collections in June rise 14% to nearly 2 lakh crore rupees, led by Maharashtra, Karnataka and Gujarat. The government notifies daily wage rates for unskilled workers under its flagship employment guarantee scheme. 21 states, including UP and Bihar, allocated a base rate of 300 rupees. Haryana has the highest wage rate of 409 rupees, with the lowest hike of just over 2%. Daily wage rate fixed at over 400 rupees for Kerala and Goa. President Trump raked in over $1 billion through his cryptocurrency ventures in 2025, according to his own financial disclosures. Earned more than $600 million through the sale of souvenir-like meme coins. The U.S. Supreme Court upholds birthright citizenship in a blow to President Trump's agenda. The top court affirms citizenship for anyone born on U.S. soil will be constitutionally guaranteed. Kylian Mbappe scores twice against Sweden to power France through to the pre-quarterfinals of the FIFA World Cup. Haaland's winner sends Norway past Ivory Coast. Mexico beats Ecuador on home turf, winning their first knockout match in 40 years. Well, let's start with the day's market action. The market snapped the two-day losing streak, with the Nifty ending above the 24,000 mark. The Nifty's gains were fueled today by Reliance, SBI and Axis Bank. The Nifty Bank outperformed as well, led by Kotak Mahindra Bank and IndusInd Bank. So 490 higher on the Nifty Bank. The Sensex and the Nifty closing in the green. But the pressure continues to be on the IT stocks. Nifty IT down by over 500 points, a cut of 2% there. And of course, across the board, IT stocks closing in the red. Rima joins us now with more on the sell-off that we continue to see in the IT index for the first half of this year. The pressure continues, Rima.
Well, this is the worst half-yearly performance for the Nifty IT index since 2001. From January to June, the Nifty IT index is down 30%, and even today, it's under pressure. In fact, the index is now trading at a 3-year low. Let's just quickly do a scoreboard first of the year-to-date performance. And as you can see, large-cap IT is down close to 35-40%, and mid-cap IT names have fallen close to about 50%. HCLTech particularly with today's crash. Now, with this, valuations have also come off. So roughly now, large-cap IT companies are trading about 13 times forward multiple, FY28. The 10-year average would be 15 to 20. Companies like TCS would be trading higher. Companies like Wipro, HCLTech historically traded at lower valuation multiple. But despite Indian IT now trading at a deep discount to what it used to, it's still trading at a big premium to global IT companies. So here's, these are some numbers. So Goldman Sachs says, so according to their analysis, IT is trading at a 14 times forward multiple. Again, this is at a discount to the 10-year average, a 35% discount to the 5-year average. But now compare it to Accenture, Cognizant and Capgemini. Their average multiples are just 8 times. So India is at 14 times. Global peers exactly doing the same thing. It's trading at 8 times. So they're saying that Indian IT companies are trading at a 90% premium to global peers, and historically Indian IT commanded a premium of 20-30%. So in a nutshell, according to them, Indian IT is still expensive relative to their global counterparts, and considering that this industry is going to see a low single-digit kind of growth, they don't sort of see it compelling. Morgan Stanley goes on to say the derating is not over. In the past, large cap IT bottomed at 11 to 13 times two-year forward multiple, so they see room for further downside. Now let's get to the fundamental trigger behind all this. Now, FY27 is going to be the fourth consecutive year of anemic growth for the Indian IT industry. KPIT today, of course, issued their profit warning for the current quarter. They're saying growth will just be, it'll be a 1%, negative 1% USD on a year-on-year basis, so minus 1%. And even for Infosys, I was looking at the brokerage estimates. It seems like the company in 3 months will be cutting the top end of its FY27 organic guidance. So the current guidance for Infi is 1.5 to 3.5%. But there are many brokerages who believe that 3.5% will come down to 3%, maybe 2.5%. The brokerage view is that organic demand recovery up until now is too slow to justify holding on to the upper end of the premium multiple. And even for the, all the other companies, Goldman Sachs has already cut the aggregate forecast for the industry to 2.4% revenue growth in the current year. Morgan Stanley too has lowered the FY27 growth numbers very sharply. For TCS, for example, it's a sharp 250 basis points correction. So what are you going to, watch? We're going to be watching, for one, whether organic growth this year will be more or less compared to what it was in the prior year. We're going to watch for discretionary spending, whether the BFSI resilience is holding on and can it offset the continued softness in telecom manufacturing. AI-led deflation, that's important. Currently, expectations are for a 2 to 4% AI deflation. Is it more than that? And is money coming in from AI-related revenue streams? AI investments, we've already seen a step up in terms of acquisitions. So how much are companies willing to plow into their AI offerings? And cost efficiency programs have been running. You've got a Project Maximus at Infosys, Fortius at Tech Mahindra, Ascent at HCLTech. So this is something which perhaps is going to accelerate, and headcounts are likely to remain muted. I think the bulls will tell you that maybe IT is cheap at 13 times. The bear tells you that cheap is relative. But it's surely going to be a very interesting earnings season for the IT sector.
Well, it is going to be an important quarter. Rima, many thanks for joining us. That's the IT sector's report card, the first half since 2001. Now, gold price is falling, with the yellow metal seeing little relief after logging its worst quarterly drop in 13 years in the last session. This as investors pivoted to the dollar on increasing expectations that the Federal Reserve will in fact raise interest rates. Rising US Treasury yields also weighed on the precious metal, so the gold price fall continues. From commodities to the crypto market, Bitcoin prices fell to a 21-month low below the $60,000 mark. This as the prospects of higher interest rates and concerns about the largest corporate buyer of the token weakened sentiment. A stronger US dollar index also weighed on the digital asset. But let's revisit the top story this evening. Iran insists that talks on a final deal will not begin until the US fulfills its commitment spelt out in the MOU. Here are the latest developments today. Tehran's chief negotiator, Mohammad Ghalibaf, has called the Hormuz Strait their greatest instrument of power. He's also warned that free passage through the Strait of Hormuz is guaranteed for only 60 days. Ghalibaf also told state media that the Gulf states had requested for the concession. Meanwhile, indirect US-Iran technical talks are underway in Doha, with Qatar and Pakistan serving as mediators. Reuters reports that Trump's envoys Kushner and Witkoff met Qatar's prime minister to lay the groundwork for technical talks, but are not attending the sessions themselves. The indirect negotiations are reportedly focused on releasing Tehran's funds and the Strait of Hormuz. In the oil market, Brent crude prices eased as investors remain cautious over the outcome of the negotiations between the US and Iran. According to maritime data from Windward, 23 vessels have passed through the strait. However, transit has not returned to the pre-war levels. Prime Minister Modi also held a call with the Iranian president, stressing the need for freedom of navigation in the waterway.
Under the agreement, Iran is committed within 30 days, and about 8 days of that period have now passed, to remove the technical obstacles in the strait, address navigational safety issues, deal with any mines or similar hazards that need to be cleared, and restore conditions so that the ships that had been there before the war can transit safely. For the first 60 days, we will not charge those vessels for these services.
Well, that is Iran's position. Now, the government has reduced the price of jet fuel by 5 rupees per litre to 110 rupees per litre from today. And just for context, aviation turbine fuel accounts for 40% of an airline's operating cost. This move comes as tensions in West Asia continue to ease, lowering the overall pressure on global oil prices. From jet fuel to commercial LPG, the centre has also cut prices for the cylinder by more than 183 rupees, marking the first cut this year in 2026. However, domestic LPG cylinders will continue to be sold at existing prices. The latest reduction in prices comes after a series of price hikes due to the tensions in West Asia. And staying with price cuts, sources say that Nayara Energy has cut the price of petrol by 5 rupees per litre. The private refiner, India's second largest, has also announced cuts for diesel prices by 3 rupees per litre. These cuts will come into effect from today. Sources have further indicated that the price cut will be applicable across all 7,000 fuel stations that are operated by Nayara. So cut coming in there from the private refiners. We are going to have to wait for the public sector oil marketing companies to move next. Auto sales in June largely on track. M&M ahead of estimates. Maruti Suzuki in line. Hyundai reporting a 16% drop. Electric two-wheeler makers shine along with healthy growth. And tractor sales for Escorts Kabuta also coming in strong. Sud is standing by with all the details.
So it's been a mixed bag, but more positives than negatives. So we start with Mahindra and Mahindra. Both auto and tractor segment numbers have been largely better than expectations. For auto segment, SUV continues to see a healthy growth. There was more than 28%, but this time the surprising part was the commercial vehicle segment. LCV, which is between 2 to 3.5 tons, their growth is more than 35%. Tractor segment growth has come at 12% versus our expectation of 7%. Company is saying that it's too early to assess the impact of emerging El Nino conditions, but if things progress well, it's going to achieve the estimates that company has given for FY27. Coming to Maruti Suzuki, sales were largely in line. Here, the positive part was the entry-level segment. Their sales have almost doubled YY. In the month of June, sales were more than 11,000 units against 6,400 units in the same period last year. And SUV segment continues to do well here for Maruti too, and their growth was more than 28%. One negative part was export segment, where growth was just 13%, and in comparison to that, domestic segment's growth was more than 20%. Tata Motors PV, healthy growth on a low base. Total sales have increased by 69%. EV segment, where company is a market leader for this, sales have almost tripled YOY. One company that has underperformed its peers is Hyundai, but sales were largely in line. It has seen a decline of almost 16%, and that's because of production loss that company has seen. There was a fire incident at its manufacturing facility in Chennai. Company is saying that it's going to recover that production loss in Q2 FY27. One segment where both companies, Ashok Leyland and Tata Motors Commercial Vehicle, have given very strong numbers. That's your commercial vehicle segment. For Ashok Leyland, MNHCV and LCV sales have seen a growth of more than 20%. MNHCV sales have increased by 24%, and LCV sales have increased by 28%. And just if you take a look at truck segment, their growth was more than 44%. For Tata Motors Commercial Vehicle 2, it was a strong print for June. Total sales have increased by 35%. Our expectation was 26% increase, and it was led by domestic segment, where the growth was 31%. Amongst two-wheeler names, Hero Moto has come out with the numbers. We were expecting flat YY, but company has seen a decline of more than 2%. And the reason was company has seen a decline in the motorcycle segment, where the decline was 7%. And because of that, domestic sales have declined by 4%. Export contribution is negligible, but their growth company has registered of 30%. So overall, it's a mixed bag, but more positives than negatives.
All right, Sud, many thanks for joining us. Worrying news, India's monsoon woes are far from over. The Indian Met Department has warned that monthly average rainfall over India is expected to be below normal in July. The forecast comes after India recorded one of its driest Junes in more than a century, with rainfall ending 39% below normal. On the western front, Mumbai received torrential rains today. Heavy rains and waterlogging triggered massive traffic snarls across the city. The Weather Department has also issued a yellow alert in Delhi and parts of North India. The national capital is likely to witness heavy rains and thunderstorms in the coming days. The government has notified the daily wage rate for unskilled workers under its flagship employment guarantee scheme. 21 states, including UP and Bihar, have allocated a daily wage of 300 rupees. Haryana has the highest wage rate of 409 rupees, with the lowest hike of just over 2%. Santya is here with the details. Santya, the MGNREGE has now been replaced. Take us through the new wage rates across rural India, across states.
Right, Shireen. So the central government has notified new wages under the new G Ramji Viksit Bharat scheme, which was introduced last year to replace the Rural Employment Guarantee Scheme, Manrega. As per the new wages, Haryana, Goa, Kerala and 3 high-altitude Gram Panchayats of Sikkim will have a daily wage of over 400 rupees for Viksit Bharat G Ramji workers. Nicobar district, Himachal Pradesh, Karnataka and Punjab will have daily wages between 350 to 400 rupees per day. And workers in Andaman district, Andhra Pradesh, Dadra and Nagar Haveli, Daman and Diu, Lakshadweep, Maharashtra, Puducherry, Tamil Nadu and Telangana will get wages between 300 to 350 rupees per day. Workers in the remaining states and UTs will get 300 rupees per day for a maximum of 125 days every year in exchange for rural development work. Shireen, with this, the government says 300 rupees has become the new benchmark for the rural wages under the scheme. The government has said that it tried to bring states and UTs with historically low wages up to a decent level, bridging the gap among states and UTs, and that is why states like Arunachal Pradesh, Himachal Pradesh and Nagaland have received a hike of over 20%. Haryana and all southern states, barring Karnataka, have received less than a 3% hike, and Dadra and Nagar Haveli and Daman and Diu got a 0% hike. With the new wages, the central government claims there will be more equality across the country. The new scheme offers 125 days of work per year compared to 100 days under Manrega. However, under the new scheme, the nature of work will be supply-driven. Under Manrega, government needed to provide work if people demanded for it. That's not the case anymore. Shireen.
All right, Santya, many thanks for joining us. The average across India, as far as the VB G bill is concerned, the minimum wage, so to speak, is about 300 rupees in rural India. Microsoft is reportedly planning to cut thousands of jobs as early as next week as the tech giant steps up efforts to rein in costs. Reports say the cuts will impact less than 2.5% of Microsoft's global workforce. The layoffs are expected to hit multiple divisions, including sales, consulting, and the Xbox gaming unit. Nestle India has reduced the grammage of its flagship Maggi noodles by 7 to 9% across multiple pack sizes. The company's kept the maximum retail prices of these packs unchanged. The move comes as the company faces higher input costs, particularly from palm oil and packaging materials. Remember, this is something that we spoke of and discussed, that as we see input cost inflation moving higher, we will probably see an impact there on grammage across FMCG companies. We told you first, it is now official. India Ratings has downgraded Jana Holdings non-convertible debentures from stable to default. Jana Small Finance Bank has said that the promoter downgrade won't have any operational impact. Ritu's here with more details. Ritu, why was Jana downgraded and what has their response been?
Well, thanks for that. India Ratings has downgraded Jana Holdings Limited, which is the holding company of Jana Small Finance Bank, to a default rating after they deferred the repayment on their non-convertible debentures. The downgrade follows the extension of the NCD maturity, which was due end of June, now to the end of December. And India Ratings classified that extension as a distressed debt exchange, which under their criteria constituted a default. Now, according to the rating agency, Jana Holdings and its parent Jana Capital both were unable to refinance their debt or monetize their stake, which they hold in Jana Small Finance Bank, before the repayment fell due, and that forced them to renegotiate the repayment timeline with their debenture holders. Now, the key question for investors now is the impact on Jana Small Finance Bank. Now, remember, Jana Holdings owns about 16.95% stake in the bank, which has fallen over a period of time from 44% earlier. But the holding company, they still need money to repay the debt, and therefore the remaining stake that they hold in the bank could come up for sale, which could create an equity overhang on Jana Small Finance Bank. But that said, the debt event is very much at the holding company level, not the bank. Jana Small Finance Bank has had no capital infusion from the holding company since 2022. They don't rely on them for funding, and there is no Jana Holding nominee on the board either. So while the rating action could weigh on investor sentiment because of the potential stake sale, the immediate financial or even operational impact on Jana Small Finance Bank itself is expected to be limited to none.
All right, Ritu, many thanks for joining us. We'll head into a break, but up next, the U.S. Supreme Court upholds the birthright citizenship in a blow to President Trump's agenda. That and more when we return. India's GST collections remain strong in June, expanding at the fastest rate in the last 13 months. Gross collections rose nearly 14% on an annual basis to 1.95 lakh crore rupees. Gross domestic revenue rose 6.5%, while revenue from imports jumped over 34%. Today also marks 9 years since GST took effect, and it has been the most significant indirect tax reform. Ashmit joins us now with the GST regime and what the last 9 years have meant. Ashmit, it's had its shares of trials and tribulations. Decode the milestones and the wrinkles and give us a sense of the path ahead.
Well, quite a few milestones when we look back at the 9-year journey. Bear in mind, this journey began in 2017 at the time when this transition took place, beginning 1st of July 2017. At the time, there were about 6.5 million taxpayers. That figure has gone up all the way to 16 million. So that is something that is seen by many as a formalization of the economy, so to speak. Going forward, the collections also have been quite steady in terms of their growth. When we look at FY26, this was over 22 lakh crore rupees, 22.27 to be specific. That's the aggregate collection for the whole of FY26. And for the first quarter of FY27 alone, we've seen collections of over 6.3 lakh crore rupees, which on a YOY basis is a growth of about 8%. So again, a significant, steady growth there. As far as the run rate is concerned, every monthly run rate, we're averaging somewhere about 2 lakh crore rupees a month. There was a historical high of about 2.36 lakh crore rupees that happened back in April of 2025. Maharashtra, again, being a large state, being a heavily industrialized state, does take the lion's share in terms of the GST contribution, makes up for about 9%. One key reform, of course, that we saw was late last year in September of 2025, to be specific, when there was rate rationalization that took place. The slabs went down to 0, 5, 18 and 40, and that was seen as a significant piece of reform for GST going forward. So when we look back at the journey, many aspects stand out. When we speak to tax practitioners, they say it helped create a national unified market. There was formalization of the economy. A lot of aspects of this GST regime when it comes to reporting, monitoring, compliance, payment, all of that was done digitally. So that was also a marked shift. Also importantly, there was a steady pace of growth of revenues. Sharing of revenue, the GST Council, this was seen as a step forward as far as cooperative federalism is concerned, and of course, the rationalization of rates. But there are, of course, a few questions that some experts raise. Bear in mind that the last GST Council meeting was in September of 2025, so it's been nearly 9 months now. The next meeting will take place later this month in July in Kolkata. Another issue, inverted duty structures. That is something that has been flagged by various tax practitioners that is affecting various sectors, not just one. So that is something that will take some resolving going forward, a wrinkle, so to speak. Also glitches, technical glitches, technology gaps. Bear in mind the GST Appellate Tribunal went online only recently. Such was the volume of cases being filed that there were glitches as such, which in fact had compelled the government to extend the deadline from June 30th to July 31st. And speaking of the GST Appellate Tribunal, there's a massive backlog. We're looking at a backlog of over 4.5 lakh cases that the Appellate Tribunal will have to deal with going forward. So clearly, many milestones, but a couple of questions also being raised.
Yes, absolutely, Ashmit. Many thanks for joining us. 9 years of the goods and services tax. Now, the U.S. Supreme Court has upheld birthright citizenship and struck down President Trump's order to limit citizenship for future children of undocumented immigrants. The top court affirmed that citizenship for anyone born on U.S. soil will be constitutionally guaranteed. 6 justices, 3 conservatives and 3 liberal, ruled against Trump. The court's 3 most conservative justices dissented. Take a look.
Immigrants are under attack. What do we do?
I just woke up to the news that the Supreme Court ruled in our favor in the birthright citizenship case, and I'm so happy. I have been writing about immigration issues and working with the ACLU for over 10 years, and I didn't think that it was going to go our way. No sitting president in American history has ever come to the Supreme Court during while court is in session, and Trump came to try, I guess, and intimidate the justices, but it didn't work.
You are born in the United States. You are a citizen, period. It doesn't get more clear than that.
If you're born here, you're an American, period, punto, no exceptions. Am I right?
Today's decision marks a striking rebuke against President Trump's executive order that purported to limit birthright citizenship. Now, every court in the United States has ruled against the president on this issue.
Supreme Court striking down President Trump's executive order denying birthright citizenship. Now, President Trump has raked in over $1 billion through his cryptocurrency ventures in his first year that he's been back in office, according to his own financial disclosures, by the way. President Trump earned more than $600 million through the sale of souvenir-like meme coins. Rachna joins us now with more. It's been a windfall for President Trump, Rachna.
Absolutely, and it's now safe to say that for President Donald Trump, crypto is no longer a side venture because it's the largest line on his balance sheet. The number is $1.426 billion in crypto income for 2025. That's according to a 927-page filing with the Office of Government Ethics. For comparison, his golf clubs, hotels, Mar-a-Lago combined brought in around $290 million. So crypto out-earned his entire legacy real estate business nearly 5-1. That $1.4 billion then breaks into three separate entities. $635 million from licensing his name to the Trump meme coin through CIC Digital, $594 million from World Liberty Financial, the venture run by his sons Don Jr. and Eric. The Trump family holds a 38% stake and collects 75% of token sale proceeds, and further $196 million from Stablecoin Holdco, a separate Trump-controlled entity. Now, the governance angle. Presidents and vice presidents are exempt from the conflict of interest laws that would bar this kind of arrangement for any other federal employee. That's written into the law itself, which means none of this is illegal in any way. But it does mean disclosure is the only real check, and critics, including Trump's own former White House special counsel, Tay Cobb, call this the most significant conflict of interest exposure in presidential history. And there's a timing twist here as well, because this disclosure has landed the same week Bitcoin logged its worst month in over 2 years, down 20% in June, with the heaviest ETF outflows since launch. So a large share of this wealth, the WLFI tokens, the meme coin holdings, still sitting in family wallets, is worth considerably less today than it was earlier. Now compare all of this to Vice President J.D. Vance. His filing runs 17 pages against Trump's 927. Vance holds up to $500,000 in Bitcoin, a passive position on Coinbase, generating no income for now. But his real money still comes from Hilly Billy Elegy royalties, his book. The White House response has stayed consistent. Spokesperson Anna Kelly says there are no conflict of interest and calls the scrutiny a recycled narrative. Be it as it may, but the filing settles one thing. For a presidency built on real estate, the real business now is crypto.
Very clearly, it's more than $1 billion income-generating business. Many thanks, Rachna, for joining us. With that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC TV 18. Stay tuned. We're back in a minute with more.
Hello and welcome to Startup Street. I'm Arundhati Ramnan, and with me as always Shruti Mishra and Ritu Singh. These are the top headlines from the startup world. Mumbai-based PE firm Ananta Capital acquires a majority stake in D2C startup Fitco. Acquisition marks Fitco's first institutional funding round. The founders will continue to lead operations as the startup aims to strengthen branding and product innovation while expanding into international markets.
Dream 11's parent firm Dream Sports shuts its wealth management platform Dream Money less than a year after launching operations with immediate effect. The Dream Money app will remain accessible until July 30, after which it will cease operations. Existing customer investments will remain unaffected.
D2C nutrition and wellness startup Supply 6 raises 48 crore rupees in a funding round led by Unilever Ventures with participation from Zero Pearl VC and actor Kriti Sanon. The startup will use the fresh capital to expand its product portfolio, enter new markets and strengthen its distribution channels.
The US Supreme Court upholds birthright citizenship in a blow to President Trump's agenda. Top court affirms citizenship for anyone born on US soil will be constitutionally guaranteed.
US President Trump raked in over $1 billion through its cryptocurrency ventures in 2025, according to his own financial disclosures, earned more than $600 million through the sale of souvenir-like meme coins.
Well, those were the headlines we've been tracking for you this evening on What's Brewing Today. In India's crowded personal care market, startups usually compete with fancy ingredients, celebrity endorsements, or endless product launches. My guest has taken a different approach, building an entire brand around an age-old ingredient most of us know, alum. In just 14 months, Fitco has grown into one of India's fastest-growing profitable D2C personal care brands, served over 6 lakh customers, and has now been acquired by Ananta Capital for a majority stake. To take us through the contours of the deal, joining me now is Sumit Marda, the co-founder and CEO of Fitco. Sumit, welcome to Startup Street. Now, this deal comes just 14 months after launch. It's also one of the fastest founder partial exits we've seen in India's startup ecosystem. Now, while the founding team continues to run the company, tell me, why was this the right time to bring in Ananta Capital, and what does this partnership change beyond just capital?
So, hey, thank you so much for having me here. And I think the way you have framed it is perfectly, you have framed it correctly. Most new age brands today, they are chasing the newest ingredients, but we went the complete opposite and chased something which is one of the humankind's oldest ingredient called alum. So yeah, that was it. Talking about the deal, I think more than capital, because as a company we were quite profitable and we were growing fast. So capital was what not we were looking forward to. But I think with this deal, what happens is Ananta coming in, we bring in a builder who understands consumer market deeply. So it's not about an external investor. They come as a builder who helps us grow and acts as a catalyst to kind of accelerate our growth into the next phase.
Okay.
And most importantly, the founders, we retain a significant stake and would continue to run the day-to-day operations. Yeah.
Okay. Sumit, sources tell me the transaction is valued at around 100 crore rupees, taking Fitco's current valuation to approximately 200 crores. Can you confirm this? And also, you've built a consumer brand around a centuries-old ingredient, alum. What convinced you there was a large enough opportunity?
So I'll disappoint you a little on that. I won't be able to disclose the exact numbers and comment specifics on it because
Okay.
it's a kind of an undisclosed deal. But I think the most important question which you asked was around the why we have built something and the thesis behind it. So it started from a very simple thought that safety and efficacy should not be trade-off. It can go hand in hand. And for the longest of the times in this deodorant market, we have seen products which have been kind of fooling us, telling that odor can be managed if you have a lot of fragrances, artificial toxic chemicals to kind of mask it. But no one was talking about eliminating it. And that is how the overall basis and thesis around Fitco came, and we came into existence.
All right. So, like you mentioned earlier, Fitco was 100% bootstrapped and profitable before this became your first institutional funding. You've built the business with a go deep, not wide philosophy, resisting sort of the temptation to launch dozens of SKUs. So, in an industry where brands often chase every trending category, how do you decide when it's finally time to expand into adjacent products? And also tell us what new offerings are in the pipeline.
So I think what becomes very important when you're building a brand is discipline, and which is very hard because it's very seductive to kind of chase the buzzwords, the keywords, the newest ingredients. But we build on a very simple, our working model was on a very simple thing. We go deep and sharp into a category and disrupt it and kind of redefine the category. And the only a right to enter into category for us is if we don't have a product which is exceptionally well. So that was the overall thesis. We won't dabble around 10 categories, but go and kill one particular category is what the way we have been operating. And yeah, we have been working on multiple categories, and we would also enter into those categories when we think that we have that right to win. And you would see some new launches coming in the new months.
And what are those categories that you're thinking about?
I mean, different categories, but I think let that come but again, that would be bigger than what today we are doing, and exceptional products with extreme efficacy, 100% safe ingredient, and no compromise.
All right. So the company is also targeting 4 to 5x growth, Sumit, over the next 2 years, and an ARR of 300 crores. What's going to drive that growth? Will it be deeper quick commerce penetration, offline retail, international markets, or just expanding the product portfolio like you mentioned? Tell us, what is the roadmap for Fitco?
So the way we look at it, it's not going to be one lever kind of thing. It's going to be major 3 pillars the way I look at it. One would be going deeper and expanding into our distribution channel in India. Right now, 90% of our business comes from our own website. In the coming couple of years, we would go aggressive on marketplaces and quick commerce, make the product more accessible. Second is, as I said, entering into new categories where we will be disrupting those categories in and out. And third is international expansion, which is on the cards right now. We would get into US, Europe, and Middle East markets.
Okay. You've already, Sumit, crossed 6 lakh customers through D2C marketplaces and quick commerce. Tell us, what is your current revenue mix?
90%, as I said, it's around from the own D2C market. We serve more than 20,000 pin codes. I think around India, we have 30,000 pin codes. We have already reached 20,000 pin codes in last 14 months. And yeah, main majority, it's built on one single SKU, which is Allen Crystal Deodorant. We have started with this, but built on this foundation, we would expand ourselves.
All right, so you're looking at both domestic and international expansion. Sumit, one final question. India's beauty and personal care market is a crowded space with global brands, legacy FMCG players and D2C startups all fighting for consumer attention. Let's say 5 years from now, do you want Fitco to be known as India's leading natural odor protection brand, or do you see it evolving into a much broader science-led personal care company?
The way I look at it, it's not either or. We are going to have both, because odor management and odor space is what we have entered into and started our complete brand. So we are going to own that completely and establish that leadership and not let that go. But of course, coming 5 years down the line, when you're asking, I see this becoming more of a personal hygiene platform with a clear opportunity of going global out of India.
All right. On that note, it's time for me to wrap up our conversation. Sumit, many thanks for joining us on Startup Street today. And of course, wish you the very best for all your growth plans ahead.
Thank you so much. Thank you so much.
And on the hot seat today, artificial intelligence has moved beyond pilots and proof of concepts. Today, enterprises are looking for AI that can automate complex workflows, improve productivity, and deliver measurable business outcomes. That's creating a new wave of startups building full-stack AI platforms for large businesses. Bangalore-based Capture CX is one such company, fresh off a $10 million funding round led by Bajaj Finserv Ventures, its first investment in the AI space. The company has grown revenues fourfold since its last raise, turned profitable, and is now setting its sights on global expansion. Joining us now to discuss this further, Sheshgiri Kamath, the co-founder and CEO of Capture CX. Sheshgiri, thank you so much for joining us on Startup Street. You know, Capture started as a customer experience platform, right? But today you're positioning yourself as a full-stack agentic AI play. What triggered this shift, and why do you believe enterprises are now ready to move beyond, traditional SaaS?
Thanks for having me over. It's a pleasure. So I think the last time when we spoke during our Series A round, right? So at that time, clearly the problem that we were going deep into within CX was to solve for enterprise. And within enterprise, the more we got into it, we realized that the problems were more and more complex, and the options that enterprises had, had a lot of limitations. So today, when we look at AI, we realize that within that, while we are solving problems across the enterprise, but within these large regulated enterprises, which are highly compliant and, security heavy, for them, it's very important to know that here is a platform that can solve for scale, solve for complexity, and solve in the kind of guardrails that their entire organization is allowing them for. So that's been our approach, and that's how from CX we have gotten wider, but CX still continues to be a big part of our footprint today.
Absolutely. So CX continues to be a big part of your footprint. Now you've raised this $10 million and the funding will largely go towards R&D and product development, right? So what new agentic AI capabilities or products can customers expect over the next 12 to 18 months? And which industries are you sort of building for next?
So banking and financial services are, of course, at the core of what we do. Over the last 12 months, the kind of traction that we have seen with large banks, NBFCs, and in India, Middle East, North America, we're quite, fascinated by the fact that there's just so much more to be done in this space. So within them, if you look at the new products or anything that we are doing, right, within agentic, how do you today process a loan? How do you process an insurance claim? How do you help, resolve a customer in the fastest and best possible way? How do you do all of this together orchestrated, not just voice being one mode, then, chat, or then, using OCR to process various different aspects of it and getting the customer what they want in the best possible way. Retail is, of course, another big part of what we do. We have a big play in the travel segment as well. So, these are some of the areas that we continue to double down.
All right, so these are the areas you're doubling down on. You've sort of grown revenues 4x since your Series A while also turning profitable, something that, very few AI companies have managed so far, right? So what's driving this growth and how sustainable is your path to profitability as you target another 5x expansion?
So the thesis for us has always been the fact that we say no to more things than we say yes to. So we have stayed away from a lot of distractions. Like, for example, we're extremely verticalized. So outside of banking, financial services, retail, travel, and maybe a little bit of healthcare there, we don't really do much in many other areas. So that's helped us to make sure that we focus on areas where the revenue is. The entire company is moving towards larger and larger enterprises. Our ticket sizes have quadrupled over the last year or so, which means that the gross margins are healthier. We're able to focus more energy on larger pockets and concentration of revenue. So that's been the overall approach for us. So while the growth has been something that even we didn't expect, especially in the last 12 months, we have a very clear path to get to where we want to be. Like we want to get to a 50 million ARR number within the next 12 months.
So you say no to more things and yes to fewer things, and that's how you're achieving this. You now serve more than 1,000 enterprises across 18 countries, including, Bajaj Finance, the Tata Group, and Reliance Group of companies, right? What's driving customer demand today? And are clients expanding their AI spends, or are you sort of winning new enterprise logos?
So that's a great question, right? So today, AI is obviously the buzzword. Everybody's talking about it. While you and I are very much sold on the fact that this can add value and there's a great deal of things that can be done, but large enterprises are yet to see the real benefit on the ground in terms of how AI can help impact, whether the impact, and it's not just about cost. The first thing that comes to people's mind is AI can help us reduce cost. Not just that, it can process things faster. It can, do things more accurately, make things more efficient. It can speak 100 languages. It can do so many more things. And because today we are, let's just take the voice example. We today process over 30 million calls in a month. We today have deployed over 2 million agents in the back office, whether it's towards processing claims to, doing various other things, which would have taken, gazillion man hours for people to be able to do that. So between all of this, our biggest differentiator over the last 12 months is we have the largest live use cases in AI in every aspect, whether it's customer experience or any other aspect of the enterprises. The names that you also just mentioned, these are very large companies with a lot of complexity. They expect everything to be done in a certain secure environment where everything is managed through infosec and all of that stuff. Running AI with such a guardrailed setup, that's the real challenge.
Absolutely. And you're looking at aggressive global expansion, right? We're running out of time. So in 20 seconds, which regions are your biggest priority and where do you see the most of your revenue coming from?
So the response over the last, 8, 9, 12 months from the North America market and the Middle East has been incredible. We have just recently set up an office in Dubai as well. US continues to grow. So these are two pockets of growth that we are really, really excited about.
All right. So those are the pockets you're very excited about. All right, Sheshagiri, thank you so much for taking time out and being here with us on Startup Street.
Thanks for your time. Thanks for having me over.
All right, moving on. From vacuum cleaners and air purifiers to AI-powered robots, Dyson has built its brand on engineering innovation. Now, as AI reshapes consumer technology and companies grapple with global economic headwinds, the British technology company says it's investing even more in the future. Meghna Sen reports from Dyson's global headquarters in Singapore. Take a look.
Dyson is known for its innovation-led technology and consumers still love it in the premium segment. Here at the company's global headquarters in Singapore, Dyson has opened its doors to journalists, offering a behind-the-scenes look at its research labs, testing facilities and engineering centers where thousands of engineers are working towards the next generation of consumer technology. CNBC TV 18 is here in Singapore to find out what powers that strategy.
Founded in 1991 by Sir James Dyson, the company has earned a reputation for engineering-led innovation. From cyclonic vacuum cleaners to air purifiers, hair dryers and robot cleaners, Dyson's products can be found on shelves across the world. In 2025, its operating profits rose to £600 million from £520 million in 2024, and EBITDA rose to £1.1 billion. But a £440 million hit from US President Donald Trump's tariffs and weak consumer confidence in the US, Germany and China pushed revenues down from £6.57 billion to £6.13 billion. Sales in Britain, however, grew. Dyson's success is not just about the engineering, it's about thought that goes into the design, which is fixated on the customer and the experience when interacting with the products. Even product colors are not random.
So we tend to use red as an interaction color for machines. It really helps guide the user. Hey, what are you going to be touching, pushing, pulling, turning on? I think it's a good example is the V16 I have right here. We can see the red lever where I'm compacting the dust. We can see the red power on the back where I turn the machine on.
Everything tells a story, whether it's a personal story.
Our founder, James Dyson, always plays a really active role in all product development. Right. And so does Jake, our chief engineer. But particularly with the colors, you'll see a real theme of purple through many of our designs. And that's because it's James and James's wife's favorite color.
Or a historical one. This headquarter in Singapore, for instance, used to be St. James Power Station. It's nearly 100 years old and once supplied electricity to Singapore. Dyson leased it in 2019 when the company moved its global base from England. It's a national monument and it came with conditions. One was that any addition made to the building had to be completely reversible. So Dyson built a building within a building, an entirely new structural system put together without altering the original 110,000 square foot space. And within these walls, Dyson is researching what the Indian consumer actually wants.
But also at the same time, when we look at our global air quality study, we find that in terms of PM 2.5, which is a pollutant, a particle, India records the highest average indoor, should we say, rate for that specific metric. So how does that link to our products? Well, we find more than ever, our wet and dry cleaners, as well as our purifier technology, are incredibly popular for those reasons in India.
The modern Indian consumer, like many others across the world, is also latching on to artificial intelligence, demanding AI applications in the products they choose. Dyson says, no problem.
AI has been embedded in our products for a long, long time now, specifically robotics, the way they navigate, perceive the home environment, where they predict the best way to tackle and clean users' homes.
But Dyson has also brought AI into almost every process and stage of product development. This helps it not just build new products, but upgrade existing ones.
I think what's particularly interesting, perhaps a lens that we're passionate about as designers, is also what we can do for products in the market already, from a customer service lens. I think with the advent of our connected products, this connected data and AI, we can now actually be incredibly proactive and predictive when it comes to how can we help users service and maintain their machines, really get the most out of machines.
Products that last a lifetime. It's not just a marketing line at Dyson, it's also why every Dyson product goes through a rigorous, one-of-a-kind testing process the company has developed entirely in-house over 13 years. Dyson deployed £400 million into R&D in 2025 and has plans to ramp this up in the coming years. For a company navigating tariff headwinds, shifting consumer confidence, and intensifying global competition, Dyson's betting on its engineering and innovation pedigree to do more than keep the lights on. And there is no thought of slowing down.
And with that, it's time for us to head into a short break. Coming up next, AI native marketing platform Just AI has raised $17 million in a Series A funding round. We put the company's founder on the hot seat to discuss the growth roadmap. Stay tuned.
Well, Just AI, which is an AI native marketing platform helping companies automate personalization, experimentation, and decisioning at scale, has raised more than $17 million in its Series A funding round. The round was led by Base 10 with participation from Y Combinator and Peak 15 partners. Now, the company claims it has already supported more than 600 marketing decisions delegated to AI every month and helped generate more than $100 million in revenue for its customers last year. So let's bring in its founder and CEO, Neha Mittal, for more on this. Neha, thanks very much for your time here on CNBC TV 18. You know, everyone is talking about AI agents replacing knowledge work. To your mind, which marketing functions do you think will be fully autonomous in the next 3 to 5 years, and which ones will still require humans?
Yeah, absolutely. So just to give you a quick overview of the company, we are looking at AI to resolve marketing for retention and engagement. And so the simplest way to think about it is when, let's say, you acquire a user, you will now want to retain them, engage them, educate them on your product. In doing that, there are parts that are still manual in terms of the operational workload. So, for example, maintaining hundreds of campaigns or rules for every single user. That's the part that we think will be automated with AI. There is a lot of business context and judgment calls that users have to make or marketers have to make. Those are things that we think are here to stay.
Well, many companies are adding these AI layers to their existing software. So what makes Just AI fundamentally different from, say, traditional marketing tech platforms, which are claiming to be agentic now?
Yeah, great question. So most of the existing marketing platforms that were built, let's say, 5 to 10 years ago, they were built on deterministic rules. Like, here are 15 rules to apply for a user, and hence we'll do your marketing. And the best they can do today is to slap AI on top of it. What we're doing is we're rebuilding the entire infrastructure from scratch and saying, hey, now marketers will use AI, whether it's GPT or Claude and whatnot, to do their marketing. But once they have their initial understanding, they now need an infrastructure layer to execute that at scale. So that's why we're basically redoing the entire stack, which is AI first instead of sort of like manual rules that they're used to.
And what's the plan with this fundraise? How are you going to deploy the $17 million check that you've got, Neha?
Yeah, there's two big areas. The first one is market expansion. So this is where Right now we're in the US. Most of our customers are here. Our team is here. We had a lot of demand in Asia and India, so we want to be looking at expanding into these markets. The second piece is, of course, building out the infrastructure that I was talking about. Traditionally, our incumbents have taken anywhere from 8 to 10 years to build those out. We, as you can tell in the AI world, don't have that much of a time window. So we're trying to do what was done the last 10 years in about a year. And so a lot of that funding will be deployed in hiring and getting the team set up for it.
Take that point. You say customers have delegated 600 plus marketing decisions a month to AI. You've helped generate more than $100 million in revenue for your clients last year. But how much of that uplift would you say can be directly attributed to AI decisioning versus just better execution?
Great question. So typically we see a lift of 20 to 30% on the revenue marketing is able to produce for a company. So typically marketing contributes about 30% to a company's top line growth, and we're able to move another 20 to 30% on top of it. The second piece that you alluded to was efficiency gains versus actual additional revenue growth. Which kind of aligns, which is very close to what our vision is, where we want to be able to move, we want to make marketing a function that can move revenue. And so the 100 million that we talk about cumulatively is actually additional revenue that marketing teams are able to produce. However, to make that effective, what's really important is that marketers can do that with a lean team and in a short amount of time. So something that we focus a lot on is how do their workflows get more and more efficient, where they can ideally shrink a 20-people team into a 3-people team to get the same work done.
Neha, large incumbents like Salesforce, Adobe, HubSpot, they're all rapidly embedding AI agents. So how do startups like Just AI compete when these giants already own customer data and workflows?
Yeah, also a great question. So data as a moat, we don't think exists anymore. Thanks to MCPs, thanks to very easily being able to connect data points across different tools. And we have classic examples of companies that do not have that worry, where they're able to share data with us very easily across different tools. So then the next question is, wouldn't these companies build out these stacks? Goes back to they would have to tear down their entire stack today and rebuild from ground up to be able to achieve that. And that's where we've sort of level set where, everybody's building from scratch. And in fact, startups have the advantage of no tech debt. We can start to build in the AI era with tools that are available to us now than what was available 10 years ago.
All right, Neha, thank you so much for your time here on Startup Street. It was a pleasure having you. Thanks very much.
Thank you, Ritu.